For that, I'm looking at Adani, Wilmar as well as DMart. Both of them came up with their quarterly updates as well. For DMart, let's start with that. No real fireworks, but nothing really to worry about as well. Standalone revenue growth at around 16.6%. The total stores at 415. What's good about these numbers is that the company has added 35 stores. So the people who are, asking for DMart to increase the pace of their store addition, that's happened. Typically, fourth quarter is where they add more stores, but 35 is higher than the average that we've seen in the last few four-quarter additions as well. But what's not is that the implied same-store sales growth, if you look at the stores last quarter, as in the last year and now, it's close to around 3% which is lower than what we've seen earlier. So the key to track now will be what the product mix is, how the margins for DMart stand out in light of the competition that we've seen from quick commerce. And more importantly, we have a new CEO. Anshul Asawa takes over from Neville Narona. So those will be a couple of factors we'll be watching out for. Mild green on DMart is what we're seeing. On Adani Wilmar, they are in the right time for the palm oil cycle, and that's working for them. 7% volume growth, 36% revenue growth, edible oil volume growth at 6%, revenue growth at 44%, food and FMCG segment growing at 11% as well. All boxes checked. And more importantly, after Adani has decided to sell their stake to Wilmar, they've decided to change the name of the company from Adani Wilmar to AWL Agribusiness Limited as well. So we'll keep an eye out on that. For now, good update coming in. See green on AWL.
Okay, so that's one positive number from the FMCG space coming through. Back to Abhishek. He's watching out for a couple of other names, Bandhan Bank and I think even RBL. Abhishek?
Deposit momentum has been pretty strong for Bandhan Bank. It's grown at 11.8% YOY, but 7.24% on a sequential basis, which is perhaps the second best deposit growth that you are seeing amongst lenders on a sequential basis. CASA is up 6% quarter-on-quarter. CASA ratio largely stable, you would call it 31.4% versus 31.7% in the previous quarter. Calculation shows that the net interest margin may get impacted because CD ratio has declined to 91.2% versus 93.6%, but no taking away from the fact that deposit growth is pretty strong over here. RBL Bank, the business growth is one of the weakest that you are seeing in last 10 to 11 quarters. However, CASA ratio has improved for them. So deposits are up 7.2% YOY and about 3.9% quarter-on-quarter, one of the lowest deposit growth on a year-on-year basis that you are seeing in last 10 quarters. CASA ratio has improved for them. We are seeing this with certain lenders that CASA ratio is improving, which is a key trend to watch out in the banking sector. 34.15% this quarter. Gross advances, they are at a growth rate of 11 quarter low, coming in at 10.9% YOY and about 2.5% sequentially, which means that the stock could be under pressure. Back to you.
All right, Abhishek, thank you very much for that. Mazgaon dock, we were talking about that earlier. Let's sort of get you the news flow here. Upasana's got that. Upasana, morning.
Good morning. Well, the stock remains in focus today as government to sell up to 5% stake in the company via OFS. Now, government currently holds 85% stake in the company and OFS includes base size of 2.8% and green shoe option of up to 2%. Now, OFS for non-retail investors will open on 4th of April, that is today. And for retail investors on 7th of April is what the company has indicated. The floor price, however, for the offer is set at 2,525 per share, which is at an 8% discount from yesterday's closing. And the total size comes up to 4,900 crore. So we'll be watching out for this OFS.
Okay, all right. Got that, Upasana. Thank you for that. With that, I think we can quickly recap our list of stocks. No, actually, we have one more before we get to the recap. Vamakshi is watching out for Angel One. Vamakshi, good morning.
Well, good morning, Surbi. Angel One has come out with a mixed update for the month of March. When we look at the gross client addition, it stood at 4.7 lakh. This is a downtick of almost 4% month on month. And this is bad because this is the third straight month where the gross client acquisition has slowed down. The client base, though, is steady at 3.1 crores, an uptick of almost 1.4% month on month. When we look at the average daily orders, they saw an uptick of almost 8%. This is after they saw a downtick of nearly 9% in the month of Feb. So that bodes well for the company. Apart from that, another positive is the average daily turnover, which stood at 36.38 lakh crores. This is an uptick of almost 23% on a month-on-month basis, and in fact, it has jumped to the highest level seen since November 2024. Keep in mind, the market share, though, has taken a hit. Equity market share is down nearly 60 basis points to 19.1%. F&O market share is also seeing a dip of almost 60 basis points to 21.5%. But the commodity market share has managed to recover after taking a hard knock in the month of Feb. Commodity market share now stands at 57.9%. So overall, a mixed update for Angel One. But in my opinion, the negatives outweigh the positives. So going with the red for this counter.
All right, the negatives outweigh the positives, but commodity is doing extremely well. Let's talk about the commodity itself. Overnight, a big decline on crude prices. How does that impact listed companies? We have Manisha joining in. Manisha, a big slide yet again.
Oh, well, absolutely. As the tariffs were announced, the crude oil prices were already trading 4% down, and markets were still digesting those tariffs. But the combination of an increased oil production and weak global economic outlook has put a very strong downward pressure on the oil prices. So if you look at the kind of decline that we saw yesterday, a 6% of a fall, well, this is the biggest percentage drop since August 2022. And for WTI, the biggest drop also since 2022. What the markets were also reacting to is the OPEC and allies meeting, which says that they are boosting output by 411,000 barrels. Now, this is versus the estimate of 140. So 400 versus 140 is the kind of number that the markets panicked under. And then the OPEC will also now meet on 5th of May to decide on what they want to do for the month of June. At this point in time, you are looking at higher supplies from OPEC. The U.S. inventories have surged much more than the street was anticipating. And then you have higher tariffs, lower economic growth, lower demand growth and expectations as well. And all of that has continued to weigh onto the crude oil prices. There are no buy calls as I was searching for them. It still is further decline that the street is anticipating and further sell calls coming in for crude at these levels as well.
Okay, all right, Manisha, got that. Let's quickly recap our list of stocks to watch. Then the ones that have positive news flow around them are HDFC Bank, Avenue Supermarts, Adani Wilmar and Bandhan Bank. Stocks with negative news flow include Bajaj Finance, L&T Finance, RBL Bank, Mazgaon Dock, Angel One, and of course there's a neutral call on ONGCs going out. Take a quick break, but up next we'll have Siddharth Khemka of Motilal Oswal Financial Services joining in to get some fundamental ideas going for Friday trade.
But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So
Welcome back. You're watching us here on Bazaar Morning Call. This morning we're looking at a 110-point downtick at the open itself. Now it's accelerated a little bit to 122. Nothing really to worry about if you compare it with the rout that we saw on Wall Street overnight and the decline that we've seen generally from our peak itself. Siddharth Khemka of Motilal Oswal Financial Services joins us now. Siddharth, good morning. The banking pack has been relatively resilient, had led the outperformance yesterday as well. And we have an update coming in from HDFC Bank. What do you make of the fourth quarter update, and do you believe that the better days are ahead for that index heavyweight?
Good morning. Glad to be on the show. So I think overall banking is kind of insulated from this global volatility. That is also helping. Plus, we have the domestic liquidity measures taken by RBI, the interest rate cut cycle beginning. That is also kind of supportive to the entire banking as well as the financial services sector. To their credit, I think some of the bank business updates have come out to be very strong compared to what we were expecting, and that is also kind of helping in this environment. On its own, I think HDFC Bank, good steady numbers, and I would specifically point out to the deposits growth at 14% last few quarters. That was one area where a lot of concerns were there in terms of whether after the merger with the large balance sheet size, they will be able to get those kind of deposits, and CD ratio, how they had gone up. And with the 14% deposits growth, I think CD ratio has also declined almost 177 basis points on a sequential basis. Advances pretty steady and stable at 5.4% growth. So I think overall strong business growth. CASA ratio improved for HDFC Bank, and with the stock price remaining in a consolidative mode, I think valuations also looks good. So pretty positive on HDFC Bank from here on.
Pretty positive from HDFC Bank from here on. IT, Siddharth, the index sold off like there were special tariffs on it yesterday. The index ended 4% lower, but understandable, right? I mean, if the worry is US big time, and look at how the US market traded last night, almost as if anticipating like a sharp slowdown, even the R word. What is your sense from here? It was, by the way, not just Infi and TCS and HCL Tech, even Coforge was down 9%, Persistent was down 8-9%, Index was down 4%.
So yeah, I think Prashant, while there's no first order impact on the IT space because the services have not been included in the reciprocal tariffs, I think there's a big second order impact on the tech companies, the discretionary spends, which were expected to pick up this year. And we all were hoping that in the month of Jan that this year could see an exports recovery as a key theme. Somehow that's not playing out, and there's a lot of, you can say, unclarity or no clear visibility in terms of growth from some of these key regions. What will also happen is that not only US, but some of the other regions, the developed regions, Europe, some of the other economies where Indian IT services have a big business, economic slowdown could be a big challenge, and that could lead to cuts in discretionary spending and hurt the Indian IT companies. And I think valuation for, especially for some of the mid-cap companies, the growth had been pretty strong, and hence valuations were on the higher side. Something like a Persistent, Coforge, which used to be our top pick. I think at this juncture, it definitely remains better to stay away from IT because clarity is not there in terms of growth. And I think post Q4 numbers, we'll see a lot of companies cutting down on their FY26 guidance. That could even hurt more when that happens.
All right, so that we'll ask you to stay on and listen into the conversation that we've lined up for you and the viewers right now. We spoke about the banking space, we spoke about IT. Let's speak about CSB Bank, the first management on the show today. The company reported a fairly strong fourth quarter business update where advances, deposits, both of them showed strong sequential growth. So to discuss this and more, we do have with us Pralay Mondal, who is the MD and CEO at CSB Bank. Thanks a lot, Mr. Mondal, for joining in. You know, I'm looking at your deposit growth, and that's the number that really stands out for me. A 24% jump year on year and a 10% jump quarter on quarter as well. That's better than all the others that we've seen in the industry. So the question is, what did you do differently, and how much of this is sustainable from here on?
Good morning, Mangalam, and thank you for having me on your show. You're right that we had a good growth, not only on deposits, but on assets, fees, everything. But of course, if you have to grow the overall balance sheet, liquidity and deposits is very important, especially in the kind of quarter we were in the last quarter, which had liquidity deficit. So we wanted to ensure that we manage the liquidity risk in terms of CD ratio, LCR, everything right. So we said that deposit is a first priority. And we ensured that all our businesses, whether it is a wholesale, SME, retail, branch banking, everywhere, we are focused on deposits, and that's the result which you're seeing today. We had a growth not only on deposits of 10% quarter on quarter and 24% year on year, but also we had a quarter on quarter good growth on CASA, which was 10%, which was very, very pleasant for all of us. Having said that, I think the big picture is that all our segments, whether it is retail, SME, wholesale, and gold, at least in my tenure, for the first time, all four verticals have done consistently well across, and almost no business has grown lesser than 20%. Every business has grown higher than 20 to 23%, and that's a very, very big positive for us, which says what I was telling all through, that now most of the verticals will consistently deliver. And hence, while gold continues to do well, but on a quarter-on-quarter basis, some of the other businesses has grown faster than the gold, and hence we'll see that our mix at least on a basis point basis, gold can come down a little bit, though gold has also grown year on year at 35%.
So in that case, if you could give us a sense of what growth should we expect from an advances standpoint across all your verticals and overall as well. You said gold as a percentage will come down because other sectors are growing. So if you could give us a sense, say MSME, private loans, etc., at what rate will they grow? What rate would your overall book grow? And what is the expectation on gold as a whole?
Yeah, so Mangalam, we have always said that we have a vision SBS 2030 by which by 2030 we will have wholesale 30%, retail 30%, gold 20%, and SME 20%. We are on track because we are significantly putting our technology transformation this year. This is the last year by when our entire tech stack will be in place. We are going through a core system migration, entire surround system changing, which will help us in building not only the liability franchise, but also the entire retail assets franchise. So we have now started our retail assets journey in real earnest this year, and you will see the impact of that next year. On your specific questions on assets businesses, we have seen a significant quarter-on-quarter growth on the wholesale side. SME has also done very well. Retail, we have been a little careful on the unsecured MFI in that space, and hence some of those businesses has regrown. But overall, some of the other businesses we have focused on that has grown very well. So, and gold has grown like 8% quarter-on-quarter and 35% year-on-year. So overall, I think if we need to give a forward-looking kind of understanding, we should be able to grow upwards of 25% in assets growth, and it is quite comfortable. The big question is how do we manage the liquidity and how do we manage the deposits? Assets growth is not a problem for us.
And what does that do to your, spreads, NIMs, and credit costs? Because if your assets are growing over 25% and you are still, maintaining some sort of caution on unsecured loans, at the same time you're drumming up deposits to hold on to the liquidity that you have. What does that mean in terms of guidance, if you could give us for your NIMs, spreads, and asset quality?
Yeah. So on NIMs, what happens is when we are primarily focusing on gold loan as a primary business, NIMs, of course, were high. And this year we had, penal interest, which was withdrawn from a regulatory perspective. Our other business mixes are growing, which doesn't have that kind of a yield which a gold will have. And we have significantly slowed down on the unsecured side. Given all this perspective, obviously, we will come to more realistic level on the NIMs. And generally, the industries, I would say that the mid sectors of the large sector banks are somewhere around 4%. I think we will be trying to put ourselves somewhere between 4.4, 4.3 in that range. But I've always said that growth is what we're looking at. And once our tech transformation, which is a big year for us, this financial year is where we'll redefine the bank completely, moving into a complete modern system. And hence we can do everything what other banks can do. Once we do that, I think the overall franchise concept will start delivering. On the asset quality, I think we're doing pretty well. Even last year we are below 20 basis points on credit cost. GNP and NPA has been below 1.69%, below 60 basis points. I think, at that level, we should be able to hold on to our kind of NPA. A few basis points up and down will continue to happen, but I think we're pretty comfortable on the credit quality of the portfolio.
Right, Pralay, we'll leave it there. This year will be transformative and we wish you all the best of luck as you continue to execute that. Appreciate it, and we'll chat again soon. Thanks very much. So that is CSB Bank with perspective there on their business. Now, the new reciprocal tariffs announced by Donald Trump risks tipping the American economy into recession and pulling the global economy down with it, says Mark Zandi, chief economist at Moody's. We spoke with him yesterday. Listen in.
Well, if the reciprocal tariffs are implemented in full, I would expect some retaliation from countries abroad. I don't think they're going to sit on their hands. So the combination of those two things will result in a recession, an economic recession. It's a tax on American consumers. The bulk of the tariff increases will fall on them. Businesses that import product will have to pay more, which will hurt their profitability and thus their investment in hiring. If I'm right about the economy and the impacts, I do think the president will ultimately react to that and hopefully will pull back and declare victory and move on. And if so, we can avoid an outright recession. But time is running out. He's going to need to pivot here pretty quickly. Otherwise, I think the U.S. economy is going to go into recession and take the entire global economy with it. I mean, I don't think any country in the world is going to get through this without some significant hit to economic growth. Some countries are going to navigate through better than others. You know, India's got a lot of, it's a resilient economy. It's got a lot going for it. And I think, you know, should be able to weather the storm reasonably well.
Okay, by the way, global markets are not looking any better. Most of the Asian screens are extending their declines. Australia's down 2%, Japan's down almost 2.7%, and South Korea is still down about 1%. So the picture isn't getting too much better, at least right now. We also caught up with Neelkant Mishra of Axis Capital as well as Sameer Arora of Helios Capital to get a sense on what these tariffs could mean for global markets and, of course, for India.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets. I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6% of volatility that. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time.
The first thing in a big picture sense, although, you know, in our long only fund, we are fully invested and all that. But I would think this behavior of the market is a bit suspicious and not to be trusted because, you know, Indian market has made this simple thumb rule, not that they will analyze the stock, but whether that day there is net selling or not by FIIs. See, the thing is from an economy point of view, it's not a big deal because we don't have big scale of imports and exports. You have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you'll get FI flows. But if the US market is down, you know, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money. You may lose less. You may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US.
All right, with that, we'll take a short break. Come back on the other side. We'll get you trades up for today. The setup coming in from Mitesh Thakkar and Shrikant Chauhan for a quick technical check on the market. We'll also get in some more stock ideas.
China, first row. China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half.
Okay, welcome back. 8 minutes to go for the pre-open session. Mitesh and Shrikant are with us with what they want you to do as far as trades are concerned. Gentlemen, great to have both of you here. Mitesh, will we see what we saw yesterday? Or it's all very confusing. Generally, that's the broader sentiment. Even if one is, will we get away with a 100-point cut, you think? Or will it be even better? Or you think it's going to be a little different? 5%, 6% sell-offs last night.
So, morning, Prashant. I think, both the Nifty and the Bank Nifty did not break the levels which would have given some kind of a reversal on the downside. Yesterday, I said 23,100 for the Nifty is the key level to watch out. We got a low of around 23,145. Similarly, on the Bank Nifty, it was 50,700, 5800 zone. We got a low of around 50,900. But between the two, I think the chart of Bank Nifty looks much stronger compared to the Nifty. So I think today, we might, for the index again, for the Nifty again, we might open around 23,100 or 23,130 levels. If we don't see a follow through on the downside, then I think the Nifty might be stable and we might see a bounce back. Could be led by financials. It's the IT names which is worrying and which is actually keeping the index down. So my idea is that look for, buying ideas in the mid-cap space, cement space, as well as financial names, and avoid IT and the rest of the market.
Facing names is what you would back and more positive on the Nifty Bank than Nifty itself. We'll come back to you for immediate individual stocks. But Shrikant, would you concur with what Mitesh has to say? And what are the levels in specific that you're looking at for the Nifty and the Nifty Bank?
Good morning, Mangalam. Good morning, Prashant. Yes, the overall trend of the market is still confusing. It is not crossing the level of 23,400, but at the same time, it is sustaining above the levels of 23,150, which is something like keeping the market volatile. But in case if we see today, the market is dropping to the levels of 23,000, there we should look for taking long trades in the market. Because there I am seeing good amount of buying support, and from there again, we could see a rebound in the market. And we are doing, or we can say our markets are relatively doing much better than the other markets. So close to 23,000 levels, certainly we should look for taking some bets on indices. But otherwise, it is better to be more and more stock specific, as Mitesh said.
Okay, take your point, gentlemen. So let's talk stocks then, because the index, so we need to see what the index eventually does. What about stocks? Morning to both of you, of course. Mitesh, what's your list like?
Yeah. Good morning, Subi. On the stock side, I have more of buy calls, but they are conditional because I think the trade will be slightly choppy. So I would want to buy ACC on a mild decline, say around 1985, 1980 if you get it. Keep a stop below 1960, look for targets of 2050. CAM, similarly, I would want to buy on a breakout. So 38.45, 38.50 is the pivot level. The stock, I think, closed around 38.30 odd level. So once it starts getting past 38.50, in case after the gap down it recovers well, buy here with a stop at 3800 for targets of 3960. HFCL is a buy with a stop at 81.7 for targets of 86.5. And even if you open a 50-60 point kind of gap down on Coforge, I would want to take a short with a stop about 7200 for a target of 6900.
Right. Shrikant, your stock picks?
Yeah, I think all these small size banks, they are doing well on the back of announcement on the business updates. So there we could see further more activity. And in that, we like Union Bank, which is around 130, 132 levels. If we see the overall long-term pattern of the stock, then it is showing a lot of strength. And broadly, I am of the view that the stock is heading for the levels of 150, 160 again, which was its previous all-time highest level. But yes, in the near term, we could see the levels of 140. We can keep stop loss at 126 for creating any long positions on Union Bank. And as IT stocks are finding difficulties to sustain at higher levels, in fact, most of the IT stocks have broken their important support levels yesterday. And in that, TCS has also broken its crucial support level, which was around 3,400. And based on its technical formation, now the next level to watch out for would be 3,100. So at this level, it looks weak, and there we should look for creating short positions with a stop loss at 34.75 for the target of 31.50.
Okay, got it. Thank you very much for the stock ideas. We do have to take a quick break on that note. We'll come back on the other side. We'll have the pre-opening rates, and also we will be in conversation with Digant Haria of GreenEdge Wealth. We'll put the spotlight on a lot of these Q4 BFSI updates that have been pouring in and how he's approaching the sector.
Countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered.
Welcome back. So we'll have the pre-opening rates in the next couple of minutes. Let's go back to Siddharth Khemka for a couple of questions. Siddharth, capital market stocks in focus once again. Our colleague Vamakshi was telling us that Angel One's update, again, just the number of client additions, it's all slowed down. What's your sense? And now the market's a bit wobbly. What would you do with a stock like, say, Angel One or even BSE? BSE has gone through a huge amount of volatility on this whole weekly expiry issue.
I think should be yes. Capital markets are closely linked to the stock market direction, and with markets being that wobbly, I think the pace of new client addition that has definitely slowed down. The cash market transactions, the ADTOs that have also come down on a sequential basis. I think with the market being consolidated, these sectors will remain in a consolidation mode. From the space, I think there are two segments which looks really attractive. As you rightly asked, BSE with the regulators giving out that they would unable to move their expiries to Mondays. That was a big overhang for BSE, which has its expiry on Tuesday. And I think with the exchange giving clearly out that there can be only 2 days which would be earmarked for weekly expiries, Tuesdays and Thursdays. That definitely leaves some room for BSE to gain market share. And the other segment being the mutual fund industry, despite all this volatility in the last few quarters, we have just seen marginally dip in the number of monthly SIP data. I think that is another space which so far looks resilient. So the overall view is that the sector could remain in a consolidation mode given the market volatility. And B, within that space, we like A, BSE, and B, from the mutual fund space, we like HDFC, AMC, which has been consistently delivering in terms of profitability growth. And we also like TAMS.
All right. And what about Mazagon Dock? The government is selling some stake. There is an OFS. It's likely to open lower because of the supply. But on Mazagon Dock and a lot of these defense plays, do you believe that the correction is an entry opportunity? Because orders we've seen over the last month or so pick up.
Definitely, Mangalam. I think we are structurally positive on the overall defense space. And last month of the financial year, we saw hordes of the bulk of ordering activity because the government had to reach and achieve the full year order target. So that definitely gives a lot of visibility in terms of the order book and revenue visibility for the defense players. Within the defense space, what we like the market leaders with the separate sub-segments. So within the electronics space, Bharat Electronics would be our preferred pick. We see a steady 25-30% earnings growth, valuation being very comfortable. With the aviation, we like HAL, which is again a market leader. And in the shipyards or the naval defense companies, I think Mazagon Dock has a very strong order book visibility. Valuations definitely look attractive. And we believe that in the current geopolitical environment, India stands out clearly, not only from a domestic demand, but from a global exports perspective as well, with Europe slated to increase their defense spending. A lot of the Indian defense players will benefit from the increased demand. And I think any decline would be an opportunity to buy into some of these large defense names.
Okay. All right, Siddharth, we'll leave it on that note for this morning. Thank you so much for joining in. You have a good trading session ahead. By the way, it's quiet and flat, which is very good. Even if the market decides to just do nothing and stay quiet, yesterday was a day like that. Today, also, if we can just, get by with a couple of points here and there, it'll be a great thing. 4 or 5 points down on the Nifty. That's it at a time when Asian markets are sliding between 2-2.5%. So that's serious resilience. Let's see. When people like Samir were also saying, Samir Arora was yesterday telling us that there's no need to immediately go in and do something in the market. Maybe just sit out for the next couple of sessions till this settles.
Just a word on the rupee. The market may be flat, but the rupee is anything but that. It's above 85 against the dollar for the first time since December 2024. This after a time that we had seen a big rout, almost 88 on the rupee versus the dollar. And the dollar index is now down about to 101, obviously led by the strength in euro and yen. Strength in the rupee in light of that should be good, at least stem the outflow that we're seeing from the FIs in the cash market, etc. Not necessarily fundamentally good for exporters, but from a market standpoint, it is a positive. Rupee strengthening, it's just below 85.
This is absolutely staggering what's happened in the currency markets, right? This was all about making America great again. But what's happened actually is the dollar has crashed since these tariffs were announced and they were rolled out.
They want dollar down.
Exactly.
They've been saying that, well, we've paid the price for the US, US dollar being the reserve currency.
So we'll punish all the currency manipulators
because
now.
The deficits and all of that. I mean, the dollar essentially has been too strong. So they want to push it lower. They want other currencies higher. So it's and actually in a different kind of a way it's playing out now. The broader dollar 102 now.
Yeah. Okay, so that's the global picture. The Nifty is flashing some green as well, by the way, 3-4 points on the upside. Like I'm saying, if it continues like this, it will be fairly good. Let's put the spotlight on the banking space now. A lot of those banking updates have been coming in. So let's quickly run through them. A couple of broker notes as well on what we've heard from the banks at the end of fourth quarter. Abhishek.
Well, to begin with, HDFC Bank has reported its, provisional numbers with respect to business update. Sequentially, the deposit growth of nearly 5.9% is one of the best that you are seeing in last 4 quarters. And advances growth of nearly 4% quarter-on-quarter is one of the best that you are seeing in last 5 quarters. What's also heartening to see in their business numbers is that the CASA ratio has jumped up sequentially to 34.8% versus 34% in the previous quarter. Bajaj Finance, the AUM growth is really on the weaker side. One of the weakest growth that you are seeing in YOY in last 8 quarters, and sequentially, that is quarter-on-quarter, the loan growth rate is one of the lowest that you are seeing in last 11 quarters. So AUM growth is about 26% YOY and about 4.7% sequentially. What's also disheartening to see is that their cross-sell rate has fallen to 5.9% versus 7.2% in the previous quarter. So this cross-sell rate of 5.9% is one of the lowest in last 4 quarters and second lowest in last 15 quarters. Now we have UBS, which has written on various banks. They have upgraded SBI to neutral. Target price has been raised to 840 per share. They said that the risk reward is balanced and sustaining the net interest margin will be the key for re-rating. So they have increased their EPS estimate anywhere between 3% to 5% over the next 2 fiscals. They expect that improved liquidity condition along with income tax rebate and 8th pay commission recommendations to boost deposit growth in the system. They have also written on Bank of Baroda. They have upgraded it to buy. Target price has been raised to 290 per share. They say that the upgrade is on stable outlook and attractive valuation. So they expect the net interest margin to witness relatively lower pressure versus peers for Bank of Baroda. And valuations are undemanding. The stock is trading at just 0.8 price to book value September 26, which is near its 5-year average. Back to you.
All right, Abhishek, thanks a lot for that. With that, we'll bring in Digant Haria, who's the founder at GreenHedge Wealth, to discuss the financial services updates that have come by. Digant, good morning. There have been a bunch of numbers, updates that have come in from this space itself. What, according to you, was the 1 or 2 things that stood out, and what is it that fell short of your expectations?
Morning, Mangalam. Good to be here. See, I think there's not much to read in the results for this quarter because see, what has been plaguing the sector for last 1 year, it has been very, very tight deposit or liquidity, so to say. And the RBI regulations were also on the tightening side. Now, somewhere in January, February, we have seen a reversal of both of these things, which is, the RBI has eased its stance in terms of regulations, and RBI is focusing on liquidity and the global events which are happening. The dollar strength is weakening, the GSEC yields are down, the US 10-year yields are down. So all this is good for liquidity. So I think the results that you are seeing, okay, be it a Bandhan Bank or be it an RBL or be it, this Bajaj Finance, all these are indicative of a tight liquidity environment where there will be pressure on your deposit rates, cost of funds and minims. Not much to read there. I would say, from June quarter, you would start actually seeing some improvements in the numbers, both in terms of deposits and margins. So I think this is a quarter, Mangalam, where we just have to pass our time. Market has already rewarded some stocks. I think some other stocks will be rewarded in the coming 2 quarters. So, in financial sector, we'll see a good rotation happen, So, yeah, that's my opening comments, Mangalam.
Digant, morning. But when you look at, do you think banking and the general consensus opinion has been that for a long time, actually, that this is a safe place and valuations are more reasonable, etc., etc. Although along the way, we've had so many accidents as well. So I've got to navigate carefully here. But what is your perspective? I mean, as a banking analyst and you're also in a way a macro watcher as well. Will it really play out? Banks as a good investment opportunity in an absolute sense from here, Digant?
Morning, Prashant. So I think, some of it has already played out. After 2 years of underperformance, it became a safe haven. And then you saw some rally in ICICI Bank, Kotak Bank, especially at a time when markets were not at all doing well. They, in fact, corrected 10-15%. So I think some of that outperformance is already there in the price. If I look at the larger ones, which is Kotak, ICICI, a Bajaj Finance or a Chola Finance, the best of the names, it's already there. I think we will see a rotation. In the next leg, you may actually see Axis, HDFC, the Bank of Baroda's, SBI's, the PSU banks, which will take charge. But all said and done, I don't think there's more than 10-15% kind of a macro rally there in the sector. Because, the villain of this sector, so to say, is the PSU banks. PSU banks are so healthy, alive and kicking that they will not let the private sector grow beyond that 12-13% or have margins which were very high in the past. So I think this sector is, going to be a low growth, low return kind of a sector. In current markets, it's attractive because everything else, the outlook is hazy. But yeah, I don't think big money is to be made. This is a safe haven, 10-15%, and that should be it.
So, Digant, just to take that point forward, and then there is the other big debate that's been raging, right? Whether fundamentally and structurally, the whole model of banks and how they make profits, whether that's coming under question because of the whole deposit issue, right? We had Uday Kotak tweet on it, saying that banks are lending at rates higher or nearly higher than their cost of funds. So in that light, is the hope of banks leading the next bull market and, large private sector banks finally outperforming, is that hope a little misplaced?
Yeah, Surabhi, I think you're right that, I think the banking sector will help the index in not falling, but I have my doubts if it can help the index in actually outperforming and starting a new bull run. And the reason for that is simple, that the PSU banks are growing as much as the sector growth. The sector is growing at 10%. PSU banks are growing at 10%. So where is the room for that 15-18% growth? Markets get excited. The valuations get re-rated when you have 15-18% kind of growth in incomes. I think that is very, very difficult in this environment. So which is why, I say that it is a rotation market. ICICI and Kotak, the valuations have gone up. So now Axis and, SBI and, these banks, HDFC have to catch up. After that, maybe microfinance will see some cyclical recovery. Then some regional banks, once asset quality problems are sorted, then maybe RBL and, indices, these banks can have some rally. But it's just like a rotation. I don't see more than 10, 15, 20% anyways in this, entire sector. So yeah,
okay.
You're right. Yeah.
Okay, Digant, your point's well taken then perhaps investors need to think about that and not get carried away with, with some of those hope trades, so to speak. Now, what about NBFCs? Let's look at Bajaj Finance. Their AUM growth is about 26%. Stock has already done so well. It's the best performing stock in a difficult year so far, 2025, right? But again, do you see it really blazing the path in terms of growth? And let's not forget what the RBI said to Bajaj Finance just, I think it was yesterday, right? That letter of displeasure, quote unquote, about some of the outstanding issues on retail lending. Your thoughts?
Yeah, so Surabhi, this Bajaj Finance was a play on, the middle class, the growing consumer middle class in India. I think last 10 years, we have done a lot of penetration and, this sector is no more that nascent sector. So Bajaj Finance of today will have a lot of volatility across the way. Last decade was a clean sweep. This decade is going to be volatile. I think a lot of the improvements which will come in the next 6-12 months in the NBFC space and Bajaj Finance, it's already there in the price. There is no big money left in Bajaj Finance at the current levels. And on your broader question, Surabhi, that what about NBFCs? I think in NBFCs, we should play cyclicals. Right now, commercial vehicle finance is at the top of the cycle, so we should not play that. But microfinance is probably at the bottom of the cycle. So somewhere in 2 quarters, microfinance may start reviving. So I think you have to play cyclicality because structurally there is no big trade in the banks and the NBFC sector. So you just have to rotate. That's our view.
Thank you for your insights, Digant. Always a pleasure speaking with you. That's his view on the NBFC and the banking space itself. Interestingly, public sector banks won't let private sector banks grow beyond 10 to 12% was the key takeaway for me. Mitesh joins in once again. Mitesh, it's 9:13 right now. Your pre-opening call?
I'll go with the buy on ACC for targets of 20.
And Shrikant? All right. Shrikant is in there. So meanwhile, we'll just await the market opening. As of now, I'm just looking at a couple of stocks. In that, Zomato is the one that really stands out. I'll keep an eye out on Zomato, largely because there's a note this morning that has come in from Goldman Sachs, which says that the pessimism on Eternal is overdone. Why is that? Because after the big decline that we've seen, current share price implies just either of the two things. One, the food delivery valuations are near zero, or secondly, Blinkit EBITDA is structurally halved. And they see both of them as, non-zero probabilities and much unlikelier scenarios. So on the back of that, the risk reward is skewed towards the upside. They have a target price of 310, which implies a near 50% upside from here itself. But despite the decline and the positive skew, the only headwind for Zomato from here on is the possibility of MSCI exclusion, because if the FDI cap comes through, the stock would be excluded from the MSCI index, and that would lead to a $1 billion outflow. So that's something that we'll most definitely have to keep an eye out on for Zomato.
Absolutely. So we'll keep an eye on this one as markets open. What do we have, in terms of a start? So the Nifty Bank is ticking higher, about 0.5% up on the Nifty Bank, 51,700 or so, I think. The Nifty is down about 1/3%. That's about 80 points lower. Nifty Bank is up 0.12, but it's in the green. I mean, yesterday as well, the Bank Nifty was the one which first turned around because the Nifty started to recover later. We have 100 points now on the Nifty, so it's a very sort of normal kind of a open. You would look at the screen, if you did not look at what happened last night on Wall Street, you wouldn't guess that 5-6% kind of cuts on Wall Street, but that's what you have. IT, I want to take a quick look at it because the top 5-6 losers were all IT yesterday, and I can spot a few. That's a heat map. I can spot Infeed, HCL Tech, Wipro, TCS, etc. amongst losers right now. But otherwise, I mean, very few gainers, and bulk of it, of course, on the red side to begin the session. 130 lower on the Nifty. Surabhi.
Okay, let's talk about the key losers then. ONGC is sliding with the 6% drop in oil prices. ONGC is straight away lower, biggest loser on the Nifty right now. Hindalco is 2.5% down. Tech is still falling. Infosys, HCL Tech, TCS, all of these stocks are down between 1% to as much as 2.5%. What else? Tata Motors, again, global-facing business, 2.5% lower here as well. Maruti is lower. Bajaj Auto is lower. Eicher Motors is lower. So most of auto actually is down this morning. Beyond that, you've got Reliance, NTPC, Coal India. These are all the stocks which are down a little over 1%. Let's see what's bringing up the upside. The stocks that we were just discussing with our BFSI expert. HDFC Bank about 1.5% up. Bajaj Finance is barely there, just at the flat line. Really can't even call it a gain. And HDFC Life is also close to the flat line. Otherwise, everything else is either flat or very clearly down. ICICI Bank, most of your other banking names, not really able to support the market much. Let's look at State Bank of India, also lower. So IT and most financials keeping things under check this morning.
Keeping things under check, and the sell-off is accelerating as we speak. You know, we opened closer to the flat line. Now we're down 120 points immediately on the Nifty. And the bigger weakness is the mid-cap end of things. We outperformed the mid-cap end yesterday, but right now the mid-cap index is down about 0.8% straight off the bat. It's the mid-cap IT names which are taking a big knock. But alongside that, we have Bharat Forge, which is lower as well. So, you know, industry is exposed to exports or overseas sales, etc. Angel One, weak client addition and lower market share is something that, you know, the street does not like. That stock down 3%. Avenue Supermarts, again, you know, no fireworks in the numbers, 3% SSSG. Despite the store addition, maybe the street is not very happy with the 16.6% revenue growth. They would have expected a little more. That stock lower by about 3% as well. On the way up, though, you did speak about, you know, how the upstream oil companies were lower. But look at the oil marketing companies, HPCL, BPCL, IOC, all of them doing extremely well. Interglobe Aviation as well, you know, uses oil as a key input, doing a lot better. For the second day running, all these textile names are surging. So we have, you know, names like Shriram, Silk Milks, Kitex, Garments, all of them higher by 3 to 5%. On the way down, though, we do have Mazagon Dock, which stands out with a 6% cut on account of increased supply to OFS that has been announced. All in all, relatively worst day for the mid-cap end of things, and the Nifty now down almost 150 points. The Bank Nifty is the one which is really outperforming, and the biggest contributor to that is HDFC Bank, which is up around 1.5%.
Absolutely. So that's essentially the overall lay of land as far as specific stocks are concerned. So 0.6 lower on the Nifty. Nifty Bank is in the green, as Mangalam said. Of course, broader markets. It's too early to look at overall NSE advanced decline ratio because things are still opening up, but we'll give it some time. But maybe just put up the Nifty IT index, 4% yesterday. And by the way, earnings start next week. You know, we'll talk, of course, about Jan to March and what the quarter looked like. But more than that, I think a bulk of the conversation will be around tariffs and what the implications, etc. Are they seeing anything? Are they hearing anything from their clients in the US? 2%, so 6% in 2 days. Well, it's a sharp hit which is coming through in that space. So
just was pointing out, Mazagon Dock down 6.5% because of the OFS. The stock immediately adjusted to the OFS price, which is 2,525 rupees. So there was that much of a discount, and that immediate adjustment has happened as we speak. And yeah, Mangalam, Avenue Supermart still down about 4% I guess, despite the top line, what was looking like a decent top line growth.
Yeah, but I guess the street wanted a little more. It's no other, you know, explanation for that apart from the fact that the street wanted a little more. You add more stores, you get eke out a positive same-store sales growth, 16.6%. That also speaks about some sort of weakness that we're seeing in urban slowdown, which still continues, because this is the best barometer to track urban middle-class consumption. And if that's not growing, then maybe it's bad news for a lot of the other FMCG companies as well, which are hoping for some recovery to come by.
Dabur, how can we forget? So not sure about where that recovery is. But IT and FMCG, both big sectors, and both have their own overhangs.
Yeah, absolutely. Let's welcome in Shreyas Devalkar, Head of Equity at Axis Mutual Fund. Is with us. Shreyas, good morning. Good to have you with us here. Thanks for your time. So what is the Saransh, if I can ask you that, in terms of how's the view developing you know, between you, your team, fund managers, analysts, in terms of stocks you own? What kind of impact do you see because of these tariffs, etc., which have been announced? And it's not just day one, right? I mean, you'll have to sort of track this as you go along. But headline view first, Shreyas.
Sure. Thanks for inviting. If you look at, actually, as it is always said, that uncertainty is always the certainty, and more so in this market nowadays. In this tariff and associated impact on the companies, generally exports-oriented sector, one need to be really careful. That's what we are also looking at, because there may be some retaliation from multiple countries, there will be legal challenges, and there will be even this tariff may get reduced. Probabilities there, obviously, in this. So any action which we take now based on what is the outlook, and forget about us taking any actions based on the stock's price movement, etc. The companies as such themselves won't take actions, right? Whether it is any decision to try to shift plants or set up a plant, and this indecision, which is probably will hurt in near term. It can be indecision simply from a US company not to import today because today tariff is higher, while you don't know 15 days down the line the tariff will be lower, and those chances are there. So there's a lot of uncertainty which will have impact in numbers for company as such. That's where the bigger discussion is on where the uncertainty is low and where one can invest in from a longer term point of view. In that context, generally in over last 5 to 6 months, actually, we have increased our exposure to financial services sector, and that primarily because of the reason that it would be immune to such volatility. At the same time, we would have reduced to any export-oriented companies, may it be auto ancillary or IT sector. Today, and one more angle in this market today is about valuation, and that is very interesting. Generally, market is anchored today still, I don't know, but still I believe that market is anchored to the valuations in last 3 to 4 years. While one need to really check and recheck why and wherever the valuations are higher than pre-COVID level, one need to really justify why they are higher and whether they should be there or not. I'm not saying they should not be. Point is, one need to really think about it and check what it is and where it is, considering again the uncertainty overall in the economy and global economy as such. So these are the few thoughts which we have today now.
By the way, look at the Nifty chart and the stocks. Now it's a bit of a waterfall decline. It opened okay, and then it's just... Look at the Nifty now. Look at that graph. It's a straight line down and everything is suddenly selling off, including pharma stocks. ONGC instantly opened 3% lower, now 6% lower. Look at a Hindalco, opened about 2% lower, now 4% lower. And even pharma is not getting spared. Look at Sun Pharma, Cipla, a lot of these names under a fair amount of pressure. Reliance itself is suddenly down 2%. So it's a complete knock. 220, and it's accelerating now. It's gathering momentum on the downside. So let's watch. Difficult morning.
You know, just on that point, and I think Shreyas was saying maybe 15 days later tariffs could be lower.
Kind of pull back a little bit.
But you know, I think if you hear, and we played out that soundbite, you tossed to it, the Trump soundbite, right?
Yeah.
Right. He seemed unperturbed. He actually, if you just see what he actually said after a 6% decline, he said, well, readjustment was needed. You know, so
the operation had to be done.
Operation. It's a patient. Operation is now over, and now there is recovery, etc. So almost as if they're prepared for it. And if you remember in the speech to the joint session of Congress, Trump had at that point said, there was this one line. He said there'll be short-term pain. So actually, and of course, I mean, his Treasury Secretary is a 30-year market veteran. So it's very unlikely they didn't see that markets will.
But they haven't thought this through. It seems they have.
So, which then means that there is no quick, going back. The bar is high, negotiation, etc. can happen. Not that it can't, but the bar is high. It's going to be tough, and they sort of dug their heels in.
So the only way to basically get to the other side is go through it and stick with the pain. I mean, the decline on the Nifty itself accelerated a little more as we broke yesterday's low. Yesterday's low was 23,145. The next 100 points came immediately. Now the 23,000 mark is psychologically extremely important. So we'll keep an eye out on that. We have a couple of technical levels as well. You know, the 20-day and the 50-day moving average very close.
You know why? Okay, I just looked at the Asian screens. The reason why we've got this waterfall decline on the Nifty now is suddenly Asia is completely cracking. In the last, I think, half an hour, Japan has fallen 1%. It's a large market, the Japanese market. And Nikkei was about 2.5% lower at 8 o'clock in the morning. Now it's 3.5% lower. So this is big stuff. It's painful stuff. And folks, even if one has to just walk through this is not about, immediate readjustments. You don't readjust global trade lines in a matter of 2 weeks or 1 day. You know, the supply chain realignments, it's very big stuff. and the markets, it's a new beast that the market really has to perhaps deal with post-COVID. Shreyas, hi, great to have you on the show. So in the interim, I mean, we can go to economics and we can say India doesn't get impacted that badly, but markets move on sentiment as well, right? Sentiment plays a huge part, and that's working against us right now. What should the strategy be for investors to ride this period out? Whether it lasts a week, a month, 3 months, we don't know.
True. In that context, as I said, this uncertainty is mostly currently emanating from the global, and in this uncertainty where this tariff and the end game is not yet seen. Actually, everyone is evaluating currently the first derivative. The second and third derivative is more important, where how it affects the demand globally, and accordingly how it affects Indian companies. So as far as investors are concerned and investments are concerned, the way we are looking at it is be cautious on the exports-oriented sector. Valuations keeping aside, and as far as domestic oriented sectors, as a long only investor, one should look at more towards the domestic oriented sectors, which may be in financial services, in consumption space, as well as in the investment space.
Okay.
All right. Now, just a quick word on the IT services. I mean, it's well understood, right? US is the problem. So in India, IT is exposed 70%, 75% of the business still comes from there. So it kind of throws everything in a flux. But how are valuations here? And any views, strong views here, Shreyas? Or any names or any segment here? Go on.
Definitely, yeah. So this is a very interesting sector, and this I always use as a case study for this uncertainty. If you look at the first decade of this century, this sector used to grow at closer to 15%. The second decade, it used to grow at closer to 10%, and today it is closer to 5%. And if you see, valuations are broadly there in this period. One can argue that yes, the payout companies actually stopped acquiring the way earlier they used to be acquisitive, and that's why the free cash flow generation was poor. Today, the free cash flow generation to PAT is right from 80 to 100% in the large cap, and somewhere to 60 to 100% in mid and small cap. And then the payout ratios are also higher. So that warrants somewhat the re-rating, adjusting for a slowdown in the growth. But the fact of matter is the growth is lower than earlier with increased payout ratios. So this valuation, though, may look like that yes, they have not got derated to the extent of the slowdown in the sector, but partly it is getting supported by the higher payout in the sector. So in my judgment, whenever historically we have seen that whenever there is an uncertainty, wherever there has been any potential lack of decision making by their US-based client or Euro-based client, this sector, irrespective of its valuation, has faced challenges in terms of its valuation. And in the context of this decade, the way the growth has been, one need to look at it holistically and then tread it through it cautiously, rather than going by the headline valuations per se.
You know, everyone's talking about relative places for safety and domestic-facing names in the light of global uncertainty. Maybe banks are one of them. Then you have the consumer space, you have the cement space, you have local infra space and defense space, etc. But one is just trying to understand whether there will be any absolute gains out here or not. Because earlier we had Digant say that, maybe because of the public sector banks outperforming, private sector banks' growth will be in check. We've seen updates coming in from the consumer space. They aren't, very satisfying. At the same time, things where there is some sort of growth, the multiples are out of whack. So what does one really do?
Yeah, that's where it is interesting point which you raised on the absolute gain, and that's where someone who is investing in the market, one should look at a relatively longer term view of 2 to 3 years at least, rather than hoping that there will be immediate gains in this, unless again all these tariff related things get changed. And as you are also highlighting, it's not likely that soon something would happen on this, and that's also opinion of multiple experts that the changes are not expected to be sooner. Even in India's case, the bilateral trade agreement is now expected over 2 to 6 months. So that is again, so whenever these countries will go through these bilateral trade agreements, you will see that more clarity will emerge in this uncertainty.
Okay, all right, Shreyas, we'll leave it on that note. Thank you very much for joining in and offering us some perspective on what's turning out to be another slightly difficult morning. The mid-cap index is also down 1.5%. It's tough to show bravado in the face of a 5-6% kind of an overnight US market decline. What's interesting is, I'm just being a little nostalgic here, I mean, in earlier periods of uncertainty or crisis, COVID, even several market routes before that, on days like these, you would always see pharma and FMCG rally. But we're in such a different market. Pharma is not rallying for its own reasons. And FMCG, Mangalam's FMCG sector, it's got a challenge of its own, right? Typically, those were your safety spots, your places to hide. But FMCG no longer is able to play that role for reasons we all know.
Yeah, but despite that, for what it's worth, if I may, Tata Consumer is still among the top Nifty gainers right now. Britannia is mildly in the green. And we have HUL, which is recovering from the lows, as is Nestle. But there is no growth out here. So you'll just keep an eye out on how that pans out. But from extreme defensive domestic, let's go across to the one which is on the offensive right now, the way down, the IT sector. You know, IT Rima is everything that FMCG isn't, apart from the fact that the only thing that is common is the underperformance that we're seeing for both of them.
Indeed. So let me just quickly run you through what brokerages are saying now. First, Bernstein says the impact on Indian IT over the near term will be uncertainty in terms of tech budgets and spending. So their expectation is tech budgets will get pushed out further, and that will drive lower growth. The worst case scenario is that a global financial crisis, way back in 2008 kind of a scenario, when the global world, slipped into a deep recession. And at that time, Indian companies had reported a 10% quarter-on-quarter revenue growth. TCS was down 6%, in terms of a revenue growth sequentially in Q4 of calendar year 2028. Accenture was down 13% in terms of a top-line growth. Now, Bernstein is saying that that's not the scenario that they're anticipating, a GFC kind of a scenario, but they do anticipate that growth rates will get impacted. So they prefer quality. Their bet lies with Infosys in the large cap space and high growth mid cap companies like Coforge and Persistent. They're underweight auto ER&D companies like LTTS and Tata Elxsi. Now, JP Morgan is saying that when can the stocks potentially bottom out? The bear case scenario for them is that there is no growth for large cap IT names like Infosys, TCS, HCL Tech in FY26 and no margin expansion. If that is the case, then we're staring at deep EPS cuts for FY27. And if you apply the bottom PE multiple, then you're still looking at downsides of 7% for TCS, 6% for Infosys, and 14% for HCL Tech. For mid-caps like Coforge and Persistent, etc., and some of the others, we can potentially, in a bear case scenario, right, that is no growth. In FY26, we could see EPS cuts of 10 to 15%, and then there could be downsides of 13% for Coforge and 25% for Persistent. So their recommendation is stay light on IT, don't buy into any stocks in the earnings season. A conservative guidance commentary from IT companies could drive stock prices lower, and that perhaps could throw up an opportunity. So they like Infosys and some of the growth mid-caps. Macquarie, on the other hand, believes that the current market reaction is overdone, and if you have a long-term time horizon, then this is an opportunity to load up on the stocks. Back to you.
Yeah, but you'll have to have nerves of steel and a stomach to, to withstand that whole volatility, digest that volatility, if you want to be that braveheart buying IT. On days like these. Thank you very much, Rima, for bringing us the street view. Sector definitely under pressure. Let's move on to our next corporate conversation then. Bajaj Auto is the company that we have on our radar now. The stock, like the rest of the market, has been under a little bit of pressure, down about 2% this morning. The monthly sales numbers came out and they were more or less in line. March sales data coming in, domestic sales were quite flat. Exports saw a small 2% growth. We have with us Mr. Rakesh Sharma, Executive Director of the company. Mr. Sharma, always a pleasure to have you with us on our morning show. Thank you for joining in. I'll talk about the domestic sales in a bit, but I mean, as an industry veteran, let me ask you the bigger question. I mean, this whole tariff storm that's blowing out. I remember when we spoke about this earlier, of course, you're not that impacted. Your big export markets are Nigeria, Africa, Latin America. But as you watch this from the sidelines, are there any second or third order, perhaps, impacts that you would be wary of?
Good morning, Surabhi. Yes, indeed, the world order equilibrium has been disturbed, and a lot of us who took globalization as an irreversible phenomena are now seeing the winding down of that. while we are not impacted directly, but these kind of uncertainties lead to the weaker currencies moving, getting devalued, leading to retail inflation, and could sort of dampen demand. There are countries like Mexico. Mexico is one of our largest overseas markets, both by volume and value terms, and how the economy of Mexico is impacted. We have to see once all these tariff, the dust around the tariff wars sort of settles down. So there is no direct impact, but yes, like you said, there are secondary impacts to be watched out for.
So what is your exposure to Mexico in terms of your total export pie? What does Mexico contribute?
I won't call it exposure. It is a substantial, like I said, it's one of our top 3 markets. I would say we do about 10,000 units per month of very high-end products. So we have to see, till now there is no major impact in terms of demand, and growth rates are sort of almost similar. But going forward, we just have to be watchful as to how the economy of Mexico gets impacted.
So just to complete this point on global trade negotiations and pressure, now, whenever Mr. Trump speaks, he loves to talk about motorcycles, right? We've all seen that, and India has had to respond by lowering some duties so that those Harleys can ride into India. Could that, going forward, if we are willing to give more, could that become a challenge for your super premium bikes? I mean, KTM, the super premium brands that you're selling here in India and overseas as well?
Not at all. See, we are already competing with US brands and Chinese brands and Japanese brands in over 108 countries, right? So if we are competitive overseas, we will be competitive in India. So quite frankly, this is not a great issue for us because even if we lower duties or bring them in line with the US, we would in fact require reciprocity. And in any case, our exports from India to, that is Bajaj Auto's exports from India to the US are very small. And, only the KTM and the Triumph joint products, which we have co-developed and are manufactured in India, they go over there. They constitute about 1 to 2% of our entire exports. So even from that point of view, it's a very minimal impact. But from the point of view of lowering import duties in India, I think we will be competitive.
Mr. Sharma, we'd ask you to just hold on for 20 seconds before we come back and speak about the domestic markets as well. Because it's that kind of market where you look at Twitter before ticker. Donald Trump has now put out on
Where
pharma,
is this, Mangalam?
We're just trying to figure out, is it on social media, is it on Truth Social, is it on a statement, etc. But what we know is that pharma tariffs will be coming soon. And he said, and I quote what is being flashed, pharma tariffs will be at a level you haven't seen before. And to add to that, he said that they will be viewed as a separate category. Now, yesterday, the only sector that outperformed was the pharmaceutical sector, expecting some sort of relief because, for the sector on the whole, along with a few other, they were excluded from these tariffs that were announced. He said it will come in the near future, not too far. And now the fear of that comes back once again. I wonder what the hedge fund guys would be doing, yesterday with the outperformance that we saw, with now the underperformance that we're seeing. A couple of these stocks which have high exposure to the US markets, Aurobindo Pharma, etc. in particular, Zydus Life is the other one, all of them at the low point of trade, and that's the one which is now causing some fear.
Mangalam, that's what I was saying yesterday, right? I mean, that tariffs exempted for now. For now. But that was because, he's talked about pharma so many times to suddenly think that he'll now not do it, especially after what he did on tariffs, which was much more severe. So, I mean, generally the sense was that it'll come. And the executive order specifically said this is national security. He said, why does he want pharma tariffs? Because he wants pharma, he wants these things to be made onshore in the US.
In America.
So I think that perhaps is the reason why you have this now coming through. It's a soundbite. It's an interview, I was saying. It's an interview to Sky News, we are being told, which has happened now. and or maybe later it's being aired, and we'll play that specific soundbite out for you in a specific in shortly. But these are, I mean, ignore the rhetoric at a level you haven't seen before, but maybe not, right? Because he's done what he said he will. But the tariffs are going to come. What we'll do also, of course, is revisit this space with Vinny because she had some exposure details, etc. That table, very helpful company-wise exposure to the US market. So that coming up in just a bit.
I think in line of that, the only thing that the market's taken cue from here is that the two things that Donald Trump can't impose any tariffs on are the Indian banks and the Indian consumer stocks or the Indian telecom space as well.
That's true.
Because that's where you have a bunch of flows coming in immediately. Up until yesterday, we were like, okay, maybe there is some relief with pharma. It's not included immediately. Maybe sometime later. For now. But as soon as that news came by, we had a swift move of capital towards the domestic consumption names itself. We have HDFC Bank, which is zoomed in, and all the other FMCG stocks that Surabhi was talking about have now moved into the green as well. Not Vodafone Idea, but looking at the Nifty FMCG index and HDFC Bank. So the Nifty now holding closer to that 23,100 mark versus the 23,000 mark itself. But let's go back to our conversation with Mr. Sharma of Bajaj Auto. Mr. Sharma, with all that is happening around the world, it is easier to talk about and discuss economics. But from a business standpoint, both globally, growth has been lacking at a lower base but a higher rate. But domestically, you had guided for a 6 to 8% sort of growth and you've ended up doing just 2%. So when we stand at the start of FY26, what is your target for the next year when it comes to domestic volume growth and export volume growth for the next year?
Yeah, well, I would say that the outlook for the industry, which we are presuming is about similar as what we had said last year, about 6%. But the important thing to understand is that the nature of growth is not completely linear and completely secular. You will have quarters which will be very, very high growth, and you will have quarters which will be very, very low growth. And as we move forward, you see these differences between growth rates and the actual performance, between outlook and actual performance, there is a constant dynamic over there to manage, which is between growth and profitability. Because growth is just one dimension of the market. The other dimension of the market is competitive nature, the inflation. And as you know, at Bajaj Auto, we are constantly trying to optimize both the top line performance and the bottom line performance with market share and competitive position. So a lot of these variances which you see is trying to get what we feel from our corporate standpoint is the best competitive position, which is a competitive position comprising of not just a volumetric position, but a value position and a certain profitability profile. And we will continue to do that. And we think that through its ups and downs, next year the motorcycle industry should be looking at a 5 to 6% growth.
And what about you?
Well, we would like to outpace that, and particularly in the top half of the industry, which is the 125cc plus industry, we would be planning to grow beyond what the industry is going to presumably grow at.
All right, Mr. Sharma, thank you very much, sir. Pleasure speaking with you, and we'll sort of continue this discussion, fast-moving environment, more so on a global level. So that discussion on autos, etc., will continue. We'll take a quick commercial break here. We've got a discussion on apparels coming up. We've got a discussion on the EMS space coming up as well. You'll hear from Gokuldas Exports and PG Electroplast coming up. Welcome back. We have the management of Gokuldas Exports joining us. Seva Ramakrishnan Ganapati is Vice Chairman and Managing Director at Gokuldas Exports joining us. Mr. Ganapati, good morning. Prashant here. Yesterday your stock was up 7-8%. I mean, leave the stock aside, but that's just an indication. Market assumption is tariffs here are going up. They're going much higher in places like Vietnam, Cambodia, where a lot of the China manufacturing moved after the first round of tariffs. So maybe there was some shift to India. Is that really the case?
So it's early days, so we need to see how all of this pans out. Relatively speaking, we are better off compared to other competing countries. Take China, Vietnam, Bangladesh, Indonesia, all of these countries, so we're better off. However, apparel already attracts tariff from 15 to 30%. Now, the new reciprocal tariff, which ranges from 26% for India to 54% for China, are all in addition. Such a high tariff could impact consumer demand as increased costs eventually will be pushed onto the customers. So, of course, this will happen with a phase lag. We will have to see how all of this out and, how does this impact volumes going forward. So that's something which we will have to wait and see, as to the impact of some of the tariff on some of these areas.
What is the tariff US charges right now so far on Indian apparel imports?
So on all apparel imports, US charges anywhere between 15 to 30%, 32%, currently, depending on the product type.
15 to 32%. And what is, for your products, what is it on an average?
So on an average, it would be about 17% or thereabouts in that ballpark.
17.
Yeah, that's right.
And what percentage of what you produce goes to the US?
Goes to the US? It's about 70%.
So 70% of what your revenues are tariffed at 17% right now.
That's correct.
And they will be now, from the 9th of April, the 17 plus 26.
That is correct.
I mean, not 26. It'll differ based on... No, it'll be 26, right?
That is correct. The 26 is a flat increment, and then depending on the product, the base tariff will change.
Now, what are the tariffs? What are the cumulative tariffs on Vietnam, Cambodia, China? After this, you must have looked at it. Yeah, the new ones.
Against our 26, for China it is 54%. I think it is some 45 or odd percent, 46%. Bangladesh it is some 13%. So 37% against our 26%. So Bangladesh will be +9, Vietnam, there you have, So all of these are...
Mr. Ganapati, our tariffs, you say, for example, if you take Gokuldas as a proxy for the industry, will be 43%, right? Total 43% tariff.
That is correct.
17 plus 26.
As in the base tariff plus 26, right?
Correct. What is that same number? Existing tariff, because those countries would also charge some tariff, right? On apparel exports to the US.
No. Their base tariff...
Yeah.
So their base tariff remains the same, anywhere from 15 to 32%, depending on what product you export. So China, since they export more synthetic garments, their base tariff will be even higher because synthetics attract anywhere between 25 to 30%. So let's say their average is something like 20%. So on 20%, there's another 54%, so that goes up to about 74%. For China.
We're all... Okay, so the delta between our 43 and where they are is how much, roughly, between these three? These are the three important ones. Bangladesh, Vietnam, and...
Yeah. So when you look at the delta, everything depends on the product type. So remove the base tariff. If you look at our 26, Bangladesh is 37, the delta is 9%. Look at our 26, take China at 54, 26 to 54, that is the delta that we are talking about. That's about 28%. And with Vietnam, it will be about 20% or thereabouts, 19%.
Okay.
That's the tariff delta.
20% tariff delta. I mean, we are cheaper
19%.
by, just tariff-wise, we're cheaper by 20%. The other...
Approximately,
The cost of output, is it... Can that kind of take care of this difference or no? I mean, in terms of competitiveness,
no, this is huge.
Sheer competitiveness.
This is huge. I mean, a 20% delta and so on and so forth are very large. It's very difficult to manage it through cost management and all of that. So, cost of raw materials, etc., will not offset all of this. This tariff delta is advantage India. But then I think what we really need to keep in mind is that what is the impact of all of this on end user demand? Because all of this looks great on paper. We have to see how does this impact consumer demand in the United States, which is a very large market. And if this tariff actually will get passed on to the customers, will they buy in the volumes that they will, they have been used to buying, right? So that is something we need to see. So and if that volume drops, of course, India will still tend to keep a good share of the volume. So there is a benefit for us. But, any drop in volumes does impact the industry as a whole, right?
And we don't know,
we have to balance
just
these
purely with regards to tariffs, we don't know how these countries will give in, cut tariffs and try to negotiate deals, etc., right? That tariff differential may change. We don't know, depending on what everybody does. I just want to make a quick mention, Mr. Ganpati, just coming to you. There's a flash at the bottom of the screen. There was this confusion, then it was confirmed because the board which President Tariff had when he announced the tariffs mentioned Indian tariffs at 26%, but then the website said 27%. So the understanding by the end of the day yesterday was that the actual tariff which US will charge on Indian imports is 27. Now what we're saying is that the Annex 1 on the White House website mentions 26% tariff. So basically,
the president can't be wrong. It's as simple as that. Yeah.
So it is,
he was holding a placard which said 26.
Yeah.
The next year on the website said 27. By the end of it, the placard is right.
Correct.
So it's 26.
So, it is 26, not 27. Just
that doesn't make much of a difference.
Yeah, it doesn't make much. It's a technical thing, but yeah, I mean, it is what it is. Mr. Ganpati, two questions. One, have you heard? It's very, very early, but have you heard? Because the underlying consumer demand in the US. Just look at the stock market yesterday, right? Have you heard from big clients, and you supply to most of them? Gap and Victoria's Secret, and I don't know what. There are so many other big brands. Have you heard anything from them from after what we've seen in terms of tariffs?
See, everybody is trying to assess what the impact will be because every brand has worked out certain scenarios of tariff, and this tariff has been way out of the range of the scenarios that they had worked out. So nobody has absolute clarity on which way the consumer demand will go. So it will take a few days for them to react. But the tariff quantum being so high, they will have to really strategize as to how do they deal with it. These quantums cannot be pushed back to the suppliers because no supplier can bear this kind, nor can the retailer bear this. So eventually it will have to be passed on to the customers.
But have order cancellations started? There is some feedback from the Indian Apparel Association that they're asking for, importers are asking for discounts.
No, not yet. It's too
That's
early.
not happened. So, you've not seen that?
No. We have not seen that.
Sorry, you were saying, you were adding something.
What I was saying is that, look, at the moment, summer products are already in the warehouses in the United States or are in transit. Now, those will enter at the previous tariff, tariff rates. So the consumer impact will start from fall winter, which is still quite some way off. So we are talking of something like September onwards, because the tariff will impact the incremental goods which are now going from April onwards. So the impact of tariff will come with a phase lag. In the meanwhile, my sense is that many countries will continue negotiations with the US government, and we may see a change to all the tariff tables that we are looking at.
No, absolutely, Mr. Ganpati. Every day is a new day. Every day these numbers are changing. But as of now, if you work with 26%, how much of it will have to be passed on to the US customer? And therefore, what is your realistic assessment right now in terms of a drop in demand?
So very hard to say, very, very hard to say. So consumer demand is price elastic, right? And will all of the 26 be passed on to the customer? I think a large chunk of it will have to be, because rest of the value chain cannot absorb this. And keep in mind, India, only India is slapped with 26, right? Other countries are even higher. So their imports from Vietnam and China are far, far higher than that of India. So on an average, the impact on US imports will be closer to 30%, 32%, or even 35%. So we got to see whether, such high tariffs can be passed, can be absorbed by the value chain. Unlikely. So it'll get passed on to the customer. Now, whether the customers will react by buying less, what other ameliorating measures are there in the US, which allows consumers to come and buy more? All of that will have to be seen in conjunction, and we have time. We have time for about 3-4 months before all of this kicks in, because we're talking of goods which will attract tariff and be consumed by customers down the line, not right away.
We take that point entirely, and obviously when things start to look like they're settling, we'll also have the question of whether India can benefit from this by virtue of its own capacity, by its own capabilities, etc. or not. Players like you will obviously outperform, but maybe a large amount of fringe players may not get the similar benefit as one is expecting. But I guess that's a conversation that we'll have at a lot later time. Thank you so much for joining in and giving us your perspective on this one. But meanwhile, while we were having that conversation, we had the commentary coming in from Donald Trump on pharmaceutical space. Now we have the video bite as well. Donald Trump saying that pharma tariffs will be starting to come in soon. Let's hear it out from Donald Trump himself.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
All right, so that is Donald Trump saying it as is on the pharmaceutical space, and that's the one that actually spooked the entire pharma stocks as well. And now as we speak, a lot of them are at the lower end of today's trading range. Divi's Labs and Cipla, for instance, down about 5%, and a big gash is what we're seeing on Sun Pharma and Dr. Reddy's as well. So,
by the way, that's yesterday to today, and this is the discrepancy, because when the US president held up that placard, and also this was posted widely on social media handles, India's tariff was 26%. But what happened was that when the annexure came out on the official US website, India was getting a 27% tariff levy. And we did check this back with a lot of specific US government officials here in India and overseas as well. And it seemed to appear that 27%, the official number from the website, was the number. But now that US website has changed the number from 27% to 26%. So as they say, perhaps the president cannot be wrong. He said 26, so 26 it really is.
26 versus 27.
20, it doesn't really.
Yeah, it is what it is. What's really, spooking the street right now is the Nifty is on the verge of breaking that 23,000 mark as well. So that's the important number.
It has, in fact.
It's broken the 23,000 mark, I think, for the first time in the last 2 weeks or so after it conquered it. Let's speak about the impact of that on, could there be any sort of, problems coming in for a lot of these electronics makers? We have PG Electroplast joining in. Obviously, the thesis here for all these electronics makers is manufacturing in India for India, import substitution. So to that extent, not a lot of these players have any export sort of exposure. And add to that, the government recently approved the electronic component PLI of 23,000 crore rupees as well. Kotak in its recent note did say that this will aid backward integration. To what extent and what could the impact of the global noise be on businesses like PG Electroplast? We have Vikas Gupta, the managing director, joining in. Vikas, first up on the exports issue. I presume that you have zero exposure to exports, but in light of higher US tariffs, do you think the electronics industry in India could get impacted? That's point number one. And secondly, what kind of benefits do you expect from the cabinet approval of electronics component manufacturing scheme of close to 23,000 crores? How does that aid things for people like you?
So good morning, Mangalam. Basically, when we look at the exports for our company particularly, right now our exports are almost negligible. And if we talk about particularly about the US market, our exports are actually nil. So we do not see any impact on our company for the tariffs that has been announced by President Trump. Regarding the overall industry, I think industry might gain in a longer run with these tariffs coming in, because the differential of the tariff between the Vietnamese and the Chinese origin goods vis-a-vis with the Indian origin goods is it's quite large. It provides an opportunity for arbitrage, but we have to see how it will play out, because everybody, all the governments will be trying to negotiate with the US government to look at the lower tariffs. So we don't know how it will play out. So we have to wait and see how it goes. Regarding the electronic component.
Yeah, Mr. Gupta,
please,
we'll
Surbhi.
come to the PLI scheme in just a minute. I just have one or two additional questions to complete the export picture first. Understand that you don't have exposure, and I mean, I'm sure you're feeling very relieved in an environment like this. But otherwise, electronics exports is the big effort for India to sort of take it forward, particularly in products like mobile phones, right? Would you have a sense? I know it's a bit of an unfair question. It's a better question to be put to the industry association. But when we talk about the total electronics industry, would you have a sense of how much our exposure would be to the US right now? I mean, a lot of people are setting up big capacities. iPhones, for instance, I mean, from Foxconn to the Tatas, there's serious investment that's gone into it.
So, Surbhi, for me, I do not have the exact numbers, but largely what I can see, India is aspiring, and the players in the Indian electronic EMS space are aspiring to set up a large capacities and ramp up our exports, particularly for the mobile phones to the US markets. And it has actually happened in last 4 or 5 years. If you see the exports have grown multifold for the mobile phones from the Indian companies. So going forward, I think once the dust settles down on that this tariff issue, maybe I think still there will be advantage for Indian companies to look at.
Yeah, but right now we have to deal with this 26% additional tariff. The PLI scheme, now just to connect back to the other question, the PLI scheme that finally got announced, 25,000 crores, I think is the total value. Now that is entirely for domestic markets, or is there a sort of a portion of that also incentivizes making electronics for exports?
So, Surbhi, the broad draft of the policy and the articles that I have read, I've gone through. As per that, basically the focus for this electronic components manufacturing scheme is to deepen the component ecosystem in the country. And there are key electronic components for which we are still dependent on overseas vendors. That is basically the idea from the government side, to see how we can develop the component ecosystem for those key components in India. And I think the Indian companies will have to become the part of the global supply chains, global value chains to participate in those critical components.
And what does this do to players like you in particular? Are you having any backward integration plans right now for yourself? If yes, then, how does this scheme aid your margins?
So, Mangalam, right now, if you look at for our company, particularly the electronics is a very small part of our overall revenue business.
Right.
Regarding the backward integration, we are in talks for the component backward integration in our appliances category. Regarding the electronic components manufacturing scheme, definitely we are evaluating this, and we are, in fact, we are actively will be pursuing the opportunities in this space also. And going forward, as and when the policy comes out, the detailed policy comes out, we might be participating in this policy as well.
What would your exposure to electronics be according to you? And with the backward integration that you're thinking for appliances, how much would that aid your margins by?
So regarding the electronics business right now, it is not even 10% for us in our overall revenue scheme. And we have aspirations and ambitions to grow that electronic business vertical as well. So we'll be pursuing the electronic components manufacturing scheme. Regarding our backward integration in our appliance category, we have already announced our intention to get into the air conditioning compressor manufacturing, and we are in active talks for that. So hopefully we'll be able to close that agreement within 3-4 weeks' time.
And how much money are you looking to put to work for both of these, for the component manufacturing, compressors specifically, which directly ties in with your business, gives you better backward integration? How much for that? And how much for this new electronics vertical?
So for the compressor manufacturing, we have already earmarked capex of almost around 350 crores. So that is already earmarked. Regarding the electronic component manufacturing scheme, so there are different components requiring the different amount of capex. So we have to evaluate, and it will be too early for me to commit on the capex amount in that scheme.
All right, and this 350 crore yields what kind of improvement in cost and margins?
So, Mangalam, if you look at the compressor plant that we are planning to put up, that will be largely margin accretive, because almost 50% of that compressors we will be using for in-house consumption for making of air conditioners, and balance 50% will be sold to the outside customers. So if you look at the revenue side, we are looking at asset turns of almost around 4 to 5 in that, with a capex of 350 crores. But out of that, almost 50% will be consumed in-house.
Okay, all right. Got it. And the timeline for commissioning, I'm guessing it will take at least 2 years plus, right?
So, Surbhi, our target is that in the calendar year of 2026, maybe in the second half of 2026, we should be able to start the production on that.
Oh, okay. That would be fairly quick. Got that?
I just, since we have you with us in the interim, I would like to know your thoughts on demand for this summer, because I remember this very interesting conversation that we had with you and, Mr. Tyagarajan of Blue Star as well, saying that if AC demand grows beyond 25 to 30%, there could be a bit of a supply issue. Has that happened so far? We're just a couple of weeks away from summer, so I presume a lot of these orders for your clients would have been made already.
So, Mangalam, I would say still, we talked only maybe 2 weeks back. So still the market is hoping for a good summer. And I think if you look at the trend for last 15, 20 days, the heat wave has picked up across different parts of the country. And we are seeing a very robust demand. And we are keeping our fingers crossed. Let us see how it plays out. For us as a PG Electricals, let me clearly state here that we are adequately covered to take care of the demand for the months of April, May, and June. So for our side, there is no trouble. But definitely some industry players might face some kind of shortage of the compressors if the demand picks up beyond the 20-25% target.
As of now, all signs are that it will be 20-25% itself, and perhaps not beyond that.
I'll say it's too early, but the sales are looking quite good. I would say it can be more than 20-25%.
All right, got it, Mr. Gupta. We'll leave it on that note. Thank you very much for joining in. Appreciate your viewpoint. That's PG Electricals. By the way, look at markets. It's serious pressure across Asia, and we've not been spared in the global storm either. The Nifty is down 275 points, but this is still the best looking screen across Asia. Singapore, a market like Singapore now is down 3%. Japan is down almost 4%. South Korea is down about 2%. So all the markets from where we started at 8 a.m., they have doubled down, in terms of the decline. That's the extent of the fall after a serious drubbing yesterday as well. Tough Friday. Let's take a break. We'll come back on the other side and figure out how the commodity markets are coping with the Trump impact.
My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately.
Welcome back. Let's shift focus to the commodity space. Manisha, what is it that you're tracking today? It's been a steep sell-off across the board overnight.
Yes, and the pain is that it doesn't stop there, does it? Because all the time zones yesterday saw very sharp declines, whether it was currencies, the dollar index, which has declined quite sharply as well, and all commodities trading at multi-week or multi-month lows there. But I'm keeping my focus on the crude oil prices because the declines here have been the sharpest. 6% of a decline in the overnight markets, and that has been the biggest single-day decline since July 2022. That's how bad that the crude markets have taken it. If you look at this week itself, we are down by 4.5%. And if you look at the prices in the last 1 month, they are down by 7%. And in the last 12 months, the crude oil prices have gone negative by 24%. So good for the consuming countries. Let me tell you that 80% of global countries actually import crude. For those countries, this price decline actually is quite positive there. Let's look at the reasons why we have seen such sharp decline come in for the crude oil prices. Well, to begin with, the US has put tariffs of anywhere between 10 to 49% on trading partners. You know, that's the other thing about international commodities. These are global commodities in nature. And when you see specific countries putting tariffs there, it does disrupt the overall international market there. And that's exactly what is happening with the crude prices also. Apart from that, there also are concerns that these tariffs could lead to weak global economic growth going forward. And that would mean weaker crude demand going forward as well in sense of fuel. In any case, with the kind of renewables investment and energy transition that we have been seeing, we have seen some pressure come in for crude, but this just adds more to that. Apart from that, the US crude inventory is also gained up by 6.2 million barrels versus a forecast of a decline of 2 million barrels. So this was a big surprise coming in for the markets. And then it also has been about the OPEC and allies meeting, which was yesterday. They also have speeded up the output hike going forward for the month of May there. If you look at the numbers, well, the street was working with a number of 140,000 barrels per day of an increase. What OPEC and allies gave you was 411,000 barrels per day. So this is 3 times more than what the street was anticipating. So when you look at OPEC and allies, there are 8 countries who actually have agreed to that. And these are inclusive of Russia, Saudi Arabia, UAE, Kuwait, etc. What the markets are also looking forward to now is the OPEC and allies meeting. The next one happens on the 5th of May. That will tell you on what is anticipated for the month of June. But very closely for today, it is going to be the US non-farm payroll data. Well, the further cues would come in from that.
Okay, all right, Manisha, got it. Thank you very much for that. And with that, we have to take a very quick break, come back on the other side, and it'll be time for a special segment. It's the it'll be the Citizens Monetary Policy Committee. Tata will be in conversation with experts to discuss whether the RBI will cut repo rates and boost liquidity in the monetary policy. That's all set for next week.
Of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years. And we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very, very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years.
The tariff drama is done. The next big event in the economic calendar is the Reserve Bank's Monetary Policy Committee meeting on April 9th. Trump's tariffs seriously threaten growth, so should the RBI MPC be ultra dovish? As always, the Citizens Monetary Policy Committee of CNBC-TV18 meets to discuss the issues that lie before the RBI MPC and what they ought to do on April 9th. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh of SBI, Sajid Chinoy, JP Morgan, Samiran Chakrabarti of Citi, and Sonal Verma of Nomura. Gentlemen and Sonal, thank you very much indeed for your time. The first question has to be the global setup. So Sajid, let me start that with you. How does the global economy look post this massive tariff imposition? Are you seriously cutting global GDP estimates?
Lata, we're doing more than that, because I think you have to, what we've seen this week is a seismic event. And I think this needs to be viewed at three different levels. The first level is to understand that Asia has been particularly badly hit. This is no surprise. I think the tariff approach was a very mercantilist approach. If you look at where the US runs the 15 largest bilateral trade deficits, 10 of those 15 countries are in Asia. And therefore Asia, whether it was China, Vietnam, Japan, India, other countries were hit with very large tariffs. So this is going to hurt Asia directly, because now an export-led model that many Asian economies have with a lot of exposure to the US will come under threat. You've got large exports to GDP to the US and a large increase in tariffs. That's the first level. But there's a more important level here that affects the global economy. What this tariff increase does over the last few months is effectively increase US import tariffs by 20 percentage points. US tariffs are now the highest in over 100 years if these tariffs sustain. And this constitutes the largest tax increase on US households since 1968, when the US Revenue Act came into being, right? So the sense is that a very large tax increase is inevitably going to throw the US economy and with it, the global economy into recession later this year. And I think that's the big change from this week, that we now have greater concerns that the US and global economy will spill over into recession later this year. So economies now have to worry about both hits. A, your tariffs go up and that hurts your exports, but B, global demand is going to be much, much weaker later here because you're in a global recession. And number three, and we don't have time for that today, there's a much larger structural question. Is this the beginning of the end of the 80 years of deglobalization that we've seen since the Second World War, and what does that mean for growth, for inflation, for productivity around the world? But those are more weighty questions that will unfold in the months to come.
Yeah, no, that's a debate for another day. But for the moment, the MPC is going to be faced with an extremely difficult global environment. Samiran, we were already worrying about our own growth. This is an added headwind. Do you think there is space for extra dovishness or even requirement for extra dovishness because of the global story?
Thanks, Lata. I think the way MPC will probably look at it is that from a risk minimization perspective, now the downside risks to growth are much higher than the upside risks to inflation. That clearly opens up space for more easing. Our baseline is that we should see a 25 basis point of rate cut in this policy, along with a change in stance. The RBI has already provided significant amount of liquidity to the system for better transmission of this rate cut. And that assurance would also come in the April policy. Additionally, we have added an rate cut in the August policy also in response to these downside risks to growth. So that way we now have another 75 basis point of more rate cut in this cycle. But we have also very clearly mentioned that we are entering a period where it is possible to imagine that the policy rates could stay below the neutral rate also, because this 75 basis point rate cuts will only take us close to a neutral rate of about 5.5%. So given our estimate that inflation is running close to 4%, but there is a possibility that we might want to go below neutral also. But like it's a very, the world is in a state of flux. So I don't think policymakers will be very proactive always in this. Maybe to some extent, they will wait for how these things unfold before taking that final call on whether to go below the neutral also or not.
Okay. When we ask for your votes, let me see how many of them agree with you in terms of 3 more cuts or 4 more cuts. But let me first get the GDP numbers. That's also a forecast we will look for. Sonal, that question to you: will India's GDP growth number come under pressure? The Reserve Bank's current forecast or February forecast for FY26 was 6.7. Will they have to lower it?
Yes, we do think there's downside risk to the RBI's projection of 6.7%. Now, the direct impact on India because of US exposure is actually not that high. India's exports to US are about 2.1% of India's GDP. So the impact is manageable. But I think the indirect and sort of the second round effects are what could be more material because it's broadly a universal tariff that has been imposed, so global trade numbers are likely to get downgraded. Uncertainty is weighing on business investments, and tighter financial conditions will also feed back into weakness in private investments going forward. So we do think that the growth numbers starting April, which will reflect the real underlying export growth as compared to the last 3 to 4 months where there was front loading ahead of anticipated tariffs, are likely to be materially weaker. Our own growth projections for India are at 6% for FY26, and we do think the 6.7 of the RBI is on the higher side.
Okay, 6%. I think that's not a number I heard from many people. I heard 6.1 to 6.3. But then the MPC has to concentrate on inflation. Soumya, that to you. Will India's inflation pan out as 4.2%, or can it be even lower?
Yeah, thank you, Lata. No, I think amidst this global turmoil, uncertainty, and a complete flux with the system has been thrown in since yesterday, I believe the good news is on the inflation front. The numbers for inflation are actually looking significantly better now. And if the current estimates holds, I think for most of the months in the current fiscal, I think till October or so, the numbers will stay closer to 4% or even lower than 4% on many of the occasions. So that means actually that the RBI target of 4.2%, in fact, for the last fiscal which has went by, the RBI projections will also be was higher. And this time also the RBI target of 4.2% inflation is likely to be undershot. So from that point of view, inflation as of now doesn't look a big issue. And there are two more factors which actually are downside risks to growth, which could also act to a comforting factor on inflation. One is the point that because of the global uncertainty on tariffs, there could be a price decline in some of the sectors which are more integrally linked. So that could also have a sobering impact on the inflation. And given the numbers and given the fact that the growth continues to be a little bit weak, so that will also give a comforting factor in terms of a manageable core inflation. So if I take all these factors into account, the inflation numbers are going to surprise on the downside, at least for now, for next several months in this fiscal.
Okay, point taken. Huge disinflation. You can't sell to the US, so you sell it more cheaply to the rest of the world. That big disinflation we will have to countenance. But Dr. Sen, let me turn the question on its head. Samiran is going to the extent of, even we have to go below the neutral rate. What about savings, sir? We are at, kind of a 5-year or what? Some people say even 40-year low in terms of household savings. Can we go no holds barred on cutting and dovishness?
Yes, in a sense, we can, and we will probably need to do that. So here I agree with Shomiran. We may actually need to go below. But this is not the time to do it. I mean, one has to think this through a little bit. You'll have to see what strategies different countries around the world are going to adopt, because there's going to be a wholesale change among almost all countries of the world in terms of the way they are going to plan their reaction to what has transpired. So yes, I think we should be prepared for lowering everything. Inflation, I completely agree with that. Inflation is likely to come down sharply, and this is not just about what's happening globally. It's also that if you really look around the world, the only country that really stands out as being able to grow on its own steam is India.
Yeah.
And so, when somebody talked about, I think, mentioned that the growth would be probably sub 6%, I think that's not a bad number, by the way, because other countries are looking at facing recessions. Yes. And I think we would be around the 6% mark, purely on the basis of our own strengths. The point is, we shouldn't rush into anything until we see how things are evolving in the rest of the world.
All right. Fair point, sir.
Taking premature steps is, I think, a bad idea.
Okay, rushing into anything is a bad idea. So I'm smelling that we are not going to get a 5 out of 5 in terms of repo rate cut. But those questions after the break. I will have to take a break. We have to analyze the inflation situation a little more because that's the MPC's mandate. And then, of course, we will ask for the committee's votes. All that coming after the break. Bazaar viewers, you will get to see the entire show after market hours.
It was only 7 years ago when I came in, we started with China in charge, and we took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man.
unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है।
Pharma stocks fall following US President Donald Trump's comments for tariffs for the pharma sector. He said that pharma tariffs are under review and will come in at levels never seen before.
HDFC Bank is bucking the trend in a weak market on the back of a strong fourth quarter business update. The lender has seen its best quarter-on-quarter deposit growth in 4 quarters and the best loan growth in 5.
Upstream oil companies ONGC and Oil India see a big decline as Brent falls below $70 a barrel on OPEC plus output hikes and uncertainty on demand post Trump's tariffs orders.
Masgao Dog is also under pressure now, down nearly 7% after the government is set to sell up to 4.83% stake through an offer for sale. The floor price was at an 8% discount to yesterday's close. The OFS is currently open for non-retail investors.
Bharat Forge shares down over 8% in early trading after Morgan Stanley downgrades the stock to equal weight from overweight earlier and also cuts its target price by 15% from the previous target price. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangala Malu. With me, Hormas Fatakia. Another day, another rout is what we're seeing in our markets. A 300-point decline on the Nifty, taking it below 23,000, taking it below the 100 and the 50-day moving average as well, or rather the 20-day moving average as well. We'll keep an eye out on how it pans out from current levels. But what's interesting is that we're down. We're not out. If you compare it to all the other indices across Asia and what took place in the US. So we're relative outperformers, but when we're down about 300 points, it's not always relative, it's absolute that matters.
Indeed, and it's kind of a delayed reaction, right? Yesterday we were fairly resilient to what was happening across the globe, but considering what transpired on Wall Street overnight and considering what's happening in whatever Asian markets are open today, you're taking it a bit on the chin today, particularly for the Nifty and the broader markets itself. But one sector that was an outperformer today, seeing a very, very sharp sell-off now, are the pharma stocks, and they are declining following US President Donald Trump's comments on tariffs for the pharma sector. And he said that the pharma tariffs will be starting to come in soon. This is what he had to say.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
All right, near future, not too different future at a level that is not seen before. It'll be a separate category, and that's caused a massive cat among the pigeons when it came to the pharmaceutical stocks itself. Just take a look at a couple of these moves. We have Divi's Labs, which is down 5.5%. Cipla is down about 5%. Dr. Reddy is down 5%. And these are frontline stocks that we're talking about. Look at the broader markets, the cuts are a lot more. Strides Pharma down 9%. Aurobindo Pharma 8% lower. Laurus Labs itself is down almost 8%. Granules, you look at whatever, Zydus Life down anywhere between 7 to 8%. So it's a big decline that we're seeing on this space. And this at a time when, everyone was hoping for the big CRDMO sector in India doing extremely well. So uncertainty is something that we have to contend with right now, especially given the outperformance that we saw yesterday itself. Let's welcome Manas Jaiswal for a quick technical check on the market. Manas, we were hoping that, supports around that 22,900, 23,000 would hold on because of the moving averages, yesterday's low, the recovery that we saw from yesterday's levels as well. Where do you see the market going from here on, especially at the 300-point decline that we're seeing right now? Do you think that this is a better level to buy or maybe wait for better levels?
Good morning, Mangalam. So since Nifty has broken the key support of 23,000, I think the next target would be 61.80% retracement level of its entire rally from 21,900 to 23,900. So I am expecting a target of around 22,700. I think not at current levels, but if you see any recovery near 23,050 or maybe 23,100, then one can create short position. Stop loss should be around 23,250 and target would be 22,700 where the 61.80% retracement level lies.
After a few days, the template has now changed from buy on dips to a sell on rallies for the index. Manas, good morning. Thank you for joining in. What are the specific stocks that you're recommending now in a broader market? In a market like this where everything is in the red, be it pharma, metals, it's only banks like HDFC Bank that are bucking the trend.
So, Hormuz, because the trend is negative, I have two sell recommendations. First is a sell on Aarti Industries where stock has broken the key support of 385. Now, the next target would be around 360. So, take a short call here. Stop loss should be around 391. And second is a sell call on Birlasoft where, because most of the IT stocks are looking weak, Birlasoft has been making lower tops and lower bottoms from the level of around 560. Now, today we have seen a fresh breakdown. So, take a short call here. Stop loss should be around 381 and target would be around 350.
All right, Manas, thank you so much for sparing time and joining us today with your views on the index and specific stocks as well. By the way, just before we move ahead, the metal names too are taking it on the chin today. All constituents of the Nifty metal are down in the red, anywhere between 3 to 7%. Vedanta is leading the fall here, 7% lower there. Hindustan Copper down 7 as well. Nalco is down 6%. Hindalco down 6%, as is Tata Steel. So among the top frontline names, as Mangalam was mentioning, for the pharma space, the same is the story for the metal names as well, be it Hindalco, be it Tata Steel, all of them declining anywhere between 6 to 7%. But shifting focus to our special segment where we get you a few ideas for profit for Money Control Pro, Neha Dave of moneycontrol.com now joins us to talk about a stock that she is tracking closely.
Today's stock idea is CMS Infosystems, a market leader in the cash management business. The key question is that why consider a company in the cash management business at a time when the digital payments are hitting through the roof? Despite the exponential growth in the digital payments, the cash in circulation continues to grow, although at a moderate pace. For CMS, cash logistics is the largest segment wherein it caters to the banks and helps them manage cash for ATM and retail services. The top 3 private sector banks and the top 5 public sector banks are the company's clients in this segment. While CMS draws around 61% of its revenue from the cash logistics business, which is a steady business, it has been diversifying into other business lines. Managed services and technology solutions is another segment, and that contributes around 39% of the revenue, and it includes installation, operation and maintenance of brown label ATMs, providing control systems, software for banking automations and remote monitoring solutions that helps in smooth functioning of ATMs. The most encouraging has been a breakthrough into quick commerce platforms for providing remote monitoring solutions at their dark stores and warehouses. Last week, RBI announced a hike in the ATM interchange fees, which will come into effect from 1st May. This will incentivize banks to add and outsource more ATMs, thus benefiting CMS. Moreover, CMS can potentially benefit from the challenges faced by AGS Transact, which is the closest peer in the cash logistics business. In terms of valuation, the stock is currently trading at around 14 times earnings estimated for FY27, which is very attractive for a company that has a healthy balance sheet with no debt, strong management with a proven track record, and robust return ratios with return on equity of around 20%. Long-term investors should consider this stock for the portfolio.
All right, we take that point. With that, we'll slip into a short break. On the other side, get stock specific, a bunch of stocks moving around. We'll get you the reasons why.
हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos?
Couple of these telecom stocks doing extremely well. So we have Indus Towers, which has moved higher. Bharti Airtel has been doing well. Max Financial is the other one, which is higher by about 1% as well, recovered from the lows. But one of the stocks which is underperforming in today's trading session, though of lows, is Avenue Supermarts. And the biggest reason for that is no fireworks that the company reported in its fourth quarter update as well. So just to take you through the update, 16.6% is the growth that the company has reported in its standalone revenue, just shy of that 14,500 crore mark. The total stores at the end of this quarter was 415, implying that they added about 35 stores in the fourth quarter. And implied SSSG over the last 1 year seems like it is close to 3%. Why do I say that? Because between last year to now, the growth in number of stores has been close to around 13%. So 3 to 3.5% is the sort of same store sales growth, which the street is not very happy about. Importantly, what we need to track at a time when there is so much competition is the product mix. What's the kind of margins that they are making, the scale in DMart Ready, and the strategy of the new leader. Remember, come Feb 2026, we have Anshul Asawa, who takes over from Neville Narona. Brokerages have written, Citi has a sell call with a target of 3350 rupees. They said that the average revenue per store actually grew 3.1% in the fourth quarter versus 1 to 7% range that we saw in the previous 4 quarters. So that's telling you about the same store sales growth. They believe that throughput continues to be impacted by adverse product mix, and they save fair amount of risks to SSSG given competitive pressures, store additions itself, and the PE multiple at which the stock has been trading brings a lot of downside risks more than the upside risks. Morgan Stanley too has an underweight rating, a target of 3260 on DMart.
Significant correction from the top as well, right? DMart 2.5% lowers, one of the underperforming names from the highs that the broader markets had made. But the other one that's not doing well today, though, is Mazagon Dock, and that is under pressure after the government has decided to sell some stake in the company through the offer for sale mechanism. Upasna is joining in to tell us more on that. Upasna.
Well, as rightly pointed out by you, the government has announced an OFS of 4,900 crore. The government will sell up to 5% stake in the company via OFS, and mind you that the government is currently holding nearly about 85% stake in the company. Looking at the finer details, the OFS includes a base size of 2.8% and green shoe option of additional 2%. Now, OFS will open for non-retail investors on April 4th and for retail on April 7th. And as mentioned earlier, the floor price of the offer is at 2,525, which is at a discount of 8% from yesterday's closing price. But stock has corrected since the start and is down about 6.5% in today's trading session, nearing the floor price level. Now, let us look at the near-term triggers for the company. The company is technically one of the only companies qualified for the supply of P-75-1 submarines, and this order opportunity can be as high as 50,000 crores is what the street is eyeing. Additionally, company also has pending orders worth 25,000 crore, and if we look at the company's current order book, it stands around 3.5 lakh crore. And with this additional orders, it could scale up to as high as 3 times the current order book is what Antique has also estimated. So all in all eyes on this stock today.
Indeed, 6.5% lower is Mazagon Dock. The floor price is 25.25. So there's some bit of correction that the stock has also seen from the highs. There is Mazagon Dock. But the other one reacting to the back of its business updates is Angel One, and Vamakshi is joining in with more on that. A 5% lower on Angel One, Vamakshi.
Well, yes, Hormaz, the stock is tanking in trade today on the back of a mixed update from the company. But, of course, the negatives are outweighing the positives for this counter. Keep in mind, gross client additions stood at 4.7 lakh. This is a downtick of almost 4% on a month-on-month basis. And this is bad because the pace at which the gross client addition was happening has been slowing down over the last 3 months. Client base is steady at 3.1 crores. This is an uptick of 1.4% month-on-month. On the flip side, when you look at the average daily orders, they stood at 53.7 lakh. This is an uptick of 8%. Average daily turnover too saw very strong uptick, 23% up month-on-month at 36.38 lakh. This is in fact the highest level that we've seen since the month of November last year. On the flip side, when we look at the market share, that has taken a bit of a hit. Equity market share is down nearly 60 basis points. So is the F&O market share, down 60 basis points to 21.5%. And this is a decline that we're seeing in the F&O market share for the second consecutive month. The commodity market, on the other hand, has recovered after taking a sharp knock in the month of Feb. Commodity market share now stands at 57.9%, an uptick of almost 260 basis points month-on-month. So therefore, it's a mixed update, but the negatives outweigh the positives.
All right, Vamashi, thanks a lot for that. But the stock that is actually outperforming today, doing well and stemming the losses that we're seeing on the frontline index, in fact, leading the Nifty bank to outperform today is HDFC Bank. It's up around 1.5% off highs, but still holding up. Abhishek joins in with the fourth quarter business update and what it looked like for HDFC Bank. Abhishek.
Well, it's one of the best quarters that they have had in last 4 to 5 quarters with respect to the business growth rate that you are seeing on a sequential basis. Take a look at the deposit growth, nearly 5.9% over there on a sequential basis is one of the best that you are seeing in last 4 quarters. Now, the advances growth is at 4% quarter on quarter, which is one of the best that you are seeing in last 5 quarters. On the other hand, the CASA or the low-cost deposit momentum has been better than the deposit growth, and this is after many quarters that you are seeing over here. So 8.2% CASA growth on a sequential basis has helped the CASA ratio improve on a sequential basis as well. So CASA ratio has increased to 34.8% versus 34% in the previous quarter. So advances growth on a YOY basis is at 5.5%, but on a sequential basis is at 4%. The AUM growth over here is 7.7% YOY and about 3.3% on a sequential basis. Calculation shows that the CD ratio or the credit deposit ratio has declined both YOY and quarter on quarter, in line with what the management has been guiding, that they intend to lower the CD ratio from the current high levels, and that's been taking place. Back to you.
All right, Abhishek, thanks a lot for that. So that's about HDFC Bank. And in fact, all the stocks that we discussed right now, if you want some insightful analysis on that, if you missed this on the television and you want all of them on your hands, here's the CNBC-TV18 app. You get instant access to breaking news, in-depth articles, all the financial world updates at your fingertips, at your convenience, at your own sweet time as well. You can download it from the CNBC-TV18 app You can download it either from the Apple Store or the Google Play Store, or just scan that QR code, which gives you access to the app itself.
On the line. How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com.
Welcome back. Now, even as the index is 270 points lower, negotiation talks between the US and India are continuing. The government sources have said that while India remains concerned about tariffs, government sources suggested that there is no need for undue worry. Abhimanyu is here with all of those details. Abhimanyu.
Now, post-imposition of reciprocal tariffs by the United States, government sources have told CNBC-TV18 that while India is not happy with the tariffs, but no formal objection has also been made to the move. They also indicated that India already has an early mover advantage as it has already engaged in negotiations with the US for over 50 days for a bilateral trade agreement. Also, India is the only country where the US had sent a negotiation team for talks in the Trump 2.0 administration. Sources also cited several challenges in exports of shrimp, gems and jewelry, and also competition in the export of carpets compared to countries like Turkey. Opportunities have also been cited in several sectors like electronics due to tariffs on Vietnam and China, and for export of textiles due to the tariffs which have been announced for Bangladesh and Vietnam. Also, government sources added that reciprocal tariffs which have been imposed are based on trade deficits the US has with respective countries, and country-specific tariffs are largely aimed at generating revenue as well as creating negotiating leverage for trade ties and trade deals with several countries. Sectoral tariffs have been placed higher as per sources to benefit domestic industry in the United States, though the cost of production will increase in the United States, which is already not too competitive in terms of manufacturing in some sectors. It remains to be seen how the situation is going to pan out with respect to the impact of reciprocal tariffs on India as well as other countries.
All right. In fact, let's listen into Mark Zandi of Moody's, what he had to say about the reciprocal tariffs and what all our experts are making of this as well.
Well, if the reciprocal tariffs are implemented in full, I would expect some retaliation from countries abroad. I don't think they're going to sit on their hands. So the combination of those two things will result in a recession, an economic recession. It's a tax on American consumers. The bulk of the tariff increases will fall on them. Businesses that import product will have to pay more, which will hurt their profitability and thus their investment in hiring. If I'm right about the economy and the impacts, I do think the president will ultimately react to that and hopefully will pull back and declare victory and move on. And if so, we can avoid an outright recession. But time is running out. He's going to need to pivot here pretty quickly. Otherwise, I think the U.S. economy is going to go into recession and take the entire global economy with it. I don't think any country in the world is going to get through this without some significant hit to economic growth. Some countries are going to navigate through better than others. India's got a lot of it's a resilient economy. It's got a lot going for it, and I think should be able to weather the storm reasonably well.
And we also spoke to Neelkant Mishra of Axis Capital and Sameer Arora of Helios on this move and their reactions to this. Listen.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets. I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6% of volatility that
the first thing in a big picture sense, although, in our long only fund, we are fully invested and all that. But I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze the stock, but whether that day there is net selling or not by FIIs. See, the thing is from an economy point of view, it's not a big deal because we don't have big scale of imports and exports. You have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you will get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money. You may lose less. You may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US.
Take that point entirely coming in from Sameer Arora. When things go down, the only thing that goes up is the correlation between them and not necessarily isolation. The Nifty, though, has ameliorated some of its losses from the time we started the show, but that's not saying much because when we started the show, it was down 300 points. Now it's down 278. With that, Hormaz me take your leave on this edition of Chartbusters. The team of Trading Hour comes up next.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
My fellow Americans, this is Liberation Day. Waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal.
Good morning. Welcome to Friday's edition of Trading Hour. Considering the Trump tariff tantrum, we are going to say, thank God it's Friday. I'm Reema Tendulkar. With me is Vivek Iyer, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio. And what we have on our hands at 11 o'clock is that all global markets are sinking on the back of these global jitters, Trump-induced, the Trump tariffs hurting, the sentiment across all markets. The Nifty is now just below 23,000, though just maybe in the last 30 minutes, we've seen the Nifty recover a tad bit, a couple of points intraday. That will come up for you on your screen. But benchmark indices down 1% for the week so far. The Nifty's lost closer to 2.5%, while the mid-cap index has lost nearly about a little less than that. So that's the picture when it comes to the benchmark indices. Outside of that, it's the Asian markets that we should take stock of. The Japanese index is down nearly 4%. The Korean markets are down 2%. Hong Kong and China, remember, are shut today. The mid and small caps are, bearing the bigger brunt of the selling pressure. The mid-cap index is down more than 2%. The small-cap index is down 3%. And look at the advanced decline ratio. Yesterday, we were celebrating, despite all the global volatility and chaos, the advanced decline ratio was positive. But today, it's completely reversed. 2,100 stocks in the red for about 430 stocks in the green. Big gap between the stocks advancing and declining stocks. And on the way down, it's metals. Again, the fear is global economy tipping into a recession. So metals is weak, IT is weak, and pharma. Look at the way pharma collapsed in a matter of minutes after Trump said that pharma tariffs are perhaps coming very soon.
Good morning, Reema. Absolutely. So yesterday, the entire pharma bag, saw a rally on the back of the fact that there were no tariffs being implied. And there was a little bit of a cool-off towards the end of the session in most of the pharma names yesterday. But today, there are fresh bites from Trump himself indicating that there are going to be tariffs on pharma, and tariffs will be at levels never seen before. On the back of that, the entire pharma index. Look at names like Dr. Reddy, Lupin, Cipla, Sun Pharma, Loris Labs. All of these, Aurobindo Pharma at one point of time was actually at the lower circuit, the first lower circuit of 10%. They've all recovered a little bit, but the entire generic pack today is under significant pressure. What's actually helped the recovery, especially in the last half hour, is the fact that consumption stocks have seen a recovery. So names like Colgate-Palmolive, names like Nestle, names like ITC, Britannia, these are some of the stocks that have actually aided the recovery as far as markets are concerned. And financials like Bajaj Finance and HDFC Bank too have helped prop the Nifty slightly higher after the kind of intense sell-off that we saw in just an hour ago. But the most important story of the day, Reema, has to be pharma. Remember, pharma stocks fall following US President Donald Trump's comments on tariffs for the sector. He said that pharma tariffs are under review and will come in at levels never seen before. Let's listen in to what he had to say.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
Okay, let's go across to Vinny now to understand the likely impact these tariffs, potential tariffs, could have in the exposure that Indian companies have to the US.
Latest update that has come in where Trump made some comments coming in on the pharmaceutical space, saying that they will be announcing tariffs in the near future and not the distant future. And because of that, we're seeing pharma stocks are in focus today. Now, let's take a recap of what is currently charged by India on US. So India charges 10% tariff on pharma imports. US currently is not charging any import duty on the products for Indian category and Indian companies. So yes, as of now, the charge is nil. Now, what Trump wants to do, wants to charge them with a reciprocal tariff on this front. So it will be 10% or more than that. That's something that we're keeping an eye out on. What is the risk and who is at risk in terms of pharma companies? The main risk comes in for generic formulation players and CMO players in the pharma space, which is at the highest risk. The exposure of US generic companies is quite high to Indian companies to US generics is quite high, and that is why we will see that impact coming in. One-time hit in terms of EBITDA that we could see coming in, a negative impact would be around 9 to 12%. This is according to what we have a note coming in from Citi. Now, obviously, let's talk about the exposure. Gland Pharma has an exposure of 50%. So the impact on its EBITDA would be in the range of 8 to 10%. Aurobindo Pharma, 48% exposure to the US, and that would be in the range of 12 to 13%, I beg your pardon, in terms of the hit on the EBITDA front. Dr. Reddy's in the 10 to 12% range, 47% exposure there. Zydus, 46% exposure, so 8 to 10%. Lupin, Cipla, Sun Pharma and Torrent Pharma, a lesser exposure is what they have, and the impact on the EBITDA is lower. Now, why is that so? Because these companies have facilities in the US. Cipla, Dr. Reddy's, Lupin, Syngene, Piramal Pharma, Sai Life Sciences, all of these have exposure, means in terms of facilities that they have in the US, and that is why they're already set up in terms of the facility there. So maybe they could start importing from that facility. Instead of importing from India, you can sell from those facilities, which doesn't charge as much duty as what it would be charged from the Indian manufacturing facility if imported there. And that is why lesser impact on these companies on the EBITDA front as well.
Thank you very much for that. To take the discussion forward, Nimish Mehta, founder research at Delta Advisors, and Aditya Khemka, fund manager at Incred Asset Management, join in on the show. Gentlemen, thank you very much for joining in. Even yesterday we knew, right, although it got exempt, we knew that future tariffs on pharma are not entirely ruled out, and now the president has said it's coming and in not so distant future. So Nimish, first share your thoughts, right? What could be the base scenario and what will be the impact on Indian pharma?
Thank you for having me on the show. What I understand is that, the pharma related tariffs are not strictly going to be like the reciprocal tariff that we have seen for other sectors. It is more to do with safeguarding their essential product supply, then also to probably safeguard some of the technology that otherwise gets shifted outside of America. So this is more like, Atmanirbhar Bharat kind of a thing, and less like a reciprocal tariff, which is a reciprocal tariff, I understand, is just evening the differences between tariffs of two countries, something with, US and the other country. So in this case, the focus is likely to be product specific and essentially on products which are supposed to be essential medicines for the US market. And that's how I feel it is likely to happen. And in that case, China would be one of the biggest impact, losers in a way. And indirectly, that might also even help Indian companies. That's my first view on that.
Okay, so which products, Nimish, to your mind, would be most affected or would come under the purview of these tax? And you're saying we're not going to get a baseline tariff, even if it's, say, assume a 10%. You don't think that's the likely scenario? And then coming back to the point, product specific, which products, and why do you think China is going to be impacted more?
So first of all, China, because, most of the essential products or the APIs are being supplied by China. And that would include, even the essential products is what I believe. And that is, and we also know that there was, even before Trump came in, we already had a Biosecure Act, which was targeting China and essentially to ensure that the technology doesn't go away. So China, one, has high CDMO exposure, and two, because their APIs are dominating the market, including that of US market. And that's why that is going to be of, higher impact to them. Second, I particularly don't know which are the products which are considered as essential products for the US market. But if I may to make some guess, probably some cancer medicines and, cardiovascular medicines and stuff like that might probably be under pressure. But I really don't have that information as to which are the essential medicines considered by the US market.
Right. Aditya, let's bring you also into the conversation. Yesterday morning you joined us and you said that pharma tariffs are not yet being imposed. The relief that we enjoyed yesterday was very, very short-lived. Aditya, your first take on this, and also if you could help us, if you've done any sensitivity analysis in terms of, which are the companies you expect or which are the players that you expect to be most impacted. Will it be the generic players? Will it be the CDMO players? Or will it be the specialty pharma players?
Hi, good morning and thanks for having me. So just to begin with, I think the most impacted players will be generic players. The reason being twofold. Number one, the volumes of generics that goes from India is significantly higher than the volume of innovator products or specialty products or API for that matter that go from India to the United States shows. So the highest impact will probably be on the generic players. Number two, because these generic players don't have any bargaining power on the table. It's a commoditized product that they sell. Every player has the same product. So when it comes to the bargaining table with the buyer or with the government as such, they don't have any bargaining power on their side to sort of discuss any meaningful outcomes for themselves. So the pecking order would be mostly impacted would be generics, followed by API, CDMO, and lastly the specialty guys, because the specialty guys have the most bargaining power. They have patented products. So those products will have, help them to get more say into the matter compared to the generic guys.
Any tariff, whatever form it may come in, has to be borne by someone, Aditya, whether it's the end consumer, whether it's the distributor or the manufacturer. Now let's talk about generics to begin with, since they might be potentially the worst affected to your mind. They already add wafer thin margins. So what are the current margins? And now that you have to do some sort of an analysis, right? Because you're looking into the future and the future is all unknown. But what could be the potential impact? How much will they have to bear? And therefore the EPS estimates. And in that context, then how do the stocks look after the correction?
Yeah, look, so it's very, very difficult for us to quantify what margins these companies make in generics because they don't report these margins separately as such. They report a consolidated margin. What I can tell you is that if there are three potential buyers in US, wholesalers in US that buy from almost 300 plus pharma companies from India. And, the products are basically commoditized. There is no differentiation from one manufacturer's product to the other. So if you just think of the bargaining power tilt here, the tilt is clearly lying with the three buyers versus the 300 plus suppliers. So in that scenario, who bears the brunt? Economics would tell us it is more likely to be the pharma companies that will, maybe not completely, but partially will have to bear the brunt. And then also so if you look at the complete supply chain, right? So there is the insurer, there is the wholesaler, and then there is the manufacturer. I think the most fragmented industry in any supply chain bears most of the brunt. And in this situation, the most fragmented industry is the supplier, which is the Indian pharma manufacturers. So if you have to sort of put me in a corner and put a gun to my head and ask who will bear the most of the brunt, the economics will tell us it has probably got to be the pharma manufacturer.
Right, and which is why we're seeing the kind of impact on the pharma stocks today. Nimesh, just throwing a couple of phrases at you. Number one, generic price erosion, something that Indian pharma companies have been seeing for quite a while. Second is, a lot of companies are talking about reshoring back to the USA. And number three, something that you mentioned, relative better placed that India is compared to China. On all of this, what is your view, especially the fact that reshoring is expected to take quite a bit of time, right?
Correct. So, yeah, what I understand is that the reaction that we see today on the stock market to me looks a little overdone because, yes, there is a lot of competition in the generic segment, and I fully agree. But, the primary reason of this competition or the pricing pressure we see in generic is also because of Indian pharma manufacturers. So there are so many manufacturers, which is itself is, kind of drawing the prices down in a normal market scenario. But if you look at Indian pharma as a consolidated unit, so their bargaining power is going to be very high. So in toto, if there is one company who is, getting impacted because of the tariff, the most likely scenario is that all of their competitors or most of their competitors will also be in the same boat. So from that perspective, I believe that the generic, prices may just go up, and in case where they just, the generics exit the market, then there is also a fear of having shortages in the market. That's what we have seen, for example, in the last few years, where GMP regulations became stricter, and you see so many, factories actually, under trouble, and that is what was driving shortages and also eventually the prices up. So my sense is that Indian pharma per se is kind of relatively better poised, and especially when you compare it with their counterparts in China. So that way, I think, yes, purely speaking, if you put a number in the Excel sheet and say, here is the profitability coming down, well, this is what the reaction might be. But if you say that, right. So it's a non-discretionary sector where you can't just avoid consumption.
Right. Thank you so much, Nimesh, as well as Aditya, for joining us. It's still a developing story. We don't know the quantum of tariffs. We don't know when the tariffs will come. But Indian pharma stocks today are reacting quite sharply. Thank you once again for joining us. Let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
That, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half.
Welcome back to Trading Hour. Well, as promised, we'll now shift focus to the commodity space. Manisha joins in, and today we are focusing on crude.
Well, yes, we are looking at crude oil prices and various other commodities as well, Vivek, because everything has seen a very sharp decline on the lower side. Yesterday, during the day, in all time zones, whether it was Asia and then Europe and then US markets, we've seen a decline. And that has just seen a more repeat of that happening in Asia right now. So the crude oil prices fell 6% yesterday, and we're looking at another percentage of a decline in the Asian markets on your screens right now. Well, three things here. One, of course, it is about the fears of global trade war after the kind of tariffs that we have seen come in. The world believes that this could lead to weaker oil demand going forward for 2025. The second point is the US inventories, which have surged way more than what the street was anticipating. And the third thing is about OPEC and allies, which have decided to increase output by 411 barrels per day starting the month of May. And they could increase it in the June, and this is much higher, 3 times more than what the street was actually calculating. So always you have seen the crude oil prices decline because of that. But it's not just crude. Take a look at the gold prices, 1.5% of decline overnight, and gold has continued to see a further decline. If you look at the gold range yesterday, we saw an all-time high of 3,160 on the higher side, and then 3,060 by the New York Times yesterday. So it was $100 of a range, and we seem to be holding around 3,100 at this point in time. The other thing is about silver, which also saw a decline of 5.5% overnight. Not just silver, platinum declined 4% to a 2.5-month lows. Silver is trading at a 1-month lows. Copper prices have continued to decline as well, 2% of a cut coming in for that one, 3-week lows there. And then the agriculture industrial commodities like cotton for textiles and then rubber for various things also saw 4% of a cut coming in, and we are looking at multi-month lows onto that one as well. Many of these industrial commodities also have declined because you've seen a bigger chunk of tariffs coming on China, which is the major producer and consumer for many of these commodities. So a major hit coming in because of that as well.
Okay, commodities hit as Trump has threatened demand and the economy, and even gold, has slipped overnight. Sometimes you sell not what you want, but what you can to lock in the profits. Manisha, thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in with his top trading bets.
countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years. And we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
Welcome back. We've managed to get our head above the 23,000 mark, but it's still a steep cut of 250 points. Sensex down 650 points. Mid-cap index deep in the red. 1,200 points gone on the mid-cap index. Mitesh is now back with us for a quick technical check on the markets. Mitesh?
Yeah. I think the biggest worry for me is that the Nifty is, below 23,100. And if we get a closing below that, while there is mild support at 22,950, which is where, we have made a lower 22,920. But broadly, that could, a closing below 23,100 could suggest a breakdown and possibly more declines in the coming times. And we could then be looking at a test of 22,800 and in the worst case scenario, 22,600 as well. So, let's see how it pans out till the end of the day. But this is not a very positive sign. The good thing is that the bank Nifty is comfortably placed on the upper end. And a move above 51,800 could add fillip, and that could, in turn influence Nifty as well. So both the investors watching closely, but trading with stock-specific biases.
Mitesh, your individual picks and also a view on the pharma sector, it's seen quite a bit of a knock. Do you feel some of these stocks can see a bit of a bounce back?
So on the stock side, I have a buy on Colgate-Palmolive with a stop at about 24.14 for targets of around 2,500. That's one stock which is braving this fall very well, and the setup has also improved dramatically today. Strong buy signals on the intraday charts as well. So that's a positive stock. The other one is a the other one is a sell on Infosys with a stop at about 14.71 for targets of 14.20. As far as pharma is concerned, we had this slightly positive sentiment when the tariffs were announced, but then today there's some kind of a breakdown on most of the pharma stocks. So not very positive over there. The one which I like is Glenmark. If it can hold above 1470, 1475 zones on the closing basis, if that happens, then you might see a bounce back there.
Thank you so much, Mitesh, for joining us, giving us a view on the markets, your individual stock-specific ideas, and also your view on the pharma pack. But we'll now take a short break. Up next, we'll discuss market fundamentals with Madana Gopal and Ramu from Sundaram Alternate Assets.
Tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair.
Welcome back to Trading Hour. Well, the brief rebound that we saw in the market has once again ensured that there is further selling pressure. What's now taken a fresh dip is actually the Nifty IT pack. The whole host of mid-cap IT stocks especially has seen significant selling pressure, and even the large cap names are seeing selling pressure. Names like TCS, Tech Mahindra are the ones that are most impacted, and along with that persistent yesterday that saw almost a 10% dip, today is down another 5%. Names like Cyan 2 are under significant pressure in today's trading session. But as promised, Madana Gopalan Ramu from Sundaram Alternate Assets joins us to discuss market fundamentals and his top sectoral picks. Thank you so much, Mr. Ramu, for joining us. First up, your view on the tariffs, which are the sectors now you feel post yesterday's sell-off look attractive, and which are the sectors you will avoid post this particular development?
The way we are trying to keep it is very simple. We are trying to focus the stocks that we own and what is the earnings growth in those stocks. The majority of our allocation is in domestic driven, domestic capex and domestic consumption driven. We have very little weights, we are underweight on both IT and pharma, which is right now being the most talked about sectors at this point of time. So to that extent, does it worry what is happening around us at this point? Not really. We have some exposures, but they are very low compared to the overall. We are underweight in those spaces. We will continue to keep looking at these two spaces. We feel so that the base case that we are assuming today is a lot of noise will be there. But what eventually happens in these two sectors might be the end result might be much lower than the fear that is getting created at this point. It's too early to say where we are heading to, but there is certain contradicting factors here to really feel that Mr. Trump's administration will achieve this inflation target, growth target, along with this tariff and trade surplus thing that they're trying to address. It's contradictory in nature, right? So it's not going to, we probably seeing a fear that is getting into the market. The end result might be much different. So we have cash in our portfolios at this point of time, and we are slowly evaluating opportunities in sectors where this fear is creating value zones. We are not in an urgency, but we definitely feel the end result might be very different. And therefore, you have to start looking at these sectors wherever there could be value zones created. But there is no urgency here. I think this fear can give you opportunity to enter into some of these sectors at a really good value.
So the value sectors, which are IT and pharma, and how far are we from getting to the value zone?
Again, I said, I think this noise will take some more time to kind of settle down, because what the negotiation that is being talked about, both on the tariff side as well as on the trade surplus side, while on the tariff side, a country like India has nothing big to lose, in our opinion, from our numbers. But on the trade surplus side, we can still address it if given a certain time period, like probably over a next 2-3 year time period. But imagining the same thing to happen for Europe and Japan and other countries, it looks very difficult. So to really decide on what will happen to the global economy because of all this noise, it's beyond our, I think, beyond our ability to think through. But what we are saying is keep it simple, work on your domestic companies, wherever you have exposures, you can be there, because I don't think domestic economic growth is suffering because of all this to a large extent. And we have large exposures there. We have cash, and we are slowly evaluating IT and pharma from that perspective, particularly IT. We feel that 10 to 15% correction in some of very good growth stocks, we can start getting some entry point. But I think we are not in an urgency here. The base case that we are assuming is things will not be dramatically different from what they are right now from a demand perspective in these sectors, while this noise can throw you opportunity to make good entry points.
Understand that. Within IT, would you look at large caps? Would you look at the mid-cap names? And, in terms of sectors, would you look at IT companies with exposure to the BFSI or to the auto space? Where would your preference lie?
maybe mid caps. 2-3 ideas we have always played, and because of valuations we exited these ideas last year. But if we are able to get them at a really good bargain, we don't mind getting into them into these names, because there the growth is pretty good. With large caps, we have worry that the growth can be structurally much lower. It can be in single digit for a long period to come. But with some of these mid cap names, the growth has been pretty interesting, and we have sold them, and they were trading at almost like 50 times plus sort of valuation. If you can get them at less than 30 times sort of a valuation, why not? Unless you have a different view on their demand scenario going forward, that's why I said we feel that these are certain sectors where to really think that it will shift to US is a very big call, and I think the end result might be very different.
Okay, and in terms of pharma, what is it that you're doing? Do you like the API names? Do you like the generic names, or is it a complete avoid? Before you answer that, Mr. Ramu, our ticker team just alerts that as you can see at the bottom of your screen, Union Bank has actually gone ahead and given its Q4 quarterly update, and the company has missed both its loan growth as well as deposit guidance by a significant margin. It has missed even the revised guidance that it had given mid-year, and the loan growth at 8.6% versus a guidance of around 13%. A significant miss coming in over there. Mr. Ramu, while you answer the question on pharma, are you also worried about the BFSI space, or do you find value there?
No, I think BFSI, it's a purely domestic story, right? And I don't think there is a big growth. The slowdown in the economy in the first half of this year is now recovering back. And a lot of effort has been taken by the government, both monetary side as well as fiscal side, to support the growth and consumption. So we feel that domestic consumption will come back in FY26, particularly in the second half. Therefore, BFSI consumption both looks interesting. Within BFSI, we have always been playing only NBFCs. So in NBFCs, given the regulatory related noise that was there last year, and therefore the valuations were lower, this year we are seeing growth is not slowing down. We saw the Bajaj Finance number yesterday, right? The growth is not slowing down. We are hearing the similar sort of outlook from other companies that we own as well. So growth is not slowing down. The credit cost issue is it's getting resolved slowly and steadily, which got gone into in unsecured loan and MFI loan. That is also getting resolved now. With all this, I don't think we can be very negative. And given the noise that is surrounding the IT and pharma space, which forms almost 20% of the index, if I'm right. So you can't go so negative on the financial space. And within financial space, NBFCs likely to deliver much better growth as well as earnings growth, loan growth as well as earnings growth. So that's a space that I'm not too much worried at this point of time.
Mr. Ramu, any specific views, especially when it comes to some of the old economy stocks? So you did speak about domestic theme, something that you like. So do you like capital goods name, utility names? What are your preferences there?
We are playing one as NBFC, as I highlighted to you, because this is a play on the income growth in the country, per capita income growth. Similarly, we have a similar view based on per capita income growth. Consumer discretionary looks interesting, and with the government taking effort to support the consumption this year with tax cuts, and also there could be some rationalization on GST also we hear, which if it happens, it's again a good boost. So all this are leading to a situation that domestic consumption will be focus area for the government. Government spending also has improved, right? So consumption looks interesting. Consumer discretionary within that looks interesting to us, and we have been always bullish on that space. Within infra space, power sector looks pretty interesting. I think the power sector capacity creation slowed down during COVID. It is not coming back in an urgency. There is capacity constraint globally as well as in India. And this will take a lot of time to get addressed. And Chinese competition is not there after so many years of this sector getting impacted. So power sector equipment manufacturers, we are bullish, and it is reflecting in the numbers of these companies. You see the Q3 earnings growth when the slowdown in the earnings of Nifty is almost like 5% growth, right? So our portfolio delivered almost 20% growth in terms of earnings. So it shows our portfolio is positioned towards growth sectors, and the earnings growth is still continuing. To that extent, again, to repeat, if you are focused on the stocks that you own in the portfolio and their earnings growth, and if it is more domestic driven,
Right, Mr. Rami, right.
It's not something very easy.
Right, we get that. Thank you so much for joining us and giving us your take on the markets on a day that's once again marked by quite a bit of volatility. Time now for a short break. We'll put the spotlight on the IT sector and the likely impact of Trump's tariffs on the quarterly performance of Indian IT companies.
I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है, भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि बड़े
Welcome back to Trading Hour. Well, like we just highlighted, Union Bank, the company put out its quarterly update, and that particular stock and that company has actually gone ahead and missed its guidance, the stock now at the day's lowest point. But the Indian IT sector is the one that we are focusing on. Rima is at the wall to explain the impact of the tariffs.
Thank you very much for that. So I've collated all the brokerages and how they've assessed the potential impact of Trump tariff on the Indian IT sector. Now, Bernstein highlights the near-term risk is a potential recession in the US or global economy that can delay IT spending and result in tightening of the tech budgets. But they've also come out with a worst-case scenario, and that is we could see a deep global recession similar to what happened in 2008 with the financial crisis. And back then, the major IT services saw a significant revenue decline. So, for instance, TCS's revenues were down 6%, Accenture was down 13%, all in Q4 of calendar year 2008. And we're looking at these numbers on a quarter-on-quarter basis. On an average, it was about a 10% sequential decline. Not that Bernstein expects a GFC-like situation once again, but they do expect IT growth to remain flat in FY26, contrary to their earlier expectation of some sort of a recovery post FY25. Now, given the market volatility, their preference is with quality large cap. So Infosys is their top pick. They also like Coforge in the mid-cap space, and the sector that they're underweight, that's the auto ER&D companies. So names like LTTS and Tata Elxsi. Now moving on to JP Morgan, and they're asking the critical question that everyone wants to know. When will the sector bottom out? Now they've identified a bear case scenario, which is no growth for companies like Infosys, TCS, HCLTech in FY26, and also no margin expansion. That, according to their mind, if this plays out, bear case, we're looking at a 9 to 11% EPS cut in FY25, leading to a potential downside of 7% for TCS, 6% for Infosys, and up to 14% for HCLTech. Mid-caps could see an even steeper impact. So according to their bear case analysis, 13% stock price decline for Coforge, going up to 25% for Persistent. So the question is that when is the right time to buy? Well, they believe not before earnings, because a conservative guidance could push the stock prices lower, making a post-earnings entry point perhaps a better entry point. Let the stock prices fall post-earnings. JP Morgan does suggest a lighter IT positioning, but they remain overweight on Infosys and mid-cap growth company. Kotak is worried that this uncertainty at the start of the year will delay spending, and it will affect the June quarter, which is your seasonally strong quarter. They once again cut the revenue and EPS estimates for IT companies after cutting it as recently as March of 2025, baking in the US tariffs. And they're saying that FY26 could even be worse than FY25. And their growth estimates are up for you on your screen. What Kotak Institutional Equity expects in terms of growth rates, expected to be slightly lower than FY25. Given the higher scrutiny on guidance, they say it may be even prudent on the part of companies to defer the guidance until there is more certainty on the demand environment, or restrict the guidance to next quarter where there is a higher degree of visibility. A recession, to their mind, means that more downside risk exists in stocks, while a slowdown will lead to reasonable upsides. And finally, Macquarie, on the other hand, they see the market reaction is overdone. Investors with a long-term outlook should use the opportunity to add to positions in Indian IT. So that's the picture and the way Indian IT has moved over the last 2 days and what brokerages are saying. Sandeep Agarwal, fund manager at Sovilo Investment Managers, is now with us on the show. Sandeep, your first thoughts on 4% downside in IT stocks, 2% now. What is it that you anticipate?
No, so Rima, you have very nicely, said most of it. But let me say this, that, we should see the Indian IT space in three directions now. First of all, if it was tariff, then you can pass on some cost pressures to the client and you can find out a way. But here, it is not about tariffs. It is about global growth coming down. And you know that global growth coming down for a sector which has 80-90% exposure to exports is a very, very scary thing. And secondly, the domestic exposure, whatever they have, they don't make much money in that. So, there is a double challenge. There is a growth challenge and there is a margin challenge. So both the challenges are there. Additionally, remember that till now, neither tariffs have been announced nor any cost of doing business increase has been announced. So since November, when, presidential elections were happening, that time we have been saying consistently that, the cost of doing business can definitely go up. Although you can't execute this services project in US for sure, but there could be more cost implications. So that is still not there. Tariff is still not there. And right now we are only dealing with the uncertainty related to growth. So I think, there could be multiple legs of disappointment. One, growth, second, margin pressure, and third, uncertainty. So I believe that, there is still downside here. And I will not call this bottom. In my view, probably once guidance starts coming in, which I believe that, the companies must give some guidance, even if it is 0%, because then at least it will remove the third risk, that is the uncertainty risk, at least from the picture. Problem is that if they don't issue a guidance, then the uncertainty risk still persists. So my view is that the EPS can actually decline after a long period of time in FY26, and that is what I'm fearing.
But Sandeep, the last time we had this kind of an uncertainty and growth scare was in 2008 and then COVID. Are we in a similar situation for Indian IT right now?
So, in COVID, what happened, it was very short-lived and immediately people realized that, you have to do work from home. So right now, the situation is totally different. In COVID, it was a pandemic kind of situation where you're not able to go and work, but you can do remote work. Right now, the problem is whether there is a demand. And Rima, very well that, one or two large contracts getting postponed or cancelled or in abeyance, any such announcement will bring down the multiples of the sector in a very significant way. We have seen that in past with RBS and other contracts. So my worry is that any large contract cancellation, non-issuance of guidance, decline in quarterly number, any of this stuff will bring down the multiples substantially because the multiples are very, very high still, given the growth prospect. The PEG ratios for large caps are like 4-5 times. The PEG ratio for mid caps are like 8-9 times. That is very, very high. So we definitely need to be very careful because the growth will come down substantially if uncertainty doesn't go. And the multiples have not come down to that extent.
Okay. So what is the growth estimate for FY26, say for large cap IT names on an average? And how much higher are the PE multiples? My point is, what should be the growth rate for FY26 to your mind? And what are the appropriate PE multiples you should ascribe for that kind of a growth rate? And how much higher are we currently? What's the extent of derating?
So I think, for the large cap, expecting beyond 4-5% growth for any of the large cap will be very, very risky. I think that is the max. So you should expect from -2% to 5% for large caps. I think that is a decent range. And for high growing mid caps and small cap, maybe, up to 10-12%. Now, given that the multiples are where they are expensive. In my view, if my growth will be below 5%, I should not go beyond 16 to 18 multiple. That also because this is a cash-rich sector, there is a dividend support and all those things. And if the growth is like 10-12%, why should I go beyond 25-28 times 1 year forward? And I think right now the multiples are nowhere close to that. So I believe that, there is a risk to this numbers and multiple level of risk. Remember this, what we are talking about is only growth. Now, if, cost of doing business goes up and margin can definitely take a hit because remember in IT, the nature of the business is such that 70-80% revenue is given, means it is always there because you are servicing contracts for long term. but 20% of the business has to be new, and additionally for 5% growth you need 5% new business. So 25-30% business in this environment, new in such uncertain environment profitably is a really tough task. And you can't postpone your wage hikes for a long period of time. And even if you postpone wage hike, there are other costs which are like rent and other things which can't be postponed. Airlines, hotels, you are seeing the travel costs are going up substantially. So margins will also be under pressure. So there is double whammy on that.
Okay, so large cap IT companies to see a max growth of 4 to 5%, and therefore the PE multiple they should be trading at fair value should be 16-18 times. And currently, most of the IT companies are above 20, going up to about 23-24 times for TCS. And even for high-growing mid-cap companies, PE multiple should not be more than 25 times. So Sandeep, the entire IT space is in a void, or are there any stocks that you like? What are you advising your clients? And especially if they have, positioning in tech stocks already, should they be looking to sell right now?
So, a major damage has happened in last 5-6 months. We are in probably the last leg of damage where, another 10-15% correction can happen, and we can't say it for all these stocks. So, in my view, if someone has positioning, better to stay for long term. If someone wants to enter, maybe, around the results when all the worst is built in, then you can start nibbling and build positions. We still prefer, ER&D, but as you rightly mentioned, ER&D stocks are still very, very expensive. I am not at all comfortable to pay more than 25 times for even ER&D stocks, although they will grow at double the rate of the IT services stocks. So for long term, they will make a lot of money. But I think, there is uncertainty. The problem is not growth. Once, companies say that, okay, we are going to grow at this rate, then you can do the modeling. Right now, there is uncertainty on growth, there is uncertainty on margin, and there is uncertainty on cost of doing business. So 3 uncertainties, how to assign multiple and all this. So it is a really challenging scenario right now.
We'll keep coming to you to get advice for our viewers on what they should be doing right now. But thank you, Sandeep. This was an enlightening conversation. And big cuts. Coforge down 6%, Persistent down 5.5%, Hexaware another 5% gone, Birla Soft literally no place to hide today in IT. Get into a break. On the other side, we'll invite the management of Naukri.com to discuss the hiring trends seen in the month of March.
खराब हिंदू कौन बड़ा है? और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं. जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक. अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना. इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के. हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है. आपके यहां जरा भी देर नहीं लगेगी. मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता.
अध्यक्ष महोदय क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं. अध्यक्ष महोदय जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back to Trading Hour. Well, the sell-off has intensified. The small cap index now down 2.8%. But one particular stock, especially that's seen a bit of a sell-off in the last two trading sessions, is InfoEdge or Naukri. Remember, Naukri.com recently released their JobsPeak index for the month of March. The Indian job market saw a slight decline in hiring on a year-on-year basis. The index also highlights that a 4% decline was seen in overall fresher hiring. To discuss more on this, we are joined by Pawan Goel, Chief Business Officer at Naukri.com. Thank you so much, Pawan, for joining us. First up, give us a sense of how the month, panned by, and also how the quarter panned by, especially in terms of hiring trends.
Yeah, so from let me take the month first. This is the March JobsPeak. Now, this month JobsPeak index is flattish, so I think down -1, but it's colored a lot because Holi was there in our measurement period this year, but it was not there in our last year. So if you were to adjust for the Holi impact, we don't do that in our index, but if you adjust for it, it would have been normally 6, 7, 8% point up. So fundamentally, the white collar hiring market in March has been better than last year if you were to informally adjust for Holi. Though our index is flat because of the measurement period where Holi was there this year, but not last year. Okay, so that's one thing that I would want to call out. Second thing, if you just adjust for that, IT, which shows flattish, would be up 6, 7 points for, I can't say the exact number, but you can say it's in the single digit growth in IT. Now, other trend that we see in March is, which has been secular, that non-IT hiring has been better than IT hiring, and which has been a trend which is sustained for some time. The second thing we also continue to see is smaller city growth, though of course from a smaller base, they are still higher compared to the metros. So those are the trends that we continue to see. Now, February to March, one thing, there are a couple of sectors where things have changed. So if we look at travel, tourism, hospitality, in February it was growing phenomenally, but given the Holi season as well as perhaps the Mahakumbh is behind us, that's gone down from 20 to -10%. Defense and government defense segment, that has seen a substantial growth. So that was around flattish last month, but now it is in 20%. The other secular trends, which I think we've talked about earlier, AI, ML, again, continues to grow at a very, very fast clip. It is in the high 20s, high 30s, depending on the specific skills, that continues to be there.
Pawan, on IT, X of the holiday impact, growth would have been approximately?
It's hard to say because, but I would guess somewhere in the 5 to 10% range.
5 to 10%. And what have you picked up in terms of whether this will sustain? Because there is this whole cloud of uncertainty on IT now, on tech budgets, IT spending, given the Trump tariffs. What are you hearing on that front, and whether this IT growth will sustain in the coming months?
So prediction is hard for us to do, but what I can say is we don't see any evidence of that yet on our platform. You're absolutely right about the overhang of the tariffs and its impact on the overall economy and subsequent impact on IT jobs. So then the short term, very, very hard for us to predict. But if you look in past, in the past downturns, there's a downward trend followed by a substantial upward swing for IT in India, if you look at the last two downturns.
This number about, fresher hiring seeing a 4% decline in the month of March, is that a trend which has been there in the past and it's just persisting, or is it something new? And how worrying is it?
So fresher hiring has been subdued for a fairly long time. Now, there is fresher hiring, there is growth there are pockets of growth, specifically in non-IT. There is sectors which are hiring freshers. But overall, in a secular way, there's more and more demand for experienced people. So if you take 16 plus years experience, there the growth is in double digits. As you start coming down, the growth starts coming down. And as you come to fresher, it comes to decline. And this trend has persisted for several quarters now. And this is certainly challenging for graduates entering the workforce.
So this weak hiring numbers for freshers, is it restricted to the tech sector or is it widespread and more broad-based?
It is more in the IT space. There are pockets of growth in non-IT. I wouldn't say it's secular even in non-IT, but there are certain sectors if I were to bring in. So for example, architecture, KPO research, facility management, media and entertainment, these are all seeing double-digit hiring growth for freshers. But in IT, we cannot find those pockets of growth for freshers.
Right. Very quickly, Mr. Pawan, FY26, which is the sector that you expect to outperform the most?
See, from a long-term point of view, what we have seen over the last couple of quarters, the non-IT sectors, we've seen travel, tourism, hospitality doing well. Healthcare, we have continued to see doing well. These are the 2-3 sectors that have continued to do well. But we unfortunately cannot predict what will happen. We only can talk about what we have seen on the platform.
Pawan, thank you very much for joining us. Enjoy these monthly updates from you on the labor market picture in India. But let's move on. Trump's reciprocal tariffs have shaken the global market. Prashant is joining us. He's at the big wall to decipher what the Trump government aims with this shakeup.
Well, thanks very much for that. Now, it's Liberation Day +1, right? I mean, if I can call it that. The day after what US President Trump and many in Washington have called Liberation Day for the US. Of course, on Wall Street, it was, a different kind of a day. Big time losses, 5-6% cuts, worse since COVID markets in 2020. What is the Trump team's positioning now in terms of what the message they're sending out? The message from his team seems to be clear. They're not backing down. So what's the latest? There's no indication yet that Trump or his team are willing to dilute or delay the proposed tariff. Yes, the administration is open to negotiations, but they are not chasing a quick win here. The bar to even getting to the negotiating table, from what we've heard so far, seems to be much higher. The US isn't just looking at tariff parity, the way the calculations, etc., have been made and the numbers have been put very high. It's aiming for a global restructuring of trade with special focus on structural and non-tariff barriers. And of course, even if there is a deal down the line, the new tariff floor will likely remain at 10%. So minimum is 10, and I mean, on top of it, maybe it can be negotiated down. A key document is already in play. So because I mean, you may wonder, what is the roadmap here? How do you go about negotiating these things? The 2025 National Trade Estimate report from the USTR, it's 400 pages long. It's actually available online. You can go and check it out. It breaks down the foreign trade barriers country by country and was prepared by the Trump team itself. This could shape how and when countries get invited to the negotiating table. So what are the next steps here? The USTR is expected to send a detailed report to the US Congress clarifying what exactly was announced in the executive order. We're also watching for guidance from the Council of Economic Affairs on how they've calculated the proxy tariff rates. Remember that it's not reciprocal tariffs. The tariffs are real, but it's not reciprocal. The number for India is 52%, whereas if you add, the 9.5% which we charge the US plus VAT, etc., it's nowhere close to 52. A practical question ahead, which needs to be also watched closely, is this. Can the US Customs and Border Protection actually process these new tariffs without causing port delays or disrupting supply chains, etc.? Important to remember for business disruption, and we'll be asking companies over the next couple of weeks as well. So far, the global reaction actually has been measured. There's been outrage. Several countries have expressed disappointment, regret, but mostly have stopped short of announcing retaliatory measures. For now, most governments seem to be keeping the door open for negotiations. But that could change quickly. So one day after Trump's big sort of tariff play, the tone is set. This is about long-term leverage, not short-term wins. That's the message, at least, that I picked up from everything we've heard so far. This is not to say that there won't be negotiations, but it looks like the Trump team is digging their heels in after the sweeping and much harsher tariff announcements that we saw a day earlier, and wants the message out. Come and negotiate, but the bar is going to be quite high. Back to you.
Thank you so much, Prashant, for joining in and explaining to us on what Liberation Day +1 actually means and what exactly to look forward to ahead. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000, it's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be...
A sharp fall in global equities filters through with the mid-caps bearing the brunt. Uncertainty over the impact of FT tariffs imposed by the US severely hurts sentiment. Metals and pharma are the biggest drags.
Pharma stocks are spooked by Donald Trump's comments saying tariffs will be imposed in the not-so-distant future on drug imports by America. He adds that these tariffs will be at levels not seen before.
HDFC Bank reports a strong show in the fourth quarter with its best growth in deposits and advances in over a year. Its deposit mix also improves quarter on quarter. The stock perks up.
Crude sees a sharp 6% drop overnight on fears a trade war will trim global growth. A move by OPEC Plus to speed up output expansion also dents prices. Crude sensitives swing to the news.
The White House clarifies that the tariff on India is 26% as presented by President Donald Trump and not 27% as was indicated in the annexure released by the White House.
The day of resilience, the day of breaking down, the day of outperformance. You can call the last 2 days in just these 3 words. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Hormas Vatakia. We come to you live from the CNBC-TV18 Motilal Oswal studio. Yesterday, we did see a bit of a decline, but there was an air of resilience in that decline. Overnight, we saw big cash on Wall Street. This morning, there was that news that came in on the pharmaceutical space, so that led to a further underperformance, or maybe coming to terms after the resilience that we saw yesterday. But today's decline, while it is high in an absolute term, it is still muted when you compare it to what all the other companies, or all the other countries rather, are doing as well. So we have a gash. There is not that air of resilience, but there is still outperformance. The broader markets have it a lot worse than what it was yesterday. So we have more stocks, way more stocks declining than the number of stocks which are advancing. Hi, Hormas.
Hi, Mangalam. 1,500 points on the mid-cap index, 3.5% shaved off on the small-cap index. Not looking good. At the same time, yesterday, the advanced decline was exactly the same image. The colors were flipped, but now the advanced decline firmly in favor of the losers in today's session. And it is these 3 export-focused names that are bearing the brunt, be it pharma, be it IT, or be it even the metal names who are declining despite the weakness in the US dollar. But the focus this morning has been on pharma. They were the ones that were the outperformers in yesterday's session, after there were no reciprocal tariffs mentioned on them. But US President Donald Trump has made his remarks at the Air Force One, speaking to reporters, saying that the pharma tariffs are under review and will be coming in at levels never seen before. Listening to what the president had to say.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
Right. What's the likely impact? What is the exposure for Indian companies? Let's go across to Winnie, who's brought out that list and the kind of problems that Indian pharmaceutical companies could face if tariffs would come soon. Winnie.
Latest update that has come in, where Trump made some comments coming in on the pharmaceutical space, saying that they will be announcing tariffs in the near future and not the distant future. And because of that, we're seeing pharma stocks are in focus today. Now, let's take a recap of what is currently charged by India on US. So India charges 10% tariff on pharma imports. US currently is not charging any import duty on the products for Indian category and Indian companies. So yes, as of now, the charge is nil. Now, what Trump wants to do, wants to charge them with a reciprocal tariff on this front. So it will be 10% or more than that. That's something that we're keeping an eye out on. What is the risk and who is at risk in terms of pharma companies? The main risk comes in for generic formulation players and CMO players in the pharma space, which is at the highest risk. The exposure of US generic companies is quite high to Indian companies to US generics is quite high, and that is why we will see that impact coming in. One-time hit in terms of EBITDA that we could see coming in, a negative impact would be around 9 to 12%. This is according to what we have a note coming in from Citi. Now, obviously, let's talk about the exposure. Gland Pharma has an exposure of 50%. So the impact on its EBITDA would be in the range of 8 to 10%. Aurobindo Pharma, 48% exposure to the US, and that would be in the range of 12 to 13%, I beg your pardon, in terms of the hit on the EBITDA front. Dr. Reddy's in the 10 to 12% range, 47% exposure there. Zydus, 46% exposure, so 8 to 10%. Lupin, Cipla, Sun Pharma, and Torrent Pharma, a lesser exposure is what they have, and the impact on the EBITDA is lower. Now, why is that so? Because these companies have facilities in the US. Cipla, Dr. Reddy's, Lupin, Syngene, Piramal Pharma, Sai Life Sciences, all of these have exposure, means in terms of facilities that they have in the US, and that is why they're already set up in terms of the facility there. So maybe they could start importing from that facility. Instead of importing from India, you can sell from those facilities, which doesn't charge as much duty as what it would be charged from the Indian manufacturing facility if imported there. And that is why lesser impact on these companies on the EBITDA front as well.
Vinny, thanks a lot for that. At one point, most of these names were down and out. The Aurobindo Pharma was down 10%, but Laurus Labs now is the top loser on the Nifty 500, is down 8% now as we speak. Granules is the other underperformer today, 7% lower on that. Aurobindo has recovered slightly from the lows of the day, does not feature among the list of top losers on the Nifty 500, and this is despite the stock being down 6%, so it shows the kind of fall that most of the other names are currently witnessing on the broader markets. You'll talk about the metal names as well. Hindustan Copper is down 7%, Vedanta is down 7%, Nalco is down 7% as well. So metal stocks taking a bit of a battering in today's session. The Nifty Metal Index down at the lowest point of the day, 5% lower as we speak. We take a short break, but we get you more on the markets and specific stocks and continue our conversation on tariffs on the other side. Stay tuned.
Booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in, trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? And the tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again.
Welcome back. You're watching us here on Halftime Report. Now continuing our discussion on the tariffs, and there's this agreement that has come in between the ambassadors as well, the reciprocal tariffs that were put on India. Now sources are telling CNBC-TV18 that the India-European Union trade ministers will hold talks again within a few days. Parikshit is joining in with more details on that. Parikshit, what are your sources telling you?
Well, the US reciprocal tariffs that have been imposed on all nations, including India and European Union, are definitely going to have a knock-off impact on the India-EU FTA talks. In fact, the talks are likely to get accelerated because of the global environment. Top-level sources tell us that Commerce Minister Piyush Goyal and EU Trade Commissioner Maros Sefcovic are going to hold talks very soon. There's going to be a phone conversation within the next few days, and there is very strong political determination to get an FTA done. Sources tell us that India is very keen, actually, to get an FTA done by the end of this year. The European Union is also watching out for India-US tariff talks very, very closely, and they are trying to see what kind of concessions India gives to the US government in terms of the agriculture sector, the dairy sector as well. Sources tell us that the European Union is not looking for any kind of quick fix, the way the US may be looking for India in terms of concessions, but they want a fully WTO-compliant FTA that serves the interests of the countries in the long term as well. Speaking to CNBC-TV18, the EU ambassador to India, Hervé Delphin, said that some progress has been made in talks. Talks have been positive, but they need a meaningful package which would serve the interests of both countries. They are hopeful of an early harvest by the end of the year and perhaps more meaningful progress on the larger FTA negotiations by the India-EU summit next year as well. And the EU, according to him, is very keen to increase cooperation in sectors like clean tech, semiconductors, defense and security as well. And they want a very broad-based agreement with India. And automobiles and components will definitely be one of the key pillars of this FTA.
All right, let's see how that goes. And from a consumption standpoint, we'll most definitely look at any sort of, reprieve coming in on imports of alcobebs from there. There is obviously the bigger benefit will be from the India-UK FTA, which will allow for Scotch to come by at favorable rates. But if India-EU FTA talks happen, will wine come by at favorable rates or not is something that we'll most definitely keep an eye out on. Speaking about stocks which are moving around, look at the consumption space. Pidilite is higher, obviously benefits from lower crude prices. Colgate's doing well, as is Berger Paints. But the one that's top of the pops right now is Marico. At the high point of today's trading session, came up with its fourth quarter update yesterday on the back of, having seen a big outperformance earlier itself. The stock did not react as much, but now it's moved higher to the high point of trade. Another stock which is doing well is HDFC Bank on the back of a good fourth quarter update, and that is reflected in the way the Nifty Bank's doing as well. Almost 2% higher for HDFC Bank. Abhishek joins in. Abhishek.
Well, to begin with, sequentially one of the best deposit growth that you are seeing in last 4 quarters and one of the best loan growth that you are seeing in last 5 quarters. This was HDFC Bank's provisional business update do suggest. So deposit growth is at 14% YOY and about 5.9% sequentially. The CASA growth in absolute value is more than 8% quarter on quarter. So suggesting that the CASA ratio has also improved by almost 80 basis points sequentially. Now, this is heartening to see after a long time. Many lenders have been able to improve their CASA ratio. Now, advances growth is at 5.5% YOY, but 4% quarter on quarter. So the sequential growth is one of the highest that you are seeing in last 5 quarters, and this was led by the retail portfolio for them. Overall, the AUM growth is about 7.7% YOY and 3.3% sequentially. Calculation does show that the CD ratio or the credit deposit ratio has declined with reference to both YOY and quarter on quarter as well, and this is in line with the management guidance that they will be looking to lower the CD ratio in the coming quarters. Back to you.
And HDFC Bank is bucking the trend, ensuring that the Nifty is still holding on to losses of around 285 points and not falling further. But Abhishek, stay on because you have more details on the business update that Union Bank has shared.
Poor performance with respect to what they actually anticipated for FY25 and what actually they have delivered. So the growth rate continues to remain below industry levels for quite some time now, and they have missed the guidance as well. Deposit growth is at 7.2% YOY and about 7.7% sequentially. The guidance was about 9 to 11%, FY25 deposit growth over FY24. So domestic deposits are up 6% YOY and about 7.5% sequentially. The domestic CASA has grown by 3.9% YOY and about 7.8% sequentially, which suggests that the domestic CASA ratio has improved by 10 basis points quarter on quarter to 33.5%. Now, advances growth is at 8.6% YOY and about 3.6% sequentially. Their advances growth target for FY25 was about 13%, and they have massively missed over there. The domestic advances are up 8.3% YOY and 3.5% sequentially. The domestic retail loans, that's up 10.5% YOY and about 3.2% sequentially. Suggests credit deposit ratio, the calculation does show that it might have declined by a massive 300 basis point quarter on quarter, which suggests that the net interest margin could come under pressure in Q4 FY25 versus the number that they had reported in Q3 FY25. Back to you.
All right, Abhishek, thanks a lot for that. That's about Union Bank, down about 5%. Mazagon Dock is the other stock which is under pressure after the government has decided to sell almost 5% stake in the company. Upasna joins in to tell us more. Upasna, right from the word go, the stock has been lower because of increased supply and the price at which it was made, the supply was made.
That's correct, Mangalam. Now, let us look at the few of the OFS details that the company is given. Now, the government will sell up to 5% of its stake in the company. And mind you that the government currently holds nearly about 85% of the stake in the company. Now, this OFS includes a base size of 2.8% and a green shoe option of 2%. And OFS opens for non-retail investors on 4th of April, that is today, and for retail on 7th of April. Now, if we look at the floor price of this offer, it stands at 2,525 per share, which is at a 8% discount to yesterday's closing. But stock has corrected quite a bit today in today's trading session, and the total size is 4,900 crore. Now, if we look at the near-term triggers for the company is qualified for supply of P-75 submarines, and the order opportunity is as high as 50,000 crores in this. Now, additionally, company has also indicated that it has pending orders worth 25,000 crores. Now, if we look at the order book of the company, it currently stands at 3,50,000, and according to Antique, this order book can swell up to 3 times larger post this order opportunity that the company is looking at. So this stock certainly remains in focus on back of this.
Pasna, thanks a lot for that. Now, even after that 4.8% stake, the government will still have an 80% stake, which is well above the minimum shareholding norm. So that risk of further supply will still remain as an overhang on the stock. 7% lower on Masgaon Dock, 25.50 now, nearing towards its floor price of the OFS, which is 25.25. Some flashes on your screen as well. Emcure Pharma's European arm will acquire UK-based Manx product portfolio now for around £20 million is what the flash is. The stock too, in line with other pharma names, is also down around about 3.5%. But one of the other underperformers in today's session from the broader markets is Bharat Forge, and that's after Morgan Stanley has downgraded the stock and has also cut its price target. Sudarshan is here with more on this and its rationale. Sudarshan.
So Morgan Stanley has cut its stance to equal weight from overweight, and target is cut to rupees 1167 or 1170 from its earlier target of 1366 per share. That's a cut of almost, or say, more than 15%. Also, it has lowered EPS estimates for FY26 by 15% and FY27 by 11%. Now, giving the reasons, MS says this estimated slowdown in the US and the tariff issue could offset the gain by non-auto business and defense. Also, US auto and non-auto could face challenges on both the fronts, that on growth as well as the margin. And US truck, which forms nearly 99% of its standalone revenue, is already facing challenges. You could have seen the North America Class 8 truck orders even for the month of March. The orders had come in at a 7-month low. And on the tariff issue, it says 25 to 27% tariff on auto and non-auto products can impact the margin by 200 basis points in the near term. And as far as the valuation is concerned, MS believes that valuation at current levels looks full. And one thing that is management has been talking about the resolution of overseas subsidiary. On this front also, MS believes that it can be further delayed. So considering all these factors, it has downgraded the stock.
All right. So Arshan, thanks a lot for that. So those are a bunch of factors why Bharat Forge is down about 7%. We take a short break. On the other side, Manish Athiramani of Deendayal Investments will join in with some trading strategies. Manish has been calling the Nifty right quite a few times in the past. So let's get in his verdict after the decline that we've seen right now.
Wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security.
Welcome back. Let's look at the setup from the F&O standpoint. The Nifty just under that 23,000 mark. The market's under a bit of pressure, no two ways about that, especially if you look at the broader market. So if you look at the Nifty, it's down about 1.16%, supported by a couple of indices we'll talk about. But the mid-cap index, that's where majority of the pressure is. It outperformed in yesterday's trading session, now firm underperformer. Let's look at sectors and how they are moving. All the export-facing sectors, Nifty Metal, Nifty Pharma, Nifty IT, down 3 to 5%, and that's putting a lid on the gains. All the domestic-facing sectors, you have the Nifty FMCG index, the financials, and the Nifty Bank mildly in the green. So the ones which are impacted are seeing a bigger gash. The ones who are relatively immune are seeing a smaller gain. So that's the tone and texture of the market. The Nifty, after having fallen, is very close to the 20-day moving average. Today, for most part of the day, it was under the 20-day moving average. Now it's recovered close to the 20-day moving average. It's exactly where we are, 22,986, but below the 50-day moving average. Can it close above 23,000 today or not is the big question, or will it close below the 20-day moving average? And the active Nifty option suggests that for the next week, 23,100 looks like a bit of a supply zone because 23,000 call writers are fairly active. On the way up, 23,100 call writers also equally active. So between 23,100 and 23,150, you might see some supply getting activated. But at lower levels, there is purchase at 22,900, and that's reflective in the kind of put writing that we've seen at 22,950 itself. That's the 22,950 call. 22,950 put comes up for you. That's seen some writing as well. A lot of shorts added on Bharat Forge and Lotus Labs, so keep an eye out on that one. And the first entrant in F&O ban for the April series could be Hindustan Copper. It's at 99% of the threshold level. Remember, stocks which crossed 95% enter the F&O ban. So Hindustan Copper may be the one that enters.
In the F&O ban for most parts of the series, right, is Hindustan Copper. So unsurprisingly becoming the first, or potentially being the first stock who can enter the F&O ban. But Manish Hathiramani of Deendayal Investments is joining in now for a quick chart check. Manish, good afternoon. Thank you for joining in. Are you now in a no trade zone on the index, or would you still want to short it for further downside now that you are at that 20 DMA mark? And what are your stock recommendations this afternoon? Manish, I think you're on mute.
Good afternoon, Hormoz and Mangalam. Thank you so much for having me on the show. Well, I'll just take you back about 10 days when we were on the same show, when I had discussed the importance of 23,600 to 23,650 to be a major hurdle. While you might note that over the next 2-3 days thereafter, we did cross those levels. We went to 23.7, we went to 23.8 intraday. But when we closed, we were not able to decisively keep above 650 for more than 2 days at a stretch. That is the level that has acted as a major resistance. We are currently tinkering with the strong supports of 22,900 to be specific. A break of this will now currently disturb this recent up move that we have seen, and that can drive the index down all the way to 22,600 for starters. Having said that, the upside resistance is now capped at 23,650. Like you correctly said, I am in a no trade zone. I will start looking at shorts only at 22,900 breaks. While saying that, I'm now working with 2 shorts. The first one is on M&M, which is for a target of 24.35, stop loss of 27.80. The major concern with this stock is that there was a low of 30th of October, which has been broken. That level was 2669 to be precise. The last 10 to 15 days is also showing us an inclining volume with a fall, which is a negative sign. The second sell is on LNT, which is for a target of 3075, stop loss of 3500. Here too, it is a similar example where a low as far as 5th of June last year has been broken a couple of weeks back, which makes it vulnerable to retest those levels.
All right, so you're not in any trade zone right now, and if the Nifty breaks 22,900, you would go short. At what point do you go long?
The bare minimum, Mangalam, would be at least 23,650. So that is where we really strong. Unless we don't get past those hurdles, it will be a resistance. While I'm still hoping that we should be getting buy signals, because I don't think we have broken down. The breaking down will only happen if 22,900 were to break.
And if that were to break, where would we go from? How much lower could the levels be?
I think for starters, we should look at 22,650 to 675. And thereafter, if we break those levels, then we will start revising those targets.
All right, closer to support levels below which there could be a 1200-point downtick, but an upside right now looks unlikely until we cross the 600-700 points from where we are right now. Thank you, Manish, for joining in and giving us your views on the indices. On the other side, we'll move away from the listed equity markets and individual stocks. Instead, we'll speak about the world of private equity investing. More importantly, what the trends out there are. Sridhar Sankaraman of Multiples Alternate Asset Management joins in to discuss their strategy. Stay tuned for the next segment, which is Fund Race.
Blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore.
Welcome back. You're watching us here on Halftime Report. We've been speaking about the equity markets through and through, but let's talk about our special segment, which is called Fund Race, where we're joined by Sridhar Sankaraman of Multiples Alternate Asset Management. Their private equity platform manages assets for almost $3 billion USD assets under management, with a couple of listed and a few unlisted investments as well. The most notable of them, I can see there is Dream 11, there's Quantifi. You had investments in Delivery and IEX, which you've exited, and then there are Genie Mode, Montra Electric, Mo Engage, etc. as well. Sridhar, thank you so much for joining in. It's your second conversation with us. The first time you said that you back companies which have consumer love or brand love. Now that, since then to now, sentiment has changed. Things have, gotten a lot more cheaper or a lot more worse when it comes to growth, whichever way you cut it. What are the current challenges, opportunities, and the valuation environment? How are you looking at all of this from your lens?
Sure. Thanks, Mangalam, for having me here again. And I'm glad you have a great memory. See, for us, we are looking to take bets which are fairly long-term, right? 5, 6, 7-year bets. So the near-term doesn't change our long-term thesis in any significant way. I would say this is a great year for private equity because the last couple of years, capital markets was a real option for even companies which were not really ready for an IPO. But now the fact that things have corrected, I would see a lot more action on the private side. But to just quickly comment on the companies that you read out, the one common theme you will see in these companies that they are all new age businesses.
Yeah.
So as Multiples, we took a very early call to invest in technology about 12 years ago. And our underlying theme was to say there'll be a lot of value created by new age businesses. If you think about the listed ones today, new economic businesses, there'll be about 20 of them which are listed with a market cap of 100 billion. That's 3.5% of our overall market cap. the way I see this, in the next 10 years, Mangalam, this will be 15 to 20% of market cap. So it's a large value to be created by tech businesses. And we were the first private equity fund to start investing in tech businesses 10 years ago, right? And that's something that we will continue to do. So we've invested maybe about $400 million in these companies, already taken out more than $1 billion. And this is only with exits from 3 of these companies, or 3 or 4 of these companies. So we see huge potential here. So these are the kind of companies that we would want to continue to go for.
Now, Sridhar, good afternoon. And you mentioned you take a 5 to 7 year opportunity, right? Where is that next 5 to 7 year opportunity? Because you hear a lot on the street that B is the next A or Y is the next X. Where is that opportunity, that next 2,000, 10,000, multiple crore opportunity that you are finding?
So 2-3 things are changing, right? One is, for the first time, we are seeing that consumers are becoming a lot more open to pay for subscription in India. I mean, we would hear this for the longest time that, people are not okay to pay for subscription, OTT. But if you look at the numbers of even people like Sony Live today on what is the kind of subscription revenue, something is changing. Quick commerce, we are all paying for delivery now. Something is changing. There is a lot of subscription-led businesses, which we see that naturally comes with affluence, is one large opportunity. The second large opportunity is India B. And India B is not really, I'm not talking about Gorakhpur here, I'm also talking about Govandi, right? I mean, India B is also within our, within our big cities. And the products and services for India B will be different than products and services for India A. So that's, again, the next big, because they have just about started the discretionary consumption curve. So these are 2 large areas on the consumption side. In addition to this, on B2B as well, we are seeing opportunities where we are focusing our time on businesses which are not just buy and sell, but where can you add some value and create some serious moats. So we basically look at opportunities in 3 buckets. One is a new age businesses, which is about 10 investments that we have done and fairly successfully, which are tech led. And India being India, you will see a lot of these tech businesses keep allowing you to either create a new economic opportunity or challenge an existing opportunity. And if you're disrupting an existing market, your ability to grow faster, then the market rate is much higher, which has clearly been our experience. The second bucket is classic growth. And the third bucket is buyout. So we are also seeing a lot of families were earlier not willing to sell their businesses. But in the last 2 years, we've evaluated about 20 buyout transactions. Just evaluated. The fact that so many deals even came to us tells you that something is changing. Families are a lot more open at 2 things. One, to professionalize management. And they believe that they need a change agent to do that. And the private equity fund can be that change agent. And the fact that the next generation is saying, Papa, I may not necessarily want to run this business. And so therefore, that's a big shift. The fact that shareholder and manager could be different, which has always been the case in the West, is now beginning to happen in India. So these are opportunities that we're seeing.
You spoke about exits and how you have a 5 to 7 year horizon, etc. Exits are now getting pushed down the road, a little more difficult. How are you navigating through that? Because I remember a lot of PEs who had lined up IPOs, and you said that not companies which were even ready for IPO were going IPOs. Gets a lot more difficult, right? And the other part that you spoke about, people paying for convenience. It has been shown so far that, the expected addressable market out there was not as big as the actual addressable market. So I'd written this thing called, we're not a TAM market, we're an ARM market. You have to look at the actual addressable market. So what are your thoughts on that and exits on the whole?
So I'll take the exit question first, Mangalam. There's a very vibrant P2P secondary market, which is now emerged. So if you look at it, it's not just capital markets as an exit window, but also private equity to private equity. And the amount of dry powder there is in this country is fairly substantial. So so I think there is a lot of action there as far as exits is concerned, and also strategic, right? In the sense, there are companies which are owned by private equity funds which are being purchased by strategic businesses. On the question on where is the TAM? It's a very valid question. So we are really looking at businesses where there is a particular serviceable addressable market. We are not taking bets where you have to believe that this will happen, but we already have indications. I'll just give you an example, right? When we invested in delivery, e-commerce was picking up. We looked at a lot of front-end e-com businesses. We could never build conviction on who will make money and how. That was our thesis on saying that the guy at the back who's really delivering the parcel wins irrespective of whoever is winning in the front. At that time, delivery was making money on a per parcel basis, even though overall, they were in loss making. But the fact that the opportunity was visible, the macro was visible, is absolutely the call that you need to take. There has to be a path to profitability.
Sorry to cut you there, but you've made your money in delivery. Shareholders haven't. If you look at it from the IPO price, the post-listing high to now, even now there is so much supply in the market, and fundamentals haven't kept pace with what other parts of the market have done. So that was what I wanted to understand. I mean, good on your fund that you guys exited with a fair amount of multiple, but, and you know, when you speak about the listed space, the new age businesses turning from 3.5% to almost 10 to 15%, are there any opportunities in the listed space which give you that sort of upside potential? Because, you know, from a retail investor standpoint, they can't get access to deals much before them being public.
Yeah. So Mangalam, as you know, we don't do public investments. So we are largely focused on the private side, and you know, and our return expectations are of course very different than that of a public market investment. Therefore, so I'll not be able to give you a prognosis on which are the stocks to track. But I would say that there is enough and more proof of concept of people having made money on tech-led businesses on the private side. It's just all about the stage that you invest in, and if you hold businesses for fairly long periods of time. I mean, kind of Zomato is a great case in point. They are now close to a $20 billion business, right? So I think three things that really matter is the founder agile? Because I think businesses are getting built and disrupted very quickly. The concept of build to last is something that is being challenged every day. Right. So you need to look at businesses which are very, very strong founders, very agile, you know, markets with very strong profit pool and clear path to profitability. I think if there are these three fundamentals are in place, I don't see why the value will not get created over long periods of time.
You know, Sridhar, just one final question. You know, is there, you spoke of opportunities, right? With the recent shift in market sentiment that you've seen over the last 6-7 months, have there been any asset that you were looking at earlier has now become more reasonable and you are eyeing those now?
Absolutely. So, you know, as I speak, there are at least a couple of opportunities that we're looking at where expectations of both the founder and maybe incumbent investors have become a lot more realistic. The bid-ask spread has kind of reduced. So I'll give you an example. On the consumer side, in the last 2 years, the number of deals that we looked at, to the actual deals that got done, only a third of the deals actually got done. Okay. Because A, the growth did not come, and B, the bid-ask spread was very, very high. Right. I think that is something that I'm saying that could likely change in the next few quarters.
Any specific categories?
Wait and watch this space for more action, Mangalam.
All right, I will do that. You know, and just off the cuff, you have investments in Dream 11, right?
We have exited that as well.
You exited that. How much did those ads cost? You're not going to tell us. All right, what we'll do is we'll take a short break on that note. On the other side, we'll focus on Trump tariffs' impact on IT sector and what brokerages are saying about that, because it's been the sector that has been on a rout over the last couple of trading sessions. Fair amount of value eroded out there. Keep an eye.
April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs, and they understand.
Welcome back. Still 280 points down on the index, and the broader markets too faring no better. The mid-cap index is still down around about 1,500 points. The small-cap index too has around about a 3.5% cut as we speak. A slight recovery from the mid-cap index, at least 1,350 points lower now. But the small-cap index still continuing to trade with losses of well over 3%. Stock that has sprung up among the list of losers is Samvardhana Motherson. That is now down 7% at the lowest point of the day and is sprung up among the top losers on the Nifty 500. So not good going there for Samvardhana Motherson at the lowest point. And there as well, Hindustan Copper, as Mangalam was just mentioning, may enter the FNO ban. So 7% lower there as well. And ONGC, of course, after that sharp fall in crude oil prices overnight, taking both ONGC and Oil India down. ONGC is down 7% and Oil India too is down a similar quantum. But as we were mentioning, the Indian IT sector has been the one that has been not directly or indirectly impacted by Trump's tariffs, but the risk of a slowdown or a recession in the US could have a near-term impact. Rima has collated what brokerages are saying on this. Rima.
Thanks so much for that. So let me start with Bernstein, and they say the near-term risk for IT emanates from a potential recession, which can delay IT spending and result in tightening budgets. In a worst-case scenario, they're saying we could see a deep global recession similar to the 2008 financial crisis, the global financial crisis. And back then, the major IT services firms saw a significant revenue decline. 6% quarter-on-quarter revenue decline for TCS in Q4 of calendar year 2008. Accenture's revenues fell by 13%. Not that Bernstein expects a GFC-like situation once again, but they do say the growth will get impacted. Growth is likely to remain flat in FY26, contrary to earlier expectations of some sort of a post-FY25 recovery. Given the market volatility, their preference lies with large-cap quality names. So Infosys is their top bet in the large-cap space, Coforge in the mid-cap space. The sectors that they are avoiding are the auto ER&D companies. So LTTS and Tata Elxsi, they're underweight. Now moving on to JP Morgan, and they're asking the critical question: when will IT bottom out? Now, they've identified the bear case scenario, which is basically no revenue growth for companies like Infy, HCL Tech in FY26 and no margin expansion. If that plays out, then we're talking about an EPS cut of 9 to 11%, leading to potential stock price declines of 7% for TCS, 6% for Infosys, and 14% for HCL Tech. Mid-caps could see an even steeper impact, so 13% of a stock price correction for Coforge and 25% for Persistent. So the question is that when do you buy? Not before earnings. The conservative guidance that these companies might give might push stock prices lower, and that could provide a better entry point. JP Morgan does suggest have a lighter IT positioning. They remain overweight on Infosys and some of the growth mid-cap growth companies. Now, Kotak is worried that this current uncertainty at the beginning of the year will delay spending and impact the June quarter. Now, the June quarter is important because it's seasonally strong, and that's what gives the IT companies strong growth for the full year. So, and once again, Kotak has cut the revenue and EPS estimates after cutting it just in March of 2025. So in 1 month, they've again lowered their revenue growth, baking in the US tariffs. They're saying there is a possibility that FY26 could be worse than FY25. And their estimates are up for you on your screen. We'll just get them up over here. Given the higher guidance, scrutiny on guidance, Kotak also goes on to say it may be prudent on the part of companies to defer their guidance until there is more certainty on the demand environment, or they could restrict the guidance to the next quarter where there is a higher degree of visibility. A recession, to their mind, means downside risks in stocks exist. If there is just a slowdown, not a recession, we could see reasonable upside. And finally, let me cap it with Macquarie, and on a good note, because they think the market reaction on Indian IT is overdone. Investors, if you have a long-term outlook, you could use this opportunity to add to positions in Indian IT. Back to you.
Right, Rima, thanks a lot for that. So that's about the IT space. With that, let's take a short break, come back on the other side. Commodities, that's the other thing that we are tracking today, and that's largely because of the big rout that we've seen in commodity prices ever since Trump tariffs were announced as well. So not just the IT, pharma, metal space, we have all the other commodities basket under pressure too. Manisha Gupta joins in with a gentleman from Swiss Asia Capital. Stay tuned for that.
President Xi understood. He said, look, I understand, and the other countries, and they all understand, we're going to have to go through a little tough love maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं हैं यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं।
In an otherwise wobbly market, we have Interglobe Aviation, which has moved to the high point of trade, doing extremely well this afternoon. Well bid on account of higher volumes, better market share, and perhaps lower costs as well, as crude prices are lower. Speaking about crude, a lot of the other commodity prices are lower as well. We have Manisha in the studio with us. Manisha, take it away.
Well, thank you so much for that, and welcoming a very special guest. Jörg Keener is MD and Chief Investment Officer at Swiss Asia Capital. Jörg, thank you so much for joining in here at CNBC India. Your first reaction really to tariffs and the way gold has performed really. We've seen $100 of a range yesterday, and a lot of people would like to believe that gold is kind of underperformed given the uncertainty that we have, and the safe haven buying that the markets were anticipating didn't really happen.
I think the safe haven purchasing has been starting a long time ago. I think it started in the year 2000 and has accelerated actually constantly. And if you think the dispute about these upcoming tariffs have been going on now for quite some time. So we had already a big move going from the basically low 2000s into the 3000s now. So we already done a very good 30% move. The market still looks like it wants to go further, and I think with many people still having to meet Basel III requirement, particularly the US and UK banks, the pressure on the way up is still there.
Jörg, so what is your sense on where is gold heading now? Are we looking at some more correction before we start to run up? And how far do you see on the higher side gold prices really targeting?
Look, we are trading quite a bit above the moving averages. So let's say we could have a smackdown to 2.8, 2.9. That's all possible. I don't think we'll be staying there very long. I think that the trend will continue to go up and accelerate. And when I mean acceleration into July, I think you could easily see somewhere between 3.5 and a few $100 above that for this year. And probably prices in the tune of $5,000 to $8,000 in the next couple of years.
Oh, wow. That's very bullish cues coming in for gold. Jörg, what's your sense on silver? Because that's lagged behind a bit. All-time highs are far away, but it's making it very hard to keep up with the kind of run-up that we've seen in gold. Would you say silver seems to be resembling more like metals right now rather than the precious metal?
I think what you have is a huge accumulation of silver, particularly into China. And we see people shorting the silver markets through ETFs, which has basically been keeping prices down. So we have a real mismatch on the West versus East. We see as well huge spreads. So you could actually sell silver into China at $3 spread. So that tells you actually that we have backwardation in the system, that silver should actually really perform very well indeed.
So Jörg, where do you see silver going forward then? Do you think there are buying opportunities coming in here, or there's more pressure that could be seen?
Look, I think in the low 30s is a great time to buy, and you want to be testing at least the $50 mark, which is basically would be a triple top in the short term, and then we'll see where we go thereafter. But I think that's about the trading range, $30 to $50 for probably the foreseeable future.
So, Jörg, while you are quite bullish on gold and silver, how would you look at metals as a space? Because the two major economies, China and US, really seem to be trade warring right now. How is that going to impact the prices here?
I think what you start seeing is that you're going to get very different prices from country to country as we're moving from a global world to a decentralized world. So your pricing might be very different places. You see with this onshoring, which happened in the United States, a large capital investment cycle taking place again, next to the one we see in the BRIC countries. So the demand will certainly be there. So I don't have a problem with metals. I think if you look at copper, it's been highly volatile this year, but looks like it's been breaking on the way up. Palladium, platinum, which are the other two PMGs, they've been disappointing. They've continued their correction on the way down. We'll see when they will turn. They are so small, it might not really that matter. So copper is only the other big metal in the room, which is really showing the sign that all metals are going to turn. If you look at iron ore, which is important from an economic activity, you're actually seeing the shipments into China are still continuing to be going at record pace, and that at a time where you have military buildup, which is high for steel production. I think that shows you as well that metals should actually be reasonably well supported.
Jörg, I also want your sense on the crude oil prices, because we've seen 6% decline overnight, 1% down as we speak, and the markets tend to tell us that another 6 to 8% of a decline or even more is not ruled out. How would that augur for the US shale producers then?
Look, let's say we go another $10 down because everybody's going to be afraid of shale production out of the United States. That's all possible, good and right. So that's a 10% risk on the downside. On the other side, we have a possible risk of further warfare in the Middle East and in Russia. And in case with the Straits of Hormuz going to close, then maybe your oil price will be $100 plus in no time, because there will be no shipment going through the Middle East. So your risk-return metrics is from the upside downside actually doesn't favor that the downside has so much risk over time.
So what is your targets then, given the kind of scenario that we are in right now, where we're looking at OPEC and allies increasing production, the US inventory is going higher, tariffs impacting demand going forward? How do you see that impact on prices?
So it's not very positive for the producers from that point of view. So we're not really buying the equity in the energy space, but on the energy itself, I think if you look at energy prices, they can be so different. You can have onshore supply and production at costs, which in some countries is so low you can't compete. So I think you really have to figure out where you buy it. Overall, I wouldn't be a massive buyer of energy right now. But if you are living in a specific country, you certainly should actually be looking at locking some of that in. Depending if you're a producer or not a producer, I think is probably one of the key issues.
Jörg, thank you so much for sparing time and joining us today, this afternoon. Manisha, thank you for joining in as well. Will not be a buyer on energy at this price, but very bullish commentary coming in on gold prices, of course, and that has been the one that has been shining through and through. By the way, some sell-off has intensified on the index, though. 300 points down now on the Nifty. 22,950 is where we are, and 22,900 is the level that Manish Hatiramani was also talking about for further downside on the index, and IT is the one that has been bearing the brunt of this. Coforge is down another 6% today. Persistent is down another 5%. And Emphasis down another 5% as well. We take your leave on this edition of Halftime Report. Business lunch for the next 30 minutes.
जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। ये सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21.
A sharp fall in global equities filters through the mid-caps bearing the brunt. Uncertainty over the impact of hefty tariffs imposed by US severely hurt sentiment. Metals and pharma are the biggest drags. Pharma stocks are spooked by Donald Trump's comments saying tariffs will be imposed in the not-so-distant future on drug imports by America, and he adds that these tariffs will be at levels not seen before. HDFC Bank reports a strong show in the fourth quarter with its best growth in deposits and advances in over a year. The deposit mix also improves quarter on quarter. The stock perks up. Crude sees a sharp 6% drop overnight on fears of trade war will trim global growth. A move by OPEC Plus to speed up output expansion also dents prices. Crude sensitives swing to the news. The White House clarifies that the tariff on India is 26% as presented by President Donald Trump and not 27% as was indicated in the annexure released by the White House. Hello, good afternoon. You've tuned into Business Lunch coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala. Thank you so much for tuning in. Not a pretty picture coming in on the market front that we're seeing. D Street in the red. Look at the Nifty day's lowest point, almost over there, 22,967, 1.24% decline that we're seeing for the Nifty 50. Advanced decline ratio today clearly is in the favor of declines versus advances, so that pressure is there, and that is what you're seeing in the mid and small cap as well. That underperformance that is coming in for the broader markets clearly visible over there. The Nifty mid cap is down a more than 2.5%. Nifty small cap is also seeing a sharper fall coming in, day's lowest point, almost 3% decline that we're seeing. Only sector that's in the green today is the banking financial side. We did have those Q4 updates coming in. HDFC Bank, like we were talking about as well, so keep an eye out on the banking space. Pharma and metals among the top drags in today's session, given the new commentary that is coming from Donald Trump. And continuing with the topic of Donald Trump and the tariffs, now global equity markets, when you look at that, that went into a risk-off mode following US President Donald Trump's Liberation Day tariff announcement. Stocks on Wall Street saw a sharp cut with over $1 trillion of investors' wealth that was wiped out. Let's hear out the US President on what he had to say in terms of recession to the sharp fall in the US market.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing, plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 billion jobs. And so it was a sick patient. It went through an operation on Liberation Day, and it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in, trillions.
And the president was also asked if he was open to negotiating with countries if they called on him. Here's what he had to say on that front.
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation.
Now, Trump's reciprocal tariffs have shaken the global markets. Prashant is joining in with us now to decipher what Trump government is aiming with this shakeup.
It's the day after what US President Trump called Liberation Day. It was a different kind of a day for Wall Street. Indices sold off big time. Nasdaq was down 6, S&P was down 5, Wix was up 30%. It was the worst COVID market since the depth of COVID crisis in 2020. What is the Trump team's positioning thinking now? Well, the message from his team seems to be clear. They're not backing down at all. The latest in that sense, right, how this sort of goes forward, there's no indication yet that Trump or his team are willing to dilute or delay the proposed tariffs. Yes, the administration is open to negotiations, but they are not chasing a small or a quick win. The bar to even getting to the negotiating table seems to be much higher. The US isn't just looking at tariff parity, it's aiming for a global restructuring of trade with special focus on structural and non-tariff barriers. And of course, even there is a deal down the line for countries, the new tariff floor will likely remain at 10%, as we well know now. In terms of what basis this negotiation will take place, a key document is already in play. The 2025 National Trade Estimate report from the USTR is what I'm talking about. It's online. You can check it out. It's 400 pages long and breaks down the foreign trade barriers country by country and was prepared by the Trump team. This could shape how and when countries get invited to the negotiating table. So what are the next steps here? Well, for starters, the USTR is expected to send a detailed report to the US Congress clarifying what exactly was announced in that executive order. We're also watching for guidance from the Council of Economic Advisors on how they've calculated these proxy tariff rates. It's not reciprocal tariff. They're real, but they're not reciprocal. Controversial claim that India charges 52% on US imports and many other countries for that matter. There is also a practical question ahead which needs to be watched closely. Can the US Customs and Border Protection actually process these new tariffs without causing port delays or disrupting supply chains? important to monitor for any business disruption. We've, of course, been asking companies that. So far, global reaction has been actually measured. Several countries have expressed disappointment, regret, outrage, but many have stopped short of announcing retaliatory tariffs. For now, most governments seem to be keeping the door open for negotiations. But that could, of course, change quickly. We'll find out it's a fluid situation. So one day after Trump's bold tariff play, the tone is set. This is about long-term leverage, not short-term wins. This is not to say that there won't be negotiations, but it looks like the Trump team is digging in their heels after the sweeping and harsher than expected tariff announcements a day earlier, and wants the message out, come and negotiate, but the bar is going to be quite high. Back to you.
Thank you so much for that, Prashant. But on that note, let's also listen into what Mohammad Al-Erwan, Chief Economic Advisor at Alliance, had to say and his views coming in on Trump tariff orders and the impact on the global economy.
They are significant, and you've seen this come from markets. You've had a major repricing of growth prospects with a recession in the US going up to 50% probability. You've seen an increase in inflation expectations up to 3.5%. And you're having business leaders right now, they're not waiting and debating should other countries retaliate, de-escalate, or just wait. You're hearing business leader after the other, that's what I'm hearing, saying we're going to get hit on cost, we're probably going to get hit on revenue, we need to do something about it. So there has been a significant change in the outlook for the US economy and the global economy. I don't think it's inevitable because the structure of the economy is still strong, but the risk has become uncomfortably high. I think that the market is underestimating the inflation side of what's happening. The first reaction has been concerns about growth, and that's totally understandable. We haven't had two other reactions yet. What will happen to growth in other countries? And that makes a question mark on whether the dollar weakness will continue. And then the second, what does the Fed do? I think that if we're lucky, we'll get one rate cut, not 4, 1, and it wouldn't surprise me if we get none.
Okay, now let's move on and also listen into what is coming in on the new reciprocal tariffs that were announced by US President Donald Trump in terms of risks tipping the American economy into a recession and pulling the global economy down with it. So this is the word coming in from Mark Zandi, the chief economist at Moody's. Listen into what more he had to say.
Well, if the reciprocal tariffs are implemented in full, I would expect some retaliation from countries abroad. I don't think they're going to sit on their hands. So the combination of those two things will result in a recession, an economic recession. You know, it's a tax on American consumers. The bulk of the tariff increases will fall on them. Businesses that import product will have to pay more, which will hurt their profitability and thus their investment in hiring.
Let's now listen to Kate Moore, CIO at Citi Wealth, talking about Trump's tariff announcements and impact on the markets and what investors should do in the light of uncertainty and more.
That effectively we don't want to be adding to risk right now. If you have a portfolio that is fully invested, we're going to sit tight and think about being a medium and long-term investor. But if you have cash that you were looking to deploy, the uncertainty factor, whether it's in bonds or in equities, was too great for us to have a really convicted call. Price levels are really interesting, and we'll be watching some of the technicals. We want to be thoughtful about when we re-enter the market or we think about adding to risk. But I would also note the uncertainty factor is just starting. I mean, one of the things I kept telling the team going into yesterday is April 2nd is not going to be a clearing event for the market. Earnings are just going to be starting. I'm watching really closely how companies talk about what they expect for the balance of 2025, even ex the tariffs, because we know that there was some slowdown in momentum.
Okay, on that note, we're going to step into a very short break. When we return, we get you more news and updates revolving around Trump tariffs orders and its impact.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, Global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be a booming country.
Welcome back. Thanks for staying tuned into Business Lunch on CNBC TV18. Now, the US president has also had another surprise in store when he said that his administration was working on imposing tariffs on the pharma sector as well. Listen in.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category. And we'll be announcing that sometime in the near future, not too distant future.
And after this commentary that we heard, we saw that the pharma stocks have actually started seeing a fall coming in. Yesterday, we saw that run up. The top sectoral gainer today, the top sectoral loser is Nifty Pharma. Now, why is that so? India currently is imposing around 10% tariffs on imports from US in the pharma sector. US is not applying any tariff on Indian imports as of now. So 0% tariff there. So they want to apply tariff on this. Now, who is the most at risk? If you look at it, generic formulation players as well as the CMO players, they are the most at risk. They have high exposure to the US as well. So depending on the exposure, obviously we'll see an impact coming in. It could be in the range of around 9 to 12% on the EBITDA front that we would see that hit coming in, and one-time hit is what analysts are highlighting. Now, other than that, we had further details that came in from a Citi note as well, where they were talking about exposure and what would be the hit in terms of EBITDA. So when you talk about Gland Pharma, they have a 50% exposure. So the hit in terms of the EBITDA would be in the range of around 8 to 10%. Other than that, Aurobindo Pharma, 12 to 13% hit on this EBITDA margin that we would see. It is around a 48% exposure there. Dr. Reddy's 47% and to 12% range of EBITDA hit, while Zydus is 46% and an 8 to 10% hit. Now, other than that, Lupin, Cipla, Sun Pharma and Torrent, they are seeing a bit of a lesser impact of less than 6%, 7% range, and below that mark is what the impact we'll see. A lot of these companies also have facilities in the US. So Cipla, Dr. Reddy's, Lupin, Syngene, Piramal Pharma and Sai Life Sciences, they have facilities there. So that impact on these companies would be a bit lower. But as of now, we are keenly watching out for what Trump is going to be announcing in terms of what would be the tariff as well. So that is something to watch out for today. All the stocks are down and out in trade. But let's also listen in to analyst Nimesh Mehta of Research Delta Advisors and Aditya Khemka of Incred Asset Management on what he had to say about the Trump's pharma tariff announcement.
What I understand is that the reaction that we see today on the stock market to me looks a little overdone because yes, there is a lot of competition in the generic segment and I fully agree. But, the primary reason of this competition or the pricing pressure we see in generic is also because of Indian pharma manufacturers. So there are so many manufacturers, which is itself is, kind of drawing the prices down in a normal market scenario. But if you look at Indian pharma as a consolidated unit, so their bargaining power is going to be very high. So in toto, if there is one company who is, getting impacted because of the tariff, the most likely scenario is that all of their competitors or most of their competitors will also be in the same boat.
I think the most impacted players will be generic players. The reason being twofold. Number one, the volumes of generics that goes from India is significantly higher than the volume of innovator products or specialty products or API for that matter that go from India to the United States shores. So the highest impact will probably be on the generic players. Number two, because these generic players don't have any bargaining power on the table. It's a commoditized product that they sell. Every player has the same product. So when it comes to the bargaining table with the buyer or with the government as such, they don't have any bargaining power on their side to sort of discuss any meaningful outcomes for themselves. So the pecking order would be mostly impacted would be generics, followed by API, CDMO, and lastly the specialty guys, because the specialty guys have the most bargaining power. They have patented products.
Okay, apparels is one of the other segments that is likely to get impacted by the reciprocal tariffs. We spoke to apparel export body representative, and he said order cancellation and discount demands began last week and have escalated after the tariff announcements. While Gokuldas Exports Management says that consumers may not be able to bear the increase in tariffs.
What is happening here is the US importers, they've already started asking for discounts and cancellations. Now, this is a big issue for us, and this needs to be addressed by the government. They have to take it up with the government there, or, like China did, when 10% tariff was imposed on China, many retailers, they started pushing manufacturers to reduce prices.
This is huge, I mean, a 20% and so on and so forth are very large. It's very difficult to, manage it through cost management and all of that. So, cost of raw materials, etc., will not offset all of this. So this tariff delta is advantage India. But then I think what we really need to keep in mind is that what is the impact of all of this on end user demand? Because all of this looks great on paper. We have to see how does this impact consumer demand in the United States, which is a very large market. And if this tariff actually will get passed on to the customers, will they buy in the volumes that they will, they have been used to buying, right? So that is something we need to see.
Now, sources tell CNBC-TV18 that trade ministers of India and the EU will hold talks within days for over a free trade agreement between the two parties. Parikshit Luthra is joining in with us to give us more details on this one. Parikshit.
US reciprocal tariffs will have a knock-off effect on India-EU FTA talks. Sources say Commerce Minister Piyush Goyal and his counterpart, EU Trade Commissioner Maros Sefcovic, are going to talk again very soon. The tariffs imposed by United States on both EU and India will accelerate efforts to conclude an FTA by the end of 2025. Sources also add that India is very keen to have an FTA by the end of this year. We learned that EU companies are very keen on investing in India, but technical barriers are holding them back. The European Union is also following India-US trade talks very closely, especially on agriculture and dairy. Reduction of tariffs on cars and components would be one of the central pillars of the trade talks, just the way it is an important part of negotiations between India and the United States. EU is looking for a fully WTO-compliant FTA with India, not a quick fix, and something that will serve the interests of both countries in the long term. Speaking to CNBC-TV18, the European Union ambassador to India has said that reciprocal tariffs strengthen the rationale for an India-EU FTA, and the US tariffs will not define these negotiations. He further said there is determination and high-level political engagement to get an FTA done. EU actually wants to see the fruits of the harvest by end of the year and more progress on the FTA by the next India-EU summit next year. The ambassador, Hervé Delphin, said that while there is good progress, both nations will continue discussing elements of a meaningful trade package. The European Union is looking to significantly scale up cooperation in clean tech, semiconductors, defense and security with India.
Thank you so much for that, Parakshit. On that note, we're going to slip into a very short break. We'll get you more news and updates on the other side.
Country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in. Trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other...
Welcome back to Business Lunch on CNBC-TV18. Now, the Supreme Court slams Delhi High Court order directing takedown of Wikipedia page critical of Delhi High Court decision. Ashwat Kumar is joining you. Natas, to give us the recent and latest update on this front. Ashwat, what is this details that you're picking up here?
Well, just to begin with some context as far as this dispute is concerned, ANI had challenged a web page that appeared on Wikipedia in the Delhi High Court. ANI had alleged that this is a case of defamation. The reason for that was because that page had described ANI, the news agency, as a propaganda tool of the government. Now, that is something they had objected to. They fought in the Delhi High Court. The Delhi High Court, however, importantly, in the course of these proceedings, had directed for takedown of a page which had basically captured the essence of this dispute between ANI and Wikipedia. That direction for a takedown of that web page is something that has now been challenged by Wikipedia before the Supreme Court. And this is where today's proceedings come into context. The Supreme Court was not happy with the Delhi High Court. Supreme Court was not happy with how the Delhi High Court had directed for a takedown of the page without even a conclusive finding of whether there's been any defamation, of whether there's been any contempt of court. In fact, the Supreme Court observed that, questioned how such orders can be passed, noting that courts need to have a far thicker skin. They cannot be, quote-unquote, so touchy about criticism. In fact, the Supreme Court observed that on a daily basis, the media is far more critical of the conduct of the judiciary, far more critical of the conduct of the Supreme Court, and that there is a thick skin required that judges need to have, that courts need to have, that such orders for takedown, especially against the media, cannot be passed. That's the initial, of course, the prima facie finding of the Supreme Court. At this stage, the hearing in this case will continue on April 9th. Back to you.
Okay, Ashwin, thank you so much for that. More updates will come in on April 9th. On that note, let's also listen into Commerce Minister Piyush Goyal. And he said and has said that the Indian startups should introspect on the sector they choose to focus on. Speaking at the Startup Mahakumbh 2025, Goyal also said that the startups are focused on food delivery and hyperfast logistics, while Chinese startups are involved in semiconductor and robotics. He added that having just 1,000 startups in the deep tech sector is a disturbing situation.
We are focused on food delivery apps, turning unemployed youth into cheap labor so the rich can get their meals without moving out of their house. And against that, what does a Chinese startup do? Work on developing electric mobility, battery technologies, and with that, they're today dominating the electric mobility ecosystem. We are very proud of what India has done. But are we the best in the world as yet? Resources are going only towards hyper-fast logistics. And look at what the other side is doing. Robotics, automation, machine learning, preparing themselves for 3D manufacturing.
And on that note, we'll wrap up this edition of Business Lunch. And as we wrap up this show, there's some somber news coming in for y'all. Yesteryear actor Manoj Kumar passed away at Mumbai's Kokilabin Hospital earlier today. He was 87 years of age and he was known for his roles in patriotic films and earned the title of Bharat Kumar. Some of his hit films include Purab and Paschim, Kranti and Roti Kapra aur Bakan. The veteran actor received Padma Shri in 1992 and Dada Saheb Phalke Award in 2015.
And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why?
Final 2 hours of this trading weekend has been an action-packed one, even though it's been a truncated one. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia. With me is Vivek Iyer. Vivek, good afternoon. It's not the Friday that the bulls were hoping to have, but the broader markets are facing some bit of pressure compared to the benchmarks.
Good afternoon, Hormaz. A week that you'd want to forget given the fact the kind of volatility you've seen, especially in the last couple of trading sessions on the tariff tantrums that we are seeing. Mid-cap index down almost 3%, small-cap index down over 3%. But we have quite a lot lined up on the show. Let's start off with the top headlines. A sharp fall in global equity filters through, with mid-caps bearing the brunt. Uncertainty over the impact of hefty tariffs imposed by the US severely hurts sentiment. Metals and pharma are the biggest drags. Financials, although, buck the trend.
Pharma stocks are spooked by Donald Trump's comments saying that tariffs will be imposed in the not-so-distant future on drug imports by America. He adds that these tariffs will be at levels not seen before.
Bharat Forge shares down near 7% in trade after Morgan Stanley downgrades the stock to an equal weight from an overweight rating earlier and cuts the target price. The brokerage says US slowdown and tariffs could offset non-auto bills and defense order gains for the company.
Nifty Metal is the top sectoral loser after Donald Trump's reciprocal tariffs sparked slowdown concerns. Stocks like Vedanta, Hindalco and NMDC have lost between 6 to 7%.
Mazgaon Dock is under pressure after the government is set to sell up to 4.83% stake in the company via an offer for sale. The floor price of the OFS is at 2,525 rupees a share, which was an 8% discount to yesterday's closing price.
Not much has changed over the next 30 minutes and the Nifty is still down around about 300 points, still trying to hold on to that level of 22,950 is for the index. Of course, we're going to end the week lower and that's of course after the volatility that has resulted due to Donald Trump's reciprocal tariffs. But take a look at the broader markets. They are the ones that are in the thick of things. They are outperformers when the markets were falling earlier in the week, but not the case today. 1,500 points gone on the mid-cap index and around about 3.5% gone on the small cap index as well. So the broader markets are the ones that are facing the pressure, be it mid cap IT, the metal names, the pharma names, all of them are bearing the brunt of the resultant global volatility as a result of Donald Trump's reciprocal tariffs. But which are these mid cap movers which are either taking it on the chin or are bucking the trend? Vamakshi is joining in with just that. Vamakshi, good afternoon.
Well, good afternoon, Hormaz. You know, the bulls will be saying, thank God it's Friday, and that is because the markets will be shut for the next 2 days. But, you know, we still have a couple of hours of trade left. So let's look at some of the top losers today. The list includes a pharma name, which is Laurus Labs. That stock is down nearly 8%. Samvardhana Motherson, of course, has been declining in trade today since the get-go, trading close to the day's lowest point, down nearly 7.5%. Ipca Labs is one such other counter, down 7%. LG Equipment too, down nearly 7%. The metal stocks also continue to decline in trade today on account of some of the demand concerns that are creeping in. Hindustan Copper, of course, is down nearly 8%. Welspun Corp is down 7%, and so is Nalco. NMDC too trading lower in trade today. Apart from that, it is the IT space that is bearing the brunt of the market. KPIT Tech, which is a mid-cap name, down nearly 6%. Coforge, Sonata Soft, down nearly 6.5%. Angel One also reported its update for the month of March. The stock is declining on the back of that. Bharat Forge, of course, there's a downgrade coming in from Morgan Stanley. They've downgraded it to equal weight, cut the target price to 1,170. AB Fashion and Retail too. There was an analyst meet yesterday. A couple of brokerages have come out, and Citi has a sell call, target price of 260 per share on that counter. On the flip side, you know, in such a weak market, we have very few gainers, and those are on the screen. Rainbow Medicare, you know, that stock is up nearly 3%. We also have Castrol India, which is up nearly 1.5% or so. Imami as well as Marico, some FMCG names, domestic facing, those stocks are up and away in trade today.
Thank you so much, Vamakshi, for joining us, giving us a sense of how exactly trade is panning out in the broader end of the markets. But it's now a good time to welcome Hemen Kapadia from DR Choksey FinServ for a technical check on the market. Good afternoon, Deven. You know, every time we speak to you, markets have seen very, very sharp moves. This Friday is no different. Small cap index is down 3.5%. Where do you see markets headed from here on?
Very good afternoon to you. Thank you for having me on the show. It's always a pleasure.
Well, this is, I mean, obviously markets are a reflection of human sentiments, but there's an entirely human made problem, rather American made problem. So VIX is down to sub 14, frankly speaking. Nothing wrong. We had a 1800 point move in the Nifty, Vivek. So one would have expected a time price retracement, which we're going through, but this has gone deeper than expected or beyond comfort. We had 3 bullish gaps. The second one gets covered today. So the last one is much lower. I don't think that's coming, but the setup is not exactly very copacetic. Bank Nifty relative strength, but we could see some sort of cooling off happening over there. But despite all the gloom and doom, I feel it's an opportunity to buy if you're brave enough. Obviously, stop loss need to be kept in place, because if the Dow Jones tanks 1500 points in a day, there's nothing one can do except hope and pray that we didn't carry a position overnight. But yeah, I believe there is significant support at 22,800 or so. So I wouldn't be very bearish, and I have a couple of buy calls in this market mayhem currently, Vivek.
I mean, so until what level would you be a buyer? Until you reach 22,800 and you hold on to that? If you go below 22,800, would that view change? And of course, you could share your recommendations as well.
Yeah, I think you sort of captured it pretty well. I would say till 22,800, sorry, till 22,800, I would be reasonably okay, and that would be my operating stop loss. If 22,800 breaks from a closing point of view, then all bets are off, and you'd probably take a hit, take a stop loss, and leave. Having said that, 2 stocks where you can buy. First is PEL, Piramal Enterprises. One can buy PEL at around 970, stop loss 955, target 1010. We've been consolidating, moving sideways in an 8 trading session range. Our downside appears limited. All the mechanical indicators are in buy mode. There's a turnaround on the weekly charts also. So I believe it's a correction within an up move. Almost similar logic comes in for CAMS, Hormuz. One can buy CAMS at 37.10, stop loss 3660, target 38.10. Once again, 8 to 9 trading sessions, sideways movement in the midst of an uptrend. Oscillators by weekly chart showing positivity. Everything seems to suggest that, okay, there's a recovery, not a rally, but the recovery has not run its course. Even now, there is steam left, Hormuz.
All right, Hemant, thank you so much for sparing time, joining us today this afternoon with your views on the index and specific stocks as well. Just before we take that break, to pull up Tata Motors is down to the lowest point of the day. Of course, on mid-cap radar, but need to pull up Tata Motors at the lowest point of the day now. The stock made a recovery from its 52-week low from 606 up to levels of 700, and now is back down to levels of 600, back near to its 52-week low. Just before we take that break, a small programming note for our viewers as well. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and are shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2. We'll take a short break. Back on the other side.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
At what point do we say you got to work for yourselves, and you got to? This is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
Welcome back. And as President Donald Trump has imposed a 26% import duty on India, let us connect with the management of Pearl Global Industries. The MD and Group President Pallab Banerjee is joining in to decode the impact on India's textile sector. Mr. Banerjee, good afternoon. Thank you for joining in. I'd like to start off by asking you, what do you make of this decision, especially considering the fact that you have a significant manufacturing presence both in Bangladesh and in Vietnam, where significantly higher tariffs have been imposed in comparison to India, although you do have manufacturing operations in India. But what do you make of this move?
It's a good afternoon, first of all. Thank you for having me on this show. Definitely, it's a big step from US President, and I think he's redrawing the entire supply chain of the globe. Of course, it's a start. It's just the start at this point of time, and a lot of things would happen. As of now, I think the tariff that has been imposed for all the countries which is making the apparel across the globe, where the major production is happening, so that's going up significantly. So, and this is the kind of tariff that has been imposed, cannot be mitigated just by changing the supply chain, at the drop of a hat. So that means what I'm looking forward to is definitely some kind of inflation that will be passed on, that will happen in the garment prices or the retail prices in USA, which I think he's ready for.
Right. Pallab, like Hormal just asked you, when you're talking about your manufacturing presence, you actually have manufacturing presence. You have 9 facilities in Bangladesh subject to higher tariffs. You have facilities in Vietnam as well. They too are subject to higher tariffs. So relatively, it appears as though Pearl Global is most susceptible to higher tariffs compared to your own Indian peers as well. So number one, what is the percentage of exports you do to the US market from the facilities outside of India? And do all of those exports go mainly to the US markets? And how will you mitigate the impact that you're going to be seeing from the higher tariffs?
Yeah. So our share in the US market, that means our goods that is going into the US market, is close to about anywhere between 45% to 50%. There are certain global brands which operates out of US. We are supplying to them. That percentage sits with us about close to about 60%. But the goods that is going inside the US would be less than 50%. Now, the countries like Bangladesh, which had a duty advantage or GSP advantage that they had for countries like European Union, UK, and all these Canada and all. So naturally, the business is more from there compared to US as a market. If I talk of India, India has been more exposed to the US market. Talking of Vietnam, that would be again more to the US market, because Vietnam, we make some specialty product which is not possible anywhere to make apart from China. So that's how our business strategy has been. And so that's how the distribution has been. Now, talking about tariff, you have to understand the whole thing, that if you look at US statistics, US imports about $90 billion of apparel. If I talk about only my industry, which is apparel. So out of this 90 billion, almost 21% is coming out of China, and followed by about 18%, which is coming out of Vietnam. Another maybe 9% is coming out of Bangladesh. If you look at this, between these 3 countries, almost 50% of the goods is going into USA, and the numbers are substantial. If you see, China does about close to $18-19 billion of goods which is going into US. Similarly, Vietnam would be another $16-17 billion. Bangladesh would be another $10 billion. So this is the kind of FOB that is going in from this. If I talk of that 90 billion, so these numbers cannot be shifted overnight.
Right.
Cannot be formed.
Mr. Banerjee, sorry to cut you in. I was reading through your previous quarter earnings call where you had mentioned that as your order book, your share of US customers to non-US, US based customers to non-US based customers is 65-35. 3 years back, it was 85-15. Now, when these tariffs kick in, what does it do to your business, your company in general? Because would that number come down further? Would you be turning focus more towards a domestic focused business? And once these tariffs also kick in, and potentially if you do have to end up paying higher tariffs for exporting from Vietnam and from Bangladesh, what does that do to your overall projections? Because you had also made a projection that you plan on getting on to revenues of around 6,000 crores by FY28. What does that do to those targets?
So I don't see any change immediate. Of course, there will be a lot of changes that will be happening from going forward. But for the next 2 to 3 months, I don't see immediately like things will change drastically. US have to wear the garments and they have to import the garments. And fortunately or unfortunately, whatever you say, the 50 to 60% of the garments is coming or going from Asia. Yes, what will start happening over time is that the countries which has got lower tariff, the brands or the retailers would try to be more exposed into those countries. But those countries have to build up the infrastructure to supply the apparel. So as I was talking about the numbers, if you see like it's a big number of $45 billion that is coming from these countries, which is now getting a tariff of 45% extra tariff that they have to pay. Now that cannot be like overnight shifted to a country which doesn't have like, which are the countries that are attractive now? A Turkey or a Central America or maybe an India, which is at 26, lower than the others. But hardly we have any manufacturing setup which can give these big numbers. Of course,
understood
that our number in India will go up, significantly at this point of time.
Pallab, right. Pallab, one question. We also understand on the back of these tariff imposition, we understand that there could be a certain impact as far as demand is concerned. We also understand in order to mitigate the impact, there will be certain price hikes necessary. Do you feel that customers are well placed to absorb these price hikes? What percentage of the incremental increase in tariff can be passed on? What is the hit you will have to take to margins in case you are not able to go ahead and fully impose or fully pass on the price hikes? And also, for Pearl Global, could you give us a consolidated or what will be the effective tariff that is applicable to you post this imposition, given the fact that you have multiple facilities across the globe?
See, first of all, the tariffs are not paid by us.
Right.
The buyers, the retailers and the brands,
absolutely,
when they import the goods, that's the time they pay the tariffs. Now, let's say a company in the US, which is importing goods from us or anybody else, they would be paying this additional tariff. If they're taking the goods from India, the additional tariff comes out to be 26%. If they're taking the goods from, let's say, the other country like China, then it's 54% additional tariff that they have to pay. Now, that's why I was talking about like a 45% additional tariff, let's say the average from these main manufacturing countries of apparel, that cannot be absorbed by the retailer or by the supplier. Because if you do the maths, then that 45% means like 15% at the retail level.
Right.
To 15% of the price increase, the cost of goods that is going up by almost like 45%. That will impact, like normally it's 3x. Let's say a $10 garment where the American retailer have paid a duty of 17%. I'm talking about cotton garment. Let's say this cotton shirt. When it's imported into US, if it's landing at $10 after paying a 17% duty, now there will be an additional duty. If you're taking the goods out of China, Vietnam, Bangladesh mix 50%, that means the effective tariff comes out to be almost 45%. Now that means this $10 garment will be sold, let's say 3x. That's an average if you talk about, I'm just generalizing the whole fact now.
Okay.
So that it will be sold at $30. So that means this 45% effect is 15%. Now the supply chain will be working on how to mitigate this risk. 15%, that means even if it's divided, let's say for a hypothetical situation, 7.5% absorbed by the retailer and 7.5% absorbed by the supplier. Now both this company cannot survive by absorbing from the bottom line 7.5%. So naturally, this will be passed on to the consumer. And what portion of it, whether 10% of it, 12% of it, 8% of it, that's something we will see over these next few months that will be working out. Now, so is looking at this 7-8% or 9% kind of inflation in this particular category, and similarly some other categories that's getting imported. That's one of the hypothetical situations that I can think of. Now, as a company of Pearl, what should be my mitigation risk? Yes, we have been working from. We have already decreased from that 85% to our dependence into US market. US in general, like the goods that is going into the US, would be just below 50% at this point of time. But US-based customers, still we are at 62% approximately. So now that number will continue to fall for immediate effect for me, for my benefit, for my company's benefit. But then over time, this is the biggest retail market, the biggest consumer market. So it cannot we have to be in synchronizing what's happening out there. So according to me, some of it will be passed to the inflation, and this scenario of the supply chain will be redrawn.
Right. There are plenty of questions, Palab, but we're running out of time. But thank you so much for sparing time and joining us today. Wish you good luck for the rest of the financial year as well. That was the management there of Pearl Global in the line of fire. Actually, it's 17% lower now. One of the few garment exporters that are underperforming in today's trading session. We take a short break, and we'll be before we take that short break, the 350 points down now on the index, and of course to 22,900 is where the index is now, and a very key support level is where the Nifty currently stands at. Take a short break, back on the other side.
That started 25 years ago believes that its best is yet to come.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, I mean, it doesn't feel like 25. I think life in the internet industry is life in the fast lane. Till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board.
Who said IPO?
Who told us on a January board meeting that, guys, you are ready to IPO. We said, what are you talking about? He's saying, yeah, 3 years ago we were at the same level and you guys are growing faster.
What's the most unusual celebration case that you've seen?
I believe they're now breakup and turning single again parties.
What, breakup and turning single again parties?
Their parties and get-togethers. like, listen, now guess what? We're all single with parties. But all kinds of stuff is happening, as we know. Like, proposal economy is happening, People now, youngsters are choosing exotic locations to go make a proposal, and they actually travel.
For the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before. Right? It's a combination of short-term vacations, and we've seen trends like
the YOLO phenomena is here to stay.
And Gen Z, and it's real, and Gen Z.
India, very, very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China charged. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they all understand. We're going to have to go through a little tough love, maybe. But they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं
Welcome back to Mid-Cap Radar. Well, the sell-off that started or resumed at 1:30 has intensified. All of the four indices are now in the red. The Nifty Bank 2 has given up its gains and now trading with cuts. A couple of stocks, especially from the metal pack. Have a look at Hindalco as well as Nalco. Both of these stocks under significant pressure today. In fact, the entire metal pack is one of the sectors that is under immense pressure in today's trading session. The mid-cap IT space, or the Nifty IT index 2, continues to see the sell-off that started yesterday morning, and the mid-cap IT index, especially a few stocks have lost in excess of 15%. Names like Persistent, Coforge are some of the stocks that are under significant pressure. But with that, it's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.
नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ, ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी बताएंगे। मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है। आपके यहां जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24.
Hello, good afternoon. You've tuned into Your Stocks, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Winnie Motiwala, and thank you so much for tuning in. A quick look at what the market is doing this afternoon. We've seen a bit more of a fall coming in for the Nifty as well. It's below the 22,900 mark now. 1.5% of a decline that we're seeing coming in for the Nifty 50. So surely keep an eye out on that one. Other than that, we have the Nifty mid and small cap that's seeing a sharper fall as well. Almost near the day's lowest point is that what the Nifty mid cap is trading at, as well as the small cap. Mid cap is down 3.2%. Small cap is down almost 3.874% almost, we could say, coming in. So from the day's highest point, look at the fall that's come in, and that's just intensified. Advance decline ratio, it's favor of the declines versus advances, there's no doubt about that. So that's also something that we're watching out for. And Nifty Bank, which was managing to hold on to some bit of a green, that has also flipped and gone to the red. It's down 0.1%. Only one which is managing to hold on to some few very stocks on the financial side right now are holding on and keeping Nifty Financial Services a bit on the positive side. Pharma, obviously among the top sectoral losers, I beg your pardon, coming in today's trading session, as well as metals among the top sectoral loser as well. So keep an eye out on what's going to be headed in the last 1 hour of this trading session. It's going to be important to watch out for as well. 1.5 hours will be key to see where Indian markets also close. But on that note, let's get started with the show for today, where we solve all your stock-related queries. And joining in with us, we have our independent market expert, Shaina Mukaddam, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all your stock-related queries. Good afternoon, Vaishali, as well as Shaina, and thank you so much for joining in with us. Let's get started with the queries for today. We have this first query that's coming from Rajan Nayyar, who's writing to us from Mumbai. He's holding 1,000 shares of ITC, price of 160 rupees per share. Currently, the stock is... Okay, it's ITC Hotels, I beg your pardon. So ITC Hotels is what he's holding, 160 rupees per share. Currently trading at 199 rupees, and he's a long-term investor. Wants to know if he should continue to hold at these current levels, add more, or maybe look to exit also and book out his profits. Shaina, afternoon, and let me take this to you. ITC Hotels, obviously recently we've seen that demerger coming in, but overall, what is your outlook for ITC Hotels?
If you compare ITC Hotels to, its nearest competitor, the large, Indian hotels, I think it is still available at a discount to Indian hotels. In terms of quality of the properties that they have, it is definitely comparable. Of course, in terms of size, it is smaller, but at the same time, the potential to growth, because, now that they're demerged as standalone entity, I believe that they can grow through various ways. Also, in terms of their organic growth, it is possible that they can expand management. They can take over management of hotels also incrementally. Also, they can have strategic tie-ups going forward. See, I have personally added it, but at much lower levels, of course, when it first demerged, and even through the ITC demerger. But I believe I continue to hold, and I believe it makes sense even to add at current levels if you're a long-term investor. So for me, it's hold and add.
Okay. Can look to add if you are a long-term investor. ITC Hotels is what we're talking about. So I would expect my producer to show ITC Hotels. ITC right now obviously is buzzing away in trade. But Vaishali, on the charts and technicals then, ITC Hotels, what should the viewer be doing with this one?
Hi, very good afternoon, all of you. So I think, the way market is going, it's quite in a, corrective, and it's dampen the sentiments of the bullish view. So I would say, since it's already getting good returns, no harm booking partial profit. And if this stock again further dips to around 185, 180 levels, that would be an ideal level to add again. So partial profit booking should not be ruled.
Okay, partial profit booking should not be ruled out as well. Okay, let's move on to the next query for today. We have Mir Khanna, who's writing to us from Mumbai. 20 shares of Polycab is what he's holding. Price is 5,200 rupees per share. Wants to know the prospect of his investments. Polycab, Shaina, Polycab is one of the stocks which had really done well post-listing. And there was no stopping it as well. Just kept going up and away. 5,200 also is a very high level from what its listing was. So now what should they be doing? Because they're making some bit of a loss on this one. Do you think we could see that run-up coming back for Polycab?
Well, see, that run-up that has actually happened has made the stock pretty expensive. So even after this correction, in my view, it's still expensive. If you look at it, it's almost about 26, 27 times EV to EBITDA. And, I would say FY26, so current year. And at the same time, the major issue out here is Ultratech is likely to come in with an investment of 1,800 crores into the same line of business. And I would believe, even if their Polycab is able to maintain its market share, which looks a bit difficult, but because 50% of the complete market is already organized market. So they would have to give up some market share. Also, I think this will keep a cap in terms of how much they can pass on any price increases. There could be a pressure on margins. All this is medium to longer term. But at the same time, because of the expensive valuations, I would say one can book some part profits. Not to say it's a bad company, but it's expensive.
Not a bad company, but expensive. Obviously, that's what we're keeping an eye out on. Plus, competition is also increasing. Vaishali, your view coming in for Polycab, right? Because I think in December itself, just December 2024, when you look at it, it was around that 7,500 mark. Now, today it's at 4,999 approximately. What should you be doing with this? What should the viewer do? Get out of it? Because his buying price is a bit more higher than the current levels that we're seeing today.
So I would say actually it is showing signs of weakness, but all the same, keep a stop loss of 4,800, because if we see a decisive break of 4,800, it could trigger further selling pressure because, well, the trend is still weak. It was still showing some consolidation, and once again, it seems to be getting a new round of selling pressure. So 4,800 is the final support. Hold with a stop loss.
Okay, keep an eye out on the stop loss, and that's key to watch out for as well. Maybe some bit of a decline, but stop loss will be key to maintain over there. Let's move into the next stock for today. And next query for today, we have Vishal Jain, who's writing to us from Kanpur. He's holding 80 shares of Industar. Price is 320 rupees per share. Wants to know if he should remain invested in this one. Shaina, we have seen those recent announcements that came in on the Vodafone side just this week, with the government stake, converting it into equity, and that will increase the stake. With that, we had seen that Industar also see a bit of a run-up on that day. But overall, your view now for Industar?
Yeah, Vinny, that was one of the best news that, you could have had for both Vodafone as well as Indus Towers. And this also, this helps Indus Towers in a couple of ways, because Vodafone does account for almost about a third, slightly more than a third of its revenues. So the fact that now Vodafone will have that leeway to go ahead and expand, it could take some further loans, it could expand on basis of a larger asset base. So to that extent, it's a positive. And Indus Towers, historically had been, it has not in the recent past been a good dividend payer. So I would say it is advisable to continue to hold. Looks like it could do better from here. So Indus Towers, yes, it's a hold. They're positive views.
Okay, Industar, that's a hold view coming in from China. As of now, making 320 is the buy price, and stock is trading at 362. Vaishali, your view coming in for Industars, right? Overall, in the last 1 year, it's had its fair share of ups and downs, but managing to give a return of around 18%. What should the viewer do now?
So this is one of the few stocks which is having a good trend, and well, for a short-term perspective, 375, 380 is the resistance. But well, even when I'm looking at the weekly and the monthly chart, I think this stock is a hold for long-term purpose. One may get good returns from here on too. So continue holding and add with the support of 340.
Okay, add with the support of 340, can continue holding this one. Next query for today, we have Venkat, who's writing to us from US. Sorry, I beg your pardon, writing to us from Chennai. He's holding 100 shares of Canfin Homes, and this is at a price of 588 rupees per share. Stock is trading at 668, making some bit of a profit on this one. Wants to know whether he should continue to hold or buy more shares at the current level as well. Shaina, your view coming in for Canfin Home?
See, it's a small cap housing finance company. I believe its valuations also are not expensive. It's just current year 1.8, FY26 1.8 times price to book. They have given a very strong guidance in terms of ROA. They've given a guidance of more than 2%. They're talking of a ROE of 17 to 18%, a good growth coming in both in the AUMs of about 15%. So I think all these things put together, along with a decent valuation, fair valuation, it could be a good hold. You could also add.
Okay, good hold, and can also look to add maybe Canfin Homes on the charts. Vaishali, your view?
This too is in a trending mode, and I think 640 is the near-term support, 700 is the near-term resistance. So if one needs to add near the support levels and look for a positional target of 780 to start with, and from there on we can have a relook.
Okay, 780 to start with is a positional target that you're giving as well, and the support levels where you can add. But on that note, we're going to step into a very short break, and here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens.
I think the first thing we have to address is safety and hygiene. I think we have to be perceived, and we'll only be perceived if we are a very safe place to travel for everyone, including particularly women travelers. So I think we all know there have been enough incidents, they keep happening. That has to stop. Otherwise, what happens, we'll have two kind of tourists. We'll have the super rich tourists who come and have the 5-star premium holiday, rose-tinted glasses, blah, blah, blah. They go see everything. They don't really feel India, but they're seeing a very sanitized India. Or you have the backpacker who's out in the hills and doing whatever they're doing, coming from wherever, etc. That's so you don't have the classic middle class.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and then we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So we are tucked away in some file
luckily
somewhere.
finance had all records and everything's electronic. But yeah, people were like that. Like I remember them coming saying, "आपने कुछ एक वो दिया था letter नहीं मिल रहा." They were scared. It's gone.
So you're the big daddy at Make My Trip, but you're also the big daddy for the startup ecosystem.
Yeah, from young Turk to not so young Turk, 25 years. So I think we all grow up. Now that you showed me the old young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times. So, we recall that and don't forget when people, help out when in the tough times. So thank you for that.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC.
Welcome back to Your Stocks on CNBC-TV18. Thank you so much for staying tuned into the channel. Let's move on to the next query for today, and this one is coming in from Umesh Goyal, writing to us from Patna. He's holding 50 shares of Trent, and this is at a price of 5,000 rupees per share. Wants to know what he should be doing now with Trent. Currently trading at 5,500 approximately levels. Hold or look to sell and book out some profits. Shaina, your view coming in on Trent, right? We've seen that, the value play from Zudio side, which was working for the company, the revamp of Westside coming in, a lot of changes that Trent has also made. And plus, the stock has seen a very good run-up. There's no stopping it till the recent time. We've seen that very, very sharp run-up. So what should one be doing now?
All those things are a positive, and the run-up actually made the stock extremely expensive. Now, even after the correction that we've seen, it still remains expensive. It's about 80 times current year FY26. In terms of valuation, it is expensive. At the same time, most of these initiatives that they have taken will be a long-term driver. And in the shorter term, it could consolidate a bit. So I would say if you're a long-term investor, you continue to hold. If you're a short-term investor, I think you could take part profits. But otherwise, given the quality of management and the initiatives they have, including even Star Bazaar, they've got that also on their list. So I think it's a hold for the long-term investor.
It's a hold for the long-term investor. Vaishali, your view on the charts and technicals, right? It has become a bit expensive, like Shaina was mentioning as well, because we've seen that run up in the last few years, especially since COVID. Didn't stop till 2024. So what is it that you're watching out for on the charts?
No, precisely. Stock has fallen from 8,500 to recently making a low of 4,500. We've seen a run up, but technical resistance comes here strong at 5,600, and that's what we are seeing. It's not going beyond. So I think there could be a further retracement. So of course, if it's for a short-term holding, one needs to book profit or keep a trailing stop loss. And I think the fair value for this stock would be somewhere around 4,500 to 4,300 level.
Okay, keep an eye out on those levels over there for Trent. Let's move on to the next query for today. This is coming from Venkat Matta, who's writing to us from Hyderabad. He's holding 1,500 shares of Central Bank of India. This is at a price of 42 rupees per share. Wants to know whether he should continue to hold this or book the loss. Currently, the stock is trading at 36 rupees. Shaina, your view coming in on Central Bank, would you suggest a hold, or maybe there are other banks which the viewer can, look to invest in?
See, Central Bank is one of the banks which the government has announced that it will be offloading, some bit, like maybe 2.5–3% of the equity. There are 5 banks that they have listed out, and this is one of them. So maybe at a higher level, I would have been a bit negative. But if you see in the last couple of weeks, or I would say even days, the stock has corrected quite a bit. And at current levels, the valuation is now below 1-time price to book. So I would say that, even if the government was to come out with their issue in the near term, I don't see too much of a discount from current levels. So the OF and plus the OFS of about 2,000 crores, that would enable them to, have funds to grow their advances further for the medium to longer term. So I would say if you're an investor, you could continue to hold.
Okay, as an investor, could continue to hold Central Bank. And on the charts, Vaishali, your view?
I think it's deep oversold, even on the daily, even on the weekly and monthly. We have seen very good correction. So no point exiting at these levels. Wait for the bounce to come whenever it does, and we can have a relook then.
Can have a relook, wait for the bounce, and then look at it. Right now, Vaishali also feels on the charts and technicals, it's in the oversold territory. So maybe we could, look at it once, it comes back to those levels or bounces back. Let's move on to the next query then, and this is coming from Priyanka, who's writing to us from Noida. 20 shares of ONGC is what she's holding. This is at a price of 200 rupees per share. Wants to know if she should continue to hold, book out her profits, and long-term outlook is what she's watching out for. Long-term outlook point of view, does it make sense to continue to hold ONGC? Shaina?
This is a very difficult stock to give any long-term answer on. I'll tell you the reasons. One is because if you look at valuations, it is not expensive. If you look at current year valuations also, it's about 8 times price to book. It is a good dividend paying company. It is, of course, a government Maharatna, Navratna, very good company. Now, these are the positives. The negatives are quite a few. One is, of course, crude oil prices we are seeing coming off. If you see the last quarter, their average realizations were about $72. So now it has come much below that. So if you look at 1 quarter forward, there could be some issue regarding this issue where, the price have come off of crude. So inventories could take a bit of a hit. Secondly, if you see ONGC has a subsidiary in Venezuela. Now, you don't know what the Trump government is going to do in terms of tariffs, and if anybody has any imports from Venezuela, what is going to be the impact on tariffs and on the company. So all these things are very, there are a lot of gray areas. So what I would say is that it is better to switch from ONGC. There are other sectors, like for example, next week you have a shipping company which the government is going to offload some stake for the retail. You could pick up something like Mazgaon Dock. You could pick up something over there. So there are alternates where you should, in my view, switch.
Okay, there are alternates and better to switch. As of now is the word coming in for ONGC from China. She's highlighted both the positives and negatives for y'all. On the charts and technicals, Vaishali, any different story? And would you suggest anything else on ONGC then?
I think ONGC is on a corrective mode. All likelihood it will retest 200 levels and perhaps go low. So I would say exit for now.
Exit for now, okay. So better options coming in. Even Vaishali is highlighting exit for now. China has given you the pros and cons, so keep an eye out on that. Let's move on to the next query for today. Now, this is coming from Deepak. It's writing to us from Bihar. 15 shares of Tata Technology. Average price is 1,099. Okay, so significantly higher from the current levels. The buy prices. So long-term prospect for this Tata Technologies. Shaina, your view coming in for Tata Tech, right? Because after the listing, I don't think it's managed to, grab on to that upside or anything on that front. So what are you watching out for? And fundamentally also, how do you think Tata Tech is doing?
No, it hasn't actually. And so the investors have not made any money on it. And given the expensive valuations, it's 8 times priced, I think price to book, 40 times P. So despite the stock not having performed, it still remains expensive. The overall tech sector is likely to see some bit of a slowdown given the fact, that the overall GDP of not only US, but the rest of the world is likely to see we really don't know, but we could see some issue out there over the next, couple of months. So to that extent, IT could take a bit of a hit on an overall basis. Tata Tech is also going to be impacted by the auto sector, not really likely to do too well over the next 2-3 quarters. So I don't see any, reason why to be in Tata Tech. If you want to be in IT in the same group, I would say TCS is a better option, which has the same problems, no doubt. But at the same time, I think they should do better when the rebound comes for the next 6 months to 1 year.
And on the technicals, Vaishali, a quick take. What should we watch out for?
Definitely, it's not showing any signs of strength. It's only showing a new lower that is likely to take place. So I would not recommend right now.
Okay, not recommend right now for Tata Tech. New lows are expected. But Vaishali as well as Shaina, thank you so much for joining in with us. This was the last query for today. Have a great weekend. Hope no surprises coming on Trump front and hoping for a better market next week at least. But with that, we'll wind down this edition of Your Stocks on CNBC-TV18. Thank you so much for tuning in. Up next, your closing bell to take you to the last hour of trade.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. and about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day, and it's going to be a booming country, a very booming country. It's going to be amazing, actually, and we see it because we have trillions of dollars committed to come in, trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Dollar index is actually shuttling lower here. That's mostly because of expectations of potential economic weakness here and rates going much lower.
I mean, it's to be expected where this is a patient that was very sick.
It's the worst day for U.S. equities since 2020, I think June of 2020. Basically got to go back to COVID kind of days.
India's got a lot of it's a resilient economy. It's got a lot going for it, and I think should be able to weather the storm reasonably well.
The Nifty Bank is ticking higher, about 0.5% up on the Nifty Bank.
Uncertainty is always the certainty, and more so in this market nowadays.
What we really need to keep in mind is that what is the impact of all of this on end user demand?
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category.
6% of a decline in the overnight markets, and that has been the biggest single-day decline since July 2022.
The Nifty is now just below 23,000. Now, Bernstein highlights the near-term risk is a potential recession in the US or global economy that can delay IT spending.
They are significant, and you've seen this come from markets. You've had a major repricing of growth prospects.
The Nifty is still down around about 300 points, still trying to hold on to that level of 22,950 is for the index.
Well, markets are down, and they are responding with some amount of severity. We're down 1.5% on the Nifty, but the broader markets are selling off much harder, and it's a tough global screen that we woke up to. That's essentially going to be the focus. What next as we head into the weekend? We're coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I'm Prashant. With me, my colleagues Surabhi and Rima. Guys, hi. Afternoon.
Hi, I can just say thank God it's Friday, right? 1 hour to go.
And I hate to say it, that both of us are in similar colors. I mean, I think we're bleeding red along with the market. But what a session, guys. I mean, look at the way stocks are falling. Tata Steel is down 8%. Hindalco is down 8%. So, global decline. I think yesterday we were, feeling a sense of relief, maybe a little bit of bravado. But 24 hours tells us that we're not disconnected with the global financial system.
And today's fall is in sync with the global market.
Yeah.
So it's not that today we're outperforming. It's not relatively we're looking better.
Actually, we are doing even better. Even now we're doing better.
That's over 2 days, but I meant today.
That's an eternal optimist speaking. Wonderful.
Or pessimist, because if you're doing you're not as worse off, then maybe there's more to come. Because we're down only 1.5, and Wall Street was down 5-6. Asia is down. By the way, Japan, was down 10% at one point. 10.
Yeah.
And then there was a sharp rally into close.
Yeah.
So
and then it closed with a cut of about 2.75%.
Yeah, so there was a very sharp move.
But
anyway,
Europe is 1.5 down.
Absolutely. So yeah, I mean the tariff tumult continues in that sense, and it's Nifty which is down 1.5, mid cap index is down 3, the small cap index is down 4. So in a way, I mean it's like large caps. If you go by safety, right? Nifty, mid cap, small cap, and then in that sense, I mean, maybe in a twisted way, it makes sense. Nifty, of course, the level, we are exactly at the 50% retracement of the rise that we saw. This level we put out for the last 2 days, 22,917 is that level. Okay, now we've broken that as well as we come in. But it's not a big break. It's about 20-30 points lower than that number. 22,896 is where we're at. The next support, I mean, 38 got broken today, 50 has gotten done. The next one is 22,692, 22,700 roughly. That is a 61.8% retracement of the full rise from the lows of March 3rd to the 25th of March. And below that, then I guess it's the March low itself. But we'll see. Take it step by step. And of course, the close over the next hour will be important. Nifty Bank is a big relative outperformer. It's down only 0.25%. So, and you know, it's HDFC Bank, Federal Bank, ICICI Bank, Axis, Kotak, PSUs, not so much. Now, Asian stocks are lower. China, by the way, is shut. Asia is lower. Treasuries rallied a little bit more. I'm talking about US Treasuries. Trump says he will relent, but you know, he needs to see something phenomenal being offered. That's the word he used. It has to be phenomenal. That's the problem. What is phenomenal? How do you get out of this? What's the, in a way, you know, is there an exit out of this? Is there a way to get out of what he's imposed? I think that is the basic problem right now. He said, of course, that pharma tariffs are on their way. So we'll see if something comes over the weekend. It kind of builds in that risk. And later today, we have the US jobs data, which is especially important because so many high-frequency numbers have all showed that the economy is already slowing down. So in that sense, this will be something to watch. And of course, Powell speaks as well after the jobs data at some point in the US session. So lots to track. Rima.
Powell speaks tonight.
Tonight, yeah.
Oh, well, that's going to be important. For the Nifty, as Prashant said, below 22,900. And with the fall today, we're below the 20-day moving average, which is, again, closer to 23,000 and below the 50-day moving average. The key rates from frontline Europe will come up for you on your screen, and they're down close to about 1.5% and opens extending the sell-off. Metals are hit the hardest today. So the Nifty Metal Index has a cut of about 6.5%. And individual names, 8.5% on Tata Steel, Hindalco 8%, Vedanta down 9%. Brent crude prices continue with the slide and now below $68. In the morning, we were closer to 69, maybe slightly lower than that, and now 67.66 on Brent crude prices. And other commodities too are under pressure. Mid-cap IT, that's lost about 10% over the last two trading sessions, yesterday and today. In fact, more than that, maybe even inching towards a 12-13% kind of a knock on a Coforge, Birlasoft, Persistent. Very few stocks in the green, but I think top honors to HDFC Bank today. Finally, good deposit numbers quarter on quarter.
I think beyond the deposit numbers, it's just like what can you buy in this market which will not be impacted too much by anything that's happening global facing? Where can you hide for cover? Pharma is not that sector. FMCG is not that sector. IT is not that sector. So you're left with very little choices. But financials and pristine, clean financials are the only stocks which perhaps are offering that sense of safety, coupled with the fact that the Q4 numbers have been pretty decent for most. Bajaj Finance about 1.5% on the higher side, HDFC Bank, ICICI Bank. So financials are becoming a bit of a safe haven. However, I mean, a lot of commentators you've heard on the channel since morning have been saying that they might not necessarily be market leaders, poster boys for a new bull market, but at least they are offering safety right now. Anyway, when you talk about losers, and even if you're looking at the broader market, I mean, the decline on a couple of these large stocks, either they're large caps or large mid caps, it's staggering. Like I'm saying, global facing names, commodity names like Vedanta. Vedanta is now down 9%. Hindalco, Tata Steel, we've discussed. Look at Oil India, smashed 8% lower. So Nalco, commodity stocks are absolutely getting pummeled. So that's one clear takeaway. Stock like Bharat Forge, I mean, clear exposure to the US market. Though they said, Mr. Kalyani told us that they have plants in the US and they're going to try and ramp it up very quickly to see if they can produce more out there. But that's the sense of damage that we're seeing. PG Electroplast, 8% down. PG doesn't even have exposure. We spoke to the company this morning. They don't have exports right now. And it's all very domestic facing, room air conditioners, etc. But people are just taking the money and running for the hills, at least for the timing. Look at the mid-cap index, down 3.3%. This is not a market where anyone wants to show bravado, and maybe for good reason. Okay, so let's straight away get to the strategies. How do you navigate a market like this? We've got Mitesh back with us. Mitesh, good afternoon. Tough, last 24 hours. What would your advice be now?
Yeah. So, I think, one, I was slightly cautious on the Nifty, saying that below 23,100 we might see more declines and a reversal could depend on the Bank Nifty. In the early hours, the Bank Nifty was positive, but then it's also turned negative, and therefore, the Nifty has sustained below 23,100. Now it's opened negative targets of 22,800. We are practically there, and then 22,600. So good chance that we can possibly see 22,600, 550, 570 come into play. And that's where there's a gap and some kind of a pivot, which was made on the 7th of March. So with that kind of scenario, I think, buying would not be advisable. In fact, we've been suggesting people to exit long positions. I have a sell on REC with a stop at about 407.5, target of around 380, about 388 can be looked at. The other one is Piramal Enterprises PEL Limited. That's also having a negative setup on the hourly charts. So sell here as well with a stop at about 975 for targets of 930.
Okay, all right. Mitesh, thank you very much for that. Which was the last one, Mitesh? Sorry, missed that. The last trade?
The last trade was Piramal Finance.
Okay. By the way, any thoughts on, look at what's happening with, and Manisha will be coming up and joining us in just a bit. Look, any thoughts on Vedanta? It's the biggest volume-led loser. It's down 10%. Look at...
Hindalco, Vedanta, exactly the price damage on metals.
Tata Steel is down 8-9%, and just whacked down. Any thoughts, Mitesh?
So, to me, I think, there is clearly some kind of a negative setup which has happened in the charts. In fact, it actually started the decline yesterday, and then today was a gap down, and then we've seen follow through. Prashant, the only hope is that on the 28th of Feb, which is the weekly closing of Friday, we had a closing of 394, and before that, I think, way back in August 24, we had similarly some base building around this 390 mark. So it's getting close to that, but the setup suggests that even if you get a bounce back from 390, that should be used to exit anything around 410, 415, and there's a higher chance of us breaking below 390. If that happens, then 365, 360 should be the minimum target.
Okay, the Nifty Metals Index is down 7%. That's, wow, I don't remember a 7% fall. I think you'll have to go back a long time to see that. I think the last time we would have seen something like this is on the election day last year, which is 4th of June. But that's what we have now. Dilip Bhatt is with us. He's founder at Pedigree Advisory. Dilip, thanks very much. Let's just start with the metal space. What's going on?
Good afternoon. I think maybe the metals have taken it on their chin. But if you ask me very frankly, it's markets just across which has taken it on the chin. Maybe metals have taken it a little more. I think this uncertainty which possibly was there, and a lot of people which I believe were bullish on the metal sector, I think suddenly after all this, now probably they have downgraded their expectations. But my own sense is that it's still very uncertain times, very difficult to generalize today's movement and make a secular call. So I would say that this uncertainty is reflected across most of the sectors, maybe a little more, little less. I will say that, for example, pharma, nothing has been said on pharma, but just because the president just made a statement that he's looking at pharma also in terms of levying the tariff, and you see the kind of reaction that is happening. So I would not read too much into this particular fall of metal. I would say let's look at the market and the sectors across.
Okay. Dilip, hold that thought. We want to talk a bit more about the metal sector, put the spotlight on how metals are faring. Manisha is now joining in. Manisha.
Well, thank you for that, Reema. Well, it's a second straight day and we're looking at very sharp cuts coming across commodities, and I'll put metal in focus right now. The tariffs have come strongly huge for China, which consumes and produces nearly 50% of the world metals there, and that's exactly the reaction that we are seeing right now. Also, ahead of all of these tariffs, US had shipped in a lot of metals also. So, it really is about buy the rumor and sell the fact kind of situation that we are seeing coming in for metals at this point in time. I'll start with copper, where we have seen very sharp declines, 8% down in this week, and it's come off 10% from its all-time highs that we saw in the previous week itself. With this kind of a decline, we are trading at a 1.5-month lows in case of copper on LME at this point. Aluminum is down 5.5% over this week, and if you look at this year as well, aluminum now has turned negative for 2025. It's down 5.5% for the year as well. Aluminum currently is trading at a 9-month lows. Zinc is another one, down 5.5% for this week. It's down 10% for this year now, and that one also is trading at around 9-month lows. So very sharp cuts coming in for the metal prices for the last couple of days here. And it's not just about the base metal prices. Steel is now trading at a multi-month lows. You have iron ore prices, which are down nearly 6% this week. That one is trading at a 5-month lows as well. Silver, which is now counted almost like a metal, is also seen very sharp decline. It's down 8% in this week, and silver is now trading at a 1-month lows as well. So the decline clearly coming in across board, but the major of sharp cuts really coming in for aluminum and zinc. These two metals for the year now have turned into negative, which was positive until previous week. So clearly, these are the two metals hit the most.
Oh, absolutely. And it's a global risk-off, right? I mean, people are just moving away from risk assets, whether it's stocks or even some of these commodities that have, run up quite a bit. And it's just a quick pile-up into U.S. Treasuries, which explains where the yield is 3.9 on the U.S. 10-year. So we know where the money is going. It's all going into U.S. Treasuries for the time being. Aditya Velekar, Senior Research Analyst at Axis Securities, is with us. Manisha, thanks very much for that roundup. Let's take this forward with Aditya. Aditya, so given that this is not about demand-supply, this is a market moving entirely on sentiment, what would you advise people to do with listed metal stocks? I mean, Tata Steel, Hindalco, 9-10% of a decline coming in. So for anyone who's got a trading position open, what should the course of action be?
I guess, yes, the risky assets are taking a backseat. So it's a risk of sentiment. And what we have seen is that post the Feb 12 tariff announcement from President Trump, there was a rush from exporters to push the metal to US to take the advantage of higher physical premiums in US. So that arbitrage window is now getting closed as the actual tariff announcement is materializing. So that's why we have seen that the LME copper, aluminium, and zinc, they have withstood the initial tariff announcement and the prices were strong. But as the arbitrage closes down, so there is no momentum or no incentive for traders to push the metal to US. And that has led to a sudden decline in the LME aluminium prices and other base metals since last couple of days. So that's number one. And number two is now the question is arising on the medium-term demand and how that will pan out, because the supply chain, because of these reciprocal tariffs, that comes into the question, because most of the Southeast Asian countries where the reciprocal tariff is imposed, and also China. So how the metal will flow ex-US market, that is also one of the reasons where the demand picture in the medium term is coming. And domestic US demand is also come under question. So all these factors indicate that if the demand dynamics ultimately gets dented, then the prices, commodity prices have to reflect downwards. So in general, we have seen in last couple of years that the metal cycles are not moving secularly upwards. The cycles have become shortened and volatile both. That is because the major consumer, China, the property sector is not picking up and it has stagnated. So we have to play in a very short volatile cycles. We have to capture the cycle at the bottom when the valuations are very lucrative and at the bottom. And we have to exit when the valuations are expensive. So now we foresee some further downside from here if the stock prices correct maybe by 10%, another 10%, then the valuation becomes attractive. And then once again, we can think of entering the cycle. But as I said, the cycles will be very short and volatile both.
10% lower for both ferrous and non-ferrous from here on?
So recently the non-ferrous prices were strong and those have corrected since last couple of days. And the prices may correct further. So it's slightly speculative to point out the quantum of correction. But for ferrous now, the situation, the ferrous space has already taken a lot of hitting. And we have seen that the ferrous, the steel prices have kind of bottomed out. And the steel mills have taken price hikes post the 12% import duty, safeguard duty announcement. So steel mills have taken price hikes to the tune of 1,000 to 2,000 rupees as recently as last week. And the positive point for ferrous is it is not it is slightly localized commodity as against non-ferrous. And also the coking coal prices have in the range of $170 per ton. So the kind of spread for ferrous, which is the difference between the prices and the raw material, that is coking coal and iron ore, that spread is kind of preserved and is improving. So ferrous at this point of time looks okay as compared to non-ferrous, because for non-ferrous now the fall in the price trajectory has just begun, and if the demand destruction happens, then the prices may come down further. So that's the entire view.
Aditya, main issue is this last point you mentioned, right? I mean, fears of demand destruction, overcapacity, and demand destruction on the other side. That's the basic issue. That's the basic fear going ahead.
That's the basic issue, and the narrative was that non-ferrous metals, they have a structural demand tailwind because of the electric vehicles, because of the renewable energy and all those developments. But with Trump coming in, and a lot of those narratives are getting sidelined, or there is a lot of uncertainty on those narratives also. So, and there is we don't have to forget that China is still producing a quantum of metal, which has to, and its exports are still at a very high level. So it has to divert those exports to somewhere else. And with the protectionist policies coming from Europe, US, and elsewhere, South Korea, so there is a lot of question mark on where this metal will flow. What will be the stockpile, and where that stockpile will flow. So all those things is weighing on the metal prices.
Okay, got that. Aditya, thank you very much. Good speaking with you, and quick view there. Dilip is still with us. Dilip, thank you for waiting. So what should one do now, Dilip? I mean, from if one is active in the markets and not a SIP kind of investor, then you just sit back. I mean, what is there to do? But if you're a do-it-yourself investor, what should one do?
So I would still say that if you still have, you're not booked profits, you're still fully invested, and you have some fresh inflows, I think there is no need to commit early in this particular market. Possibly a small amount of SIPs that you can do in this market. I would say that, as we all know, that market certainly does not love uncertainty. And, though the tariffs have been announced, I think it has only accentuated the kind of uncertainty that we're talking about. Too many moving parts, a lot of kite flying happening. And today, I mean, it will be, if you see the fall in the commodity price, especially the oil, is supposed to be good news for us, because every $1 movement is equivalent to almost about $1 billion, $1 of oil movement. So I would say that one should wait and watch. One did not be in a hurry. This fall in oil price up to a particular point will help us. But beyond that, then there will be talk about a lot of demand destruction that will happen, the wealth destruction, sorry, that I was referring to. So, what I will say that, yes, wait for a while. I think markets have been in such a great shape in the last 3-4 years. No need to commit over the next couple of days in a hurry.
Okay. Any single stocks look attractive, Dilip? Anything you've done?
So I will say that maybe the infra space looks pretty interesting from an overall point of view. The concern still being that government is a reluctant...
L&T, Dilip? You're talking about L&T?
Sorry?
You're talking about L&T or what segment in infra?
No, I think infra space I'm talking about, infrastructure. So within that, I'm talking about that overall infra space looks pretty interesting. And Larsen & Toubro, I would say, and maybe down the line, something like a Nagarjuna construction also would look good from an investment point of view on a longer term basis. So I would say that this space still is a little more neutral to the overall scenario that is being played out.
Okay, now got that. L&T, Nagarjuna. Did we talk about pharma, Dilip, at all today? Any thoughts there? Bit of a flip-flop from yesterday? Road ahead?
I would still say that the pharma sector still looks pretty good and interesting. So if it's falling, one should certainly think about investing in this particular sector, because I think there is where that's one industry where you are going to find demand inelastic as compared to the prices. And so, in spite of the fact that the tariffs may come, but I think the US will still have to import because that's the health. So I would say pharma sector still looks pretty interesting despite the fall today.
Got that. Dilip, thank you very much for joining in. Enjoy your weekend. We need to get into a break for now, but we'll come back as we do that. Here's some good news for all our viewers because India's business news leader is now just a click away. We're introducing CNBC TV18's all-new app. You can get access to all our articles, financial world updates at your fingertips. So don't wait. Download the app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen.
Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Welcome back. The Nifty Pharma Index is down over 4%, reversing all of the gains of yesterday. For the week, the Nifty Pharma Index is down nearly 3%. Vinny's now joining in. She's been analyzing the impact of impending tariffs on the pharma sector and what they could be. Vinny?
Afternoon. So obviously yesterday what we were talking about is that pharma was exempt from the list as of now. They were reviewing those documents. Now we have commentary that's coming from President Trump. He's saying that he will be announcing tariffs in the near future and it's not the distant future. So we could expect it sometime soon. And he's also highlighted that the tariffs which will be coming this time on the pharma sector will be something that we have never seen before. So does that mean that we could see higher tariffs? Are currently India 26%. So could it be higher than 26%? Now we have analyzed some bit of a data. There's a note that's coming from CLSA highlighting the impact of different tariff rates. Firstly, let's talk about the 10% rate. Now for Dr. Reddy's, currently obviously the exposure that they have is somewhere around that 40%, more than 40%, in that 40-50% range. So then if Dr. Reddy's does see an impact of 10% tariff, it would be 12%. Aurobindo would see an impact of 15% in terms of EBITDA. This is for FY26 and FY27 if this is 10% tariff, and Zydus would also see an impact of 12%. When you see a 20% rate, it would come in at somewhere around 23% impact on Dr. Reddy's. Aurobindo would be 30%, Zydus would be 24%. Now, if you look at it in terms of the higher rates, that would be 30 and 40%, a sharper impact would come in, obviously. And for Aurobindo and Dr. Reddy's Zydus, it would be in the range of around 35-36, and Aurobindo is the highest, 45% impact on that front. 40% is obviously very, very high impact that we're watching out for. So that is a major impact that comes in for these companies specifically. Why? Because the exposure that they have to US is somewhere in the range of 45 to 49% to 50% approximately at that level. Now let's talk about the other companies, that is Lupin, Sun Pharma as well as Cipla. For Lupin, Sun Pharma and Cipla, the exposure is below 40%. It's in somewhere around 32 to 40% in that range. So Lupin would see an impact of 11% if it was 10% tariff and 23% if it was 20% tariff. Sun Pharma 8 to 16%, a bit lower in terms of impact, while Cipla for the 10 and 20% would be 9 and 17. 30 and 40% would be higher. Now, the main reason that CLSA is highlighting is that these companies see a high risk. Generic players specifically will see a higher risk coming in, and overall Indian companies contribute around 46% to the generic savings in terms of the US healthcare system. So that is a big amount and a big chunk that goes into the US healthcare system. And what CLSA believes that even if tariffs are imposed, we will be able to pass it on, and that is why they think that there will be a bit of a shift that we could see in terms of the share coming in across the globe, but surely important to watch out for in terms of the impact and how much will actually be passed on.
Okay, all right, got it, Vinny. Thanks very much. So now we are, again in uncharted territory, uncertain territory with respect to pharma. Vivek Paul, head of portfolio research at BlackRock Investment Institute, is with us now to take some questions. Vivek, thank you so much for joining in. Not an easy market at all to be in, right? Because we're just living in greater and greater uncertainty. As one commentator, I think, said that this is maybe only the beginning of uncertainty. But what do you make of the whole global stock market rout? When can there be some hope of perhaps stability?
It indeed is a very uncertain time, and you're right, and thank you for having me on. So I think the thing I would say relative to the framing you had is maybe we're approaching peak uncertainty. And I think that would be an important point to make here. Yes, there's been a lot of, day-to-day things have been shifting and changing, but I think over the course of the coming months, we would start to see some of that smoke clearing, I guess, in terms of the fog that is out there at this moment in time. By all means, I think this could get worse before it gets better. We should be very aware of the fact that there are some material changes happening to the global markets right now and a wide range of possible outcomes. But we still have a view that when you're looking at a little bit further, about 6 to 12 months from here, we'll be past that peak uncertainty and we'll start to see an environment whereby the US assets, for instance, can start to outperform again. But absolutely right now, huge uncertainty, and we could get worse before it gets better, because what we've seen in the last couple of days is a stagflationary shock.
Vivek, you said that perhaps in some time from now, US risk assets could start performing well again. Can you just expand on that? Because what's happened is obviously the US equity market's back is broken. It's taking down all global equity markets along with it, and there's a general sense of risk off. So what do you see ahead? When do you see some semblance of stability returning to that market? Because, I mean, we don't know when this is over. We don't know the new trade alignments, the final tariff lines, tariff rates. Nothing is clear right now.
It's very, very true. And indeed, the US has underperformed other regional stock markets year to date for the reasons you've mentioned, because of the huge uncertainty that is there. I guess, one of the things that I'd say, though, is that markets had been anticipating looking at the measures in the last couple of days as a sort of a milestone with regards to how we look at the future kind of opportunity set. And my point is that what we've seen announced are presented at least as ceilings. They're presented at least as an upper bound of how severe, I guess, some of the imposed tariffs could be. And there's room for those to effectively come down. There's room for the landing zone to be less than the ceilings that are currently put out there. And my anticipation here would be that as we get through the next couple of months, some of the uncertainty that has, as you say, rightly been plaguing the stock markets is likely to be behind us. It's not to say that everything is entirely clear, but we've got to remember that US US assets have underperformed year to date, and despite the fact that actually the underlying fundamentals for some of those assets hasn't materially changed, right? The overall sort of US consumer remains comparatively strong. We still have some of the best tech companies in the world in the United States and trading now at cheaper multiples than they were just a short period of time ago. So just to be clear, by no means am I saying that there is not room for this to get a little bit worse in the near run. But once we start looking a little bit further ahead, the point I'm making is that that's when we should be behind the peak uncertainty.
Couple of months, that's what Vivek is saying, that this peak uncertainty phase also could last maybe a couple of months.
The thing is, maybe we'll get Vivek's thoughts as well. The reason markets sold off in this unhinged way last night is because the tariffs were unhinged. It goes back to that how the tariffs were calculated. If they were reciprocal, markets were prepared, but they were not reciprocal. They were, in a way, out of thin air, 52%. The problem is it was calculated basis, say India's surplus
Trade
against US is $40 billion. US is saying, wipe that $40 billion clean. That's never going to happen. So there is no way out. That is the problem, right? I mean, if there is a way out to solve, you can negotiate, but what is the negotiation? What are you negotiating on? Because you're saying, we don't want this deficit. But there's no way to do that. It's not going to happen. Not just with us, with anyone else. So I think actually...
negotiating down... I take your point. I mean, negotiating down tariff barriers is one thing. You can argue that there should be no tariff or non-tariff barriers. But wiping out trade deficits is a separate matter.
Which is what they're saying. So actually, theoretically, we may be one headline away from market stability. Theoretically. I mean, they may come and say, well, this is an error. I don't know what they can say. But the point is that is essentially the issue. That how do you... There's no path forward to negotiating out of this. In the way this has been calculated is arbitrary. Vivek, would you agree with that?
Well, I think one thing that's very true, and I sympathize with the points you're making, is that up until now, markets have been guessing as to what the true underlying goals of this are. And I think, as you've mentioned, there have been different things that have been put forward. The point I'd make, though, is that there is room for that negotiation. I don't anticipate the negotiation to end at the status quo we had prior to the election of this administration. I think it's clear that the floor now is the 10% sort of effective tariff rate that we're talking about, that global tariff rate that we've been talking about. So it is a different environment that we're in relative to the past. But the point I'm making is that the markets are reacting as if, to some degree, the ceilings that have been announced are likely to be the landing zone. And that's the direction of travel of the risk sentiment. The point I'd make is that certainly with a country like India and its relationship with the United States, I think there is room for the landing zone to be a little bit different to what the current announced tariff is, and I think that's the point I would make when it comes to the
Vivek, I think that point is taken. So India's weighted average is about 9.4%, right? Let's get specific. So you say, okay, we're going to cut it down to 2%. Does that bring down our claim tariffs of 52% down to the 26% down in the same 26, which is the effective, the so-called discounted tariff? Will it help bring that down to 10%? Can we be sure?
I think...
And that's the problem. How do you... Yeah, sorry, go on.
Sorry, Prashant. Sorry, I didn't mean to interrupt you. I think the point I'd make here is, though, that this is there are, exactly for the reasons you mentioned at the outset, there are multiple dynamics here in terms of what the US is trying to achieve. And the point I would make is, for instance, rather than enacting higher tariffs on India, it could be that if India sort of responds with lower tariffs on United States imports, then effectively the landing zone looks a little bit different. So the point would be that because of some element of ambiguity around the motivation for some of this stuff, I think there is this room for the landing zone to be different to where we currently are.
Okay, Vivek, we'll leave the conversation here for now. Thank you very much for joining in with your thoughts and insights. Let's move. Yeah.
I just had that headline there, right? We're one headline away from stability. And now you think about what will prompt that headline. Well, because so far they've not bothered about, and we were discussing this in the morning, that Trump he seems unperturbed by the US market fall, 5-6% falls. Yeah. Another 5% will do it. Another 10% will do it. Because since he's taken over, he's not once talked about how proud is he that the Dow is rising every day, which he used to do when he took over the first time around. So, but it's kind of difficult to imagine that he's completely abandoned stock market health as a priority, although that doesn't seem to be top. It doesn't, seem to be making the first cut. So it's it's variable, and I think the market, if it continues to sell off like this, I think they will have to offer a path. I mean, the other parties ready to negotiate, but the point is, how do you negotiate? I think is the
when your starting point is trade deficit, that too only goods trade deficit, as commentators have been making the point. I don't think this is inadvertent. They don't want to have such large deficits with trading partners, but they've forgotten the other side of the equation. There's goods and there is services. And in services, I mean, the US has been doing a phenomenal job, which is whether it's digital tech, whether it's, of course, financial services, but they're only looking at, half side of the equation. When it changes, if it changes, we don't know. But it's something that we have to look at. Speaking of IT, let's just go back and take a look at IT stocks. I think, most of them are still down and out. But of course, the headlines have been now overtaken by metals, which is a far more weaker space in the market. Till the morning, we were bothered only about IT.
But it's still down 8% in 2 days and now 22% lower for the Nifty IT index on a year-to-date basis. A quick run through of what brokerages are saying now. Bernstein says in the near term, the impact is going to be uncertainty in IT spending. Therefore, the impact on budgets, will tech budgets come down, and will this hurt growth? The worst case scenario is a global financial, the GFC kind of a crisis, when there was a deep, widespread recession, and Indian IT companies suffered. In the quarter when there was the GFC crisis, TCS reported a 6% revenue decline on a quarter-on-quarter basis. Accenture's revenues fell by close to about 13%. Not that Bernstein is saying that we're going to have a similar GFC kind of a reaction and an economy, but they are saying that FY26 could be flatter or lower growth compared to what the street was earlier anticipating. They prefer Infosys in the large caps, Coforge in the mid caps. They are completely avoiding they're underweight auto ER&D names like LTTS and Tata Elxsi. JP Morgan is saying, when will IT bottom out? And again here, this is the bear case scenario. No growth in the top line and no margin expansion. To that, they've added the bear case PE multiples, and they've arrived at a price for TCS, which is about 5% decline from the current market price. On Infi, about a 4% decline from the current market price. And on HCL Tech, about 12% from the current market price. So basically for TCS and Infosys, perhaps the bottom is now closer, maybe just about 4 to 5%. From current levels, though on mid-caps, high-growth companies with high valuations like Coforge and Persistent, their bear case, the lowest target price for these companies could be 13% down for Coforge, Persistent about 25%. So that gives you perhaps the bottom to work with for IT.
We're looking forward to those IT conversations next week.
Well, you'll be a part of it.
There'll be. I think we'll spend 5 minutes talking about the Jan to March results and 25 minutes talking about
the uncertain environment.
See the
visibility.
The mastery that most IT managements have, with full respect to all of them, is to be able to make everything look like business as usual. They're rarely shaken or stirred. So I want to see what the two of you come up with in your conversations this time with this environment. Should be interesting to watch.
And it's, TCS is on Thursday.
Which
is a market holiday.
They're always unperturbed. The world can turn upside down, but Infosys, TCS, always unperturbed. Yeah. So
you didn't try to move the interview.
I tried.
Okay, all right. Time for a quick... time for our segment D-Street Chatter. Nimesh is now joining in with what he's picking up from people he's been sort of speaking with, and generally the mood out there. Nimesh, take it away.
Hi, Prashant. So finally, it looks like India is joining the global sell-off. So we actually was not the part of it yesterday, but today it looks like we've joined the party on the sell side. And the bigger pain is in the broader markets. The mid-cap index is down over 3%, small-cap down 4%. The breadth is weak, and a lot of individual names have seen very sharp sell-off today. So that's a bit of a jolt from a sentiment point of view, that the broader markets have collapsed very sharply in today's market. Within sectors, metals, pharma and IT are the worst performing sectors. But within that, my sense is that the biggest sell-off is happening in the IT stocks. So for the second day running, I understand there is aggressive selling from larger institutions in the IT names. And clearly, from a flow perspective, it looks like there is a shift happening from IT to financial. So that's clearly a shift from a flow perspective. On the upside, I've been talking about 23,800 as a very strong resistance. Now on the downside, 23,100 could be a bit of a near-term support on the Nifty. So watch out for that levels. But clearly, if there is a global risk on, I guess India too will be part of it, and there could be further pain in the broader market stocks.
That's already happening from today, Nimesh. But have you picked up anything on individual stocks?
Well, despite all the sell-off and all, there are a lot of stocks which are buzzing, and there is a lot of news as well. So the first stock on my list today is Sammaan Capital. Very rarely we talk about this name now. It's like a forgotten stock almost at 52-week low, not much traction as well. But now I understand there could be some corporate development in Sammaan Capital very soon. Potentially, there could be some top management reject, which could be interesting to track from here on. So that's the first name. The second stock is Polycab. Within the wire and cable names, this is one stock which is under pressure, largely on back of selling pressure. So there is delivery-based selling, and I understand a leading domestic mutual fund is looking to trim the stake there in Polycab. So that's the reason why that stock is under pressure today. Third is couple of pharma names. While we flashed that Trump's comment on pharma and the stocks, while that has recovered from the intraday lows, but there is selective buying in pharma names at lower levels. So Sun Pharma and Lupin both stands out in terms of small buying, but there is buying interest from large institutions in the pharma names. And the last is Bharat Forge. We spoke about the Morgan Stanley downgrade. The stock is under pressure. There is selling as well from large institutions. And there was a Morgan Stanley tactical sell as well. So that's adding pressure on Bharat Forge in today's market.
Okay, all right. Interesting names there and an interesting chatter as Nimish is picking up. Nimish, see you at 3:30 on Editors Roundtable. Well, we'll take a quick commercial break here. We get you some short-term trading ideas on the other side. Stay with us.
Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say...
Welcome back. So as we are getting into the final leg of trade, there isn't much recovery. 22,900, this is practically where we are at. Maybe you can say a little bit of bounce, 20-30 points in the last 15 minutes. Let's take some final thoughts with Mitesh. Mitesh, indices as well as any final stock ideas.
So I'm going with a negative view on the indices, given the fact that the Nifty has kind of given a minor breakdown. So I have some BTST call. That's the first one is Tata Chemicals. That's STBT cost. Tata Chemicals is in STBT with a stop at about 819 for targets of 800. And Voltas is the other one, which is in STBT. Keep a stop at about 1310 for targets of 1280.
Okay, all right. Mitesh, thanks very much for that. So some trades coming through there. Bharat Forge and Tata Motors are in focus here. Some brokerage notes and downgrades. So it is here with details. So over to you.
So while most of the auto companies are under pressure, but two companies that are severely under pressure, Tata Motors and Bharat Forge, and it's on the back of two downgrades that have come. For Tata Motors, CLSA has maintained its outperform call, but has removed from high conviction stance, and it has cut target to 765 from 930, and says basically it has removed from high conviction because of two main reasons. First, expected US slowdown, and JLR, because of that, JLR volume is expected to come down by 14% in FY26, and it believes that EBIT margin in FY26 and FY27 will come down to 7%, and in FY25 this margin is going to be at 9%, while JLR had said earlier that it maintains its guidance of 10% EBIT margin for FY25. Also, it has cut FY26 EBITDA estimate by 15%, but expects JLR to remain free cash flow positive. Now coming to Bharat Forge, Morgan Stanley has downgraded the stock to equal weight from overweight, and has cut target to 1170 from 1366. Also, it has lowered EPS estimate by 15% for FY26 and 11% for FY27. And the rationale of the downgrade is, first, US slowdown, and the second is the tariff. It believes that it will offset non-auto business and defense order gains that company might have got over the next few years. And it says that US exports currently forms 35% of stand-on top line, and the truck, which forms 19% of the top line, already has been been under pressure, and this 25 to 27% tariff on auto and non-auto products is going to impact margin by 200 basis points in the near term, and valuation as per Morgan Stanley appears full at current levels.
Thank you very much for that, Sudarshan. Now let's get some global opinion. Kate Moore, CIO of Citi Wealth, talking about Trump's tariff announcements, the impact on markets, and what investors should do in light of this uncertainty.
That effectively we don't want to be adding to risk right now. If you have a portfolio that is fully invested, we're going to sit tight and think about being a medium and long-term investor. But if you have cash that you were looking to deploy, the uncertainty factor, whether it's in bonds or in equities, was too great for us to have a really convicted call. Price levels are really interesting, and we're watching some of the technicals. We want to be thoughtful about when we re-enter the market or we think about adding to risk. But I would also note the uncertainty factor is just starting. I mean, one of the things I kept telling the team going into yesterday is April 2nd is not going to be a clearing event for the market. Earnings are just going to be starting. I'm watching really closely how companies talk about what they expect for the balance of 2025, even ex the tariffs, because we know that there was some slowdown in momentum.
Okay, let's get in Sudeep Bandyopadhyay, Group Chairman of Indie Trade Capital, on the show now. 12 minutes to go for markets to close what's been quite a horrendous trading session, 1.5% down in the benchmark indices. But it's the fall in metal names. It's a waterfall kind of decline in Tata Steel, Hindalco, Vedanta. 8-10% of their market cap erased. What would you advise here?
Well, I'll definitely advise people to remain on the sidelines, keep watching. Fundamentally, both Vedanta and Tata Steel does look good, but I think a couple of things have happened together. One is, of course, the fear of massive demand destruction. And secondly, I think there was a lot of tactical movement of metals into US before the tariff announcement. So obviously, the prices went up a little bit more than what was supposedly, rational. And that correction is happening. But I think primarily it's a demand destruction fear, which is leading to this massive correction in metals. Let things settle down. Let things, whichever way, find the balance. It's too fluid a situation to really comment on, whether to buy metals or not. I think it's better to wait and watch.
What about IT, Sudeep? Afternoon?
Well, IT, I think I was just hearing your commentary a while back that, we normally wait for the management commentary on the future. I think this time we will only wait for that because, the numbers don't matter anymore. What they're going to say about the future is what is most important. But having said that, I'll also say, irrespective of whatever they say, I think it's very difficult for anybody, any human being, to predict what's going to happen in the next 3 to 6 months. The way US administration is moving, it's extremely difficult to predict what's going to happen tomorrow. So, how can you predict 3 months, 6 months, and 12 months? So, yes, we will watch what they say, but I think it's extremely difficult to predict anything, whether it's us or anybody else or the IT company CEOs. So, we'll wait and watch. The possibility of a slowdown in US is real. We already kind of suspecting that the jobs data today, which is revealed, will start showing the effect of that. Chairman Powell's comments will be there after that. And if there is a slowdown in US, IT budgets will be under pressure. There is absolutely no doubt about it. And Indian IT companies, by and large, derive 50% of their income from US. So obviously there is going to be pressure. irrespective of whatever we think or wish, the pressure will be there, and it's better to be careful now.
Sudeep, the fear is that what if the IT companies don't guide? They defer their guidance, companies like Infosys and HCL Tech, and that means the uncertainty lingers on. You know, even if they guide for saying 0 growth, 2% growth, you can make the EPS adjustments and move on. But if they don't guide, they defer their guidance, citing lack of visibility, then the uncertainty lingers for another 3 months, and that could be a scarier proposition for investors in tech names. But we'll slip into a break on that note. Stay on, Sudeep. We'll come back with more on the markets.
The baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Work for yourselves, and you got to. This is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very tough, very tough. The Prime Minister just left. And he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China charged. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they
Welcome back. 5 minutes to go for markets to close. The mid-cap index is ending with a cut of about 3%. Nearly 5 stocks declining for one in the red, but some of them are higher today on decentish volume. So Kaveri Seeds 12% up. VIP Clothing, that's got a gain of about 8%. TARC, TARC 5%. Kitex Garment has a gain. Marico came out with their numbers yesterday. The stock didn't react considering the uncertainty. But today, Marico is up close to about 2.5%. And then you've got a couple of these financial names. So PNB Housing Finance and Ujjivan. You've got a Karur Vysya Bank. These are stocks higher in trade. And generally, telecom has held up pretty resilient, whether it's Bharti or even an Indus Towers. with a gain today. In conversation with Sudeep. So Sudeep, what have you done in the last 2 days? Have you bought anything? Have you sold anything? Or are you just telling your investors to sit tight?
Well, we haven't bought, sold anything. In fact, we've been advising investors to be just sitting and watching what's going to happen on 2nd April. I think in hindsight, it was not a bad decision. And at this stage, we are still watching, honestly. But my belief is that some of the sectors and some of the stocks, particularly in the large cap space, does look good. And, we had maintained this view for quite some time that every fall is an opportunity to buy a Larsen & Toubro, a Reliance Industries, maybe an Ultratech, maybe an NTPC. So these large cap stocks, which are not really that exposed to these tariff tantrums and focused on construction, infrastructure, and domestic or West Asia, I think does look good from a long-term perspective. Somebody trying to build a long-term portfolio makes sense to buy these, taking the opportunity of this correction.
Interesting names there. But all, of course, large caps in that sense. By the way, do you believe as you head into April, and this was a question even before these tariffs were announced in such a great, these big tariffs were announced, that question still lingered, that is there another dip which was pending in April? And many did believe so even before these tariffs. I don't think anybody saw these tariffs this high. So just asking you that now, Sudeep, what's your sense?
Absolutely, Prashant, that was the question in our mind as well. But I think everything got blown away with this set of tariffs, and the correction, which we would have probably seen a little bit of correction here and there, did come. But I must mention to you that we were positive actually on the domestic internals. Look, inflation has started coming down. And that gives RBI a fantastic handle to keep cutting interest rates. Now, this does augur well for the economy and the markets. So we were banking on this rate cuts to kind of propel the market and the economy ahead. And probably that's going to happen anyway. Of course, this entire trade war fiasco, trade war issue needs to be examined much more detail. And things haven't settled down in this front yet. So that, of course, is a big uncertainty. But otherwise, assuming the monsoon predictions and monsoon is good, I think things should start improving. Q4, we are not expecting anything great. It will be by and large in line with the muted expectations we have from corporates. But going ahead, I think things should start improving. That was the prediction. Now, this entire tariff thing needs to be understood, and entire calculation needs to be remade for arriving at what's going to happen, what's impact is going to happen on Indian economy and Indian market. That needs to be seen. But I think time for that has still not come. We'll wait and watch for a few more days before carrying out that exercise.
No, point taken. The strategy which you described, not to do very much, right? What can one do? Just watch this market whipsaw up and down. And I think that point about large caps is well taken, Sudeep. Thank you very much for joining us today. Have a restful weekend, and we'll chat again. The market, of course, is down sharply. Is there some recovery? Maybe, yeah, there is some recovery. I think, let me see what the low was today. The low was about 22, the low was 22,857 was the low. So we broke below that 50% retracement level, and we have managed to come back above that level. So that 50% retracement in 22,917, and we are at 22,915. Can you believe it? It's almost there, exactly there by close. We'll get the adjusted close, of course, and maybe the numbers will change a little bit because there's been a sharp recovery which has come through as well. We have the Bank Nifty, which of course is the clear winner, not just today but for the week as well. For the week it's flat, for the day it's down only 0.16%. Mid-cap index and small-cap indices on today, that is Friday, sharp cuts, but for the week down between 2-2.5%, because earlier this week they had some gains posted as well. So that's the overall picture as far as the broader indices are concerned. I'm just going to quickly take you through two indices which I think deserve special mention. IT index should come up. 9% knocked off in the last 2 days. Actually, for the week, it's down 9. Bulk of it has come, of course, the last 2 days. And the metals index down 7.5%. So, this is 7.5 this week. So IT and metals really took it hard. And pharma, of course, it was complete flip-flop. Thursday higher, Friday lower. So the Nifty pharma index up on your screen, 4% lower. So yesterday the pharma index ended 2% up. It's lost double of that today. So that's the overall picture. Well, I think that gets us to a close as we wrap up this edition of Closing Bell. That's it from all of us here. Goodbye. But don't go anywhere because we're going to jump across to the roundtable. The Editors Roundtable program comes up next in just a bit.
We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं हैं यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी।
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com.
Trump's tariff measures have triggered a global market sell-off. The Wall Street takes it on the chin as well. The Nifty and the Sensex are down over 2.5% this week, with the IT sector seeing some of the deepest cuts. We are talking about, what has been a hugely volatile week in global financial markets, India included. So let's talk about what we're getting you on the show. This is Editors Roundtable. I'm Surabhi Upadhyay. With me, of course, is Rima, Prashant, Nimesh, and we have a very special guest, Prashant Khemka, joining us. And today we're going to talk about a lot of the Trump headlines, the tariff realities, the negotiations that are still ongoing, and what this period of huge uncertainty perhaps could mean for our markets in the days and weeks ahead. So guys, it's a full house, and we have an expert to help us navigate what has been a very stressful week, to say the least, Prashant.
By the way, the situation is so urgent, it has brought Prashant to our studios.
We need Prashant and Prashant. Now, Prashant Square now to solve this for us.
I'm just joking, Prashant.
Thank you for having me here. Always a pleasure, particularly at such times.
What did you make of it? The entire, should I call it fiasco?
See, I wouldn't say fiasco. Look, he's orchestrated this since a very long time. His views on this subject are very clear. Reality is that US had played a certain role in the world over many decades, big brother kind of role, where a lot of other countries were benefiting from it. You can argue US also benefited. A lot of other countries also benefited from it. Now, let's take NATO as an example. Who needs protection the most? The European countries need the protection the most. But who's spending the most, disproportionately higher, was the US. So all he's saying is, look, guys, all our love and affection is on one side, and we continue to have that. But you put up more of your fair share on the table. Yeah? Europeans had, US in any field, most of the fields, been more and more competitive, and Europe on the margin had become more and more laid back. Now this in a way is a jolt to them, and you've seen announcements from Germany and others.
But the question is it a permanent jolt or is it a...
I think it is a structural. Permanent remains to be seen, but it's structural, because once something like this happens, you cannot say it won't happen again. For many decades, nothing like this had happened, whether it's Republicans or Democrats. Yeah. Now, what if, even if Trump were to, obviously, Trump may stand again, despite the 2 terms. He's talked about, a 3rd term and whatnot. But even if it's not Trump, but someone else, let's say J.D. Vance, he's no different than Trump, and the policies could continue. What Trump's election and his behavior and continued popularity, if it is, what that would suggest to politicians in US is that's the popular mood. And that popular mood may not be just as of then, but maybe more sustainable. And then that politics would be on the rise, and they'll compete, jostle to take that position. Different parties, or certainly Republican Party, different candidates would jostle to take the position of Trump. If they win, they'll continue similar policy. So different countries would have to adjust to Trump politics going forward.
Can I ask one more question, guys? What will take, in your opinion, since US is the problem, US markets are the problem, and the rest of the world is sort of reacting, what will take US markets to stabilize, in your opinion?
I think it might stabilize today or next week. Who knows? Because, see, the worst news is out. From here, the incremental news is likely to be better. It is not the final statement that is made. It's a negotiation, long drawn out negotiation, and he's made his position very strong on the negotiation table. Now he's going to bilaterally negotiate with these various countries, and will get a better deal for US.
But that I completely understand will hold true if the final negotiated tariff rates come down, if it's not as disruptive. For a second, if we assume and work with the worst case scenario, which was what was announced, then we're talking about a serious impact on inflation, on GDP growth rates, not for us here in India, but around the world. So that has not been priced in the market, or has it?
See, if you take, I have deep respect for the markets. They see beyond the horizon, and maybe they are pricing in, either they might be pricing that these rates would not stick, or if assumed that they price in more or less these rates would stick. In that case, if you look at the equity markets plus the commodities market plus the bond markets which have rallied, what they are suggesting is a slower global growth. Seems reasonable. When tariffs, trade barriers increase, growth should be slower, as the vice versa is true, has been true as well. And lower inflation. And lower inflation, why? Because if one hand, if demand slowdown is there, demand for commodities would be lower and whatnot. But also a lot of these tariffs mean additional capacities would be put up in the US. So if steel tariffs have been imposed, or any commodity tariffs have been imposed, then steel making units would come up. More steel making units would come up in the US. Overall, steel capacity of the world is increasing then. At a time when demand may or may not slow down. But even if the demand doesn't slow down, the capacity might increase faster. And so that should be negative for steel prices. And that would be deflationary. So I think certain pockets may see, like commodities in this example, price hits. On the whole, I'm not suggesting it will be deflationary, but I think these could imply lower inflation going forward rather than higher inflation.
Very interesting viewpoint, and different from what we've been hearing, the general view. And we'll get into it in more detail in just a bit. I'll quickly take 30 seconds to recap the Indian market action, just the numbers. We obviously got swept up in the global storm, and by the end of the week, it became very, very clear that we cannot remain unscathed. On Thursday, the narrative was that, yes, India is relatively lesser impacted or least impacted. But by Friday, the reality was that financial markets are interlinked, and if there's a global risk off, then we will not be spared. So what's the final tally? For the week, the Nifty is down 2.5%. The mid-cap index is down about 2%. The small-cap index also down about 2.5%. IT taking it on the chin because of the expected uncertainty and maybe delays in business decision-making. So 9% down on the IT index. Metals and commodities pummeled absolutely through and through. The cuts are 7.4% on the Nifty metal index. Oil and gas down 4%. The overall commodities index was also down almost 4%. CPSEs, before this tariff storm hit us, there was a nice wave building towards CPSEs, but all that was, undone in this week. The CPSE index is down about 3.5%. Pharma became the latest casualty on Friday. Till Thursday, the pharma story was very different, but now it's clear that there is no escaping tariffs even there. So that index was down about 2.7%. Financials are emerging as some sort of a mini risk, sort of risk haven or safe haven, so to speak, because IT is not giving you that, FMCG is not giving you that, it's pharma, and therefore the Nifty Bank relative outperformer by being flat, and the Nifty Financial Services Index down just about 1%. Going forward, what the market is watching, of course, is for any further clarity on these tariff headlines, and more importantly, the direction of flows, because March we were celebrating that the FPI selling is over. Guess what? They're back to selling in 4 digits, on most of the days of this week. So that becomes another critical point to watch.
I think apart from what you said, what to look out for, we have a policy next week.
I forgot that.
And
yes,
that will have a big
absolutely.
impact
Yes.
on the financials.
Yes.
So
Yes.
I just want to ask you, Prashant, given what we've seen in the global context, with a lot of headwinds for the export-oriented sectors like pharma and IT, as a fund manager, would you look to position yourself out of those and move to the domestic plays like FMCG and banks?
Certainly. So see, normally, usually we don't do such top-down reallocations. We tend to not take big macro calls on sectoral mix compared to the benchmark, because it's all relative game. Our sectoral mix tends to be more or less in line with with some puts and takes in the benchmark. The idea being to identify better stocks. Now, if it were so that we were very overweight, let's say IT sector, then it is possible we would have reduced that risk at this time, because the uncertainty has shot up so much that it's not prudent from a risk management perspective to have a huge IT overweight. Right now, the domestic sectors are fairly well represented in the portfolio. Because not that we were anticipating something like this or something, but as you might know, we've discussed before, financial sector always has very healthy representation in our portfolio, and that is the case today as well. So be it lending institutions, private banks or NBFCs, they're very well represented. And yes, in general, this is more about trade. So domestically oriented sectors are likely to do better operationally. Now, from a stock return perspective, remains to be seen. Remember, exactly 5 years ago at this time, consensus was pharma is the place to be. For coming years. And pharma turned out to be amongst the worst performing sectors since COVID bottom or COVID hit. We don't know whether we've hit the bottom, but so what the operating metrics do and what the stocks do might be very different going forward in this case as well.
By the way, there's a news flash as we are on. China's imposed extra 34% tariffs on all US goods.
There we
from
go.
10th of April.
It's a full-blown war now. Tit for tat.
Everybody's got domestic constituency, right? I mean, you can't appear to be weak. And as Canada shows, there are some brownie points to stand up to Trump.
Absolutely.
I mean, I think that is the other thing. By the way, on a lighter note, 10 years ago, somebody just sent it to me. This is Donald Trump, exactly 10 years back. He tweeted saying if the Dow ever falls more than 1,000 points in a single day, the sitting president should be loaded into a very big cannon and shot into the sun at tremendous speed. No excuses.
I'm sure people are going to tag him and repost this.
We need to adjust for inflation, right? 10 years.
Anyway, let me just go across and what's the thinking from here? That's essentially the question that I'm trying to answer. Over the last 24 hours, by the way, we've heard from many people. We heard from Trump himself. This is after the reciprocal tariffs. They're not reciprocal really, but after the tariffs, the Commerce Secretary has spoken. Treasury Secretary Bessent is on record. And all of them have indicated they're open for negotiations. The problem is, what is the path forward for negotiations? But anyway, let me just quickly talk about this, right? So there isn't any clear indication that Trump and his team are backing down from the proposed tariffs, not at least right now. And this is point number one. They don't want to. It doesn't look like they're waiting, or rather willing to take a small win, which also would be quick. And that's essentially the question that we were discussing earlier. Something very soon, very quickly, somebody offers something and you take it, lower tariffs, etc. The bar seems to be higher. And I think that is essentially the point of these arbitrary tariff numbers they've imposed. So you set the bar very high and then make it really tough for the other party. And of course, I mean, these are points we've discussed earlier. US wants a global restructuring, focus more on changing structural and non-tariff barriers. And it also then becomes a point about credibility, right? I mean, you can lower tariffs, but if you're going to address deeply ingrained non-tariff barriers, that could take years. It may not even be possible. So that is not credible, whereas the market is looking for like a credible, off-ramp from this. I mean, a path out of these tariffs, a way to negotiate out in that sense. Even if all of this were to happen, of course, I mean, Trump himself has said 10% tariffs is the baseline, and that will remain. There is a 400-page report, which, I mean, if you are brave enough, you can read. It's on the internet. It is USTR's 2025 National Trade Estimate Report, and it outlines foreign trade barriers identified on a country-by-country basis. And this perhaps could be, one of the things which many countries will use when they go to the negotiating table and start to talk about this. So what are the next steps? The USTR is expected to send a detailed report to the Congress. The Council of Economic Advisors perhaps will tell us how they calculated these proxy tariffs. We know the formula, but the logic behind it, because the logic seems to be we want to eliminate trade deficit, which is just not possible. And of course, I mean, on a practical level, and we'll ask companies this over the next many weeks, goods which are getting into the US at the border, I mean, do they have enough infrastructure to be able to do all this without causing too much business disruption? So far, global reaction, of course, has been measured. I say this even as we just saw the headline that China has imposed an extra 34% tariff. But I mean, China is large, China is big, but many other countries are just sort of, expressing outrage, anger, disappointment, but keeping the room open for negotiations. But this could change, so we'll have to see. So that's broadly the point that I wanted to make. The point being, it's kind of looking, it doesn't look like they're looking for quick wins. So should you expect a quick resolution to all of this? I don't think so. I think it'll take time, and that is the reason why they've kept these tariffs at a very, very high level. Why not take a quick commercial break here? Prashant Khemka is with us. We'll continue this conversation on the other side, and we'll talk domestic. Stay with us.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at
Welcome back. You're watching Editors Roundtable on CNBC-TV18. Now, the tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply underperforming the Nifty. Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of two reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March, and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position. So Prashant, what's the advice for investors who have tech positions, right? Should they just sit tight, wait for this entire thing to play out, or should they actively look at reducing their exposure to the tech sector?
So see, what we are doing as fund managers, we have, as I was saying earlier before the break, we have positions in technology companies, especially mid-cap IT, which we've had for last nearly 8 years now, one full cycle. On the whole, our exposure to tech is not much different from that of the benchmark. Yeah? And we do not take such calls to completely go out or complete overload. We believe we are in companies which over time would outperform the tech sector, gain market share, as these companies have done. They've been volatile. So when COVID hit, there was a dramatic fall in tech sector. One of the worst hit sectors was tech sector, right? Because demand for everything's going to go down. And and tech gets chopped in such kind of environment. Obviously, the exact opposite happened. If we had taken a call at that time, exactly 5 years ago, April 4th, today is April 4th, I believe, yeah? April 4th, 2020, it seemed very, very logical that you should sell out a sector like tech and load up on pharma. Everyone's eating pills of one kind or another, whole day staying home. Yeah? And that would have been the most disastrous call. And the hit you take on one such call does not just spoil a year or two. It spoils oftentimes the entire cycle, which can span over a 7-8 year time period. In India, cycles have typically been 7-8 year time period. For some people, such macro calls have spoiled their entire career in life. Yeah? So we just generally refrain. I think from here as well, certain IT companies, we hope and we believe they'll be the ones that we own. They would perform very well. They will gain market share like they did in other past environments, like after global financial crisis. Even then, IT services were supposed to be rooted out because 40% of their business comes from US financials, which was the epicenter
of the crisis.
Of the whole crisis. And yet that year they grew close to double digits. Indian IT sector grew close to double digits. Within that, some companies performed extremely well. Yeah, so I think if you are owning very well performing, high on execution IT companies, I don't see the reason to sell out at this time because you would not know when the environment would have normalized. And you would only know, the stocks would at least have rallied big time before people or investors would figure out that the markets, the environment's normalized.
He said the corporate tax cuts are next. I mean, that is going to be a big trigger to juice up the US economy. Whenever that happens, if he says now, markets will start to, feel better.
Could well be. As we were discussing, who knows? And this, look, it's foolhardy to be to have high conviction or overly confident in matters where, per the nature of the, subject matter, you should not have confidence. Like you can't have high confidence in a coin flip. Yeah. It would be foolhardy to have high confidence that it will be heads or tails. And most of the macro is of that kind. So you can't have very high confidence. But to me, if you ask, as I was, discussing earlier, it could be the worst point that the worst news are out. And the news incrementally would be better from here.
Okay, so this is really good and we're winding up on an optimistic note because amidst all this, you're actually sounding fairly optimistic to me, which is great. So leave us with maybe some final words of advice. Like you've said that select IT, you'd still keep in your portfolio. Quick two-part question. How long do you expect this process of repair, recovery and eventually getting back to the bull market again? How long could it be, best case guess, and what should one do through it?
So I think normal market, if we say, which would be, sideways with some pullbacks of 10, 15%, rallies of 10, 20%. Hard to say when exactly, but it could be that today marks in global markets, it could be that today marks the bottom of this news, for this news. Yeah. Okay. Doesn't mean it would not be volatile and would move back to 0.5% or 1% moves on a day-to-day basis. But hard, very, very difficult to say. I think one should not try to time. If you look back on various such crises, look, compare it to again, going back to COVID, because it's the most recent event that everyone would remember for the rest of their lifetime. Because there was no event worse than COVID in our lifetime. Yeah. True. And think of the damage that COVID caused in real life. Yeah. There's no other event in real life that has caused more distress, more damage than COVID. And think of what impact it had on markets. Yeah. It was one of the best years, 2020.
It was a V-shape, which was my question. COVID was a dramatic V-shape.
In the markets.
In the markets.
The real economy did
absolutely
endure a lot of pain.
Yeah.
So when something like COVID could not cause anywhere near the damage that everyone feared that day. I mean, Trump, as dangerous he might be,
I see the other Prashant laughing.
as scary as he may be, he's no match for COVID.
You're surely not comparing the,
No,
the COVID. But I get your point.
No, it is intended. It is intended. It's not as bad as COVID was. So I think there could be,
Now I'm also
overreaction.
picturizing you, visualizing it.
No, but I think point is well taken.
Yeah.
So what is that? In November of 2020 was that Pfizer vaccine, right?
Yeah.
Which is the point when the markets took on. What is going to be that point now? Maybe, I was saying on closing bell, we're maybe one headline away from market stabilizing.
The tax cuts?
Absolutely.
Maybe
You
the
just
tax
need
cuts that you're talking
not
about?
tax cut. I think you need something. They have to say this is how you can negotiate and this is how tariffs can be brought lower, because right now we don't have that clarity. You can't say 52% and then expect the entire deficit to be wiped off. That's not going to happen. So you just need that clarity and it'll come. Maybe if the US falls a little bit more, maybe that happens.
One announcement that is negotiated with one country of size and they've settled for somewhat lower tariff.
Yeah.
That would tell the world that
formula for everybody.
Yeah,
else to
formula
follow.
for others to follow.
Yeah.
Clearly, China is not following it. Not right now, given the headline that we just saw. But anyway, it's an interesting world, to say the least. Prashant, it's been such a pleasure to have you here with
Thank
us to talk about this. And we hope to see you more often, as and when possible, in our studios. Thank you so much for joining in. Thank you very much.
Thanks.
Well, all right, folks. With that, I think it's time for us to say goodbye as well. It's a wrap on this edition of Editors Roundtable. Thank you very much for watching. See you bright and early once again with the markets on Monday morning. Till then, news and views continue on CNBC-TV18.
Weeknights at 7 p.m.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000, it's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in, trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? And the tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy.
Hello and welcome to Business 360. I'm Shriram. The headlines that we're tracking for you this evening. President Trump's tariff blitz continues to rattle global markets. Wall Street suffers its steepest decline in 5 years, wiping out $2.5 trillion in investor wealth. Stocks get clobbered across Asia and Europe. China hits back with 34% tariffs on all U.S. imports.
Indian equities are not spared either. The Sensex and the Nifty dropped 1% each, while the mid-cap and small-cap indices down over 3%. Metal stocks fall the most on fears of a possible global recession that could hurt demand. Markets end the week nearly 3% lower. The Indian pharma sector's relief at not being subject to US tariffs is short-lived. President Trump warns of never-seen-before tariffs in the not-so-distant future.
Yeah, so it's who was a sick patient and went through an operation on Liberation Day, and it's going to be a booming country, a very booming country.
President Trump plays down the overnight sell-off on Wall Street, defends his tariff, says he's confident that the U.S. economy will come back stronger than ever, adds he's open to reducing tariffs if other nations offer something phenomenal. The statement contradicts White House officials who said there would be no negotiations on tariffs. Indian exports to the U.S. will see a 26% levy and not 27%. The White House clarifies that the tariff on India will be at 26%, as was presented by President Trump in his briefing, and not the 27% mentioned in the annexure published by the White House. American tariffs give impetus to the India-EU free trade agreement talks. Sources indicate both India and the EU will accelerate efforts to conclude the agreement by the end of 2025, adding that the EU is keen on an agreement that is fully WTO compliant and not a quick fix. The Company Law Appellate Tribunal dismisses a challenge by Ease My Trips Nishant Pitti to the liquidation of Go First, upholds the NCLT order of liquidation, allows Pitti to file a scheme to buy out the grounded airlines' assets. The budget session in Parliament comes to a close. Both houses adjourned sine die after having worked for over 110% of their scheduled time. 5 bills were introduced in the session and 10 bills were passed, including the Waqf Amendment Bill and the Oil Fields Amendment Bill. The Lok Sabha also passed the resolution on imposing President's rule in Manipur. The Supreme Court pulls up the Delhi High Court for ordering the takedown of a Wikipedia page critical of the High Court's decisions in the case between news agency ANI and Wikipedia. The Apex Court says courts cannot be so touchy about criticism. Prime Minister Modi meets Bangladesh's Mohammad Yunus for the first time since Sheikh Hasina resigned and fled the country, urges protection for minorities. Yunus raises Hasina's extradition and the Ganga Water Treaty. Over 100 people killed across Gaza in the last 24 hours after multiple Israeli strikes. Over 30 dead in a school providing shelter to the displaced. More than 1,100 people have died since the ceasefire collapsed. All of that coming up in just a bit, but first to the big story that we are tracking today. President Trump's tariff blitz has rattled stock markets across the world. Wall Street witnessing its steepest single-day decline since March of 2020, with the Dow nosediving 1,700 points. Over $2.5 trillion worth of investor wealth wiped out. Tech stocks were the worst impacted. 7 large of the Nasdaq-listed tech giants, colloquially called the Magnificent Seven, have seen a market cap erosion of over $1 trillion. Apple alone there accounting for 30% of the loss. Across the Atlantic, the European markets also continue to tumble. The Stoxx European 600, a pan-European index that tracks stocks from 17 countries, down over 2% in trade. The index has fallen over 5% in the last 2 days over fears that the US tariff strikes could push European economies into a recession. So a sea of red there across Europe. And the story was not different in Asia, with all benchmark indices in the red. The Japanese Nikkei, the biggest loser among the frontline indices there, and that has been the hardest hit. The man who sent the global markets into a tailspin, however, remains unfazed. President Trump laying down the market fall, saying he expected this. Take a look.
We'd love to get your reaction, sir, to what's going on in the financial markets today.
Well, I mean, it's to be expected where this is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing, plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient who went through an operation on Liberation Day. And it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in. Trillions.
I expect most countries
to start to really examine their trade policy towards the United States of America and stop picking on us. Stop saying that we can't sell our corn to India. Stop saying that we can't sell our beef anywhere. Just stop treating us so poorly if we are the great consumer of the earth. The United States buys everybody's products. We buy everybody's goods. You just have to treat us fairly, and that is the problem.
Howard Lutnick there. And stocks tumbling on the Lal Street as tariff tensions kept investors on the edge. More than 11 lakh crore rupees in investor wealth wiped out today, with the Sensex tumbling over 900 points. Nifty falling below 23,000. Both indices have lost 3% this week. That's the story on your screens. Prashant is standing by to wrap up the market action for us. Prashant, it's been quite a week for our markets, and of course, in line with what we are seeing happen globally as well. As we head into next week, what's the outlook? What's the mood like?
Well, the full force of what was announced showed up in markets today. Remember, last night was very, very dramatic for U.S. markets. The sharpest fall in the U.S. we've seen since, the depths of the COVID crisis. And the market here paid attention. The Nifty was down 1.5. The Nifty Bank, much better, relative outperformer in a big way. Mid-cap index down sharply, small cap the worst hit. And that's the way it turned out by 3:30. For the week, the Nifty is, by the way, down about 2.6%. This is Friday to Friday with a holiday, that is Monday, a holiday thrown in. Bank Nifty's index down 2, small cap index down about 2.6 odd percent. And of course, bulk of this damage came through on the last day today. Now, sectors, the two I want to point out, IT, clear loser, but again, damaged last 2 days, 9% gone. Metals, 7.5% gone, but bulk of the damage came in on Friday and some on Thursday as well. Large caps, and where there was pressure, very few stocks were up. I think I counted 3 names with gains of about 1%, but Tata Steel, Hindalco were the big losers that we had today. There was Vedanta from the metals pack outside the Nifty, which came under pressure. Oil fell sharply. ONGC was a big cut. There were auto names like Tata Motors, which were down sharply. Cipla, L&T were some of the other large caps which came under a fair bit of selling pressure. Now, a repeat somewhat of what we saw with IT yesterday. Coforge down another 8% today. You had Mazgaon Dock, which was about 7.5% lower. There was Bharat Forge, which was down 8%. Motherson was down 7.5%. Nalco was down sharply, 8.5%. Loris Laboratories, pharma flip-flop. Yesterday, some were, of course, saying that, well, the exemptions have come. We pointed that out, that it looks temporary and tariffs will come. Trump confirming that it indeed will come. So today, the index lost about 3.5% itself. NMDC was down sharply. PG Electroplast, Oil India, Hindustan Zinc, Aarti Pharma. I could go on. Lots of volume on the downside. By the way, market breadth was 4:1 in favor of declines today. Some names on the upside. There was Kaveri Seeds, which was up 11%. There was something like but actually very little by way of volumes on the upside today. And I think that essentially is also a feature that we are closing this Friday out, this week out as well. I think weekend risk remains high. Those pharma tariffs have been promised. We'll see when that comes our way. And of course, US session with jobs report will also be important to track. Back to you.
Yes, we will be keeping track of all of that. Prashant, many thanks for joining us. It promises to be a difficult week. As Prashant was pointing out, pharma stocks have seen a rapid sell-off after President Trump threatened to impose, and I quote, never seen before tariffs. Now, he was speaking to the media from Air Force One and hinted at tariff cuts if countries, in his words, make phenomenal offers. Now, this is in contradiction with the White House officials who had said that they would not be negotiating on tariffs. Meanwhile, the U.S. has revised its tariffs for India from 27% to 26% overnight. According to the new version of the White House document, the same document had mentioned 27% tariffs on India yesterday. The rates were also changed for South Korea, Pakistan, Norway, Thailand, and a few other countries in just the last 24 hours. Here's President Trump on the possibility of tariffs on the pharmaceutical sector and also the possibility of driving down tariffs if, in his words, a country offers something phenomenal.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category. And we'll be announcing that sometime in the near future, not too distant future.
Into deals with these countries if they're calling you.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used it very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation.
Well, Donald Trump there warning about never-seen-before pharma tariffs. So how will India's pharma sector be impacted by a tariff on pharmaceutical exports to the US? Vinny joins us now with the analysis. Vinny.
Now, we have analyzed some bit of a data. There's a note that's coming from CLSA highlighting the impact of different tariff rates. Firstly, let's talk about, the 10% rate. Now, for Dr. Reddy's, currently, obviously, the exposure that they have is somewhere around that 40%, more than 40%, in that 40-50% range. So then if Dr. Reddy's does see an impact of 10% tariff, it would be 12%. Aurobindo would see an impact of 15% in terms of EBITDA. This is for FY26 and FY27 if this is 10% tariff. And Zydus would also see an impact of 12%. When you see a 20% rate, it would come in at somewhere around 23% impact on Dr. Reddy's. Aurobindo would be 30%, Zydus would be 24%. Now, if you look at it in terms of the higher rates, that would be 30 and 40%, a sharper impact would come in, obviously. And for Aurobindo and Dr. Reddy's, Zydus, it would be in the range of around 35-36, and Aurobindo is the highest, 45% impact on that front. 40% is obviously very, very high impact that we're watching out for. So that is a major impact that comes in for these companies specifically. Why? Because the exposure that they have to US is somewhere in the range of 45 to 49% to 50% approximately at that level. Now let's talk about the other companies, that is Lupin, Sun Pharma as well as Cipla. For Lupin, Sun Pharma and Cipla, the exposure is below 40%. It's in somewhere around 32 to 40% in that range. So Lupin would see an impact of 11% if it was 10% tariff and 23% if it was 20% tariff. Sun Pharma 8 to 16%, a bit lower in terms of impact, while Cipla for the 10 and 20% would be 9 and 17, 30 and 40% would be higher. Now the main reason that CLSA is highlighting is that these companies see a high risk. Generic players specifically will see a higher risk coming in, and overall Indian companies contribute around 46% to the generic savings in terms of the US healthcare system. So that is a big amount and a big chunk that goes into the US healthcare system. And what CLSA believes that even if tariffs are imposed, we will be able to pass it on, and that is why they think that there will be a bit of a shift that we could see in terms of the share coming in across the globe, but surely important to watch out for in terms of the impact and how much will actually be passed on.
Vinny, many thanks for joining us. Well, we'll have to wait to see how this plays out. President Trump's tariffs are likely to impact India's exports of sin goods. Sources have told CNBC-TV18 that India has an early mover advantage as it has engaged in trade negotiations with the US. Just for context, sin goods are commodities perceived as harmful to society, including tobacco and alcohol. They're considered price inelastic, which means that their demand does not potentially drop even if prices continue to rise. Abhimanyu joins us now with more. Abhimanyu, how is the Indian government reading the situation?
Now, post-imposition of reciprocal tariffs by the United States, government sources have told CNBC-TV18 that while India is not happy with the tariffs, but no formal objection has also been made to the move. They also indicated that India already has an early mover advantage as it has already engaged in negotiations with the US for over 50 days for a bilateral trade agreement. Also, India is the only country where the US had sent a negotiation team for talks in the Trump 2.0 administration. Sources also cited several challenges in exports of shrimp, gems and jewelry, and also competition in the export of carpets compared to countries like Turkey. Opportunities have also been cited in several sectors like electronics due to tariffs on Vietnam and China, and for export of textiles due to the tariffs which have been announced for Bangladesh and Vietnam. Also, government sources added that reciprocal tariffs which have been imposed are based on trade deficits the US has with respective countries, and country-specific tariffs are largely aimed at generating revenue continue, as well as creating negotiating leverage for trade ties and trade deals with several countries. Sectoral tariffs have been placed higher as per sources to benefit domestic industry in the United States, though the cost of production will increase in the United States, which is already not too competitive in terms of manufacturing in some sectors. It remains to be seen how the situation is going to pan out with respect to the impact of reciprocal tariffs on India as well as other countries.
Abhimanyu, many thanks for joining us. President Trump has also unveiled the new Gold Card visa. In a press conference, Trump said that the new card could be available in less than 2 weeks. The card will be more than $5 million and will guarantee the buyer permanent residency and citizenship eventually. The card features Donald Trump's image. The Gold Card has been touted as a premium alternative to the traditional green card, which also allows for permanent residency in the U.S. Meanwhile, public insurer LIC has dismissed the U.S. trade representative's claims of preferential treatment by the Indian government. The country's largest life insurer maintained that it is treated like any other insurance company by the government and regulators. LIC CEO and Managing Director Siddhartha Mohanty said the USTR's views stem from an incomplete understanding of Indian insurance regulations. Now, the Trump administration's reciprocal tariffs may accelerate the FTA talks between India and the EU. Sources have said that the EU is watching out for concessions that India may give the US. Parikshit is standing by with more details. Parikshit, the India-EU FTA has been a project that's been more than a decade in the making. What are your sources telling you now on how these negotiations are likely to be impacted by the ongoing negotiations that India is having with the US?
We hear from sources who are privy to the negotiations between India and the European Union that the US reciprocal tariffs will indeed have a knock-off effect on India-EU FTA talks. Sources say Commerce Minister Piyush Goyal and his counterpart, EU Trade Commissioner Maros Sefcovic, are going to talk again very soon. This is going to be a phone conversation on the FTAs, of course, but also the global tariff situation. The tariffs imposed by US on both EU and India is likely to accelerate efforts to conclude an FTA by the end of 2025. Sources say India is very keen to have an FTA by the end of this year. We learned that EU companies are very keen on investing in India, but technical barriers are holding them back. The European Union is also following India-US trade talks very closely, especially on agriculture and dairy sectors. Reduction of tariffs on cars and components would be one of the central pillars of the trade talks, just the way it is important for India-US talks as well. The European Union is looking for a fully WTO-compliant FTA with India, not a quick fix, and something that will serve the countries in the long term. Speaking to CNBC-TV18, the EU ambassador to India has said that reciprocal tariffs strengthen the rationale for an India-EU FTA and it will not define them. He further said that there is determination and high-level political engagement to get an FTA done soon. European Union actually wants to see the fruits of a harvest by the end of the year and more progress by next India-EU summit. The ambassador went on to say, while there is good progress so far, both nations continue discussing elements of a meaningful trade package, and European Union is looking to significantly scale up cooperation with India in clean tech, semiconductors, defense and security.
All right, so let's see how those negotiations take off. Many thanks for joining us, Parikshit. That's the latest on the India-EU FTA dialogue. Time for a short break, but up next, the Indian startup community responds after Commerce Minister Piyush Goyal calls for a reality check. That and more when we return.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that.
Laurus Labs will invest 5,000 crores to set up a bulk drugs manufacturing facility in Andhra Pradesh. The pharma company said the project will generate direct and indirect employment opportunities for 7,500 people. The land for the proposed plant will be allotted by the state government. Shares of Hindalco dropping in trade. This after the company's board approved a significant fundraising plan and increase its borrowing limit. The company plans to raise up to 65,000 crore rupees for FY26. Additionally, the board has approved an increase in Hindalco's overall borrowing limit from 1.5 lakh crore rupees to 2.5 lakh crore rupees. Now, Commerce Minister Piyush Goyal has asked Indian startups to introspect on the sectors that they choose to focus on. Speaking at the Startup Mahakumbh 2025, Goyal said that startups are focused on food delivery and hyper-fast logistics, while Chinese startups are involved in semiconductors and robotics. Startup founders across the country reacting to those comments. But first, here's what Minister Piyush Goyal had to say.
We are focused on food delivery apps, turning unemployed youth into cheap labor so the rich can get their meals without moving out of their house. And against that, what does a Chinese startup do? Work on developing electric mobility, battery technologies, and with that, they're today dominating the electric mobility ecosystem. We are very proud of what India has done. But are we the best in the world as yet? Resources are going only towards hyper-fast logistics. And look at what the other side is doing. Robotics, automation, machine learning, preparing themselves for 3D manufacturing.
Well, that is the Commerce Minister there at the Startup Mahakumbh, and the startup community reacting to those comments as well. The co-founder and CEO of Zepto, Adit Palicha, said nearly 1.5 lakh people earn a livelihood on Zepto within the 3 years since its inception. He also said the company's contribution to taxes and billions has been attracted as FDI. Palicha said, and I quote, "If that isn't a miracle in Indian innovation, I honestly don't know what is," end of quote. Meanwhile, Zoho founder Sridhar Vembu, before stating Goyal's comments as a challenge to engineers and technologies, listed down areas where the government lags. In a strongly worded post, investor Mohandas Pai writes, and I quote, "Minister Piyush Goyal should not belittle our startups," end of quote. Meanwhile, Paytm CEO Vijay Shekhar Sharma said Indian startups are now at least being compared to global peers, which did not happen 10 years ago.
10 years back, nobody would have compared us to anything. The fact that you're being compared means that you're the challenger, you're the next in the queue. Many Indian companies are not only making the deep tech, the AI, the semiconductor, and you talk about the investments, you read in the newspaper, listen to your own TV channel. The beauty is that India has vibrant ecosystem. There are different stages, different companies are doing it. The success of let's say the commerce companies or many other services companies acknowledges that customers will also make a viable business model. So India, what it proves is that India is a viable business model. Number two, India has talent and capability to build and expand on new things, and the world is expecting from us.
Well, reactions there coming in. Lok Sabha and Rajya Sabha adjourned sine die, including the budget session, which began on the 31st of January. Data from PRS Legislative Research shows that the productivity of the session was over 118%. The Lok Sabha passed 16 bills and the House's productivity was pegged at over 118%, while the productivity of the Rajya Sabha stood at 119%. The Waqf Amendment Bill and the Immigration and Foreigners Bill were among the key bills to be passed in this session. Prime Minister Modi met Bangladesh's Mohammad Yunus for the first time since Sheikh Hasina resigned and fled the country. The Prime Minister urged protection for minorities in Bangladesh. Yunus raised Hasina's extradition and the Ganga Water Treaty. Now, the Supreme Court has pulled up the Delhi High Court for ordering the takedown of a Wikipedia page that's critical of the High Court's decision in the case between the news agency ANI and Wikipedia. The Apex Court has said that the court cannot be so touchy about criticism. Ashmit is standing by with more. Ashmit, this is an important order there that's come in from the Supreme Court. Take us through what the court has said.
Well, the court is extremely displeased with the Delhi High Court order directing for a takedown of a Wikipedia page. Of course, all of this pertains to a dispute between Wikipedia and ANI. ANI launching defamation proceedings in the High Court, saying that there's a page on Wikipedia which calls it a propaganda tool for the government, and this is what the fight is about. And now, in the midst of all of this, a fresh page appeared on Wikipedia which recounted the legal dispute between the two sides, and that is what the Delhi High Court has asked for a takedown on. Now, this is something that did not impress the top court. The top court said that judges of the Delhi High Court cannot be this touchy about this entire matter. That criticism is something that they need to take in their stride. Even asking the Delhi High Court, in fact, making its observations as to why the Delhi High Court ordered how it could pass such an order in the first place when there's no finding of contempt against Wikipedia, when there's no finding of defamation against Wikipedia, yet takedown orders having been issued. In fact, recounting their own experience, the Supreme Court, in fact, recounted how there is severe criticism in the media of not just the judiciary, but also the top court, that the judges need to take in their strides, that what is written today may be forgotten tomorrow, but the conduct of the judges is here to stay, and that is something that the High Court, that the Supreme Court at this point is choosing to highlight. The proceeding in this case, we understand, will resume on April 9th.
All right, Ashmit, many thanks for joining us. At least 112 Palestinians have been killed in Israeli attacks across Gaza in the last 24 hours. The Israeli army also conducted strikes on schools, sheltering displaced families, killing at least 33 women and children. Israel has also ordered more forced expulsions from southern neighborhoods of Gaza City. The UN has estimated around 3 lakh Palestinians were forcibly displaced since Israel broke the ceasefire in Gaza on the 18th of March. According to the Hamas-run Gaza Health Ministry, over 50,000 are confirmed dead, over a lakh injured since the beginning of the war. South Korea's suspended President Yoon Suk-yeol has been officially removed from office. The country's constitutional court voted unanimously to uphold his impeachment. This move followed his controversial declaration of martial law last December. The acting president will remain in charge until a new leader is elected within 60 days. And with that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
The tariff drama is done. The next big event in the economic calendar is the Reserve Bank's Monetary Policy Committee meeting on April 9th. Trump's tariffs seriously threaten growth, so should the RBI MPC be ultra dovish? As always, the Citizens Monetary Policy Committee of CNBC-TV18 meets to discuss the issues that lie before the RBI MPC and what they ought to do on April 9th. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh of SBI, Sajid Chinoy, JP Morgan, Samiran Chakrabarti of Citi, and Sonal Verma of Nomura. Gentlemen and Sonal, thank you very much indeed for your time. The first question has to be the global setup. So Sajid, let me start that with you. How does the global economy look post this massive tariff imposition? Are you seriously cutting global GDP estimates?
Lata, we're doing more than that, because I think you have to, what we've seen this week is a seismic event. And I think this needs to be viewed at 3 different levels. The first level is to understand that Asia has been particularly badly hit. This is no surprise. I think the tariff approach was a very mercantilist approach. If you look at where the US runs the 15 largest bilateral trade deficits, 10 of those 15 countries are in Asia. And therefore Asia, whether it was China, Vietnam, Japan, India, other countries were hit with very large tariffs. So this is going to hurt Asia directly, because now an export-led model that many Asian economies have with a lot of exposure to the US will come under threat. You've got large exports to GDP to the US and a large increase in tariffs. That's the first level. But there's a more important level here that affects the global economy. What this tariff increase does over the last few months is effectively increase US import tariffs by 20 percentage points. US tariffs are now the highest in over 100 years if these tariffs sustain. And this constitutes the largest tax increase on US households since 1968, when the US Revenue Act came into being, right? So the sense is that a very large tax increase is inevitably going to throw the US economy and with it, the global economy into recession later this year. And I think that's the big change from this week, that we now have greater concerns that the US and global economy will spill over into recession later this year. So economies now have to worry about both hits. A, your tariffs go up and that hurts your exports, but B, global demand is going to be much, much weaker later here because you're in a global recession. And number three, and we don't have time for that today, there's a much larger structural question. Is this the beginning of the end of the, 80 years of deglobalization that we've seen since the Second World War? And what does that mean for growth, for inflation, for productivity around the world? But those are more weighty questions that will unfold, in the months to come.
Yeah, no, that's a debate for another day. But for the moment, the MPC is going to be faced with an extremely difficult global environment. Samiran, we were already worrying about our own growth. This is an added headwind. Do you think there is space for extra dovishness or even requirement for extra dovishness because of the global story?
Thanks, Atab. I think the way MPC will probably look at it is that from a risk minimization perspective, now the downside risks to growth are much higher than the upside risks to inflation. That clearly opens up space for more easing. Our baseline is that we should see a 25 basis point of rate cut in this policy, along with a change in stance. The RBI has already provided significant amount of liquidity to the system for better transmission of this rate cut. And that assurance would also come in the April policy. Additionally, we have added an rate cut in the August policy also in response to this downside risk to growth. So that way we now have another 75 basis point of more rate cut in this cycle. But we have also very clearly mentioned that we are entering a period where it is possible to imagine that the policy rates could stay below the neutral rate also, because this 75 basis point rate cuts will only take us close to a neutral rate of about 5.5%. So given our estimate that inflation is running close to 4%, but there is a possibility that we might want to go below neutral also. But like it's a very, the world is in a state of flux. So I don't think policymakers will be very proactive always in this. Maybe to some extent, they will wait for how these things unfold before taking that final call on whether to go below the neutral also or not.
Okay. When we ask for your votes, let me see how many of them agree with you in terms of 3 more cuts or 4 more cuts. But let me first get the GDP numbers. That's also a forecast we will look for. Sonal, that question to you: will India's GDP growth number come under pressure? The Reserve Bank's current forecast or February forecast for FY26 was 6.7. Will they have to lower it?
Yes, we do think there's downside risk to the RBI's projection of 6.7%. Now, the direct impact on India because of US exposure is actually not that high. India's exports to US are about 2.1% of India's GDP. So the impact is manageable. But I think the indirect and sort of the second round effects are what could be more material because it's broadly a universal tariff that has been imposed. So global trade numbers are likely to get downgraded. Uncertainty is weighing on business investments, and tighter financial conditions will also feed back into weakness in private investments going forward. So we do think that the growth numbers starting April, which will reflect the real underlying export growth as compared to the last 3 to 4 months, where there was front loading ahead of anticipated tariffs, are likely to be materially weaker. Our own growth projections for India are at 6% for FY26, and we do think the 6.7 of the RBI is on the higher side.
Okay, 6%. I think that's not a number I heard from many people. I heard 6.1 to 6.3. But then the MPC has to concentrate on inflation. Soumya, that to you. Will India's inflation pan out as 4.2%, or can it be even lower?
Yeah, thank you, Lata. No, I think amidst this global turmoil, uncertainty, and a complete flask with the system has been thrown in since yesterday. I believe the good news is on the inflation front. The numbers for inflation are actually looking significantly better now. And if the current estimates holds, I think for most of the months in the current fiscal, I think till October or so, the numbers will stay closer to 4% or even lower than 4% on many of the occasions. So that means actually that the RBI target of 4.2%. In fact, for the last fiscal which has went by, the RBI projections will also be was higher, and this time also the RBI target of 4.2% inflation is likely to be undershot. So from that point of view, inflation as of now doesn't look a big issue. And there are two more factors which actually are downside risks to growth, which could also add to a comforting factor on inflation. One is the point that because of the global uncertainty on tariffs, there could be a price decline in some of the sectors which are more integrally linked. So that could also have a sobering impact on the inflation. And given the numbers and given the fact that the growth continues to be a little bit weak, so that will also give a comforting factor in terms of a manageable core inflation. So if I take all these factors into account, the inflation numbers are going to surprise on the downside, at least for now, for next several months in this fiscal.
Okay, point taken. Huge disinflation. You can't sell to the US, so you sell it more cheaply to the rest of the world. That big disinflation we will have to countenance. But Dr. Sen, let me turn the question on its head. Samiran is going to the extent of, even we have to go below the neutral rate. What about savings, sir? We are at, kind of a 5-year or what? Some people say even 40-year low in terms of household savings. Can we go no holds barred on cutting and dovishness?
Yes, in a sense, we can, and we will probably need to do that. So here I agree with Shomiran. We may actually need to go below. But this is not the time to do it. I mean, one has to think this through a little bit. You have to see what strategies different countries around the world are going to adopt, because there's going to be a wholesale change among almost all countries of the world in terms of the way they are going to plan their reaction to what has transpired. So yes, I think we should be prepared for lowering everything. Inflation, I completely agree with that. Inflation is likely to come down sharply, and this is not just about what's happening globally. It's also that if you really look around the world, the only country that really stands out as being able to grow on its own steam is India.
Yeah.
And so, when somebody talked about, I think, mentioned that the growth would be probably sub 6%, I think that's not a bad number, by the way, because other countries are looking at facing recessions. Yes. And I think we would be around the 6% mark purely on the basis of our own strengths. The point is, we shouldn't rush into anything until we see how things are evolving in the rest of the world.
All right. Fair point, sir.
Premature steps is, I think, a bad idea.
Okay, I'm getting a sense that we may not get a unanimous vote in terms of a rate cut, but that will be after the break. We will get our MPC members to vote on the rate cut and the stance.
Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers.
Welcome back to our Monetary Policy Committee deliberations. This is CNBC TV18 Citizens MPC deliberating, and our members, Shaumikanti Ghosh of SBI, Saj Shenoy of JPM, Samiran Chakrabarti of Citi, Sonal Verma of Nomura, and our chairman of our committee, Pranab Sen, have been discussing the issues before the RBI MPC that will come up on April 7th, 8th, 9th. Let me start now a little more about inflation. Sajid, actually that question to you. Soumya has pointed out that we'll probably undershoot even the 4.2% that the Reserve Bank has forecast. How much more? Can we even go below 4 given the global, disinflation and recession that we fear?
A lot will depend on how food prices evolve, Lata. But for the time being, I think India is benefiting from a perfect storm. We had February CPI at 3.6%. We think March is going to be close to that. So you will get a full quarter, Jan, Feb, March, where inflation will average about 3.8% or thereabouts. It's important to separate the different channels. We've always been maintaining that core inflation dynamics have been soft for the last year, because the economy still is, is living with some slack. Yes, core prices moved up last month, but that was just a facet of, gold and silver and ornaments. And that may happen again. Gold prices may well be a safe haven. So one will have to look through those commodity price changes. But generally, the sense is core, is benign. And the fact that, as you alluded to, that China has got a lot of overcapacity, and the fact that now transshipment through the rest of the region to the US will not work out because other economies like Malaysia or Indonesia or Vietnam have been hit with very high tariffs, means China's got all this overcapacity, which is increasingly going to find its way into other Asian economies, and that's going to be disinflationary. So I think the concern really is not on core A. B, this is a global demand shock. We're now seeing crude prices below 70. And so if global demand slows and you're into some kind of recessionary territory, that should be disinflationary for commodities. And C, in the near term, we're benefiting from very strong Kharif and Rabi crops. So in a way, this is the perfect storm. We expect to see inflation very close to 4%. For me, the only concern is we've had a series of food price shocks in the last 3-4 years. We can't rule that out, in the coming months. But I think the key point is, if there is slack in the economy, the RBI will be less concerned that a food price shock translates into wages and therefore can look through any temporary supply shock. So I think the bottom line is, unlike last year, directionally it's very clear where the RBI has to go because inflation is settling towards 4 and downside risks to growth have increased.
Okay. Actually, all of you are sounding dovish, but I still think that Samiran sounded the most... when he said that we will go even below, we should go perhaps below the neutral rate. Samiran, therefore, what are you expecting on liquidity? The governor's already flooded the system with over 7 lakh crore from January 15th onwards. Can there be an explicit CRR cut, for instance, even more on liquidity?
Yes, that's quite right. That just cutting rates and going towards the neutral or below neutral is not going to be enough from the perspective of transmission of these rates to higher growth. So there are kind of 2 different channels through which this plays out. The first channel, obviously, is that now we have 60% plus of loans in EBLR. So there will be an immediate relief on that front, which we expect that about 50-75 basis point of rate cuts is worth about 30 basis point of GDP positive impact. But however, the bigger transmission channel is through higher credit growth. And for that to happen, the rate cuts will have to be translated to lower deposit rates and lower lending rates and generate that demand for credit. In normal circumstances, we know that monetary policy works with long lags, but this is probably one of those times where the policymakers might want to get some immediate benefits as well, because this is not a normal cycle. So in that sense, there could be that additional impetus to provide liquidity and make this transmission faster. However, a large part of the OMOs we think is more substitutes for the VRRs that are going to mature very soon. So we don't think that a CRR cut is immediately on the cards. We have to understand that next month we're going to see a pretty large, substantial, maybe 2 to 3 lakh crores of RBI dividend also coming as durable liquidity into the system. So maybe this is not the right time for the CRR cut. But now we have to think holistically on CRR, LCR, everything, to take a call on how much reserves the banks should be holding. But that's more of a structural question, not an immediate matter.
Okay, I take your point. That big RBI dividend, probably 2.5 lakh crore or 3 lakh crore would come. So I'll withdraw my CRR expectation. Sonal, there is another way the RBI can show dovishness stance. Do you expect that the RBI can signal significant dovishness in April itself and change its stance from neutral to accommodative?
Well, our view is they can hold on to the neutral stance for now. There are two aspects. One is, the walk versus the RBI stock. Now, we know that policy transmission in India requires liquidity to be ample. And in fact, that's exactly what we've seen from the RBI in the last 2 months, with banking system liquidity moving to a more sustained surplus going forward in our view. So that is helping with policy transmission, and you could argue is a signal of an accommodative stance. But whether formally the stance needs to change to accommodative or not is more a strategic question in my view. And typically in India's case, the qualitative guidance on stance can do the job of easing financial conditions once rate cuts and liquidity easing have done their job. So I think we can probably wait to change the stance, but for all fact, the rate cuts plus the liquidity easing have already, done that signaling.
Okay, Soumya, the RBI already postponed the new LCR rules, the new project financing provisioning. They indicated a lot of dovishness with these actions in February itself. What is your sense? Overall stance, liquidity, rate, how can they show their dovishness and how much of it will they show?
No, I think in terms of the liquidity, RBI actually has been doing a commendable job, because the liquidity, which was in significant surplus, had turned positive as on March 31. So I think at over more than 1 trillion, the system was in surplus. So that's actually a positive move, because turning from a system of continuous deficit to a surplus has been because of the significant liquidity injections over a point of time. But we must appreciate that this policy of providing adequate liquidity as a buffer for better transmission, the Reserve Bank actually could promise the markets or make or ensure that this liquidity continues to remain in a surplus regime. There are significant liquidity injection coming in May. So the transmission has to be more effective. You must appreciate that last time when these rate hikes happened, in the rate hike cycle, out of the 250 basis point rate hike, the deposit transmission was higher than 250 basis points, but the lending rate transmission was actually lower. So the Reserve Bank actually would like to ensure that the deposit transmission also is in line with the repo rate cuts, because then that will give a better signal to the market in terms of an overall rate situation, which is comfortable for the entire financial markets. So I believe that the strategy of adequate stance, the strategy of repo rate cut will continue to move together to ensure that the transmission perhaps is faster this time, because we are already in an EBLR regime. So if the rates, it happens immediately. So possibly the liquidity will ensure that the lag which the monetary policy works, that also works faster, so that the transmission is overall happens quickly and effectively.
Fair point. I think the bankers will be very happy. They have been passing on lending rate cuts. Their raw material is not falling, deposit rates. I'm sure even all bank shareholders will be very happy with what you're saying. Dr. Sen, finally, sir, what should the Reserve Bank convey? The MPC is meeting under difficult circumstances. What should the overall tone be?
Well, I can only say what I would do there. The tone should be of calm. We should not give the impression that we have started to flap at what's going on. The tone should be measured. It should be calm. It should not give rise to expectations of excesses in either direction. And that, I think, is the most important thing at this time, because the problem at the moment is really a problem of uncertainty. What you need is a stable hand on the tiller, rather than saying, we've already, off the cuff, before we've had time to analyze, we are shifting course. That should not.
Fair point. The Reserve Bank should sound like it is anchoring the ship.
Yes.
And they have passed that test with flying colours in the past, so we should expect them, hopefully. But it's time that I asked my committee to vote. The first question is very obvious. What will the Reserve Bank and what will the MPC do to the repo rate on April 9th? Sajid?
A cut by 25 basis points.
Okay. Samiran?
Yes, 25 basis point cut.
Shaumyo?
25 basis point cut.
Sonal, CRR repo cut?
Only repo.
Only repo, okay. Dr. Sen, your committee is unified with a 25 basis cut. Your stance, sir?
At the moment, I wouldn't do any cut.
Okay, so actually a picture of calm. 4:1 for a rate cut. Let's come to the stance. What will RBI do to the stance, Sajid?
Change to accommodative, it will help with transmission.
Change to accommodative. Soumya?
It will be neutral.
Oh, neutral. Sonal?
Retain neutral.
Oh, really? Samiran?
A change to accommodative.
Okay, that's 2-2. Dr. Sen, which way would you tilt?
Neutral.
Neutrals. Okay, the neutrals win here. I was surprised. I thought it would be accommodative. The more crucial question, how many rate cuts in 2025, including the April cut? So is it 50 basis, 75 basis, 100 basis from April onwards? Sajid?
75 basis points with the risk of more, depending on the global economy.
Okay, so 3 cuts, perhaps 4. Shaumya?
It's 3 cuts, maybe higher.
3 cuts, maybe 4. Samiran?
Yes, 75 basis point. Possibility of more.
Okay, 75 basis. Sonal?
We're expecting 75 basis point in total.
All right. Dr. Sen, in 2025, how many cuts, sir?
75 or more, but I would do it over less tranches instead of doing just 25 basis points at each go. Because the first time you do a cut, you need to send a message.
Okay. All right. So
I would say you do 50 basis points at one shot.
Okay.
And then go to a 25 basis point cut later.
Okay, so you're expecting 50 bips now. I thought you didn't want a cut.
Not in April.
Not in April. All right. Got it, sir. Yeah. No cut in April, but a 50 basis cut as and when they start. Thank you very much for an extremely enriching discussion, members of the Citizens Monetary Policy Committee.
Charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very tough, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand.
Hello and welcome to News Center. I'm Parikshit Luthra. US President Donald Trump's tariffs have rattled global markets, increased fears of recession, and also potentially upend the world order. And even as economies across the world come to terms with how to deal with tariffs and understanding the magnitude of the tariffs, one thing is clear, it won't be business as usual trade anymore. China has already fired a salvo, imposing 34% tariffs on all US imports starting the 10th of April. US had announced 34% reciprocal tariffs on China on the 2nd of April, taking the total levy on Chinese imports to 54%. Today, we turn the spotlight on the global automotive industry. The Trump administration has imposed 25% tariffs on all imported vehicles and auto parts. As per S&P Global Mobility estimates, about 45% of light vehicles sold in the US in 2024 were imported. So what could be the possible impact of reciprocal tariffs on the global automotive industry? We're now joined by Mike Hawes, President of UK Society of Motor Manufacturers and Traders. Mike, thank you very much for joining us. We saw the statement issued by the UK industry body for the automotive sector. It was a strong statement of concern. How do you see the industry in UK getting impacted in the near term? And what would be your recommendation to the UK government in terms of retaliation?
I think, clearly the levying of a 25% tariff is significant. That is a huge cost that you can't absorb as a manufacturer. The margins are just too thin. So that will be passed on to consumers. Once you do that, raises prices. Yes, it's inflationary, but also suppresses demand. Take that back, which means that puts pressure on the manufacturers to reduce volumes unless you can find other markets. But then you look at the broader tariff, the 10% tariffs, that's at least everywhere in the world, potentially leading to a recession. So again, we can see this having a negative effect globally. So this is clearly going to be very damaging. The challenge for the manufacturers is how do you manage it at the moment in the short to medium term? Because the second part of your question, what do you need? At this stage, it's not about retaliation. I think first and foremost, certainly for the UK government, try and agree an economic deal that will mitigate or reduce some of those tariffs on automotive. That's the quickest way to try and relieve some of the pressure.
Right. I would also like to ask you now, when we speak about the next few months, how do you see demand getting impacted? To what percentage do you expect the production to be cut down to? What do initial estimates suggest to you over the next 3 to 5 months?
It's probably too early to say. Again, when we think about the UK manufacturers, the US is our second biggest export market after the EU. But the companies that export to the US tend to be high value, small volume manufacturers, sports car luxury. Think Jaguar, Land Rover, Rolls-Royce, Bentley, McLaren, Aston Martin, a tremendous stable we have here. Now they're selling into a market which, it's high net worth individuals that buy these vehicles. They can continue to afford a 20% tariff. Doesn't mean they will, though, because these are shrewd individuals, successful people. They know that there's the potential, if you wait and a deal is done, then the price might come down again. So it is a short to medium term. No one's actually measured, or forecast the elasticity of demand on that yet. But there is clearly going to be a potential reduction in production unless you can find other markets. But as I said, that's really quite challenging if there is a threat to the economies of all those global markets.
When it comes to India, we're not a car exporter, an automotive exporter to the United States for that matter. But yes, Jaguar Land Rover has significant operations in the UK and the European Union. How do you see the car maker getting impacted?
They did put out a statement a day or two ago, sort of saying they're a global manufacturer and they will adjust accordingly. They're big enough to manage some of these challenges, but they're not immune to it. They will be definitely exposed. So again, as you rightly say, they have operations in UK, in Europe. And they have strong demand in UK, Europe and other markets. So to a certain extent, they'll be looking to rebalance their production in as far as they can. But the US was a big market for them and is a big market for them. And whilst their products will still be in demand, there will be competition from vehicles made in the US, which potentially could become cheaper. How they manage that particular exposure is critical. And that's where having a very successful and financially stable company perhaps give them the ability to ride out what may be hitting them in the next few weeks and months.
Right. Now, if these 25% auto tariffs do not change and if they remain permanent, what impact do you see on jobs? One, on permanent jobs in the UK and the contractual jobs as well.
I think it's too early to say, and some reports are giving estimates, but I think they're largely fanciful at the moment. So we probably don't want to get too drawn into it. Undoubtedly, if you're going to reduce your output, then you do have to look at the number of people that you employ. Alternatively, you can slow down your production speed. Or you take out a shift, and generally the temporary workers who provide that buffer, because with any model, demand rises and falls depending on how old it is. So there's always some flex in the system. This will push that flex to the maximum. So, it's probably too early to sort of estimate. I think wrong to give numbers, but they're clearly focused on how do you retain your staff, because these are highly skilled people. You don't want to lose them. So you do all you can to keep them and try and ride out this particular challenge.
Mike, in terms of the global automotive industry, which geographies do you expect to be the worst hit right now? What is going to be the spillover impact of US reciprocal tariffs? Some of the trends that you can foresee for the next 3 to 6 months for that matter?
Well, the short answer is everyone is affected. The US is too big a market, and we've seen this morning, China's saying it will have reciprocal tariffs on US imports into China. Undoubtedly, the US is traditionally been a very open market. It's a very large market, second only to China. The successful brands, a lot of them have come from Europe, but also Japan and Korea. The Chinese didn't export many finished vehicles to the US, but they certainly export parts, components, and thinking about batteries as well. So, as I said, everyone is affected, but perhaps the most exposed are those who were importing into the US. One of the successful strategies many, certainly European, both Japanese and more latterly Korean manufacturers have had is to establish plants in Korea. That's where they make their best-selling models for the US, but that's not their entire range. There is still trade coming from Asia and Europe into the US.
Right. Speaking about the India-UK FTA now, what would be your expectation? Do you feel that now that reciprocal tariffs from US have kicked in, 25% auto tariffs have kicked in as well, it is now time for India and UK to negotiate an FTA faster and also a deal on the auto industry and auto tariffs as well?
Yeah, I think invariably what you're seeing is focusing minds. And you're looking for, potential other markets, and you want to reduce trade barriers. Clearly we're seeing barriers rise. That's not good for any particular industry because protectionism generally makes you uncompetitive, and it's not good for consumers because it will drive up costs. So the opportunity that certainly we have between the UK and India, and it's been encouraging to see both governments restarting those discussions in the last few months. Obviously, we have a new government in the UK since July last year, so that is encouraging. But it's not so much about speed. It's about getting the right deal that supports the industry, both in India and in the UK. And certainly when I talk to my colleagues in India, equivalents over there, they sort of, we view the two industries probably as complementary. What we make in the UK, isn't in competition with which made in India and vice versa. But getting that balance right for the long term matters.
Right. What would be your demand in terms of lowering tariffs in India on cars and motorcycles? Currently, fully built cars attract a duty of 70% in India. To what extent do you want this to be brought down? What has been your recommendation to the UK government?
Certainly we're in dialogue with the government. Again, it is about the balance. We'd like to see that come down. And I think, some of where the discussions were last year, there was certainly movement from the union side to reduce that. The exact number is, will be a matter of discussion because in any trade deal, it's not just a focus on one particular sector. It's a multitude of sectors. And automotive in any trade deal is always viewed as rather sensitive along with agricultural products. So it is about getting that balance between sectors and between the countries. But certainly, in principle, we always believe in free and fair trade. Now, those days might be over when you look at what's happened in the last week or so. But certainly where you can reduce those tariffs, you can make your products more affordable, raise demand and increase business opportunities. But it must be balanced on both sides of that negotiating table.
All right, Mike, thank you so much for joining us with your view on the UK automotive industry and the impact on the global automotive industry as well. And hopefully we would see some progress on the India-UK FTA talks as well. In fact, we have been reading reports that there is a in principle understanding to get it done as early as in the next 6 to 8 months. Let's see if that can be a reality or not. Thanks again for joining us.
Thank you.
Time for a short break here on News Centre. But coming up, Indian startup community responds after Commerce Minister Piyush Goyal calls for a reality check. We take stock of the government's strong commentary on startups with Aryan Capital's chairman, TV Mohandas Pai, when we return. Stay tuned.
That started 25 years ago believes that its best is yet to come.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, it doesn't feel like 25. I think life in the internet industry is life in the fast lane. Till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board.
Who said IPO?
Who told us on a January board meeting that, guys, you are ready to IPO. I said, what are you talking about? He's saying, yeah, 3 years ago we were at the same level and you guys are growing faster.
What's the most unusual celebration case that you've seen?
I believe they're now breakup and turning single again parties.
What breakup and turning single again parties?
Parties and get-togethers. like, listen, now guess what? We're all single, we party. But all kinds of stuff is happening, as we know. Like proposal economy is happening, People now, youngsters are choosing exotic locations to go make a proposal and they actually travel.
For the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before. Right? It's a combination of short-term vacations, and we've seen trends like...
The YOLO phenomena is here to stay.
And Gen Z. And it's real. And Gen Z.
The countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe, He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं हैं यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ.
Welcome back. You are watching News Center. Startup founders have stepped up to defend the ecosystem after Commerce Minister Piyush Goyal asked startups to introspect on the sectors they choose to focus on. Speaking at Startup Mahakumbh, Goyal said that Indian startups are focused on food delivery and hyper-fast logistics, while Chinese startups are involved in deep tech like semiconductors and robotics. Listen in.
We are focused on food delivery apps, turning unemployed youth into cheap labor so the rich can get their meals without moving out of their house. And against that, what does a Chinese startup do? Work on developing electric mobility, battery technologies, and with that, they're today dominating the electric mobility ecosystem. We are very proud of what India has done. But are we the best in the world as yet? Resources are going only towards hyper-fast logistics. And look at what the other side is doing. Robotics, automation, machine learning, preparing themselves for 3D manufacturing.
All right, let me now go across to... let's also get you some reactions actually first before we go across to Mr. Mohandas Pai. A lot of industry reactions coming in from Adit Palicha and also Vijay Shekhar Sharma today. So let's see if we can play out those reactions for our viewers.
Well, I must say that the payments pervasiveness will grow because if government or regulator or NPCI brings MDR, I'm sure and I'm hoping that it will come for the big merchants for whom it is not the cost so much. Rather, they pay larger cost even to the card-bearing customers. And then if this is staying free for small shops, so we will continue to see the expansion. At Paytm, because as you've seen, we champion the small shops to large shops, we do believe that MDR will bring a new revenue stream to the economy, a new revenue stream to the payment economy, and that will be a net accretive for the business and net accretive for the expansion of payments in India.
Yesterday, the Commerce and Industry Minister had alluded to startups in India and China and had explained the difference. How do you look at the entire ecosystem? Do you feel we are at the earlier end of the curve which China has already achieved, or there is much more which we need to do as a government or industry?
The first and foremost I love about it is that 10 years back, nobody would have compared us to anything. The fact that you're being compared means that you're the challenger, you're the next in the queue, and people expect something extraordinary about it. And that is the privilege. And there is no doubt about it. Many Indian companies are not only making the deep tech, the AI, the semiconductor, and you talk about the investments, you read in the newspaper, listen to your own TV channel. The beauty is that India has vibrant ecosystem. There are different stages, different companies are doing it. The success of let's say the commerce companies or many other services companies acknowledges that customers will also make a viable business model. So India, what it proves is that India is a viable business model. Number two, India has talent and capability to build and expand on new things, and the world is expecting from us.
With deep tech and AI, do you still feel there is more scope in that?
I would say that, it depends on the companies that are doing. I mean, there is no secret about it that we feel privileged that we've been able to do something in the payments, and it has become so wide. And I would again go back to sheer luck and God's love and acknowledgement that we were able to do it. It does not mean that companies were not doing that. And the same way, there are many AI companies and there are many AI products that will in due course show up. Obviously, it is something that some people started to invest much earlier, and India might have done some much later.
All right, let me go across to TV Mohandas Pai, Chairman at Aryan Capital. Mr. Pai, we have seen some strong reactions Many startup founders have been emotional. They've come up with strong reactions on the comments made by the Minister, Piyush Goyal, as well. But what's your thought as someone who's looked at the startup story of India very closely over the past few decades? Do you believe that somewhere we need to be more focused in terms of growing as a technology nation and innovation nation?
Look, we are growing as a technology nation, innovation nation. Let it be clear. We have 167,000 registered startups, 22,000 funded, with the third largest ecosystem in the world. What we achieved in the last 11, 12 years is truly extraordinary. I've been investing in startups since 2012. Through all my funds, we have more than 500 startups invested. We have about 50 or 60 deep tech startups. We see a lot of startups in Bangalore. 700 startups come for capital every month to Bangalore. And we have more than 4,500 deep tech startups in India as per Traxin. And Traxin has got the largest database on startups in India and possible in the world. We have all this, but they're very small companies and they all suffer from a lack of capital. The minister was right in saying that we don't have large deep tech startup. Look at what China has done. But he forgets to add, China invested $150 billion in AI over the last 5 to 7 years. China has invested $50 to $60 billion in the EV industry over the last 10 years and in battery technology. China has invested huge amounts in robotics and other areas. And China is a $19 trillion economy. We are a $4 trillion economy. China invested $860 billion in startups and venture from 2014 to 2024. India invested $160 billion, out of which about 75-80% is overseas capital. So these are the problems. And today we have a very oppressive regime in RBI. RBI goes after foreign capital, asks for unnecessary documentation, and is a big barrier for things coming. They're going after the venture capital industry today because of unnecessary regulations. And we have a system where big funds like LIC and others don't invest. There's a problem in this country. Minister is right.
Mr. Pai,
Minister, he must understand the problems, remedy the problem. We have met him many times earlier. I met him personally. And sometimes he has said that he's almost given up because he says the finance ministry doesn't listen. It took 8 to 9 years for the very, very wrong, oppressive angel tax to go.
Right. Mr. Pai, those are very significant points that you're saying, but what we would also like to ask you, and essentially what you're pointing out, that all these schemes for funding startups that have been announced till now, including a recent scheme by the Ministry of Defense to really support deep tech in defense, and do you feel that all these funds so far are very small compared to the needs of the industry? Of course, China, the amount of capital available from the government to startups is huge, is great in comparison. But what more can India do to make sure that there is more capital available? You're doing more in terms of skilling your workforce for innovation for the future.
Look, Parikshit, let me give you some data. The union government and state government spend 9 lakh crores a year as subsidy for the so-called poor people. Yes, poor people require the subsidy. Nobody is grudging that. How much do they spend on innovation all across India? How much do they spend on startups? 1,000 crores, 1,500 crores? That's peanuts, man. For a country of this size, 4 trillion, do we have enough money going into startups and for job creation? Who is spending that kind of money? We have a 10,000 crore AI fund, which has been announced by the government 1.5 years back. How much has been invested? We have some frontier tech fund or something the government has announced. How much has been invested? The government should give us data how much has been invested. We had a 10,000 crore fund started in 2015. We worked on it. I mean, it's been exhausted, it's done very well. Now they announced another 10,000 crore fund. In the earlier NDA manifesto, they said they're going to announce a 50,000 crore fund. We are not seeing that. They said they're going to have a 50,000 crore fund for research and R&D in Indian universities. We're not seeing much money go into that. There's been a lot of talk, but not much money has gone. I worked with startup for the last 13 years, and I know deep tech startup that take a lot of time to raise money. Money is not available because people are not willing to take long-term risk in this country because it's too small. Yes, the defense startup system has done well. They should do something bigger. They've done well. I think it's a very good start. But I think we need at least all across India, 8 to 10,000 crores at least to be spent on deep tech startups every year for the next 5 years. We need money for R&D for our universities. We need CSIR and DRDO to release a lot of technology like ISRO is doing to all the startups, though we can work together. We need a collaborative effort. You can't fight a battle with both hands tied behind your back. And what India has achieved in startup despite all is extraordinary. Look at what happened in the UPI area. All the startups have come, they work together with the government. Government had a good program. We are the global leader in payments. We're the global leader in payments. So we need something like that to happen. Look at EVs. How much money has India invested in R&D in EVs? Ask the minister how much has he invested. Very small amount. They all come up on their own. Now the companies are coming up, picking up. They're doing well. And I think we need much more capital. We need much more grants. We have to focus on innovation. Innovation requires money. It requires blue sky research. It requires universities to come forward. It requires PhDs in computer science, Indian universities. Remember that OpenAI took about 11, 12 years and spent a lot of money to start with ChatGPT, right? They've spent a lot of money. And see, we don't have that kind of money. And the focus in the government is just not there. They announce programs. I mean, it's all stuck in bureaucracy. Right. I agree with the minister that we don't have enough. But the minister, what is he doing?
Right. That's an important point. You're saying that you cannot fight a battle with your hands tied behind the back. But in terms of lowering what you call regulatory barriers for startups, when it comes to China, they set a goal for 25 years, 50 years. And we've seen the kind of engagement that Xi Jinping has been doing with tech CEOs from around the world in Beijing. How do we need to replicate this in India and also bring down regulatory barriers? You said that to remove angel tax, it's taken 8 or 9 years. What would be the next big ask from the industry in terms of lowering barriers for startups?
RBI is one of the biggest barriers for startups and flow of capital. They're very oppressive. They treat you shabbily. When you go meet them, they don't give time. When they give time, they look down upon you. They threaten you. They say that we are going to push regulations, penalize you for nothing. There's a big issue going with partly paid up units of venture funds, and they want to penalize the entire industry for a mistake that they have done. Who is listening to them? When we go meet them, they listen, look down upon us and say, this is what it is. They're not God's own creatures. They are an instrument of the union government, and they must be responsible. We can't grow a $10 trillion economy with regulations for a $2 trillion economy. Even SEBI has brought in a lot of regulations for AIF, which must be done away with, because AIF investors are sophisticated investors. They brought in a lot of regulations. Some of them are overreach. And today, we don't get long-term capital. How much money has insurance companies invested? Ask them, peanuts. LIC and all the insurance companies have a 18 lakh crore balance sheet. All around the world, insurance companies invest for the long term and make a lot of money. We have insurance companies and pension funds from Canada come here and invest a lot of money. They're making money. Why can't they invest? Because the regulations don't allow. So we got oppressive regulation by RBI, which is in a control regime. The IRDA does not liberalize the regulations, and government and the tax authorities go after you. If angels invest money, they get notices. Angels are getting scared. If you're an angel from overseas, you get a notice. Give me this, give me that. They threaten you. Give me 3 years tax notice. Give me 3 years balance sheet. Who are they to ask all that? If you have a PAN number, give the detail, they must accept it. The amount of harassment, the amount of thing is very, very high. All that must go. We cannot build a $1 trillion innovation economy based on regulation for a $2 trillion economy based on controls. Let me make it very clear.
Yeah. Okay, Mr. Pai, when it comes to having startups, now, Mr. Piyush Goyal made the point that, we are only focused on food delivery startups. Ice cream startups are being made in the country, and many of these are employing unemployed youth in the country, and they are being used as cheap labor. He made that point, and somewhere probably this is a concern for the government that we do not have a skilled workforce ready for the future. We're not as technology ready as China would be, for that matter. Having said that, because there are varying views coming in, there are startup founders who are defending the kind of job creation that have happened. There are others who are saying that this is a clarion call and should be seen as a challenge by the industry. What do startup founders now need to do? Of course, they will go wherever there is a business case. But if you had to give some advice, or if there was a point where you think the startups in the country need to think for the future and probably take an example from China, what would that be?
Parikshit, saying that you're taking cheap labor, look, they're all getting jobs, man. They're filling the belly. I like that that CEO who stood up and said, I'm giving jobs to 1.5 lakh people. If he's not given jobs, where will they be on the street? Is Minister Piyush Goyal giving to give jobs? Whose job is this to train people? Whose job is to skill people? It's a government job. It's a public investment that's required. The IT industry skilled 6 million people over the last 20 years. I was part of that. We skill them. We spend $3 or $4 billion a year. We created our own thing and created a world-building industry. What did government do to skill all of them? The education system is broken. They got half-trained people who come out of the colleges. We hire them. We train them. We spend money on them. We pay them salaries and we build this great industry. Right? We did it. What did government do? Yes, they gave us a tax break, which is very good. Now, for all this skilling, they have to spend money. Only now they have an internship program, even a half-baked scheme, but it's still better than nothing that they have. I think the food delivery companies are doing a great job. Like Zest said, all the great AI technology has come from people like Amazon. Amazon set up AWS. They did the cloud technology. They have done the AI. All the AI companies have come from the, from the startup, from the social media. They have done it because they got a huge of data.
Mr. Pai?
It's part of the system. So I think, look, don't deal with us, support us, work with us, solve our problems. We don't want one more minister pointing fingers at us. We are working our butts off building this country. I've been working on this for 12 years. I put almost all my money into startups. I'm funding them for 12 years. We are helping them. Now to hear minister talk like this is really hurting all of us. I think he must calm down and he must call all of us, listen to a problem and solve them and stop the oppressive regulations of RBI and others, which is really a barrier. Regulations for a $10 trillion
We've completely run out of time, sir. Unfortunately, we've completely run out of time, but thank you very much for joining us with your views on this challenge that has been thrown by the government and how you see it. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
अध्यक्ष महोदय मैं कहना चाहता हूं ये जो बिल लाया जा रहा है भारतीय जनता पार्टी में एक मुकाबला चल रहा है भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक अध्यक्ष महोदय भारतीय जनता पार्टी क्या है
जी मैं अखिलेश जी ने
Let's talk money.
Hello and welcome to the first edition of Let's Talk Money. You might be wondering what I'm talking about. The first edition of Let's Talk Money in the new financial year. Yes, FY26 is here and therefore we thought that it's a good time to start from the very beginning. A very good place to start. Financial planning. Why you need to understand the concept, why you need to spend some time and create the right financial plan for you. I'm, of course, your host and your friend, Surabhi Upadhyay. And today, to get us off to this good flying start, we have with us Kalpesh Ashar, who's a certified financial planner and also a registered investment advisor, and also Prableen Bajpayee, who's the founder of Finflix Research and Analytics. Ladies and gentlemen, thank you so much for joining in. And let me start by wishing both of you, as well as all of our viewers, a very happy, new fiscal. May it be a prosperous one, may be a positive one for all of us. So some opening thoughts, and I want to start with sort of experiences because both of you interact with so many people, clients, money management, financial planning. The awareness is definitely increasing that I need to invest, I need to retire rich, all of that. But is the awareness for systematic financial planning, Kalpesh, is that also increasing now?
Okay, so first of all, thanks for having me on the show, Surabhi. And I like the new greeting which we've, just coined, which is Happy Financial Year.
Yes.
So I think that should go with everyone. So answering this question, Surabhi, surely financial planning, and I would put it in perspective, personal financial planning has come a long way. I think in the last 15, 20 years when before this, term was not even known to people and everybody just knew what are markets and what is fixed deposits, the concept of personal financial planning has really grown. And I would still like to add that there's a long way to go considering that we are evolving so fast in our finances, in our economy, on a personal level, everywhere. And nothing is more important than everyone's individual personal financial plan.
Absolutely.
Because if you can't make this as a generalized statement, it's everybody has got a different profile, everybody has different types of challenges, and everybody has different capacities to fulfill his financial life. So financial planning per se has evolved.
Sure.
And earlier, which we used to just look at investments, now it's become more of a life planning concept.
Which is exactly what I wanted to talk about, and just bring in Prableen before we get down to the nuts and bolts of it. Prableen, because it's very true, even now I see a lot of people around me talking about buying a great mutual fund, and you want to be with the best performer. People feel very happy saying, oh, I bought NVIDIA and then it doubled or trebled. But why is it important to not sort of be very picky about these one or two aspects of your investments or tax saving? Why is it important to look at it holistically?
So I think Kalpesh has already covered it. And Surbhi, it's so important because when we talk about investment planning or tax planning, that's a small component of the overall concept of financial planning. So financial planning and how you're going to manage your cash flows, your taxes, your investments, these are all the smaller parts within this overall journey. And it starts from you analyzing, how much you're earning and spending. And I think for all of us who keenly watch the budget, we want to know how much the government is getting as revenue, how much it's spending, what is its fiscal deficit, how much are they exceeding their revenue by. I think it all actually applies on to us as well as individuals. So we need to do that at an individual level where we actually need to analyze the same data for ourselves in our lives so that, we as just the way we are expecting the economy to do well based on, strong macroeconomics, our own personal finance has to be strong so that, we have a good, fruitful financial life for ourselves.
Okay. So we need to have a financial plan. The question is, how do we get one and how do we build one along with perhaps an advisor? So what are the first steps? So the first sort of principles, Kalpesh, that one must keep in mind.
So the crux of a financial plan, it should be directional and it should be goal-centric. It should be able to help the person achieve his or her financial goals in life. There has to be a purpose, there has to be a motive. So how do we go about doing that? It's very structured, and I would put it simply that it's a way of life. It's just simple common sense. And people normally, what they say is that common sense is not common. And that's why they complicate things. So in financial planning, we have, I would say, the 4 to 5 pillars, which we would like to incorporate in the plan. First and foremost is the cash flow, which is nothing but enumerating your income and expenses. Very, very important, nothing but a personal budget.
Absolutely.
And many individuals, many people who think they are financially savvy, don't even, honestly speaking, know how much they spend per month. It gets down to that level. And that is where the root cause of all problems lie. So first is understanding your personal cash flow. Second is, more importantly, understanding your personal net worth. And what is the net worth comprising of? It's all the assets which you've built up thus far, minus the liabilities.
The loans.
The
borrowings.
So what do you have in assets? So you have your financial assets, your stocks, your mutual funds, your FDs, your bonds, and you have real estate. You have some investments in commodities, gold, and liabilities. So that could be your different types of loans if a person has taken, and even your credit card outstanding as on date. So that would give you a very pictorial and a numerative
what your net worth
is.
Got it.
The third part is basically, I would say, the heart of financial planning, which is understanding your financial goals. Because your income, expenses, and your net worth should be moving towards achieving your financial goals.
They should be aligned, right?
Aligned. Because that is where you select the right product to achieve your financial goals. And that could be different for each and every individual according to his life stage, according to his own perceptions and his shortcomings. So everything can't be hunky-dory, but for most of the people, if they give themselves a certain financial goal, say for example, a short-term goal, medium-term goal, and a long-term goal, we can, as planners and advisors, channelize the right instruments and the products which help them achieve to the goals. And obviously the most important last thing is protection. And how do you do that? Through ring fencing your assets or your day-to-day life through the right insurance, because there's a lot of wrong insurance being sold and missold, I would say. So you get the right insurance, adequate insurance, and obviously create a contingency fund for yourself. Because what if you have a event which is not foreseen.
Sure.
So you can combat that without disturbing your financial plan.
This is very good. I'm going to recap this. 4 pillars. Make sure that you have your mind wrapped around them. Your cash flow, what is your net worth? Investment linked goal planning. So is it all aligned in one direction or not? And then, of course, insurance and risk mitigation. Extremely important to have that as you start off with your financial plan. So what we're going to do now is, Pravleen and Kalpesh, is that we wanted to reach out to our viewers and we wanted to help them at least start off on that journey of creating a financial plan, seeing if their goals and investments are matching or not. So we've got 2 viewers joining us on the show today, and we hope to be able to help them with some advice. Jaya is the first one joining us on the show. Jaya, welcome to Let's Talk Money. Great to have you on. Tell us, how can we help you? Do you have a goal in mind?
Yeah, 2 goals. One is for travel to accumulate corpus of 20 lakhs. Another for retirement at the age of 50. Targeted corpus is 18 crores.
Oh, okay. So 20 lakh for vacations and 18 crores for travel. Clearly, the travel bug has, bit you quite a bit. But we need some more information as well, Jaya. Tell us a bit about your income levels, if you don't mind us asking.
Yeah, like monthly right now, I'm getting around 75K in hand.
Okay, so a monthly salary of 75,000. How much are your expenses and how many are fixed expenses? How much are you able to save or invest at the end of it?
My fixed expenses are right now about 20K because accommodation is provided by the company for me. So food and other accommodational expenses are about 20K.
Okay, that's great. And then with the money that you have left in hand, how much are you already investing? And also your
I'm
age.
30 and I'm investing 40K per month.
Oh, so you're investing 40,000 rupees every month. You're 30 and you have 2 goals in mind. One, build a pot for travel, and then, of course, build a pot for retirement. Got that. Pravleen, let me come to you. And I must say, Jaya, compliments to you because you've managed to keep your expenses under check. You're already investing 40,000 rupees, which is a sizable part of your salary every month. So, really compliments to you on that. Pravleen, what should she do? Where does she begin?
Absolutely amazing, Surbhi, because more than 50% of her salary is being invested, so which is great. So, the 2 goals that she's just listed out actually tells us that how important financial planning is, because I think more and more, many of us want to actually travel, and we do have the retirement as one of our very, very crucial goals. So for Jaya, if she's looking at a corpus of about 18 crores for her retirement 20 years from now, she will require a huge SIP, which is actually about 1,80,000 a month if you're looking at 12% returns on her investments. Now, of course, I think 12% is a realistic estimate here, Surbhi. But if she can step up, then somewhere around 1.3 lakh a month is what is required with a step up of about 5%. The investment that she is doing now, if we just utilize the whole 40 for her retirement corpus, then out of this 40 with a 5% step up can actually give us a corpus of about 5.5 CR in the next 20 years, which is much lesser than what she's expecting. And this 18 crores, what she wants in 20 years, would have a value of roughly 5.6 crores as on date. So the 18 crore in 20 years will be worth 5.6 crores of
because
today.
of inflation.
And Surbhi, for her, and for her travel goal, if you're looking at 20 lakhs without inflation, then all she needs to do is an SIP of 2,000 per month for the next 20 years. But if you're looking at a 6% inflation here, then the corpus need becomes bigger, about 65 lakhs. Then she requires about 6,500 per month for her travel goal. So inflation is something which really needs to be kept in mind. And we're not taking this 20,000 monthly expense, I think, to calculate her retirement requirements, because, I think it's really, really small as compared to what it would be if she's not getting the accommodation and once she has a bigger family size, perhaps.
Okay, so could you just repeat the advice on the SIP that she needs? She's already doing 40,000. So if she were to, either she has to obviously reduce her aspiration in terms of how much she wants to create for travel or retirement, or what is the other way, workaround, if at all?
So travel without inflation is only 2,000 a month, Surbhi, which is easily doable. Travel with inflation is also about 6,500 a month, which is again, I think not much because she's doing 40. But the 18 crore corpus, that actually requires a 1.8 lakh a month SIP, which is big. And she's only doing 40. So, 30 gone out of it. So still, there's a huge gap there. And if she's doing a step up, then it can help. But probably she could just keep doing her 40, and as and when, the salary increases, she keeps increasing. Hopefully there will be a bigger jump in the salary. But for now, she needs to sort of trim down on the corpus that she's planned for herself.
Okay, so a bit of a reality check sometimes is required. Kalpesh, very quickly, before we move to the next query, what would you advise?
So I think absolutely Prableen has covered the thing. Just a little bit of input from my end regarding her travel goal, which she's putting. So rather than keeping the burden on the SIP, I would just ask her to divert, if she's getting any bonus or, ad hoc pay in her job, of creating a corpus towards the travel expense.
Okay.
Because that is like a luxury.
Yeah, and you don't want to wait, 20 years to travel. You want to do it in the next 5 years.
5 years. So if she gets any bonus or an ad hoc, increment or something, that much part she keeps as a dedicated lump sum for a travel expense.
And let that compound.
And let that compound. And in that, even if not 20 lakh, I think again it's more about human behavior. If she's able to manage 5 lakh, she might as well go on a trip worth 5 lakh and enjoy that money. Why wait till 20 lakh?
Absolutely, take your point entirely. All right, we'll take a very quick break on that note. On the other side, we connect with one more viewer, try and get another financial plan going for them.
Let's talk money.
हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। ये सामने जितनी पार्टियां हैं, उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this is the first episode of the new financial year, which is why we're starting from the beginning, which is setting in motion a very clear, very well thought out financial plan. So we've helped Jaya with some of her goals and her ambitions in life. We have now Ayush Ray joining us. Ayush, welcome to the show. Tell us, how can we help you? What's your goal?
As my financial goal is to create a corpus of close to 10 CR in the next 5 years. Currently, my existing corpus would be in the range of 2.5 CR. So the remaining 7.5 in the next 5 years.
Well, that's really precise, huh? You want 10 CR in 5 years. You've reached 2.5 crores and you want to cover the rest of the distance. All right. Some more inputs will help us. What about your monthly income?
So the monthly income is in the range of 4 lakhs per month.
Lakhs per month, all right. And your monthly expenses?
Currently, I try and make it a habit of investing 2 lakhs per month. And hopefully I would be able to increase that amount by cutting down some expenses. But that's the rough estimate.
Okay, so you earn 4 lakhs a month. You manage to invest half of that, which is also great. So, kudos to you once again. Let's ask the experts. So he's got a very precise goal, 10 crores in the next 5 years. He's already reached 2.5 crores. Now, is it even possible? Even if he's all in equities, is it possible?
So first of all, Surbhi, both the viewers are utopian investors. I think if everybody invests more than 50% of their income
what a great
into
place
investments,
to be.
it will be a great place for our markets, okay? And for them individually to achieve their goals. So now on a realistic side, I think, again, congratulations to Ayush that I think he started early. Because already, if he's made a corpus of approximately what he mentioned about 2.5 crore, that's pretty sizable. The only thing what he, I think, needs to understand is that the target now, the journey forward, he needs to be a little bit more realistic because he's still wanting to get another 7.5 CR in the next 5 years.
Investing 2 lakh rupees every month.
Per month. And even if we do a normal conservative calculation at 10% or 12% on a CAGR, he needs to do a very sizable, I think, SIP of almost, if I'm not mistaken, a very large sum, which is more than his salary itself. So I think what he could ideally do is stretch his retirement or his corpus time horizon and go with a step-up type of a thing where he could reduce his expenses like what he said, if that's in his bandwidth, and try to achieve that corpus. But here he needs to be realistic because he's done the journey presently very, very efficiently.
I just want to highlight this table that we have on the screen and what it illustrates. It's a really great one that Praveen shared with us. We're taking the example of someone who's doing a 10,000 rupees SIP, and let's say they want to reach their target retirement corpus by age 55. The earlier you start, the better it is. The person who started at age 25 gets to a corpus of 3.5 crores. Someone who started at 35, 1 crore. 40 years, you're only at 50 lakhs. If you start later than that, well, then, it's 23 lakhs, which is what? Not even peanuts when we're talking about retirement security. Praveen, anything to add to Ayush's query?
I think, Kalpesh has covered it. So amazing the way but I think this table, Surbhi, which you shared in the example of Ayush, I think what we see is that compounding actually happens in a longish time period. So if you can allow a little more time for your money to work for you, I think it can be so much better. Because this example, which, you're flashing on the screen at 45, for example, if when somebody is starting and, we see just about 23 lakhs is created. This 20-year difference, we often have this tendency of overestimating our earning capacity. So even if we are doing 4 times at 45 of what we were doing at 25, we will only be at 93 lakhs. If you're doing 8 times of what we're doing at 25, we'll still be at half of what we could have achieved by starting at 25. So we have to do 16 times of what we were doing at 25, Surbhi, when we start at 45 to be able to reach the same corpus. So I think Ayush has done a great job. And if the time can be just stretched a bit for him, I think the goal achievement can be so much easier.
Whether it's wealth creation or whether it is weight loss, both become more difficult with passing age. It's better to start early, right? I think that's the rule that comes to mind. Absolutely. Ayush, hopefully that kind of helps you out. Now, I just want to end with some basic brass tacks rules that one must keep in mind. And probably let's talk about loans. We spend a lot of time talking about our investments. Perhaps not enough time is spent talking about loans. And I think one question that always confuses people is whether I should invest, whether I should, redeem a mutual fund, and then, pay for a short-term goal, or whether I should take a personal loan. What's your preference here?
So I think dependence on debt is really rising, Surbhi, and that is one of the worries, I think, especially the today's generation. So we pick anybody, any example, I think, of course, a home loan is a productive loan. An education loan is a productive loan, but we are increasingly seeing personal loans, vehicle loans, and for discretionary spending, that bucket is really rising. So I think it's important to understand that if you're taking a loan, it should be ideally for productive reasons, which is your home and your education. Otherwise, one should try and trim it. And if we take an example, let's say, travel, because we've been talking about it all along the show. So I think if somebody wants to travel abroad and requires about 3.6 lakhs, it can be done by saving 20,000 a month. But you need that 18-month period to be able to achieve that 3.6 lakhs. And if somebody is really in a rush and says that, okay, let me just take a personal loan and go on my trip. So a personal loan costing him 14% will result in him or her paying an EMI of almost 12,300 for the next 3 years, wherein the interest amount, the extra that they'll end up paying is roughly 83,000. And if you're doing your own saving and going on the trip, Surbhi, that amount is free for you to save and invest later. And if you're doing this, taking this loan, not only are you paying this interest amount, but you can't channelize that amount because you're now paying an EMI towards any savings. So it is so important to keep your debt under check. So check your debt to income ratio, put all your EMIs together, calculate how much it is, and it shouldn't be more than roughly 30 to 35% of your take home. That is really important. And there are different ways of reducing your debt, either by following, the highest interest amount first, or maybe the smallest loans. But it's really, really important to clear out that bucket if you do have more than the home loan and education loan. So unproductive loans need to be cleared out first.
Okay, all right. That's very good advice, very well taken. Kalpesh, finally, to now come to final thoughts. You gave us the key principles of a financial plan, on which a financial plan will rest. What about the important steps or the rules, to follow through on that plan? Whether it's your expenses, whether it's that emergency corpus, whether it's stepping up your investments, what are some of the other rules that one must try to follow at least?
So a person should introspect first. And as I said, nothing more important than a cash flow. So in that, first, just, create 3 buckets of needs, wants, and lifestyle. I think once a person, hand on heart does that, he will automatically be disciplined. And like Prableen gave the percentage, that even if you have a liability or you want to repay a loan or something, it should not be, according to me, more than 25%. Sure. Because then it starts eating into your lifestyle, your utilities, and even your savings and investment thing. Yeah. Second thing is, be very, very careful about the insurance part. Because that is one aspect in India where I have seen people are bleeding through their nose, yet they pay premiums in the wrong policies. Just a simple fundamental rule: insurance is for protection and investment is for growth. Please do not club both the other, each other, Keep it separate. Third thing is that investments which you make should be in products which are liquid, which are transparent, which you understand. I think, trying to be a part of the FOMO or the fad or the latest thing which gives you high returns in quick time, I think they fall flat and people have got stuck at the wrong end of the tunnel many a times. So they might be making money, but they've never created wealth. And that is, I think, the fulcrum of the whole plan, that we want to create wealth. And wealth is created by a thought and action.
Absolutely.
So I would like to sum it up in that have a goal, pursue it with discipline, and check your behavior.
Oh, absolutely. Very well said and very well summed up as well. I think if we can follow even 70 to 80% of this advice, we will, go a long, long way in realizing our financial as well as life goals. Thank you very much.
Thank you.
Kalpesh and Prableen, thanks to both of you for joining in on this first show of the new financial year. Well, viewers, hopefully you found that conversation useful. Keep connecting with us. Send us more questions, topics that you want us to highlight, and we'll take it up in the coming weeks. Thank you for watching.
Let's talk money.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shriram.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
That started 25 years ago believes that its best is yet to come.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, I mean, it doesn't feel like 25. I think life in the internet industry is life in the fast lane. Till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board.
Who said IPO?
Who told us on a January board meeting that, guys, you are ready to IPO. We said, what are you talking about? He's saying, yeah, 3 years ago we were at the same level and you guys are growing faster.
What's the most unusual celebration case that you've seen?
I believe they're now breakup and turning single again parties.
What breakup and turning single again
Again,
parties?
their parties and get-togethers. like, listen, now guess what? We're all single, we party. But all kinds of stuff is happening, as we know. Like, proposal economy is happening, yeah? People now, youngsters are choosing exotic locations to go make a proposal, and they actually travel.
So for the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before. Right? It's a combination of short-term vacations, and we've seen trends like
so the YOLO phenomena is here to stay.
And Gen Z, and it's real, and Gen Z.
"25 years ago, a young man called Deep Kalra decided that he wanted to get into the online travel business. 25 years later, Make My Trip is one of India's leading travel companies and has seen a record-breaking 23-24. Here's the Make My Trip story over the last 25 years in numbers. 80 million plus lifetime transacted customers, 490 million plus app downloads, 519 million shopper visits. That tells you of the story of Make My Trip over the last 25 years. In 2010, they decided to list on the NASDAQ. They've seen a flurry of acquisitions through the course of their journey, and there's been plenty of learnings, plenty of setbacks, but it's been an exhilarating ride. Joining us now to talk about the story, the last 25 years, but more importantly, the next 25 is Deep Kalra and Rajesh Magao. Deep, Rajesh, many thanks for joining us. Deep, let me go back 25 years. So much has changed, so many low points in the course of your journey. On many occasions, it was almost a question of, will you be able to make it through? But you have, and you survived, and you're here to tell the tale.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, I mean, it doesn't feel like 25. I think life in the internet industry is life in the fast lane. So it moves so fast. I mean, you can look back, and typically, I think somehow it's waves of five years for us. It's been that kind of story. So first 5 years were all about, I think, just survival.
Yeah.
And making sure that, yeah, we live to see another day. At least 3 of those 5 years were really dark. But when I look back, the best years, because that's when really, a germ of an idea became proof of concept, became a business, started making money. The team was together and there was a shared common passion, dream. And then it actually was happening despite all the odds. So I think that was a great period. And 2005 to 2010 was just this ferocious run to IPO.
Yeah.
And till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board,
Who said IPO?
who told us on a January board meeting that, guys, you are ready to IPO. And we said, what are you talking about? He's saying, yeah, 3 years ago, we were at the same level and you guys are growing faster. You were growing 50%. You should IPO.
And this is a man who didn't know whether the Nasdaq would in Patparganj or in
Well, this is a man who knew a lot actually and still knows. But he told us, and we took it very seriously. We were surprised at the meeting. Rajesh was CFO then, and we put our heads together. And he called a meeting. And I think for the next 6 months, he and the auditors and the lawyers, they just pitched tent in office. And in 6 months, we had IPO'd. August 2010, we IPO'd on NASDAQ, being one of the first internet companies from India to IPO there, first travel company from India to IPO there. And it was great. And then I think from 10 to probably right up to COVID was overall a really good run. Some hiccups, of course, when Kingfisher went down, it kind of challenged the whole domestic air industry. We were very domestic air dependent. We started building out a hotel business in right earnest. But it was a pretty good run till then. We had a huge acquisition. We acquired GoIbibo and Redbus at that time, learned a lot about how to assimilate large acquisitions, and then COVID.
Yeah.
So I'm just giving you the short version. And I think COVID all over again was truly, I won't say near death for the company, but it was a complete reset. Because our business went down. We reported a quarter, we were 96% down on revenues. And it was crazy because, this was national lockdown, of course. And to come back after that, to restructure cost base as much as you can. Obviously, COVID had to lift, but the way travel has come back, we all know.
Yes.
Now, you can't get a room, you can't get a seat, everything is double the price. But people have, I think, in their minds have said, listen, if I have a bucket list, I'm going to tick it off now. I think we as a company came back stronger because we went about restructuring cost in a very serious way. Like we said, okay, fixed costs, wherever we can reduce, we should. Some of the toughest decisions ever were taken, which is, yes, we had to let go of almost 10% staff, which was very hard. Have tried to take many of them back as things have got better. But I think we came out much stronger, definitely stronger than industry. And as crazy as it sounds, I think our last year has definitely, by all measures, been our best year ever. Over the last few years, we've seen growth and profitability both come together, the holy grail of the internet world.
Yeah.
We probably, I think that's what a couple of VCs had reported, we probably make more EBIT, more profits than any other internet company in India, which is a great, it feels really good. And it's a biggish company now. So when you look at the number of people and all, it's a little scary. But, knock on wood, couldn't have asked for a better 25-year script.
And an appropriate sort of 25-year gift is the fact that as you said, you've reported your best numbers ever, 46 million in quarterly profit. That's your best performance, $11 billion in market capitalization. So it's been quite a run. But Rajesh, before I get to the numbers, I want to actually talk about how you and Deep got started, your exit, and then your return to Make My Trip, because that's also an incredible story. And it's really part of what keeps Make My Trip going.
Yeah, no, absolutely.
You should share that.
No, I know. And that's a very, very interesting story. And I guess Deep likes to put it always saying maybe it was destined to be like that. So here it is, the way it has started. So, I joined and Deep was looking for a founding team at that point in time, which is Deep's idea. Deep set it up in 2000. And I approached him. We had a meeting, really long meeting. And I think I was in that meeting, decided that, Deep and I should work together. I should rather work with Deep. Because the way the whole meeting happened, the way the whole conversation happened, one, of course, the new age startup idea was an interesting idea. And I was getting ready to get into a new age startup because I had the corporate experience behind me. I had worked with AppTech for about 5 years. After that, there was actually a NatTech startup that I worked for about a year. So it was a bit of a dry run for me just to get into like a full-fledged sort of startup. I was getting sort of ready for that. So those two things happened. But here's the most interesting part that happened. So, after I said, yes, I'm ready to come and work with you, and Deep explained it to me. Make my trip, here's the idea, and we've raised some money. We've got some money. We've got like $1 million already, and we'll get another tranche of another $1 million because there was the $2 million that was raised.
Which I promised you was our promise from our VC.
Yeah, it was the promise from the VC.
They backed out.
And then it so happened 1 month down the line, the circumstances changed, and Deep called me once, and I remember I was in the car, I was driving, I parked my car near the Taj Hotel. I think I was just coming from the work. And Deep said, in all his honesty and transparency, he said, I have to share an update with you. I said, what's happening? So he said, I told you that there's going to be some more money coming in because the developments had happened by then. And they're backing out and we won't get that money. I just wanted to let you know. And I don't know whether you've quit from your previous job or not. But it is only, fair for me to share this update because this is the new development. This is very different from what we had spoken about. And the second thing is, so therefore I wanted to actually give you an opportunity. So you think about it. I wanted to let you know this information. And to be honest, and I told that to Deep at that point in time because it actually further sealed it for me. And I'm saying, here's the man who's actually coming back, who would have cared? I see Rajesh has just agreed to join and he's coming on board and joining. Who would have cared to call and said, here's the development, we may not have money? Because when I actually joined, Deep was in the US trying to actually look for more money. And we had only 1 month money, like literally 1 month money at that point in time. And I said to Deep, I said, don't worry about it. I have actually quit already. But even if I had not, I had made up my mind. And, we'll sink or swim together.
I remember those words so clearly.
Yeah.
We'll sink or swim
He
together.
said, we'll sink or swim together.
Yeah. So, because I was ready for it. I mean, so it was just a matter of, and also it's just a matter of just clicking sometimes, right? So you like a particular person and saying, well, we'll figure something out, right? I mean, we go there. Because that is what we have to. In any case, it was supposed to be 1 million is nothing, right? I mean, it just gets you going.
And at that time, it was 48 rupees. So 1 million was actually much less. It was barely 5 crores then.
Yeah, but small money, right? I mean, you're not going to build long-term sustainable business with that small money. So in any case, it was going to be first job that I had was to start looking for more money. So anyway, this is how it started. And then, because before we started, we realized that India wasn't really ready, right? So then not only the money was the issue, but the other development that happened, SARS happened, and the product market fit was not there. India's internet ecosystem did not exist at that point in time. So we were definitely pre-sunrise at that point in time. So then we was wondering about, what to do. So I think the better sense prevailed and we said, I don't think we can launch in India, so that pullback happened. And then the niche was sort of
NRI
the NRI audience.
Yeah.
And then we started, and then e-bookers from UK. And that's the other part. And that's why when I went on the other side and came back later on. And that e-bookers actually deal happened because of the circumstances, because they came in and they said that they wanted to set up an India unit. So they were looking for management team, they're looking for domain expertise, and they found that in us.
Ready-made unit.
And ready-made unit, right? So, so few people. So Deep and I were doing, sort of
both
joint
jobs
role for a while. And then I moved on the other side. And we got some money out of it. And Make My Trip just got stock money and cash. It was a cash and stock deal that happened.
It was our IV solution. We were on life support. And so we had that arrangement and that lesson, someone needed to be there. They wanted, Dinesh Tameja wanted both of us there. And I said, that's really hard because Make My Trip's my baby. But Rajesh will run it and I'll also be overseeing and all of that jazz. But that was our arrangement that, we needed, so it was a build, operate, transfer. We got fees, which kept our fires burning. And I think the big lesson there is that you pretty much do anything and everything.
Whatever it
with
takes.
whatever it takes within the realm of obviously, staying honest and staying straight. If you believe in something, you find a way. And that's when I look back and I tell young entrepreneurs even today, just don't give up too early.
What you said, and I want to get both of you to comment on that. You said, sometimes people give up too early, and your advice to entrepreneurs, young entrepreneurs who are watching this program at this point in time is don't give up too early. But what does it take to find that kind of resilience, to build the courage, to have the conviction to say, I'm on life support, but I ain't giving up?
Yeah. I think it's a couple of things, and now I've thought about this a lot because all hindsight is obviously 2020. I think the first is complete conviction in your idea, what you're trying to do, not necessarily how you're trying to do it. You can be flexible on the how because technologies change, things change, but what you're building, what this solution, is it indeed best in class? Best in India today, best in world tomorrow? Is it something where you can take on anyone because you've got, a great product, because your back-end technology is smarter, faster, more efficient, because you found a customer insight which no one else knows. So you have to have conviction in that. If you're iffy about it and you're like, yeah, maybe whatever sort of, then it's not for you. The second ingredient is definitely core team. Whether they're co-founders or their founding team doesn't really matter. These are people who've got to share your vision and your belief and actually add to it. By actually questioning and debating and making that thing sharper and better, saying, okay, listen, this is our proposition, this is what I thought, but I have these 2-3 people around me who are constantly questioning and maybe making that proposition even sharper, but also believe. And the third is, while the numbers will tell you where you're going. So we are definitely creatures of numbers, both Rajesh, me. At the end of the day, in numbers we trust because it'll tell you, where are your conversion metrics going, your whole funnel, is it getting healthier, is it getting better at a micro level? Even incremental changes on a week-by-week basis means you're moving in the right direction. You just have to bridge a gap. And the X factor is, I think that's the gut. That's what an entrepreneur will know. It's your gut instinct. Listen, isme abhi kuch hai. Let's not give up right now. Let's push it a bit more.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be a booming country. A very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in. Trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. It was reborn the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that.
But let's talk about the road ahead as well. I mean, the market has changed. The competitive landscape is different. Technology is completely different. The Indian consumer is far more savvy, does have a little bit more discretionary income, to play with at this point in time. What do the next 25 years look like? When you say the best is yet to come, capture that for me.
Next 25 years for all businesses, including us, and I'll tell you specifically what is happening for travel as well, is going to be driven by these fundamental macro story that India's outlook is, as you can see from all these matrices. Now, so what does it mean for, let's say, travel businesses specifically? And there, what is also happening, and maybe it is thanks to COVID, what happened, because, people saw those difficult times from very, very close, right?
Yeah.
If you really look at any surveys, and by the way, a global phenomenon. So if you ask a question, and we've looked at many of them, if you ask a question, where would you want to spend your, lion's share of your disposable income at your disposal? And the travel is right up there. And then the next one is the entertainment and the experience and so on. The possessions are going down.
Yeah.
The material possessions in terms of all the gadgets and the products are actually going down. So people want to spend more money.
So behavior reset.
The behavior reset is happening, right? So the consumer habit is changing, behavior is, and we see that from our own data for the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before. Right? It's a combination of short-term vacations, and we've seen trends like...
So the YOLO phenomena is here to stay.
And Gen Z, and it's real, and Gen Z.
And renter economy,
and the sharing economy.
Like,
right?
people don't want to really buy. They don't want to own assets. They just want to be light-footed. And this is people like not much younger.
Yeah.
I have a brother who's 40 years old, doing very well, lawyer, his own firm, doesn't own a house, doesn't want to own a house. And he's very clear about it. This is a complete waste.
Absolutely. And the new use cases, the celebration use cases, not only the younger population and people who are going to office, they are not necessarily celebrating everything. I mean, you have to have an excuse to celebrate and get into it.
What's the most unusual celebration case that you've seen?
Well, festival is one of them. Or I actually, just unusual one is just a long weekend and I just want to get into it. There's no occasion, there's no anniversary, there's no birthday. They say get together, have full flexibility of music and late night and party.
I believe they're now breakup and turning single again parties.
Breakup and turning single
again their parties and get-togethers. Like, listen, now guess what? We're all single, we're party. But all kinds of stuff is happening, as we know. Like proposal economy is happening. People now, youngsters are choosing exotic locations to go make a proposal, and they actually travel to that. This is the kids' generation, clearly. I know people who have chosen Morocco recently and went and made a proposal in the Sahara Desert, and these are Indians. So they're traveling all over the world to make proposals. So imagine what will happen when the marriage and everything else goes. I think it's become a celebration also. Everyone's coming to the conclusion, listen, the most valuable thing we have is time. It's the only resource that's finite.
And you can't take it for granted.
And live it up, enjoy if you have everything else, then make those moments count. And create memories. So I think all of that comes together in the travel.
Which is great news for your business.
Great news for us.
Absolutely.
Great news.
Absolutely. And the best part for us has always been at Make My Trip when you see all stakeholders getting benefit of it. Like those are the high points for us. Like when we IPO, the high point was not necessarily achieving that milestone, to be honest, because at the end of the day, it's a project for the organization. It was more that the 80% of the stockholders got benefited out of it, right? Our people.
Employees.
And employees, absolutely. And, and a lot of those actually didn't even believe in that.
What was it, right? 80% of the team had held stock. Like we had made sure they'll get some stock. So it was a big deal for everyone.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and then we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So tucked away in some file
luckily
somewhere.
finance had all records
all the
and everything's
records.
electronic. But people were like that. I remember them coming saying, "Aapne kuch ek wo diya tha letter nahi mil raha." They were scared. It's gone. Said, no, don't worry.
Suddenly it had dollar value, right?
Yeah, absolutely. You're now sitting on a very strong balance sheet. Record profitability at this point in time. What does that do in terms of fueling future aspirations? What does it make you want to do with the money that you're sitting on at this point in time? What does it mean in terms of future diversification, the kinds of businesses that you want to get into, ancillary businesses that you haven't yet explored but may want to consider?
It's a tremendous moat, firstly, and it gives you the firepower as and when required if there's a good acquisition. I don't think there's any kind that we can't really look at, just stock or stock plus, just cash or cash plus stock. But we're still very mindful about that. We still think that there's a lot to be done in travel. While you can say majority of domestic air tickets are now bought online for sure, and also for bus tickets. But the moment you go to hotels, we are still scratching the surface. So it's still in the low double-digit kind of penetration number. There's a long way to go. And the homestays and villas market has opened up, alternate accommodation. We are in that in a big way. We think that's just going to explode with, again, like Rajesh said, more affluence, means second homes, means more travel. So people's secondary homes, very often you're saying, okay, I'm going to use that home for a month in the year or whatever. Rest of the time, do I have an agency which is coming up in the ecosystem who can maintain it for me and who can rent it out and I'll make a return on it so it pays for itself or more. So I think all these opportunities are still coming. We do believe that a lot of work has to be done also in the end-to-end trip planning, which is not just the planning and the booking or when you're in trip. We think now India is becoming the kind of market where people are finally saying, listen, I want to book that thing to do when I'm there. So travel is fundamentally shifted from I want to go here, tick off, to what are we going to do there? So experiences is becoming a big thing. Also, a lot of regional travel and cheap regional. So getting to places, as we know from low-cost carriers and all, even overseas has become cheap. So we have got into GCC in a big way, UAE already, and now bigger in GCC because there's a very natural spillover of our brand there through NRIs, but we're getting into the local Emiratis also, local expats who live there. But in India, I think there's still a lot to be done in travel and related areas. Like Book My Forex was an acquisition, which is an earn-out kind of acquisition for us. Now, that's a very logical place. FinTech for travel is a logical place because, we probably have the most affluent, fertile audience on our platforms, because everyone's looking to buy something which is significant. Very often the average is, 5,000 rupees. That's very different from all the other e-commerce platforms. What can you do about that? What can you do with the customer behavior that you know? A lot of work on the back end on machine learning through data science, obviously now AI. So I think a lot of organic investments. Inorganic, we'll continue to stay selective. We've been doing some big, some small. Corporate travel. It was an area we were not in, and now it's become we're the largest corporate travel company and the largest holiday package company also independently, competing with the offline people. And we think the best is again yet to come. SME or self-service corporate travel.
So I think a lot out there. So transportation is like logical kind of thing.
Yeah.
So we are constantly looking, and I think Rajesh is the right person to talk about this.
Yeah, so so all the new pivots that Deep is talking about, Rajesh, including things like getting into the visa business, for
Yes,
instance.
very much.
Yeah.
And I'll tell you, I mean, ironically, all these investments actually, or most of them happened during COVID.
Yeah.
So we decided to take few bets. I mean, in down cycle, I think our learning also is actually twofold. One,
But
of course,
but that's what I want people to listen to carefully. You're saying at a time when your business was down 95%, where the world was going through a lockdown, you decided this is the opportune moment to actually do something new, to try something different, and go out there and launch something different as well. I mean, what were you thinking?
yeah, I'll tell you what
I think
we
the
were
ad tech
thinking.
is you should
Yeah.
talk about
Tech
that. That was
also
a great one.
No, I actually think, I'll tell you the driving force underneath, what was driving that. So there were two parallel track going. One, of course, we had to just go back to the drawing board and fix the cost, as Deep was alluding earlier. To that, you have to figure out various, fixed costs that existed in the system. So we drove huge amount of automation. We had certainly 1,000 engineers who were available with us because BAU was not happening, right? Hardly any BAU was happening. But then the other parallel track and the driving sort of thought for that was that, now COVID is going to be unpredictable, and we didn't know the time of the COVID. And, we will, as you come out of COVID, and we were sure that we'll come out of COVID because we had some conviction, having dealt with some mini crisis in the past. This, of course, was mother of all the crises. That we will come out of it. There is no question that we will not come out of it. But when we come out of it, we would have lost time. We would have lost time because, one, the COVID time itself will be the lost time. And then to rebuild the whole business to get back to the same level of size and scale will also take some more time.
Yeah.
So then if we have to make it up, because just before COVID, we were just about to become fully profitable, right? So it was a complete setback. Now, when you come out of that, and then if you have to make up on the lost time, you had to look for new avenues.
Yeah.
And that was the sort of driving thought behind. So we started looking at many opportunities at that point, and we had resources at our disposal because,
They were not
like I
doing
said, they
anything
were
at
not
that
doing
point in
anything
time,
else,
yeah.
and we were not by any stretch of imagination to just cut back on them, right?
Yeah.
So we didn't want to rationalize that because, we needed them eventually in any case. So we went back to the drawing board and we looked at corporate business. Was actually one business we had just about started prior to COVID. We accelerated that big time. We built our fintech platform called Trip Money. We built our advertisement platform internally, which is doing about 100 crore of revenue about 100 crore of revenue already. Large part of that is actually going into profits. We launched in GCC market in the middle of COVID. Like we were in UAE because we built all that, the platform that we built was based out of India because all those engineers and the product guys who we had were redeployed there, right? And then we built our My Partner travel agent platform. So we built so many new platforms during that time. Now, all of them, then as we were rebuilding the business, our core B2C business, they started to add new streams of revenue for us, new streams of profitability for us. And then once we were over sort of bringing the old business back on track, this new, streams of revenue or the businesses that we built started to add. Now, therefore, at a scale also we were growing in the mid-20s and we were making profits. So it completely changed the game. So we didn't want to sort of lose on the time that we had lost. I think the number of projects that we ended up doing in those 2 years were probably in the best ever or the maximum ever that we would have
Also
ever
kept
done.
our people busy. Not to forget Arogya Setu. That was
to
done.
forget Arogya Setu.
So that was another very exciting and obviously, not a monetary project. It was really, I think, our give back. But
How did that happen? Because I don't think people know the Make My Trip linked to Arogya Setu, and I mean most people have actually also forgotten about Arogya Setu, which is not necessarily a bad thing because we want to get past COVID but want to learn the lessons from it. But how did Arogya Setu happen?
yeah, it's an amazing story, and I'll give it to you in short. So we had an engineer, senior engineer, Rahul Goyal, who had a brilliant idea, and he said,
COVID had broken out. This was just before Holi of 2020, one day before. I remember that for a reason. And he said, boss, we can build a contact tracing way to figure out how this is spreading. And I said, are you serious? We had a chat. He's saying, yeah. And I said, write me a short note on WhatsApp because I'm going to send it to someone. And that someone was Amitabh Kant, our common friend and obviously an amazing person. And I said, Amitabh, I think we can do this. And it'll be really helpful because things were just about breaking out. And he replied with Happy Holi on the message. And I said, okay. But in a few days, he called me back and he said, can you build that, what you said? I said, yeah, we can. He said, you sure? I said, absolutely. And he said, okay, go ahead, build it. So we started building it like with a small team, Rahul, another very senior guy, Vikalp, both of them, and then a team of engineers out of Bangalore, some guys from here. We started building it. I was program manager talking. And then it suddenly became a way to get approval, obviously. And actually, a national scientific advisor at that point of time was involved. And then they were looking at 2 or 3 such platforms. So a couple of other companies, I think InMobi built something similar at that time and someone else was building. And they did a lot of rigorous testing. This was Mr. Vijay Raghavan. And somebody finally said, okay, these guys, they're doing the right thing. And go ahead and build this. So we were very clear we were going to build it pro bono. This was our give back to the nation. We had almost 20 people working on it and we were having calls every day with PMO, morning, evening, and they were very clear on how to do it. And it scaled up to 50 million users in 2 weeks because obviously government mandate, but it held on, never crashed. It was built so beautifully and well. And we were in the thick of it. I think we ran the project for about 3.5 months, a little over 100 days. And then we realized now, we need our engineers to do other stuff. We didn't want to make money out of it. So we actually handed it to the ministry. And that time it was the Ministry of, I'm forgetting who it was. The secretary was Mr. Ajay Bhushan. I'll come back to me. And then we just kind of, we're still there to help out. But then they took it over. But it was very satisfying. Yeah, it was really, really satisfying. The whole team got felicitated on Zoom. Couldn't meet anyone. But everyone got felicitated. They got
the days of Zoom celebrations and Zoom calls.
But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
Going back to the next 5, 10,
Yeah.
25 years.
Yeah.
So what is the growth aspiration now as far as
Yeah.
the business is concerned? At a group level, where do you believe you would like to see this? What are the bets what are the big, bold bets that you're willing to make at this point in time?
Yeah, sure. So I don't know whether I can talk about the growth rate specifically. Do you know we are a listed company at this point in time and no future guidance,
Ballpark.
etc. But I'll give you directional trend.
Aspirational.
Of course. No, so I'll tell you directionally the way we are thinking about it. I think for the foreseeable future in the internet world, maybe 5 years, maybe 10 years, we think there is an opportunity for MakePoint as a group to grow higher than the industry growth rate. Now, whether it is 1.5x of the industry growth rate or 2x, time will only tell.
Yeah.
But let's say the industry growth rate is X, then we will definitely be higher than that. And that is likely to be across all the businesses, even the matured businesses that we have. The other, places where we see an opportunity where there is under-penetration, where those are younger businesses, relatively low base, the opportunity is higher, and even the growth rate is going to be higher. So I'll give you a few. Like I think Deep was mentioning earlier, overall eco business still is under-penetrated in India, but also the international business.
Yeah.
And I don't think it's going to come at the cost of domestic market, because the size of the domestic market is also really, really high, whether it is international flights or international hotels. Within the overall eco business is also alternative accommodation, because there's so much of new supply coming into the market of the villas, the hostels, the homestays, huge. And that's going to sort of drive the new wave of growth as well. If you look at the corporate business that we got in, really younger business, growing at about 40% year on year, huge market. Well, if you look at the total size of the pie, the corporate business is about 30% of the total pie, and we just have small share of that. So we will continue to keep scaling that business up. Activities and experiences in destination activities and experiences is another new bet that we are taking. We are also looking to bring, by the way, cruises on our platform. So, I think the vision which was always there, that we want to be one-stop shop for all the travel needs. Now, we including all the ancillaries, whatever, whether it is Forex or it is visas or the consumer loan, or, you want curated, holidays, or you want a la carte booking, all modes of transport. We recently invested in intercity cab use case in Savari as well. And we think that on the back of infrastructure improvement that is happening in the country, the road infrastructure particularly, that is going to be another space, because it's really fragmented at this point in time. So if you look at all of this put together, whether it's international or the overall accommodation, alternative accommodation experiences, the holidays business, the corporate business, the plate is frankly full. And then not to forget about, now expanding UAE, GCC sort of business from UAE to KSA as well. And, and by the way, I just wanted to also share, and Les talked about the Redbus business, our overall ground transport business. In fact, the Redbus management team, Prakash, who's the CEO there, is overseeing the overall ground transport business for us. That playbook we have actually taken to the international destinations already, just the bus booking platform. We are already the market leader in Malaysia and Singapore. And we are investing in places like Indonesia and Vietnam, and we are also in Latin America there, right? Believe it or not. So we want to take that playbook. So the international playbook is going to be limited. Let's say Redbus, that international playbook, and the OTA market is going to be regional to start with. And we don't really want to completely change it to become like a global platform. The new thing that we've done, and that is to to cater to the Indian diaspora market globally is to become GDPR compliant. So we are now, accessible at 150 from 150 countries. And now anywhere to anywhere booking can happen. But, the way we are trying to position it to first organically get all the Indian diaspora, which is spread out. Because I think it's a very big opportunity there as well. And we'll get that organically because Make My Trip brand is popular with Indians, right? So when they come here, they're all our customers and we're going to use that. And talking about customers, by the way, the other thing that we should have mentioned perhaps was also, the high point for us is about 80 million customers who've transacted with us, right? A lot
over the course of the year.
Over the course. This is the live to date customers. And every year we will have about 121 million bookings, it's about 20 million customers. Right. So, literally about some 230 bookings a day, about 4,000 people 230 bookings a minute. And about 4,000 people on platform every minute, like all three brands put together. So that's the kind of scale, but it's not all because, if you look at the overall e-commerce category, you have, that's a growing population, about 250 million to 300 million, right? So I think if you try to sort of see big picture with all of this, the outlook looks quite positive.
I want to address the regulation issue, Deep, and through the course of the last 25 years, you've had your run-ins with regulators and with regulation, whether it's the CCI or other agencies. 2016 perhaps was the lowest point as far as dealing with regulation and regulators was concerned for you. As you look at what's happening today, do you believe that there is a need for greater engagement with regulators to really understand the nuances of what it takes to run e-commerce businesses, digital businesses, an understanding of creating regulations that are necessary to put the guardrails in place, but also there isn't a sort of overreach. What's the thinking on that front? And is it difficult today?
I think it's a rhetorical question, absolutely. And we've spoken about it, and we've obviously had our fair share, like almost all companies. And happy to say, service tax case went on for a long time, came out finally, won the case, but takes a lot of energy and takes a lot of time and money and
almost
7 years.
7 years.
7 years and a lot of distraction to the business, and it was actually baseless because I guess the way it's structured, the powers that be who can come and ask you all kinds of questions, whatever they can do, probably don't have that full understanding. So you also answered it in your question. I think a lot more working together, explaining the business model, how these models are working. Are they very different? In some cases, yes, from traditional models to understand, but the fact is that these are contributing a lot to the economy, paying a lot in taxes, giving a lot of employment. So please understand this new sector and let's figure out a smart way. Like you explain what is required and we will explain what the companies are going to do. And then, so at least the way, the overreach is definitely.
But that was a shock
back
to the system, wasn't it? I mean, you actually had a situation where one of your senior employees was put behind bars on account of this.
Yeah, 3 nights. Yeah. It was a low point for sure, but it's happy to say that, came out of it stronger. But this is happening all around. And I think it's just because if there was better understanding, it would be better. Yeah.
And across sectors, not just specific to the travel sector.
Oh, yeah. I think it's more about
I
think it's more about not so much about travel. It's more about the new economy.
Yeah.
How the new economy works. Yeah, I think it's important.
I think it might be, just maybe one of the areas. I mean, there's a lot of engagement. I mean, wearing industry there's a lot of engagement of late is happening. So I don't think to be fair. But maybe there is need not to deviate from the fundamentals of the law as well, right? So let us say whether it is consumers are the same consumers, whether they are
online
e-commerce consumers or offline consumers. Products and services that are being serviced or sold are the same products. They're not very different. The concept of businesses, the monopolies, or whatever, or data privacy, etc., are not very different, right? I mean, at the core of it, whether it is related to privacy or if it is related to any particular law around whether it is direct taxes or indirect taxes, they revolve around products and services, and they're not really different. So if we don't end up looking at e-commerce companies or the industry in silo, But go back to the fundamentals and see if there are any tweaks and amendments that are required, might be the better way to go about it. Rather than just thinking about that there is a whole bunch of legislations or the new rules that have to come in only for the e-commerce companies.
Yeah.
It doesn't make fundamental sense to me. I mean, there will be areas where you would need, because those businesses did not exist, right? You know, whether it's a gaming company or any other companies, right? But guess what? In many ways, the lottery businesses existed in the past, etc.
Yeah.
So some of those principles we should not necessarily deviate from.
Right.
And if we are trying to bring all of that together and then come up with that, then there has to be some amendment, some regulation will have to come in, which is fine, which is totally fine.
Yeah.
The other thing that I think, I mean, since we are talking about it, and the reason why we came out of it winning from that specific case was also, and that I think is the learning and maybe the piece of advice for all the young entrepreneurs as well, is to make sure that you fundamentally focus on building and doing the right thing within the frame of law as well, right? Because the reason why, and we obviously went through a lot of challenges around it on that particular specific case, but the reason why we came out of it winning, because we were doing the right thing at the end of the day. So not cut corners, don't do anything silly.
Yeah.
That's something that you should not necessarily do, even for the gray areas, right? So I think as long as you end up sort of doing your part and then engaging with the regulators and government to create awareness, to Deep's point, because it's a new area, and everybody has to sort of come up to speed with that, and then come out collectively with and not deviating from the fundamental core principles that you have, and taking a silo approach, and we might be able to sort of deal with this better.
I'll end by asking the two of you, what is the secret of an enduring friendship?
Yeah, touch wood is the thing. I think it's trust and transparency. And we said it, I guess we alluded to it up front. So I think transparency is the key, complete honesty, and it is what it is. And I think respect for each other's skills. And so I think if you're open, transparent, you don't keep secrets, and especially at work and even otherwise. I mean, at work, definitely. I mean, you have to be an open book. You have to tell when things are, whatever's going on. And so we are really also, over the years, like you would imagine, become good friends. Families are friends. You know what's happening. Because if there's something going on in your personal life, it's going to impact in your, and it's impossible that things won't happen in your personal life. So I think to be able to share that and to, just depend on each other, to cover in, to check in for each other whenever, and all kinds of stuff. Trust me, a lot has happened in these 25 years. And so he's probably my 911.
He's your wingman?
Yeah, always. Yeah. He's actually my emergency contact besides my brother and a few others. So he's an emergency contact, yeah.
So how often do you lean on Deep for...
Actually, all the time. And I must tell you, all the time, absolutely. And forget the business stuff and the work stuff. That, in any case, we discuss pretty much every day. Maybe off late, little less, not every day. But, but that is all the time. But personal front. I mean, I've told that to Deep many times, that if there is anything to do about family, about personal, he's actually my go-to man besides the family, right? So always for advice.
What's been the best piece of advice he's given you?
Well, it's not one, it's plenty of time, all the time, right?
Become CEO and run the business. Best year ever. Best year ever. So clearly, full time. He didn't want me to go. By the way, another thing probably people don't know, I wanted to do this at 50. I wanted to change gears and, impact and give back and move to the next stage of life. And he just didn't let me. He's the reason. The board I would have convinced. He said, no, one more year, don't. We are doing it fine. That time he was CEO and I was full-time executive chairman and maybe overseeing the other companies. And I said, there's so much overlap, Rajesh. He said, one more year. And that year is when COVID happened. So I wanted to do it when I turned 50. That was in 2019. Before we knew it, that one more year meant COVID. So in a way, glad, because we were both needed. We had hands on the deck, this thing. And then 1 year after COVID, I said, Rajesh, I'm serious, but I'm around. And we would do this religious catch up. We would have this 1 hour long walk and sometimes 2 hour long walk, catch up on everything. So I think if a few days go by and we haven't caught up on, we will. So we'll find a way. And luckily we stay next door. So we spend a lot of time together.
Yeah. No, there was a selfish reason for that. when I would tell him, because from his point of view, his thing was that, listen, I've got few things that I want to focus as well at the end of the day, and besides the overlap and stuff, right? So, which it didn't really bother me a lot, but I think it was just him being around. Right. It was just that.
So I promised him I was still around.
Yes.
not very much there. So it's worked out. Worked out. But I think I have to say, I think now that you showed me the old Young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times.
Absolutely.
So, we recall that, and don't forget when people, help out when in the tough times. So thank you for that.
No, but thank you for being on Young Turks over the course of the last 25 years. And we wish you both more success, not just with work, but outside of that. And Deep, I'm waiting to see what you do at 60, because clearly you've got something big lined up, but we look forward to having that conversation as well. But wish you both the very, very best of luck. And we hope the next 25 years do bring more to come as far as Make My Trip is concerned, and even bigger and better. So thanks very much.
Thank you so much.
Well, with that, it is time for us to wrap up this edition of the Young Turks Reloaded podcast. From all of us here on the team, thanks very much for watching.
India, very, very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left on the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं हैं यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करो
gets operated on, and it's a big thing. I said this would exactly be the way it is. We have $6 or $7 trillion coming into our country, and we've never seen anything like it. The markets are going to boom, the stock is going to boom, the country is going to boom, and the rest of the world wants to see it.
It's the president yesterday.
Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. You know, their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been infused, but deposit rates haven't fallen. Now, the other reason why deposits are staying high is Indians are saving less and less via bank FDs. Instead, they are preferring mutual funds. The mutual funds also keep their money in banks, but in the current account, from which they are frequently withdrawing for transactions. Such current accounts are unstable, so for longer-term loans, banks are forced to raise one-year money at 8% through certificates of deposit, CDs or bulk deposits. The question we are asking today, therefore, is, given the new savings pattern of Indians, is it likely that bank margins will continue to remain under pressure and never return to the pre-2022-23 levels? Will loan growth also be under pressure for want of stable deposits? In short, is the best of margins and loan growth behind us? For all these questions, I'm joined by 3 veterans: Dinesh Kara, former chairman, State Bank of India; S.S. Mundra, former deputy governor and a former chairman of BOB, deputy governor of the Reserve Bank; Srinivasan Varadarajan, chairman of Union Bank and a veteran banker at Axis in his previous avatar. Gentlemen, thank you very much indeed for sparing time for me. I'm deeply grateful. Let me start with someone whom I can call a practicing banker, Srini Varadarajan, who is still the chairman of Union Bank. Srini, what is your sense? Is this shift in savings behavior going to permanently impact banking as a business, as Uday Kotak puts it, that there is a challenge to the business model?
I think you've got to look at it from multiple perspectives. You're looking at the last couple of months, which has been, which everyone knows is the busy season as far as the banking system is concerned. And the maximum growth happens in that quarter. I think looking at it as a signal for what is deposit rates is not necessarily the right indicator. We will see some of the deposit rates coming down this quarter, which is typically a sort of a lean season. So that is one aspect. The other aspect which you touched upon is that whether the peak of bank margins in terms of NIMs is behind us, and is that something which we need to factor in going forward? I would think the market to a large extent is reflecting that, even though every analyst on the street is to some extent overweight banks or recommending banks. I think the banks are struggling to perform over the last couple of years. That, to a large extent, is due because of consolidation of market share amongst few banks. If you look at the last couple of years, incremental market share of 3-4 banks is above 50%. And therefore, every other bank is forced to fight for the remaining piece of the pie. And that, which means that when you're looking at bulk deposits or CD rates, when rates are set at a high level, others typically become price takers. And therefore, costs are not coming down on the deposit side. As you said, CASA and retail term deposits are growing at a steady pace, but nowhere to the pace which credit growth is happening. And therefore, NIMs continue to be under pressure and will continue to be under pressure.
Okay. Well, let me get Mr. Khara in on this. Clearly, he is a price setter. I mean, State Bank is one of the guys who's doing the consolidation. Mr. Khara, we don't see rate cuts even from State Bank. And liquidity aplenty has been given. A CRR cut in December, almost 7 trillion rupees by way of OMOs, swaps, you name it. And now we have ended the quarter with a little bit of a surplus, actually, in the interbank system. What is your sense? Is there a permanent problem? In spite of liquidity, will this deposit cut not be commensurate with the lending rate cut?
Well, I think I tend to agree with what Mr. Srinivasan has just mentioned. There are different segments of the economy, and when it comes to the seasonality of the deposit and the credit of the economy, there are various dimensions. So when it comes to deposit, particularly, when we look at the credit deposit ratio for the system as a whole, which is around 80%. So naturally, when the credit deposit is at 80%, so there are many banks which are clamoring for the deposit. And particularly when it comes to the price setters also, what you mentioned in terms of, banks like State Bank of India, who are witnessing about 12% plus growth in terms of the loan book. And also when it comes to deposit, they have to maintain the pace of the deposit growth. So they cannot be out of the market. And that is the reason why perhaps they have not seen the reduction of interest rate in the deposits.
Okay.
There are, we look at it from the point of view of the structural changes, a couple of structural changes which have happened. We have seen that, for last 10, 12 years, there is significant growth in the mutual fund AUM.
Yes.
It used to be about 12 trillion. Today it stands at about almost about 67 trillion. So that very clearly means that it's one segment of the society who have become saver in this particular situation. They have only seen the upside of the mutual fund. Only for last about 2 months' time, they have started witnessing the reversion to mean.
Yes.
And that is one of the reasons why probably you would have seen that, when it comes to SIP, whether those SIPs have been paused or there have been stoppage of SIPs. So I think this is one phenomenon, what you mentioned, whether deposit will go away and people will go for only for the mutual fund. Perhaps this is one area where now the behavior will undergo a change.
Yes.
This generation of the savers will probably have much more mature outlook. There will be allocation principle which they will be applying. They will be going deposit and as well as for the market instrument, depending upon the risk appetite.
No, that's the point, sir. My father saved only on FDs. Whereas I would assume that, and I am on the threshold of retirement in a few years, I would perhaps be more, different in my asset allocation. So, Mr. Mundra, my more elementary point, I take what Srini and Mr. Khara are saying, seasonal, slack season, busy season, all that is taken. But isn't there a permanent issue that lazy deposits era is over? And therefore, bank margins won't be what they were. Banking business won't be as easy as it was.
Okay. Interesting point, Lata, and both Srini and Mr. Khara has made very relevant point. But let me start with, there had been certain narration, and you have also mentioned recently. Number one is about, looking at that you raise deposit 8%, where the cost ultimately comes near to 9%, and you land at 8.5%.
Yeah.
Similarly, there had been narration that CD ratio is running at 80%. Now, what I would like to argue that these are a very valid point, and they indicate to a long-term trend, but they are not as binary as we can very simplistically look at them.
You're referring to the, I think we should run the Uday Kotak tweet. I think you're referring to that. That 8% cost and 9.5%, 8.5% home loan.
Yes, I am referring to that. The fact remains that while you are raising deposit at 8%, you are also having the CASA, which is maybe 3 to 5 or 7% in saving rate and zero cost at current account. So ultimately, you look at blended cost. Why I'm telling it is not as binary. Similarly, you are talking about that a home loan is given at 8.5%, but at the same time, there are loans which are also earning 11, 12%. So again, you have to talk about the blended yield. The point I am trying to make, Lata, that with all this, even with the trend which is little declining, but if you look at the NIM of Indian banks, they are still very high if you look at globally. So there is a room, and there is a atmosphere is building up where I agree these NIMs have to come down to a level which is more matching with that. So I agree with Srini that couple of months or 3 months did not to be taken as a permanently lasting trend. But my opinion, fact remains, this is a high time for Indian banks that they will have to look at the credit side and move away from this model of, getting into wedlock with an asset. Means you underwrite an asset and then till maturity it remains. It has to be originate and distribute model. And for originate and distribute model, you have to have an efficient market. It was not there at all few years back. Today there are avenues are available. But fact remains that lot more is to be done, and banks have to be prepared for this change where the NIM would be under pressure, NIM would be declining, and they would have to learn to recycle their assets and do the new underwriting.
Okay.
As well as one last thing.
Okay.
One
Sir,
cannot
sir,
only
can I
think
come
of-
to you? Can I come to you in a minute? I'll come to you in a minute. I take your point entirely that one point you make, yes, the era of lazy deposits and therefore high NIMs is under challenge. And secondly, that now banks have to circulate their assets, buy and sell their assets a little more. I'll come to that in a minute, but I want to ask Srini another thing. You know, the constant criticism, I mean, I get even trolled for that ultimately money remains in the banks. And therefore, why are you all cribbing? You tell me why it is not different. That money coming as FDs and money staying in the current account of a mutual fund, why are they fundamentally different?
Clearly, as you initially said, the behavioral analysis indicates that, yeah, the current account deposits are volatile and you cannot rely on them for long-term lending. So the point one needs to understand, and one possibly if the market or the regulator needs to sort of mandate, is that banks need to disclose quarterly average balances of all these deposits, whether it's current accounts, savings accounts, retail term deposits, and bulk and CDs. Because the composition of this is changing. The liability composition is changing. Even though a year-end number looks like X, actually the average balances are not that. And the composition of current and savings accounts in the overall liability profile is coming down. The system is growing credit at a faster pace than the average balances of CASA are growing in the system. Therefore, even though these are low-cost deposits, their share in the overall liability profile is coming down. Therefore, the cost is getting pulled up. So structurally, the NIMs are actually declining, and that is the truth, and that is going to continue. And I agree with Mr. Mundra that, yeah, banks have to be prepared for lower NIMs. I think whether you call it lazy banking, whatever we call it, I think the CASA profile of banks and as a percentage of the overall liability is coming down on an average basis. That has implications for cost of funds, and that has implications for NIMs, and that is not going away.
Okay, I was going to put that last line to vote. Are NIMs structurally headed lower? Srini and Mundra have already said yes. Mr. Khara, where do you stand? Just yes or no. Are NIMs structurally lower?
I would say that if at all you're looking at NIM of 4, then perhaps yes. If at all you're looking at NIM of 3, then perhaps no.
Okay, I will take it as 2.5 out of 3 votes in favor of the idea that margins are going to be a little under pressure compared to the past. We have to take a break, and after that, I want to ask you whether the regulator and the tax authorities need to change some rules. After the break. Welcome back to the Special Indianomics, where we are discussing whether India's banking model has been challenged and is looking like changing and becoming tougher. I've been speaking with Mr. Dinesh Khara, Mr. S.S. Mundra and Srini Varadarajan. Gentlemen, thank you very much for your patience, for staying on. My next question is, what can the regulator or what should the regulator do? Mr. Khara, the EBLR, External Benchmark Lending Rate Rule, the Reserve Bank brought it because banks were not passing on the rate cut even after RBI announced a rate cut. So they said your lending rate, many of them, will be linked to the repo rate or the T-bill rate. But the cost of funds, the deposits are not linked to anything. Do you think EBLR needs to be refined? Do, say, savings deposit be linked also to repo, something like that?
No, actually, there was a situation where there was an effort made by banks to link the deposit rates with the external benchmark. But what we have seen that, the market does not respond to that. And normally it doesn't really work out well. So that is the reason why perhaps, and also we have to acknowledge the fact that when it comes to savers, that community is very broad-based. There are very common men who may not like to have that kind of a risk sitting in their deposit book. So this is I really wonder whether it will be a success or not.
Okay.
But I think what you mentioned, when it was introduced that, you have to link up your loan book to the EBLR, then perhaps, that can be revisited maybe.
Exactly. That was going to be my question. Srini, do you think, therefore, loan book could EBLR be rejigged? Because it seems to impact only one side.
I don't think so. I'm not understanding why that should be the case. I think EBLR is now reasonably well established. Okay. I think it to some extent improves transmission. See, the whole thing on the liability. See, I think the liability side starts first. I think the license to grow for a bank comes from its ability to raise deposits in a sustained, robust manner. And I think that should be the fundamental principle behind growth in any bank. If you try and grow the asset side at a pace which is much faster than what your sustainable deposit growth is, there is always going to be a problem. And therefore, banks have to calibrate their growth on the asset side based on how their deposit profile is growing. Okay. If you try and grow assets and then try and search for deposits, you will end up sort of weakening your liability profile. And that to a large extent is what we are seeing in some of the smaller banks. So the thing is, I don't see any reason to tinker with the EBLR. I think what we need to do is to try and make sure that the liability side growth to a large extent drives the pace of asset growth. And as long as that is there, I think it will work. Okay. By growing the asset side faster is when I think the risk lower NIM sort of increases substantially.
Okay. Well, there are some banks, of course, with very stable deposits, salary accounts like Mr. Kara's bank. And so they can have the ambitions of high growth. But
that's what I said, Lata. Yeah. There are few banks which are on an incremental basis taking away the lion's share of CASA as well as retail term deposits because of their ability in terms of digital engagement and various other things they have in place in terms of customer profile. Okay. With the result that every other bank becomes a price taker and therefore they are in a very difficult situation.
Well, Mr. Mundra, I want to come to you because you brought the very important point that banks have to churn their assets now. You can't give the loan and hold it till maturity. You have to manage the book. Do you think the regulator also has to become a little open to banks depending on wholesale funds and managing the liability part also? The fixation with CD ratio probably, as it is, in the D of the deposits, they are not including NABARD refinancing and, the D is a little underestimated. So do you think separately, the RBI also has to become a little open to people taking bulk deposits and certificates of deposits? Nothing wrong. We have all to become marketized.
Okay. Number one, I think whenever there is a little sign of stress and the narration goes back that then our regulators should do something. Okay. I think all the entities are mature enough. Market processes are well established. To my mind, one, I have already mentioned that you have to manage your credit book more efficiently. You have also to become more efficient in your asset liability management. Okay. Now, if you look at it, I mean to say, you see there is something like behavioral pattern in CASA deposit, which is allowed by the regulator, right, for your ALM plotting. Now, if you look at the behavioral pattern of your CASA deposit, you also look at the behavioral pattern of your wholesale deposit, you reach to a core portion of your deposit, which you can call as a core portion. You put some allowance there also further, little bit as a cushion. That core portion is what you should use for your long-term lending. Match it. And then you have the short-term lending and the consumer loan. And that long-term book also which you create, then you should be able to churn. I think it will be a virtuous cycle. But what I am trying to say, I agree with all the gentlemen, with you, the whole structure, it has to go a structural shift. Now, there has been argument that this preemption should be reduced or other the regulatory cost should be reduced. Okay, fine. To my mind, that is not a lasting solution. That is a band-aid. Okay. Regulator do it today. Within 6 months or a year, everything will be absorbed and you are back to the same place where you are. So I think what we should look at is the more lasting and root cause solution rather than every time clamoring for that, regulator should come with some crutches and provide the help.
Okay, I want to quickly try again.
me also go across to Rajiv Nath, Forum Coordinator at the Association of Indian Medical Device Industry. Mr. Nath, many thanks for joining us. The pharmaceutical sector at this point in time is exempt, so there is a sigh of relief there, but not so for the medtech sector. What will the impact be?
It looks slightly detrimental to us, but I think business people have to look for windows of opportunity, because unlike apparels where you can move things around very rapidly, for quite some time, USA has been looking at diversifying its supply chain of medical devices to address its healthcare security needs, like India has been doing also post-COVID. So I think that is more strategic in mind. So Indian manufacturers have to see product lines where USA is wanting to shift away from Mexico or from China into suppliers like India. And this may be an opportunity for us over here to take forward. So yes, domestic manufacturing.
Well, that's the medium to the long-term consequences. But what about the near term, Mr. Nath? In the near term, with the imposition of this 27% tariff, what will the impact be on medtech manufacturers?
Well, I would say in the short term, where we are competitive and ahead of the competition from other countries, that will be maintained. There should be no immediate short-term concerns over there. The buyers will, of course, have to absorb the higher costs. So it's going to be a pinch for them. For us, tariff is not the main concern. Of a higher concern for medical device industry is the non-tariff market access costs. The cost to get a US FDA approval varies from $10,000 to $500,000, depending upon the risk classification of the product. That is for the private healthcare market. And to access the public healthcare market, that is nearly impossible because of the Buy American policy. And we're not allowed to take part in the bids for the American government purchases over there, because we are not partners to the trade agreements with the USA over there. So it is the non-tariff issues our government basically has to negotiate on our behalf in the bilateral agreements going forward. And we do hope, like they've seen some reprieve for pharmaceuticals, maybe they can consider a reprieve also for medical devices being healthcare products.
Well, reprieve or not, we don't know. But let me ask you very quickly, what is the quantum of exports to the US at this point in time? And do you believe that that is likely to see an impact on account of the imposition?
So currently we are exporting high quality consumables, disposables, and some electronics to the tune of about nearly $500 million over there. And we import from USA nearly $1.5 billion worth of goods. So the imports are double that from USA. So in that respect, yes, this policy is going to give an asymmetrical advantage to the US companies who are accessing the Indian market. Interestingly, the biggest market for Indian medical devices is USA, and also the biggest suppliers to India is USA in medical devices.
Yeah. Yes, and this will, of course, be something that I guess both sides will take up, even as far as the bilateral treaty is concerned. But let me go back across now to bring a view there from the Indian Alcoholic Beverage Association. Joining us now is Anant Iyer. Ms. Iyer, many, many thanks for joining us. We've already seen that cut by India on bourbon whiskey ahead of the Trump tariffs coming in, with the hope that perhaps that would assuage and allay some concerns that the U.S. had. But the tariffs have come in. Nevertheless, take me through the impact that you see.
Yeah, Shriram, thanks a lot for having us on your channel. We are still awaiting some clarity on what will be the exact tariff on spirits as well as wines. Currently, India has only reduced its duty on bourbon to 100%. Our fear is that it's not so much from the US, because the exports from US into India, the imports into India are about $24 to $25 million, which is very small when you compare it to the overall imports of spirits and wines from the other parts of the world, especially the United Kingdom, EU, and other countries. So our fear is that there are other FTAs now in the on the table, and those countries should not use whatever concessions we give to the US as a benchmark for discussions, because that doesn't safeguard the interests of our members and our industry. As you know, our industry is a state subject. We face a whole host of challenges. And the cost of operations that we have in India, right, are at least, at least 50 to 75% more than what it is in any developed country, or even in the middle kind of, developing developed countries, in just plate production costs, input costs, etc. So we have our own challenges, and we have already given, our representations to the concerned ministries, including our nodal ministry, which is the Ministry of Food Processing, and, requesting them that, yes, they should safeguard our interests. And we have ourselves recommended, as an industry, a staggered, reduction of customs duties over a period of 10 years. So it's not that, we haven't done it, but to have a very drastic cut may, set the cat among the pigeons, as it were.
Yes, because there is a negotiation underway with the EU as well. And of course, that is going to be one of the items there, of course, will be wine and spirits will be up for discussion and debate. And your fear is that if India cuts on this, just as we have done as far as bourbon whiskey is concerned, that will open up the room for negotiation there as well. Let me bring in Ashok Chandra, the president of the Indian Electronic and Semiconductor Association, into the conversation. Mr. Chandra, many thanks for joining us. Very quickly, the near-term impact, the short-term impact of the tariff imposition, and of course, eventually the silver lining as well, but the near-term impact.
I don't see any major near-term impact, except for the fact that whatever exports we do to United States, almost like $12 billion of electronics, if there is a short-term demand reduction in US because of the prices going up for the consumers, that's the only impact I would see. But India is well placed as of now compared to the other electronics and semiconductor exporting countries such as China, Vietnam, Taiwan, Thailand, as well as Mexico. So overall, we are, I would call, at a positive edge. And it depends on India now, how do we make use of the opportunity that is available. And I want to add one point over here, that recently one policy was announced on PLI for electronic components. And I call this as one of the winning trio for India now. The PLI for electronic components, there is a PLI running for electronics manufacturing, and there is a Semicon India program. All three put together creates a very good combination of a value addition for electronics manufacturing. And India need to capitalize on these policies and ramp up faster. So short term, no major issue. Long term, yes, maybe United States electronics manufacturing industry would get developed. But still, I would call the demand in US for electronic goods is tremendous. It's quite huge. It's almost like a $500 billion. So we will still have a huge opportunity to grow forward and expand.
Well, that is the hope, that as far as the electronic sector is concerned, this could be a silver lining. This could be an opportunity as we see significant tariffs being imposed on the likes of China, Vietnam, etc. But of course, in the near term, as the gentleman was pointing out, the fear is what will the tariffs do to global demand? What will the tariffs do to global growth? Is the U.S. possibly headed into a recession? That is now an issue up for discussion and debate. Gentlemen, appreciate you joining us here on CNBC-TV18 for the first pulse check of India Inc. on the Trump tariff imposition, what it means for India and its different sectors in the near, medium and long term. We are going to take a break here, but we will continue with Trump Watch and the tariff plan right after this. Stay tuned to CNBC-TV18. Big news breakers coming up.
Hello and welcome to this special edition of Market Editor. The markets may be our starting point today, but we are diving deeper into a space that's buzzing with opportunity. India's emerging dominance in the CRDMO space, we call it CDMO, contract research, development and manufacturing. And to help us decode this theme is none other than seasoned investor and market veteran Madhu Kela.
That's right. Over the next 30 minutes, we'll spend a few minutes on Madhu's current take on the market, but the spotlight is firmly on a sunrise sector where he sees immense long-term potential. We'll also be joined by the managements from Laurus Labs and OneSource Pharma, two companies at the heart of this CRDMO story, with Madhu turning interviewer, asking them the key questions on scale, strategy and science.
Well, from investment insights to industry deep dive, this promises to be a power-packed half hour. Let's dive straight in. Madhu, welcome to the program. Thank you very much.
Thank you so much.
And we can take a back seat today.
No, absolutely. We'll all do it together.
Hum aaram karenge, aap kaam karenge.
We'll all do it together.
But I think you've done so much work on the entire CDMO space. You and your team have really done a fabulous. I mean, we'll try and get at least a fraction of it on the air as we go forward. But since we have you with us, Madhu, I want to start with just a quick view on the markets per se and where we are. We've come a long way from the lows. What is your perspective now?
Prashant, I think from a big picture perspective, we have spoken this many times. I would once again request that people must not extrapolate what has happened post-COVID in terms of return.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top global story we have been tracking all week. US President Donald Trump has opened the floodgates for a tariff war with the imposition of reciprocal tariffs on all nations. As a part of his Liberation Day economic plan, President Trump has levied maximum retaliatory import duty on several nations. China, Vietnam, EU, Japan and India all feature on Trump's extensive list. Trump also said that tariffs for pharma sector are under review and will come in at levels never seen before. From anger and outrage to emergency meetings, Trump's tariffs evoked a slew of reactions across the world. China accused the US of using unilateral bullying practices and imposed 34% tariff on all goods imported from the USA. Canada has already responded to Trump's measures with tariffs of its own. The North American country has imposed duties of 25% on US imports worth $30 billion. Similarly, European Commission President Ursula von der Leyen has warned that the EU was prepared to respond with countermeasures if talks with Washington failed. Let's now talk about India. Trump has imposed 26% retaliatory tariffs on India. He has reiterated that India is a friend of the nation. However, New Delhi has not been treating Washington right. Remember, both the nations have been trying to secure a bilateral trade deal. Sources indicated that the US tariff action may accelerate efforts to conclude the free trade agreement between India and the European Union. We have learned that ministers from both sides will be holding a phone conversation within the next few days. We're now joined by Christine Bliss, President of the Coalition of Service Industries, the organization dedicated to enhancing the global competitiveness of the US service sector. This is an industry body that represents major American companies like MasterCard, Disney, Visa, Amazon, Microsoft, Walmart, Google, and others. Christine, thank you very much for joining us once again on Global Eye. This really hasn't been good news for the American industry, has it?
It is not. We continue, my members continue to face continuing uncertainty as to how all of this will unfold. We were very disappointed we knew it was coming, but we were disappointed with the announcement and the level of tariffs that were imposed, both the across-the-board tariffs and the individual country tariffs. Needless to say, it is causing a considerable amount of business uncertainty in terms of planning, future planning, supply chain disruptions, and simply what this will mean. Will it mean a real attempt to try and force U.S. companies to reshore their operations back into the United States? And how much energy will be spent in actually negotiating trade agreements that would secure the removal of tariff and unfair tariff barriers, which would be a benefit certainly to my members and to U.S. industry.
Right. I'd like to ask you about the impact of the U.S. services sector specifically, what do you foresee?
Well, as I said, the immediate impact, as is the case across the business community, is a great deal of uncertainty. And also the fact that many of our major trading partners and close allies have been hit with tariffs. And also on a business by business basis, we're waiting to see what the individual reactions will be about existing business relationships and operations. But clearly there is going to be an impact on supply chains as long as these tariffs are in place. And then, of course, the retaliatory measures that have been announced by the Canadians and by the Chinese. It's not clear the degree to which they will directly reach services. Some of my services companies are also manufacturers, so they can be impacted by some of the tariffs directly on goods. But to the extent that others, such as the Europeans, who have so far held back and not imposed retaliation, they at least have indicated that they would consider the possibility of imposing tariffs on services. So that's something that we're very concerned about. And also, I think we're looking for immediate declines in level of business, whether it's in the travel and tourism sector, whether it's the increased burdens and costs on distribution services, whether it's the increased burdens and costs on logistics services, will be very immediate. Because one of the things that you didn't mention in your introduction was that the president also ended, with respect to China, the de minimis exception for goods of a small value, and also indicated that over the long term, that exception would be ended for all nations, but that will depend on a determination of when the U.S. and its customs border is able to actually administer something like that. So that's going to be an added burden, especially to small business suppliers. And then finally, what we're looking at is whether it will chill investment into the United States, which is a very important source of employment, and certainly for service suppliers and others.
Okay, let me ask you about your appeal to the Trump administration. And do you even think, Christine, that these tariffs are well thought through?
Well, I do think that there was a considerable amount of thought that was put into it and debate. I think we in business were aware that certainly President Trump has a large group of advisors that were giving him various options to consider. And so, yes, I think they thought about them. I think it's just what they seem to feel was most important in the long run. And from the president's own statements, that seems to be trying to convince U.S. business to reshore onto the United States. It seems to be to also, as he feels, create an unfairness in the balance of tariffs between nations, and also feels the importance about raising revenues. So I think to the degree that those objectives were thought about, yes, they were well thought through.
All right. You know, when it comes to India, India has a lot of services export to the United States. And with the emphasis of the administration on manufacturing in the U.S., reshoring operation, creating jobs in the United States, how do you think the services export from India to the U.S. is going to be impacted?
Well, I think, again, I would turn immediately to the disruption in supply chains. I think if you look, for example, in the semiconductor industry, where India has a very large part to play, whether it's software development, research and development, I think to the degree that there are tariffs put on individual products that are part of that supply chain, price increases and thoughts about whether there has to be any reshifting, rejiggering of those supply chains, there will be an impact directly. I think similarly with respect to logistics, there will also be an impact very directly, particularly over the long term, as the de minimis exception goes away. I think other than that, really the future depends on whether there is a serious engagement and negotiation between the U.S. and India to negotiate a full free trade agreement, which would be what we would favor. That would include the removal of digital and services barriers. And that we would see as ultimately very beneficial. And let me just remark and go back to your previous question briefly, which is to say, well, I said I think yes, the tariffs were thought through in terms of the objectives that I mentioned, which I understand are those of the president's. I think from our perspective, what does seem to be downplayed and ignored are the recessionary impact, the inflationary impact that they're going to have the longer they're in place. And
Right.
that I'm very concerned about.
Okay, my final question to you would be about the progress in India-US trade negotiations. Now, we have been negotiating a trade deal for about a month. Last week was 5-7 days of intense negotiations, probably too early to come to any sort of deal. But what is your assessment as an industry veteran who has been engaged with the government through several advocacy and policy programs? Where do you think the hurdle lies in India and US coming to an agreement? When the president says India has agreed to give far-reaching concessions to the US, but we'll still impose reciprocal tariffs, why is that happening according to you? And what is US looking for at this juncture, which has not been arrived at?
Well, I think a major emphasis has been on tariffs, and probably tariffs in the agricultural area in particular. And I think from our perspective, the negotiations need to broaden into services and digital, because that's where you will see significant progress along with the lowering of the industrial tariffs. Things like data flow restrictions and data localization barriers and non-discriminatory treatment in the tax area and treatment of our electronic service suppliers in terms of their ability to supply their services. And I'm talking about things like credit cards and having access to credit. And so I think that, you ask about major hurdles. I think that getting agreement that it should be a far-reaching agreement is going to be a bit difficult, but one that we think is incredibly important, and really to strengthen geopolitically and commercially the relationship between U.S. and India.
All right, Christine Bliss, thank you so much for joining us with your view, with your reaction to the reciprocal tariffs and the kind of disruption, the chaos it's going to throw in for businesses worldwide. We're going to take a short break here on Global Eye, but coming up on the other side, US President Donald Trump's tariff blitz has rattled stock in commodity markets across the world. We will be joined by Rosenberg Research's Bhavna Chabra on the other side. Stay tuned.
It's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day, and it's going to be a booming country, a very booming country. It's going to be amazing, actually, and we see it because we have trillions of dollars committed to come in. Trillions.
Welcome back. You are watching Global Eye. Trump's tariff blitz has sent equity markets across the world in a tailspin. From US to Europe to Asia, investors are rattled as they try to grasp the magnitude of Trump's tariffs. Wall Street saw its worst day in 5 years on Thursday, a day after Trump's reciprocal tariff announcement. 7 large Nasdaq-listed tech giants, colloquially known as the Magnificent Seven, saw a market cap erosion of over $1 trillion. European markets tumbled on Thursday and Friday. These are fears across the continent that United States tariff strikes could push economies into a recession. The story in Asia has been no different. A report by Rosenberg highlights that Trump's tariff plan is destined to witness some speed bumps going forward. Rising trade tensions will put global supply chains at risk, and Treasury yields were seen declining as investors are seeking safety. How long will the tariffs continue to impact global markets, and will there be any reprieve going forward? To discuss that and more, we are joined by Bhavna Chabra, Senior Market Analyst at Rosenberg Research. Bhavna, thank you very much. Welcome to Global Eye. Now, it had been known for almost a month that these reciprocal tariffs are coming, but perhaps the extent has surprised some nations, including India as well. What do you think will be the impact on U.S. markets? If we start with U.S. markets, what's going to be the impact over the next few weeks? We saw a sharp reaction initially, but how will things pan out?
I think we have to look at it in the context of what the fundamentals of U.S. markets are and what lies ahead. So I'd like to highlight a few things here. When we're talking about trade uncertainty, global supply chains shifting, the first degree impact is trade contraction. When that trade contraction happens, earnings growth estimates they get trimmed down. When that happens, markets are bound to head lower. Then the second thing I want to think about is the multiplier effect. When the US market falls, you have wealth effect playing to consumer spending. The businesses cut hiring, they in fact fire people. Then you have people spending less. So that has a negative multiplier impact on the economy. The third thing I want to talk about here is DOGE-related cuts. So, the U.S. economy had been on this fiscal bump. We had so much spending coming in from the Biden government in terms of IRA, chips, and then before that, COVID-related support. That sort of helped the economy sail through despite one of the worst monetary tightening cycles we had seen since 1980s. So when we are coming off this kind of a situation, all these tailwinds that were there in the economy are sort of fading. And then we have an uncertain road ahead, which means trimming of earnings estimates. On top of that, the valuations, they are off the peak. So let's say I think the S&P 500 is down about 13% from the highs. NASDAQ has corrected by about 17% over there. But the valuations, they are like the S&P 500 12-month forward PE is at 20 times. Like if I were to look at last 20 years average, it's about 16 times. So now think about this. You have earning downgrades coming in, which are expected to happen in next few weeks, next few months. And then you have valuations, which is one standard deviation above the norm, a little less than that one standard deviation mark, but still high. I mean, this sounds unsustainable to us, and that's why we feel that there is more downside to come apart from what we have seen so far. Markets are not yet priced in for a trade war. We had seen trade bumps. This is like an all-out trade war. We saw retaliatory announcements from China this morning. We will see more. Like Europe is considering its response. So, I mean, it's bumpy road ahead, to put it simply.
All right, bumpy road ahead, further downside, and markets had not factored in a trade war to this extent. That's what you're saying. The impact on India, 26% tariff on India. India is not immune, but what would be your view on the Indian markets as of now? How would global investors be watching India amid this global uncertainty?
That's a good question, because India has been one of our most favorable calls over the past few years. Yes, there have been speed bumps in the road here as well. For example, like we saw this correction in the small and mid cap space over here. There are two factors to this. One is the structural growth story of India, and one is the near-term story. So we do believe that there could be challenges in the near term, but markets had corrected even before the correction in the US markets began. So the valuation had come off the overstretched levels. Second thing to consider is, yes, 26% tariffs are high, but there are two factors here. One, India's dependence on goods exports is relatively lower when compared to the other countries we are talking about here, Bangladesh, China, Vietnam, etc. Then second factor over here is, like I was talking about, how the goods dependence is lower. The second factor is India depends on services exports a lot more. And then we had valuations come off the peak. When we're talking about those factors, and then I have to speak about very quickly about how the fiscal drain or strain on India has should sort of be in the backdrop now, because we had seen government spending go down reasonably before the elections. That's sort of stabilizing. The RBI is expected to cut rates, so we look at it more favorably. But having said that, the negative news flow around pharma, etc., could keep it bumpy for some time ahead. But for somebody who can be a long-term investor in India, we advise buying on these dips.
All right, so buying on when it comes to India, but of course the tariffs in the pharma sector could be a big bump, and India is a major pharma exporter there. And Donald Trump has said that no one will be spared. Pharma tariffs are going to come like never before, like nobody imagined. He's even gone on to say that. Now, amid this all-out trade war with all nations, retaliatory tariffs coming in, what are the pockets of opportunity? Manufacturing, the auto sector definitely will be impacted. But who could be the gainers if the investors have to make the most of the current global situation? Which are the pockets of opportunity according to you?
Okay, that's a good question. So let's start with global factors to start with. So starting with the US markets, I think what we expect is there is a flight to safety right now that's happening in the market. We expect that to continue. So we believe that the US treasuries would do well in this time because the yields will fall sharply. For example, the markets were pricing in 3 rate cuts from the Fed over the next 12 months. Now that's up to 5 rate cuts. So we do expect yields fall. There are inflation risks associated with the tariffs, but we believe the growth risk would trump inflation risk because inflation would not be really, really sticky in the near term over here, over the longer run over here. So treasuries is something we like. Gold is something we like. Yes, the gold had like climbed to lifetime highs, and it has sort of come down a little over the last 2 days, but we see secular tailwinds behind gold, and that's why it's one of our favorite calls. It remains one of our favorite calls. When I'm talking about US equities, we are recommending investors to go defensives. We really like utilities. We like, we have recently upgraded consumer staples because of the defensive bent of the sector. We don't like consumer discretionary because of high tariff exposure of the sector. We also think that financials would survive this relatively unscathed in US because they are more domestically oriented. They are not so exposed to tariff. Yes, there are challenges to deal pipeline over there. Yes, there are challenges to asset risk redemptions. But to that tune, we believe it's a good idea to keep it neutral weighted to a mild overweight. Healthcare is an interesting sector in the US where we like service providers over the equipment manufacturers or pharma plays because of the very reason. So these are the things. Now, if I were to talk about India very quickly, since we are more of global macro house, so we look at it more top down. We believe financials would sort of tend to stand out in current situation because, again, in India, it's domestically oriented. So this is how we are looking at it. RBI is set to cut rates. That's good for Indian bonds. So this is how we are looking at asset allocation. Be more risk off right now. Be in more defensive segments of the market till the time this uncertainty settles down, and then investors will have an opportunity to buy assets at better prices. That's how we are looking at the situation.
All right, one final question before we let you off, Bhavna. You know, Donald Trump has said, I never go back on my announcements. So in a way, he's threatening the world that these tariffs are here to stay. Even though with trade deals with some countries, including India, there may be a halt to some of these tariffs, it seems that he would like to continue this harsh trading relationship or make trade, fair trade, a center point in global relations. Having said that, do you expect the uncertainty to settle down in 6 to 8 months and things will be normal after that? Or do you expect this uncertainty to continue for the rest of the Trump administration?
Actually, uncertainty is a hallmark of Trump administration. If we remember, Trump 1.0 was not very different. I think it's a bigger and a more louder what we saw in Trump 1.0. So we do expect the uncertainty to continue. In fact, when we released our outlook earlier this year, this was the central theme, the bog of uncertainty. So we expect it to stay. And I don't think the uncertainty ends there. One of the, few of the campaign promises that President Trump had was he wanted to talk about he wanted to go with deregulation in the financial sector and in healthcare sector and in many other sectors. He spoke about tax cuts, etc., etc. But US is staring at a huge debt figure over there. There's a debt ceiling issue. So there are multiple issues down the line. So even if the trade uncertainty settles for a bit, which we believe he's trying to use as a bargaining chip with some misguided information. For example, the tariff calculation. 26% tariff on India. India has an weighted average tariff on the US in single digits. So do many other countries. A few of them are 0%, like Australia. But Trump's administration still had tariffs on them because this is basically the trade balance with those countries divided by the total trade value. So he's basically punishing companies for having a trade surplus with the US. So his idea is if I eliminate this trade surplus, which he's reading as subsidies, it will all go away. But the problem is it comes with capital, like if I have to balance this equation of current account, if I have a trade surplus, like a trade deficit, I have a capital surplus. If I stop having this trade deficit, this capital will also flow out of the US. So we have to keep all these factors into consideration. So coming back to your question, I'm just listing out the kind of uncertainties we could see in the future. These are a few. So we really don't expect this uncertainty to go anytime soon.
All right. Let's just hope that somewhere Trump understands that his policies are really hitting the US markets and are not good news for the global economy either. Thanks, Bhavna, for joining us. Let's move on and get you more global news. Prime Minister Modi attended the 6th BIMSTEC summit in Bangkok. The summit was aimed at boosting regional cooperation among member states. The key highlight was the adoption of the BIMSTEC Bangkok Vision 2030, which laid out a roadmap for a resilient and open BIMSTEC by the end of the decade. Member states also signed a new maritime transport agreement to boost trade and cargo movement across the region. In light of the devastating earthquake that recently struck Myanmar and Thailand, leaders called for stronger disaster management cooperation. The leaders expressed solidarity with the affected communities. Myanmar's military leader, who has drawn criticism over his regime's human rights violations, also made a rare appearance at the event. Staying with BIMSTEC, Prime Minister Narendra Modi also met Bangladesh's Chief Advisor Mohammad Yunus. External Affairs Minister S. Jaishankar and National Security Advisor Ajit Doval were also present. In their first meeting since the ouster of Prime Minister Sheikh Hasina in August, Prime Minister Modi underlined India's desire to forge a positive, constructive relationship with Bangladesh. The Prime Minister also raised India's concerns on the safety of minorities in Bangladesh. Addressing the media, Foreign Secretary Vikram Misri said that Prime Minister Modi pressed the Bangladeshi leader to conduct a thorough investigation into all cases of atrocities done against Hindus in Bangladesh.
Prime Minister also underlined India's concerns related to the safety and security of minorities in Bangladesh, including Hindus, and expressed his expectation that the government of Bangladesh would ensure their security, including by thoroughly investigating all cases of atrocities committed against them.
And with that, it's a wrap on this edition of Global Eye. Thank you for watching. Stay tuned to CNBC-TV18. News continues on the other side.
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that.
Hello and welcome to India Business Hour. I'm Shriram. The headlines that we're tracking for you this evening. The global trade war escalates. China imposes a 34% tariff on U.S. imports a day after Trump's tariffs. The Chinese government also bars 11 American companies from doing business in its territory or with Chinese companies. Global markets go into a tailspin as new tariffs hit home. China's escalation of the trade war worsens the sell-off. European stocks take a beating. On Wall Street, Dow futures drop 1,500 points in early trade. Bond yields crash across the world as investors fear the tariffs could trigger a recession. Crude oil prices plunge to their lowest levels in 3 years as Brent breaks below $65 per barrel. Commodity prices get battered across the board as recession fears spark concerns of a sharp slowdown in demand. Gold prices fall from their record highs too. Asian markets continue to feel the tariff heat for the second day, and Indian equities not spared. Sensex and Nifty drop over 1% each, while the mid-cap and small-cap indices down over 3%. Metal stocks fall the most. Markets end the week nearly 3% lower. The Indian pharma sector's relief at not being subjected to U.S. tariffs is short-lived. President Trump warns of never-seen-before tariffs in the not-so-distant future. American tariffs give fresh impetus to the India-EU free trade agreement. Sources indicate both India and the EU will accelerate efforts to conclude the agreement by the end of 2025, adding that the EU is keen on an agreement that's fully WTO compliant and not a quick fix. The Company Law Appellate Tribunal dismisses a challenge by Ease My Trip's Nishant Pitti to the liquidation of Go First, upholds the NCLT order, allows Pitti to file a scheme to buy out the grounded airlines' assets. The budget session of Parliament comes to an end. Both houses adjourn sine die after having worked for over 110% of their scheduled time. 5 bills were introduced in the session and 10 bills were passed, including the Waqf Amendment Bill and the Oil Fields Amendment Bill. Lok Sabha has also passed the resolution on imposing President's rule in Manipur. The Supreme Court pulls up the Delhi High Court for ordering the takedown of a Wikipedia page critical of the High Court's decisions in the case between news agency ANI and Wikipedia. Apex Court says the courts cannot be so touchy about criticism. Prime Minister Modi meets Bangladesh's Mohammad Yunus for the first time since Sheikh Hasina resigned and fled the country, urges protection for minorities. Yunus raises Hasina's extradition and the Ganga Water Treaty. Over 100 people killed across Gaza in the last 24 hours after multiple Israeli strikes. Over 30 dead in a school providing shelter to the displaced. More than 1,100 people have died since the ceasefire collapsed. Well, let's go straight to the top story tonight. The global trade war has intensified. China has now imposed an additional 34% tariff on all U.S. products imported into China. These new tariffs will be effective from the 10th of April and are in retaliation to the US President Trump imposing a total tariff rate of 54% on China. Now, China's move came after all Asian markets had closed for the day. China's also added 11 US firms to its list of so-called unreliable entities, effectively barring them from doing business in the country and with Chinese companies. But that's not all. China's also imposed more import controls on rare earth minerals. CNBC's Eunice Yoon joins us with China's retaliation to Trump's tariff measures. Eunice, take us through China's countermeasures.
So far, the Chinese have announced 6 different countermeasures. Some of them are more meaningful than others. So the first one that I think is the most important is that they said they're going to impose a 34% tariff on all U.S. imported products. That's going to be effective as of April 10th. The second one is that they said that they're suspending the imports from 6 U.S. agricultural companies that have to do with sorghum and also chicken and chicken-related parts. There are no names at this point of which ones they're. Oh, wait, I'm just getting one. 2 companies that export poultry products, Mountaire Farms of Delaware and Coastal Processing. The sorghum company is C&D of C&D Incorporated. So this is just coming out right now. The third one is an anti-dumping investigation into CT tubes and medical equipment. And then what's interesting is that they also are going to be tightening export controls for 7 types of rare earths. And it looks as though some of them are quite important in MRI and other medical-related items, such as samarium and gadolinium. In addition to that, there are 2 other measures which look to be more symbolic because the Commerce Ministry is adding 11 U.S. companies to the unreliable entity list and then another 16 U.S. companies on an export control list. But both of them, the list of the companies are generally defense-oriented and with very little business here or have been blacklisted before. So I would have to go through all of the names, but that's generally what we're looking at right now.
Eunice Yoon, many thanks for joining us. Eunice Yoon, they're reporting on the countermeasures taken forward by China in response to the reciprocal tariffs imposed by President Trump. Now, Trump's tariff blitz has rattled stock markets across the world. Wall Street braces for what looks like another day of a meltdown after its steepest single-day decline since March of 2020 yesterday. Even as investors try to grasp the magnitude of Trump's tariff hit, the retaliation from China is adding to the nerves. Dow futures slumped close to 1,600 points, or around 5%. S&P futures and Nasdaq futures fell by 4 and 5% respectively, and tech stocks look set for further cuts. Yesterday, the 7 large Nasdaq-listed tech giants, colloquially called the Magnificent Seven, saw a market cap erosion of over $1 trillion. The yield on the 10-year U.S. Treasury fell below 4% for the first time since last October. Meanwhile, across the Atlantic, European markets continue to tumble. The Stoxx Europe 600, that's a pan-European index, has fallen over 5% in the last 2 days over fears that the U.S. tariff strikes could push European economies into a recession. And the story in Asia, no different, with all benchmark indices in the red. The Japanese Nikkei was the hardest hit, and the man who sent the global markets into a tailspin remains unfazed. President Trump playing down the market fall, saying he expected this. Take a look.
We'd love to get your reaction, sir, to what's going on in the financial markets today.
Well, I mean, it's to be expected where this is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing, plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient who went through an operation on Liberation Day. And it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in. Trillions.
I expect most countries to start to really examine their trade policy towards the United States of America and stop picking on us. Stop saying that we can't sell our corn to India. Stop saying that we can't sell our beef anywhere. Just stop treating us so poorly. If we are the great consumer of the earth, The United States buys everybody's products. We buy everybody's goods. You just have to treat us fairly, and that is the problem.
Howard Lutnick there defending the tariffs. Now, crude oil prices plunging to the lowest levels in 3 years. This is President Trump's new tariffs have triggered fears that global demand for oil will fall. Manisha is standing by with more on what's happening across the commodity markets. Manisha.
Well, it has been a decline across asset classes, but crude oil prices really seem to be taking it quite strongly. After 6% of a cut yesterday, the crude prices have declined nearly 9% in the day today as well. This has been the biggest one-day decline since 1st of August 2022. Also, this is the worst weekly decline that we've seen since October 2023 coming in for the crude oil prices. Well, apart from that, the crude is also headed to the lowest level that we've seen in last 4 years. So that's the kind of almost collapse, as markets are calling it, that we have seen in case of the crude oil prices, where 65 is where we are inching towards for Brent and 60 almost breaking when it comes to the US crude oil prices. Well, there are 3 or 4 factors that have continued to weigh onto the markets. One, it is the spillover effect of the sell-off that we've seen in various other asset classes, and then fears of decline in global economy and crude oil demand from major economies because of the kind of trade tariffs that we seem to be looking at right now. The second point is about OPEC and allies, which have boosted output from the month of May. Well, the street was anticipating an increase in output of around 114 million barrels, 114,000 million barrels. But what we have from OPEC and allies is 411,000 barrels per day. So that clearly seems to be weighing onto the prices, because that much more supplies will come into the market. And then to add to that, the US inventory is also gained by 6 million barrels. Markets were anticipating a decline of 2 million barrels. All of that really adding to the kind of decline that we've seen in case of crude prices. Apart from that, it's not just crude. If you look at the US 10-year yield at 3.89%, that also is the lowest since September 2024. So as I said, decline everywhere, and crude, whether it's bond yields or base metal prices, silver, everything seems to be in a decline.
Manisha, many thanks. That's what's happening as far as the commodity markets are concerned. But let's talk about our market. Stocks stumbling on the Lal Street as the tariff tensions kept investors on the edge across global markets. More than 11 lakh crore rupees in investor wealth being wiped out today, with the Sensex tumbling over 900 points and the Nifty down by about 345 points, a 930-point cut there for the Sensex. The Nifty Bank down by about 100 points and a 1,500-point cut there on the Nifty mid-cap. For the week, we've actually seen the indices lose 3%. Prashant standing by now to wrap up market action for us. Prashant, it's been a difficult week, and with the kind of volatility that we are seeing in the global markets, doesn't look particularly pleasant for the week ahead either.
Well, the full force of what was announced showed up in markets today. Remember, last night was very, very dramatic for US markets. The sharpest fall in the US we've seen since, the depths of the COVID crisis. And the market here paid attention. The Nifty was down 1.5. The Nifty Bank, much better, relative outperformer in a big way. Mid-cap index down sharply, small cap the worst hit. And that's the way it turned out by 3:30. For the week, the Nifty is, by the way, down about 2.6%. This is Friday to Friday with a holiday, that is Monday, a holiday thrown in. Bank Nifty is unchanged, 0. So a big relative outperformer again for the week as well. Mid-cap index down 2, small cap index down about 2.6%. And of course, bulk of this damage came through on the last day today. Now, sectors, the two I want to point out: IT, clear loser, but again, damaged last 2 days, 9% gone. Metals, 7.5% gone, but bulk of the damage came in on Friday and some on Thursday as well. Large caps, and where there was pressure, very few stocks were up. I think I counted 3 names with gains of about 1%. But Tata Steel, Hindalco were the big losers that we had today. There was Vedanta from the metals pack outside the Nifty, which came under pressure. Oil fell sharply. ONGC was a big cut. There were auto names like Tata Motors, which were down sharply. Cipla, L&T were some of the other large caps which came under a fair bit of selling pressure. Now, a repeat somewhat of what we saw with IT yesterday. Coforge down another 8% today. You had Mazgaon Dock, which was about 7.5% lower. There was Bharat Forge, which was down 8%. Motherson was down 7.5%. Nalco was down sharply, 8.5%. Laurus Laboratories, Pharma flip-flop. Yesterday, some were, of course, saying that, well, the exemptions have come. We pointed that out, that it looks temporary and tariffs will come. Trump confirming that it indeed will come. So today, the index lost about 3.5% itself. NMDC was down sharply. PG Electroplast, Oil India, Hindustan Zinc, Aarti Pharma, I could go on. Lots of volume on the downside. By the way, market breadth was 4:1 in favor of declines today. Some names on the upside. There was Kaveri Seeds, which was up 11%. There was something like but actually very little by way of volumes on the upside today. And I think that essentially is also a feature that we are closing this Friday out, this week out as well. I think weekend risk remains high. Those pharma tariffs have been promised. We'll see when that comes our way. And of course, US session with jobs report will also be important to track. Back to you.
Prashant, many thanks for joining us. And as Prashant was pointing out, pharma stocks saw a rapid sell-off after President Trump threatened to impose, and I quote, never-seen-before tariffs. Now, he spoke to the media from Air Force One and hinted at tariff cuts if countries, in his words, make phenomenal offers. Now, this is in contradiction to what White House officials have been saying, that they would not negotiate on tariffs. Meanwhile, the U.S. has revised its tariffs for India from 27% to 26% overnight. According to the new version of the White House document, the same document had mentioned 27% tariffs on India yesterday. The rates were also changed for South Korea, Pakistan, Norway, Thailand, and a few other countries in just the last 24 hours. Here's President Trump on pharma tariffs and the possibility of negotiating a deal with countries that have been slapped with reciprocal tariffs.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
To deals with these countries if they're calling you.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation.
Well, that's President Trump, and the Trump administration's reciprocal tariffs may accelerate FTA talks between India and the European Union. Sources have said the EU is watching for concessions that India may give to the US. Parikshit is standing by with more details. Parikshit, the talks with the EU on a possible FTA have been going on for over a decade now. What are your sources telling you on how the India-US BTA talks could impact the India-EU FTA talks?
We hear from sources who are privy to the negotiations between India and the European Union that the US reciprocal tariffs will indeed have a knock-off effect on India-EU FTA talks. Sources say Commerce Minister Piyush Goyal and his counterpart, EU Trade Commissioner Maros Sefcovic, are going to talk again very soon. This is going to be a phone conversation on the FTAs, of course, but also the global tariff situation. The tariffs imposed by US on both EU and India is likely to accelerate efforts to conclude an FTA by the end of 2025. Sources say India is very keen to have an FTA by the end of this year. We learned that EU companies are very keen on investing in India, but technical barriers are holding them back. The European Union is also following India-US trade talks very closely, especially on agriculture and dairy sectors. Reduction of tariffs on cars and components would be one of the central pillars of the trade talks, just the way it is important for India-US talks as well. The European Union is looking for a fully WTO-compliant FTA with India, not a quick fix, and something that will serve the countries in the long term. Speaking to CNBC-TV18, the EU ambassador to India has said that reciprocal tariffs strengthen the rationale for an India-EU FTA, and it will not define them. He further said that there is determination and high-level political engagement to get an FTA done soon. European Union actually wants to see the fruits of a harvest by the end of the year and more progress by next India-EU summit. The ambassador went on to say, while there is good progress so far, both nations continue discussing elements of a meaningful trade package, and European Union is looking to significantly scale up cooperation with India in clean tech, semiconductors, defense and security.
Parikshit, many thanks. Now, U.S. President Donald Trump has unveiled the new Gold Card visa. In a press conference, Trump said the new card would be available in less than 2 weeks. The card will be worth more than $5 million and will guarantee the buyer permanent residency and citizenship eventually. The card features Trump's image. The Gold Card has been touted as a premium alternative to the traditional green card, which also allows for permanent residency in the U.S. Back home, public insurer LIC has dismissed the United States Trade Representative's claim of preferential treatment by the Indian government. The country's largest life insurer maintained that it is treated like any other insurance company by the government and regulators. LIC's CEO and Managing Director Siddhartha Mohanty said the USTR's views stem from an incomplete understanding of insurance regulations. Laurus Labs will invest 5,000 crore rupees to set up a bulk drug manufacturing facility in Andhra Pradesh. The pharma major said the project will generate direct and indirect employment opportunities for 7,500 people. The land for the proposed plant will be allotted by the state government. Shares of Hindalco dropping in trade. This after the company's board approved a significant fundraise plan and increased its borrowing limit. The company plans to raise up to 65,000 crore rupees for FY26. The board has approved an increase in Hindalco's overall borrowing limit from 1.5 lakh crore rupees to 2.5 lakh crore rupees. Startup founders have stepped up to defend the ecosystem after Commerce Minister Piyush Goyal asked startups to introspect on the sectors that they choose to focus on. Speaking at the Startup Mahakumbh 2025, Goyal had said that Indian startups are focused only on food delivery and hyper-fast logistics, while Chinese startups are involved in deep tech like semiconductors and robotics. Take a look.
We are focused on food delivery apps, turning unemployed youth into cheap labor, so the rich can get their meals without moving out of their house. And against that, what does a Chinese startup do? Work on developing electric mobility, battery technologies. And with that, they're today dominating the electric mobility ecosystem. We are very proud of what India has done. But are we the best in the world as yet? Resources are going only towards hyper-fast logistics. And look at what the other side is doing. Robotics, automation, machine learning, preparing themselves for 3D manufacturing.
Well, that's the Commerce Minister, and here's the startup community reacting to those comments. The co-founder and CEO of Zepto, Adit Palicha, said nearly 1.5 lakh people are earning a livelihood on Zepto within 3 years of its inception. He also cited the company's contribution to taxes and the billions attracted as FDI. Palicha said, and I quote, "If that isn't a miracle in Indian innovation, I honestly don't know what is," end of quote. Meanwhile, Zoho founder Sridhar Vembu, before stating Goyal's comments as a challenge to engineers and technologists, listed down areas where the government lags. Here are some other reactions from the startup community.
10 years back, nobody would have compared us to anything. The fact that you're being compared means that you're the challenger, you're the next in the queue. Many Indian companies are not only making the deep tech, the AI, the semiconductor, and you talk about the investments, you read in the newspaper, listen to your own TV channel. The beauty is that India has vibrant ecosystem. There are different stages, different companies are doing it. The success of let's say the commerce companies or many other services companies acknowledges that customers will also make a viable business model. So India, what it proves is that India is a viable business model. Number two, India has talent and capability to build and expand on new things, and the world is expecting from us.
The minister was right in saying that we don't have large deep tech startup. Look at what China has done. But he forgets to add, China invested $150 billion in AI over the last 5 to 7 years. China has invested $50 to $60 billion in the EV industry over the last 10 years and in battery technology. China has invested huge amounts in robotics and other areas. Funds like LIC and others don't invest. There's a problem in this country. Union government and state government spend 9 lakh crores a year as subsidy for the so-called poor people. Yes, poor people require the subsidy. Nobody's grudging that. How much do they spend on innovation all across India? How much do they spend on startups?
Mohandas Pai there. Up next on India Business Hour, the Supreme Court pulls up the Delhi High Court for ordering the takedown of a Wikipedia page critical of the High Court's decision in the case between news agency ANI and Wikipedia. That and more when we return. And you can also catch all of CNBC TV18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar.